So let's begin. In this session, what we're going to do now is revise the whole chapter on accounts of companies. We will be going in full speed. Try to do not try to do any sort of writing along with me. Instead, try to sit up straight wherever you're sitting and try to recall the provisions with me, say them out loud. Alright, starting with some basic points. We had learned in this chapter that every company, whether you are a one-person company, small company, big company, listed, unlisted, any company, whatever kind of a company you are, you have to prepare totally three things. What are the three things? Number one, the company will have to prepare books of accounts. Number two, the company will have to prepare other relevant books and papers. And number three, financial statements. So point number one, no matter what kind of a company you are, every company will have to prepare totally three things. Every company will have to prepare three things every financial year. What are the three things? Number one, books of accounts. Number two, books and papers. And number three, financial statements. And these three are not one time. They have to be prepared annually every financial year. Then we will have to discuss about each of these in full detail one by one. Let's talk about books of accounts. Entire discussion on books of accounts is given in section number 128. Now, what do you mean by books of accounts? Definition given in 2 clause 13 says that books of accounts includes, it's an extensive definition. It includes what? Records. Records relating to what? Number one, sum of money received and expended. I told you nothing but income and expenditure. Number two, sales and purchase of goods and services. Number three, assets and liabilities. And number four, items of cost. But is items of cost applicable for all companies? No. Items of cost is applicable only for some specified classes of companies mentioned under section 148. So books of accounts, section number 128. What do you mean by books of accounts? Books of accounts includes records. Records relating to what? Relating to sum of money received and expended, nothing but income and expenditure, sales and purchase of goods and services, assets and liabilities, and items of cost prescribed under section 148. Now these books of accounts have to give a true and fair view of the state of affairs of the company and the branch office. True and fair view of the state of affairs of the company and the branch office. Now, true and fair view means what? Number one, that there must not be any material misstatement, and number two, it must truly reflect, honestly it must faithfully represent the financial performance and the financial position of the company. Alright, this itself indicates to us that we will be preparing books of accounts not only for the company but also for the branch office. Then we had learned that these books of accounts have to be kept on accrual basis only. We cannot keep the books of accounts on cash basis. We have to prepare the books of accounts on the basis of double entry system of bookkeeping. We cannot prepare on the basis of single entry system of bookkeeping. Then we had learned that there is no exception. Every company has to follow accrual basis and double entry basis. There are absolutely no exceptions at all. Then we had learned after this about the place of keeping the books of accounts, that where are we going to keep the books of accounts? We said that there are two options. We can either keep them at the registered office of the company, or we can also keep them at any other place where in India. Who will decide? Board of directors. How will they decide? Board resolution. Then after passing a board resolution, they have to inform whom? ROC. Within how many days? 7 days. 7 days from what? 7 days from board resolution. In what form should we inform ROC? We should inform ROC in form number AOC 5. AOC 5 will contain what? The full address of the place where the books of accounts are going to be kept. Once again, the company is going to keep books of accounts and books and papers at the registered office, or the company can also keep at any other place. Not financial statements, guys, only books of accounts and books and papers we're talking about. Company will keep books of accounts and books and papers at the registered office or at any other place. Can that other place be outside India? No, it has to be in India. Who will decide? Board will decide. After board decides, they have to inform whom? They have to inform ROC. In which form number? Form number AOC 5. Within how many days? 7 days. Within 7 days from what? Board resolution. What will AOC 5 contain? The full address of the new place. Okay, then we had learned that with respect to branch office books of accounts will be kept in the branch office only. Whether the branch is in India, whether the branch is outside India, branch office books of accounts will be kept in the branch office only. However, the branch office has to send to the registered office or any other place wherever the books of accounts are kept. To that place, the branch office will have to send PPSR, proper periodical summarized return. Again, proper periodical summarized return. Now this PPSR, there's a special point. What if the branch office happens to be outside India? If the branch office is outside India, then the PPSR has to be submitted quarterly. At quarterly intervals, it has to be sent to the registered office. All right, so this was our discussion with respect to where will you keep the books of accounts. You will keep the books of accounts in either in India, if it's branch office books of accounts, you will keep the books of accounts in the branch office only, but branch office please send to the registered office or any other place wherever the books of accounts of the company are kept. To that place please send proper periodical summarized returns. These proper periodical summarized returns, these will be sent periodically. What will be the period, board will decide, but if the branch is outside India, then the period has to be every quarter. Okay, then the books of accounts and the vouchers, books of accounts and the vouchers have to be preserved for how many years? Have to be preserved for at least 8 financial years. But however, if investigation has been ordered by the central government may ask the company in such cases to preserve the books of accounts for longer than 8 years also. And lastly, we learned who is responsible to ensure all this maintenance happens properly. 4 people are responsible: managing director, whole-time director in charge of finance, CFO, any other person who is made responsible by the board of directors. So these are the 4 people who will ensure the maintenance. Then after this we had learned that if the company wants books of accounts, books and papers and all can be kept in electronic form. But if it is kept in electronic form, there are some points which you have to keep in mind. Number 1, those books of accounts and those books and papers have to be accessible in India at all times. They have to be accessible in India means what? If you want to open the books of accounts, you have it in electronic form. If you want to access the books of accounts, it shouldn't mean you have to go to the US to access. They should be accessible in India and they should be retained completely in the same format in which they were generated, sent or received. They must be complete and unaltered. They must be in legible form. Backup has to be taken earlier. Periodical backup has to be taken now. Daily backup has to be taken. And then we also have to inform ROC about the details of the service provider. And lastly, we have to ensure that the accounting software is such that it maintains audit trail and edit log. What is audit trail? What is edit log? In full detail, I already taught you. Then we had learnt apart from all this that books of accounts inspection directors can do. Directors can be any type of directors. You may be whole-time director, part-time director. You may be an independent director, non-independent director, doesn't matter. Whatever type of a director you are, you can do inspection of books of accounts. Where can you do the inspection of books of accounts? Wherever they are kept. Where will books of accounts be kept? In the registered office or any other place in India. So wherever they are kept, there you can come and you can do inspection. Then we had learnt apart from all this that if the company wants, company can also inspect the books of the subsidiary company. But to inspect the books of the subsidiary company, the company will have to pass a board resolution, authorize one person. That person only will come here and inspect subsidiaries books of accounts. Then we learned directors, you can inspect the books of accounts, but you cannot take copies of the books of accounts. Then we learned, can the AOA take away this right from you? Can AOA say in this company you cannot inspect books of accounts? Can AOA say like that? No, AOA cannot take away this right because this is a statutory right which the Companies Act itself has given to the directors. AOA cannot take away this right. Then we learned, what if the director wants any financial information? Not saying books of accounts, I am saying financial information. What if the director needs some financial information from outside India? Does he have to travel till that place outside India? No. From India itself, he will give a written request saying what details he wants and for which period he wants the details. Company will give him the details within 15 days. And this seeking of financial information, this the director has to do only individually. He cannot do through an agent, he cannot do a representative. So if you remember, we had done a solid interpretation. I had told you that seeking of financial information has to be done individually, but can inspection of books of accounts, can this be done through an agent? The act is silent. So here if they are saying only individually, not through agent, if here also if they wanted to say like that, they would have specified. They did not specify, which means seeking financial information outside India, this director you can do only individually, but inspection you can do through agent also, because the Companies Act does not say that you cannot do through an agent. So yes, we can do through agent also, but the agent should be a person who does not misuse the information, because come on, it is confidential information. So the agent should not misuse the information which he gets from this inspection. Alright, so this was our discussion, and then we also learnt apart from directors, even ROC can inspect, even central government officers, SEBI officers, even they can inspect. But can the members inspect books of accounts? Generally members cannot inspect the books of accounts, but however, if in the AOA, if it is specifically mentioned, then yes, even members can inspect, otherwise generally members cannot inspect. Then we learnt officers and employees of the company should provide at least reasonable assistance to the persons making the inspection. Okay, so this was our entire discussion on books of accounts, guys. I gave you a solid revision. Till here, are you thorough? Yes. So what was my first requirement? Come on, sit up straight. Let's do this once again. First requirement, every company, whether you are a one-person company, small company, big company, public, private, I don't care. Every company, you have to prepare how many things? You have to prepare 3 things. What are the 3 things? Books of accounts, books and papers, and financial statements. You have to prepare these 3 things when every financial year you have to prepare. Now, each of these 3 things, one by one, we are seeing. Our first discussion is fully about books of accounts. Books of accounts information is given where? Section 128. First of all, what do you mean by books of accounts? Books of accounts include records relating to 4 things. Means or includes what? Records. Records relating to what? 4 things. What are the 4 things? Number 1, money received and money expended. Then sales and purchase of goods and services. Then assets and liabilities, and then items of cost. Items of cost under which section? Under section 148. For all companies? No. Only for those companies which are prescribed under section 148. Then books of accounts should give dash and dash view. Books of accounts should give true and fair view. True and fair view of what? State of affairs. Whose state of affairs? Company and branch office. This itself indicates books of accounts you will prepare not only for the company, you will also prepare for the branch office. Then we learned that books of accounts tell me accrual basis or cash basis. Accrual basis only. Double entry or single entry? Double entry only. Any exceptions for this? No exceptions. Every company accrual basis and double entry basis only. Then where are you going to keep the books of accounts? Tell me that whole concept. How many options you have? You have 2 options. Option number 1, you can either keep the books of accounts and all in the registered office itself, or you can keep in any other place. But any other place outside India? No. Any other place in India. Who will decide? Board of directors. How will they decide? By passing a board resolution. Whom should they inform? ROC. In what form? AOC 5. Within how many days? Within 7 days. Within 7 days from what? Within 7 days from your board resolution. And what will this AOC 5 contain mandatorily? The full address of that new place. Okay, then after this discussion we had learnt what about the branch office books of accounts. Branch office books of accounts we will keep in the branch office itself. What if the branch is outside India? Doesn't matter. Branch may be in India, branch may be outside India. Branch office books will be kept in the branch office only. Then we had learnt, but branch office, please send something at least to the registered office. Send what? PPSR. Who will send? Branch office. What will they send? PPSR. What is PPSR? Proper periodical summarized return. Who will send? Branch office. To whom will they send? Wherever the books are kept. Where will the books be kept? Registered office or any other place in India. So simple words, branch office will send PPSR to registered office or any other place in India where the books of the company are kept. Now this PPSR has to be sent periodically. What should be the period? Board will decide. But if the branch is outside India, what should be the period? Quarter, every quarter. Then we had learned that how long the books has to be preserved. First and all, what and all has to be preserved? First of all, what and all has to be preserved? Books of accounts and vouchers. How many years will you preserve? Minimum 8 years you will preserve. But if central government has ordered investigation, then how many years you will preserve? Then for more than 8 years also you will preserve. Who is responsible for this preservation? How many people are responsible? 4 people. Who are these 4 people? Managing director, whole-time director in charge of finance, CFO, any other person who is made responsible by the board of directors. And then after this we had learnt if books of accounts are being preserved in electronic form. First of all, is electronic form even allowed? Yes, can be physical form or electronic form. Then you have special rules. Special rules are relating to what? Electronic form or physical form? Electronic form. What are the special rules? They have to be accessible in India. They have to be retained completely. They have to be complete. They have to be unaltered. They have to be in a legible form. Then backup has to be taken when? Periodically. No, backup has to be taken daily, every day. And then what are the 2 special features features which are mandatory in this software. 2 special features which are mandatory. Number 1, audit trail. Number 2, edit log. Then we had learnt about inspection. Inspection of books of accounts. Who can inspect? Directors. What kind of directors? Any kind of directors. Even part-time directors? Yes. Even non-executive directors? Yes. Even independent directors? Yes. Any kind of director. Then I holding company, you subsidiary company. Can I holding company inspect your books? Can holding company inspect subsidiary company's books? Yes. For that holding company, one board resolution they will pass. They will authorize one person. That person will inspect subsidiaries books of accounts. Then after this we had learnt, can director inspect? Yes. Can he take Xerox copy? Can he take photocopy? No. You can come inspect, go, no taking photocopy. Then we learnt, can AOA say in this company directors cannot inspect? Like that, can AOA say? No. We said it is a statutory right which the Companies Act has given the directors. It cannot be taken away by the AOA. Then we learnt, what if the director is asking for financial information outside India? I am not saying books of accounts outside India. I am saying financial information outside India. What if the director is asking for financial information outside India? Then director, no going outside India. You be in India only first. You submit one request. Oral request, no. Written request you submit. In that request, what to write? How many things to write? 2 things to write. What are the 2 things? Number 1, which period I need the information, and number 2, what information do I need? Then company will give this information within how many days? Within 15 days. This seeking of financial information outside India, director you can do only individually. You cannot do through agent. You cannot do through representative. This seeking plus financial information outside India you can do only on your own. But director is asking, can I do inspection of books of accounts in India through my agent? Companies Act is silent. So the logic is, over here, if they have mentioned that seeking financial information outside India you can't do through an agent, then even for inspection, if you can't do through agent, they would have mentioned, but they did not mention. Conclusion, seeking plus financial information outside India, we can do through agent also. But we can't do through agent, we have to do individually only, we can't do through agent. But inspection of books of accounts in India, this we can do through agent also. Understanding? But the agent should be a person who should ensure confidentiality. Agent should be a person who should not leak out this information outside. Apart from directors, even ROC can inspect, even central government officers, SEBI officers can inspect. But can members inspect? Members can inspect only if it is specifically allowed in AOA. Otherwise, members cannot inspect. Okay. So this was our discussion regarding books of accounts. My first big, huge discussion, section number 128. Till here thorough, everybody? Yes, 2 times I've given you a revision. Now come to the next discussion. Our next discussion is about books and papers, also called as books or papers. Section 2, clause 12. This section gives us a definition of books and papers, also called as books or papers. Now the definition says books and papers will include 7 things. The hint to remember is Dr. DW BVM. This can be maintained either in paper form or it can be maintained in electronic form. Total 7 things. What are the 7 things? D for deeds, R for registers, D for documents, W for writings, B for books of accounts, V for vouchers, M for minutes. Again, D for deeds, R for registers, T for documents, W for writings, B for books of accounts, V for vouchers, and M for minutes. In this discussion, if you recall, we had discussed that books and papers is wider, books of accounts is narrower. Books and papers includes books of accounts, but books of accounts does not include books and papers. These books and papers can be maintained in paper form or in electronic form. Then we had learnt about financial statements. Financial statements covered in section 129. Section 128, books of accounts. 129, financial statements. Definition of financial statements. Financial statements means or includes? Means or includes? Includes. Financial statements includes what? See, are you noticing all the 3 definitions, guys? Whether you see books of accounts definition, whether you see books and paper definition, whether you see financial statements definition, all the 3 are includes. Extensive extensive definition. Okay, so financial statements includes how many things? 5 things. What are the 5 things? Number 1, balance sheet as at the end of the year, profit or loss for the year, cash flow statement for the year, statement of changes in equity if applicable, and explanatory notes. In the financial statements, there will be totally how many things? There will be totally 5 things. What are the 5 things? Come on everybody, once again, one last time. Balance sheet at the end of the year, profit and loss for the year, cash flow for the year, statement of changes in equity if applicable, and explanatory notes. Now this financial statement should be as per Schedule 3 format. Generally we say P&L account, but if it is Section 8 company, we will say income and expenditure account. Then cash flow statement is not required for which company? It is not required, number 1, for 1% company, number 2 for small company, number 3 for dormant company, and number 4 for those private companies which are startups recognized by DIPP and have properly filed financial statements and annual return with ROC. Cash flow statement is not mandatory for 4 companies: 1% company, small company, dormant company, then private company recognized as startup by DIPP and has properly filed financial statements and annual return with ROC. So financial statements includes 5 things as per Schedule 3 format. Then we learned they also have to follow accounting standards. But accounting standards, if they are not following, if financial statements are deviating from accounting standards, then we have to disclose the fact that there is a deviation, then reasons why is there a deviation, and then what is the financial effect of the deviation. 3 things we have to disclose in the financial statements. Then these financial statements have to give a true and fair view. They have to be as per Schedule 3 format. But Schedule 3 format is not applicable for insurance companies, banking companies, electricity companies. Why? Because for these companies and all, there is a different law. Like for insurance companies, you have the Insurance Act. For the banking company, you have the Banking Regulation Act. For electricity company, you have the Electricity Act. And those acts itself are giving you the format of financial statements. Follow that format, not Schedule 3 format. Then we had learned that the company has to lay down the financial statements. Before this, if you recall, in our classroom notes, I had put for you the entire set of steps. Do you recall that? We had put down the steps, the whole life cycle with respect to financial statements. We said first financial statements are prepared, then they are signed, then they are approved. After approving, we send them to the auditor for audit. So now we have audited financial statements. Then we circulate these financial statements to all the shareholders of the company. Then after that, we file, after this at the AGM, they are adopted. So now we have audited and adopted financials, and finally we file these financials with the ROC. So right now what I am talking to you about is the 6th point, adopting the financial statements at the AGM. So at the AGM, the financial statements will be laid down, also called as consideration of financial statements, also called as adoption of financial statements. Alright, then after this we had learned that what if the company has subsidiaries. So if the company has subsidiary or associate, then the company has to prepare consolidated financial statements. So company will anyways be preparing a standalone financial statements. Company will also prepare consolidated financial statements, and company will also prepare form number AOC1. All this who will prepare? The holding company will prepare. Why holding company is preparing all this? Because holding company is having subsidiaries or associates. It will prepare its own standalone financial statements. Everybody put together, it will prepare consolidated financial statements and it will prepare AOC1. What is this AOC1? It is a form containing salient features of the financials of subsidiary and associates. What will the company do with AOC1? It will be attached to the company's standalone financial statements. Then even the CFS, same process has to apply for CFS also. Even CFS has to be approved, even that has to be audited, even that has to be adopted, even that has to be filed with ROC, and we have to follow accounting standards and Schedule 3 format here also. But however, we learned if as per accounting standards, if CFS is not prepared, in that case CFS should ensure at least Schedule 3 format it follows. Then we learned if there is, let us say there are 3 companies, there is A Limited, B Limited and C Limited. A Limited is holding company of B Limited, B Limited is holding company of C Limited, C Limited is holding company of D Limited. Now I am talking about C Limited. C Limited is having a subsidiary company, so it has to prepare CFS. But still C Limited need not prepare CFS if conditions are fulfilled. Condition number 1, it should not be a listed company, also it should not be in the process of getting listed. Number 2, it should itself be a subsidiary of another company. Number 3, it should have informed all its members, hey listen, I am not preparing CFS. Not even one member is objecting to it. And lastly, the ultimate holding company right on top or the intermediary holding company, one of them at least is preparing CFS. If all these conditions are fulfilled, then in that case this company C Limited, even though you are having a subsidiary company, you need not prepare any CFS. Alright everybody, so this was our discussion with respect to financial statements, and then we also learned that if there is any violation of provisions relating to financial statements, then the same 4 people will be punished. But if they are absent, then all the directors will be punished. The punishment will be imprisonment maximum 1 year, fine 50,000 to 5 lakhs or both. Okay, so this was entire discussion of section 129 financial statements, second revision. Listen to me everybody. Books of accounts, you are thorough. Books and papers, you are thorough. Financial statement, second revision, last revision, sit up straight and repeat along with me. Section number 129. What is financial statements? What's the definition? Means or include? Include. All the 3 definitions include. Includes how many things? 5 things. What are the 5 things? Number 1, balance sheet. Balance sheet as at the end of the year. Number 2, profit and loss. Profit and loss for the year. Number 3, cash flow statement for the year. Number 4, statement of changes in equity if applicable. And number 5, explanatory notes. Then we had learned profit and loss generally, but section 8 company we will call it income and expenditure account. Cash flow statement is not required for how many companies? 4 companies. Which companies? Number 1, 1% company. Number 2, small company. Number 3, dormant company. Number 4, private company. All private companies, no. Those private companies which are startups recognized by DIPP and they have properly filed financial statements and annual return with the ROC. Okay, then after this we had learned that the financial statements should be as per Schedule 3 format, but Schedule 3 format is not applicable for how many companies? For 3 companies. Number 1, banking companies. Number 2, insurance companies. And number 3, electricity companies. Then we had learned that if it is a company and if it's preparing financial statements, these financial statements have to give a true and fair view of the state of affairs of the company. And also these financial statements should be as per the accounting standards. But if there is a deviation from the accounting standards, then we have to make 3 disclosures. Disclosure number 1, deviation, the fact that there is a deviation. Number 2, the reasons for the deviation. And number 3, the financial effects of the deviation. 3 things have to be put into the financial statements. You have to disclose in the financial statements. Number 4, we learned the whole process with respect to financial statements. Number 1, financial statements have to be prepared, then they have to be signed, then they have to be approved, then they have to be audited, then we will send them to the members, circulation to the members. Then number 6, they will be adopted at the AGM, and finally they will be filed with the ROC. So every year, every company will have to lay down the financials at the AGM. They have to lay down the financials at the AGM. Alright, this is also called as adoption of financials, also called as consideration of financials. Then we learned if the company has subsidiaries or associates, then the company has to prepare consolidated financial statements. So company will anyways prepare its own standalone financials. Company will also prepare standalone financials. I'll repeat again. Company will anyways prepare standalone financial statements. Company will also have to prepare everybody put together consolidated financial statements, and company will also prepare AOC1. AOC1 will contain salient features of the financials of the subsidiary and associates, and this AOC1 will be attached to the standalone financial statements of the company. Then we had learned all the rules and regulations which are applicable to standalone financials will also apply to consolidated financial statements. Even they have to be as per Schedule 3, even they have to be as per accounting standards. But however, as per accounting standards, if CFS is not required, then CFS should at least comply with Schedule 3. Then we had learned that if you are C Limited, even though you have a subsidiary, no need to prepare CFS if number 1, you should not be listed, also you should not be in the process of getting listed. Then number 2, you should yourself be a subsidiary of another company. Then number 3, you should have informed all your shareholders in writing that you will not prepare CFS. Number 4, your shareholders are not objecting. And number 5, either the intermediary holding company or the ultimate holding company, one of them at least is preparing CFS. Alright everybody, so with this we are done revising 3 things, books of accounts, books and papers and financial statements, and I'm sure if you've listened carefully, if you've learned all this once with this revision, you must be very thorough till here everybody. Coming to the next discussion now, section 129A. Section 129A talks about periodical financial statements. Who has to prepare? Unlisted companies. So does every company have to prepare? No, only those companies which central government requires to prepare. So section 129A gives a power to whom? Central government. What power? That central government, you can ask any unlisted company to prepare periodical financial statements. Even those periodical financial statements have to be approved by the board, even they have to be audited, and even these periodical periodical financial statements have to be filed with ROC within 30 days from the expiry of the period. But till now, has the central government prescribed any unlisted company to prepare these periodical financial statements? No. Keep in mind, it's only for unlisted companies. You know why it is not for listed companies? Because for listed companies, as per SEBI rules and regulations, they are anyways preparing quarterly financial statements. So section 129A is only for the leftover unlisted companies. 129A is giving a power to central government. The central government, you can ask unlisted companies also to prepare periodical financial statements. Even they have to be filed with ROC within 30 days from the end of the period. Then we learnt after this about financial year. Financial year is generally 1st April to 31st March. However, if the company is incorporated in the period Jan-Feb March, then the first financial year will end not on the coming 31st March, it will end on the next 31st March. So because of which the financial year, the first financial year can be more than 12 months long also, but maximum it will be 15 months long only. Then we learned that there are cases where, let us say there is a company in India, there is a company outside India. So this Indian company may be a holding company of this foreign company, or the Indian company may be a subsidiary of the foreign company, or it may be an associate of the foreign company. Now this Indian company is following the financial year April to March. This foreign company is following the financial year, let's say January to December. It will be very difficult to prepare CFS when they are following two different financial years. So in that case, this Indian company can make an application to the central government. The central government, please let me also follow Jan to December, whatever they are following. So if an application is made like this, if central government is satisfied, central government will allow you also to follow a different financial year. Earlier, we had to make the application to NCLT, but as per the amended updated provision, this application has to be made to the central government. Understood everybody? So there's an Indian company and there is a foreign company. Foreign company is following a different financial year, Indian company is following a different financial year. Because of this, preparation of CFS is going to be difficult. So the Indian company can make an application to the central government that please let me also follow a different financial year. Then after this, we had learned that financial statements inspection can be done by the shareholders, where at the registered office, not at any other place in India, only in registered office during business hours. This is financial statements. So books of accounts, can the shareholders inspect? No. But financial statements, yes, the shareholders can inspect. Then we had learned about board report covered under section number 134. So board report has to be prepared by the board of directors on the basis of the standalone financial statements of the company. Here our hint to remember was card, cam, film, DQ. 2 cards, cam, film, DQ. This was a hint to remember the contents of the board report. If you remember, contents of the board report we had learnt in 2 parts. In the first part, we had learnt the contents as per the act. Then we had learnt contents as per the rules. Listen, here only 1 revision, no 2 revisions over here. 1 revision, listen carefully. Board report, section number 134. Board report is prepared on the basis of the standalone financial statements of the company. Contents of the board report, first part as per the act. Card, cam, film, DQ. What does each letter stand for? C. C stands for contracts or arrangements with related parties. We said it is not wrong to enter into contract with related party. What is wrong is not disclosing. So you have to disclose contracts and arrangements with related party. Then A, web address where the annual return has been placed. The website address where the annual return has been uploaded. Then R, how much are we going to transfer to reserves? D, how much dividend are we going to declare? Then another card. So what is the company doing for conservation of energy, technology absorption, foreign exchange, earnings and outflow? Then what is the state of company's affairs? Then R was for risk management policy, D was director's responsibility statement, which we will revise later. Then CAM, another C, CSR. A was formal annual evaluation, but formal annual evaluation is not for all companies, it's only for listed companies and those public companies with paid up share capital at least 25 crores. M is for material changes, any material changes and commitments which are going to affect the financial position of the company. Then after this we have the last 6 points, which is film DQ. F stands for any fraud which has been reported by the auditors. Then I, any declaration which is given by independent directors. L, loans, guarantees and investments. M, board meetings. D is what is the company's policy for directors appointment, and Q is if the auditors have given any qualifications, observations, reservations, remarks, adverse remarks or disclaimer, then the directors have to give their explanations and comments. So card, cam, film, DQ, this was our hint for the contents of the board report. What are these points, guys? C stands for contract or arrangement with the related party. Just tell me the keywords. We have spent good amount of time, one whole class we spent to understand each of these points. Just tell me the keywords now. C for contracts or arrangements with related party, A for annual return, R for reserves, D for dividend. Then C, what was the next C for? Conservation of energy, technology absorption, foreign exchange, earnings and outflow. A, state of company's affairs. R, risk management policy. D, DRS, director's responsibility statement. C, CSR. A, formal annual evaluation. M, material changes. F, fraud. I, independent directors. L, loans, guarantees and investments. M, material, this M is board meetings, number of board meetings in the year. D, company's policy for directors appointment. And Q is, if the auditor has given any qualification, adverse remark and all, then the directors have to give their explanations and comments. Okay, then apart from all these discussions, we had also learned the contents of the board report as per the rules, and then we had learnt about DRS. DRS was extremely important. Here I had told you totally there are 9 points, 4 A's and then FIC CJ, 4 A's and then FIC CJ. What are the 4 A's? First A, whether the directors, it is their responsibility to ensure that the accounts are prepared as per accounting standards. Then B, directors, it is their responsibility to ensure that the accounting policies are selected by them and applied consistently. Remember accounting policies, LIFO or FIFO, SLM or WDV. So all that they have to, who has to select? Directors have to select, and then they have to apply consistently. Then number 3, the third A, whether proper and sufficient care are taken with respect to accounting records. Last A, whether proper and sufficient care is taken with respect to safeguarding assets of the company. Then F, whether proper and sufficient care is taken to prevent and detect frauds in the company. Then I, whether the internal financial controls are adequate and effective. Then C, whether the compliance systems are adequate and effective. Then G, whether the books of accounts are prepared on going concern basis. And J, whether prudent judgments are being made. Wherever provisions and judgments have to be made, the directors have to ensure that the judgments and estimates are prudent, like provision for bad and doubtful debts. It should be a prudent provision. It should be a reasonable provision. So this was a director's responsibility statement. So with respect to the board report, what are the points we've spoken about now? Board report, number 1, we saw the contents of the board report as per the act. Then we saw the contents of the board report as per the rules. Then we saw the director's responsibility statement. Contents as per the act, your hint was card, cam, film, DQ. Then what is director's responsibility statement? Here you had 4 A's and then FIC GJ, 4 A's and then FIC GJ. So what does each A stand for? Tell me one last time director's responsibility statement. The first A, guys, the first A, accounting standards. The books of accounts are prepared as per accounting standards. Next A, accounting policies have been selected and applied consistently. The next A, proper and sufficient care is taken with respect to accounting records. Last A, proper and sufficient care is taken with respect to safeguarding assets. F, proper and sufficient care is taken with respect to preventing and detecting frauds. So these 3 points are proper and sufficient care. Then I, internal financial controls are adequate and effective. Compliance systems are adequate and effective. So these 2 points are adequate and effective. G, going concern basis. J, judgments and provisions are made on prudent basis. Alright, so this was the first part of our board report discussion. Then board report has to be signed by whom? If it's a 1% company, it will be signed by one director. If it is any other company, it will be signed by chairman of the company if he is authorized by the board. If he is not authorized by the board, it will be signed by 2 directors, out of which one of them shall be managing director. Then we learned we also have an abridged board report which is applicable only for 1% company and small company. So in abridged board report we had seen only some of the contents will be there, not all the contents. But remember, abridged board report is only for 1% company and small company. Okay, so this was a board report discussion. Under board report, first of all, we said board report will be prepared by the board of directors on the basis of the standalone financial statements of the company. Then we had learned the contents of the board report as per the act, card, cam, film, DQ, contents as per the rules, and then we learned about director's responsibility statement, 9 points, 4 A's and then FIC GJ. Then we learned who will sign. 1% company, only one director will sign. Other companies, chairman will sign only if he is authorized by the board. If he is not authorized by the board, it will be signed by 2 directors, one of which will be managing director. Then abridged board report is applicable for whom? Only for 1% company, and for small company, only for them abridged board report is applicable. Till here understood everybody? This was section number 134. Then we have section number 133. Section number 133 is a section which talks about accounting standards. So central government has a power to prescribe accounting standards on the basis of the recommendation of ICI. So here we had learned that the companies, there are some companies which will have to follow Ind AS. So for them, companies Ind AS rules 2015 we have, and some companies who have to follow the Indian GAAP, who have to follow Indian accounting standards. For them we have companies accounting standard rule 2021. So accounting standards rule will apply to those companies who have to follow the Indian GAAP, that is accounting standards, the Indian accounting standards, and Ind AS rules will apply to those companies who have to follow Ind AS. The Ind AS and AS, what's the difference? I had told you that Ind AS are in line with IFRS, but accounting standards are generally what we call as Indian GAAP. Okay, then we had learnt about right of members to get copies of financial statements. This was section number 136. So under section 136 we had learnt that the company has to send a copy of the financial statements including CFS, auditor's report, and all documents that have to be attached to the financial statements like board report. All this company has to send to whom? To every member of the company, to debenture holders of the, to debenture trustees of the company, and any other person who is entitled to receive. Basically, whoever has a right to receive the notice of the meeting, all those persons will get the circulation also. So who else has a right to receive notice of the meeting? The auditors of the company, the directors of the company. So all those persons will also get this circulation. Okay. So the circulation of financial statements. Come on, once again, what has to be circulated? The financial statements. Now, what kind of financial statements have to be circulated? See, before circulation, they are already audited. So we will be circulating the audited financial statements only. We can circulate only audited financial statements. So audited financial statements, audited consolidated financial statements, audit report, and all attachments. Attachments will include board report also. So this bulk of documents, these documents have to be circulated to whom? To every member of the company, the debenture trustee of the company, and every person who is entitled to receive the notice of the meeting, like the auditors and the directors of the company. This has to be sent at least 21 days before the meeting. So here I had interconnected this provision with you with the notice provision. I had told you, just like how even notice has to be sent 21 days before the AGM, even this has to be sent 21 days before the AGM. So generally both go together, both go hand in hand. But what if the company was not able to send before 21 days? It's okay, company sent during the 21 days before the meeting, but in that case you need permission of majority of members and who are holding put together 95% of the capital. But I had also told you, generally it is 21 days, but if it is Section 8 company, then 14 days only is required. Okay, and if the company is having a subsidiary, then the company should give separate financial statements of the subsidiary company to all shareholders. No, only to those shareholders who ask for it. Then we had learned, company, if you are a listed company, we will not trouble you. We will not ask you to send this entire set of documents to each and every shareholder. It will be so expensive for you, so time consuming for you, it will be inconvenient for you. So company, no need to send so many documents to each and every shareholder. If you are a listed company, you can simply upload all this. You can simply upload all this on your website. Number one, you can simply put all this on your website. Number two, keep everything at your registered office during 21 days before the meeting. If shareholders want to inspect, let them come and inspect. But company, send something at least to the shareholders. Send form number AOC3. AOC3 will contain salient features of these documents. This has to be sent to whom? To members and to debenture trustees. This we will not send to other persons, to auditors, directors, to them and all, we will not send. So if you are listed company, no need to send the entire bulk to each and every shareholder. Instead, upload everything on the website and also keep everything at the registered office available for inspection during 21 days before the AGM, and send something at least to the members. Send form number AOC3. Looking at form AOC3, if any member asks for full set, give full set to that member. Then on the company's website, we also have to upload the financials of each subsidiary. Now that subsidiary happens to be a foreign subsidiary, and in that particular foreign country, if audit is not mandatory, it's okay, we can upload unaudited financials itself. If the subsidiary happens to be a foreign subsidiary and the financials are in a different language, please don't upload about Chinese language and all, please translate it into English and try to keep the format as close as possible to the Schedule 3 format. Okay, then we learned what's the manner, what's the mode, how will we send these financial statements to the shareholders. I had told you that this is not a mandatory provision. I had told you that companies may, not shall. So it's not a mandatory provision, it's a directory provision. Now this provision is applicable to whom? To listed companies and to those public companies which have a net worth of more than 1 crore and a turnover of more than 10 crores. Listed companies, public companies with net worth more than 1 crore and turnover of more than 10 crore. What is the provision? How are they going to send all these documents to the shareholders? They can send it by electronic mode or by physical mode. Electronic mode is applicable if the shares are being held in demat form, or if the shares are not held in demat form but those shareholders have given a consent that yes, to us also you can send by email. So if you are sending by email, you will send by email, number 1, to those shareholders who are holding shares in demat form, and number 2 to those shareholders who are not holding shares in demat form but they have given their consent to get by email. But we will send to which email ID? Not to the email ID which the shareholders have given to the company, to that email ID which they have registered with the depository. And all other companies will send physical copies. All other companies means, all other cases means those cases where the shares are not in demat form and also the shareholders have not given consent to get an email. All other cases we will send by physical copies only. And wherever we spoke about 21 days, if it's a Section 8 company, we will consider it as 14 days. So this was a discussion on Section 136, right of members to get copies of audited financial statements. See, till now, what are all the points we've learned? We spoke about books of accounts, we spoke about books and papers, we spoke about financial statements. Till here you're thorough. Then we spoke about financial year which is generally April to March, but if the company is incorporated in Jan, Feb, March, then the first financial year will end not on the coming 31st March, instead it will end on the next 31st March, because of which it can be longer than 12 months also, but max to max it will be 15 months only. Then we had learned about board report Section 134. It will be on the basis of standalone financial statements and it will be attached to the standalone financial statements. We said, however, if it's a 1% company or if it's a small company, they'll prepare an abridged board report, a smaller version, a simpler version, a summarized version, only for 1% company and small company. Then we learned Section 136. See, Section 136, I'm giving you your second revision. Listen to me. In Section 136, what are all the documents? Number 1, financial statements plus CFS. Now, what kind of financial statements will they be? Before circulating, we already got them audited. Remember the life cycle of the financial statements? Before circulation, they are already audited. So, we will send audited financial statements plus auditor's report plus all attachments. Attachment will include even board report. So, all this will be sent. To whom will be sent? To members, to debenture trustees and to all other persons who have the right to receive notice of the meeting. Now, all this will be sent when? Before the meeting, leave 21 days. Before 21 days itself, we have to send. What if you are not able to send before 21 days? It's okay, send during the 21 days. In that case, any extra requirement? Yes. You need permission of majority of your members who put together are holding at least 95% of paid up share capital. Then after this, we had learned that if any shareholder is asking for subsidiaries financials, we have to give subsidiaries financials also to those shareholders, but not to all, only to those shareholders who are asking for it. Then we learned, however, company, if you're a listed company, it will not make sense if you're going to print so many documents and send all these documents to each and every shareholder. It will not make sense. So if you're a listed company, do 3 things. Thing number 1, keep everything at your registered office open for inspection during 21 days before the AGM. Number 2, upload everything on your website. And number 3, send something at least to the members. Send form number AOC3, which will contain salient features of all these documents. Looking at AOC3, if any shareholder is asking for full set, to that shareholder alone you give the full set. Then we learned in the website, we also have to upload subsidiaries financials. Now again and again we are talking about subsidiaries financials. See, if the subsidiary happens to be a foreign subsidiary and in that particular foreign country, if audit is not mandatory, it's okay. We can use unaudited financials of the subsidiary. If they are not in English language, they have to be translated into English language, and the format should be as close as possible to the Schedule 3 format. Then we learnt what is the manner of circulation. How is a company going to circulate? This concept is applicable to listed companies and to all those unlisted public companies with net worth more than 1 crore and turnover more than 10 crores. Net worth more than 1 crore and turnover more than 10 crores. The manner is, there are two options. We can either send by email or we can send by physical mode. Now, when can we send by email? We can send to those shareholders who are holding shares in demat form. We can also send by email to those shareholders who are not holding the shares in demat form if they are not holding the shares in demat form, but they have given consent that yes, you can send by email. To those shareholders, we can send by email. In all other cases, we will send by physical mode only. But this provision of the manner of circulation, this provision is not a mandatory provision because it uses the word may. It says company may circulate the financial statements in these modes. So this is not a mandatory provision. This is a directory provision. Okay. This was a discussion regarding circulation of financial statements. This also everybody has understood. I have given you 2 revisions, guys. Yes, then after this, coming to section 137, which talks about filing financial statements with ROC. See, we have to file financial statements with ROC. Alright, now what and all do we have to file? Copy of the financial statements plus consolidated financial statements plus all the documents which are attached to the financial statements, audit report, board report and all, and also financial statements of foreign subsidiaries, not financial statements of Indian subsidiaries, financial statements of foreign subsidiaries. So what do we have to file with ROC? Financial statements plus CFS, then all attachments like audit report, board report and financial statements of foreign subsidiaries. Now these financials have to be audited and they also have to be adopted. Again, try to recall, I just now gave you a revision of the life cycle of financial statements. So before we file, filing with ROC is a last step. Before that, they are already audited, they are already adopted. So we will be filing audited and adopted financials, we will be filing with the ROC. Okay, they have to be filed in form number AOC4 within 30 days from the AGM. But however, the filing has to be in XBRL, Extensible Business Reporting Language. In these 4 cases, what is XBRL, how does XBRL work, all that discussion I have done with you in regular class, not going into that once again. So XBRL is mandatory for 4 companies. Number 1, listed companies and their Indian subsidiaries. Number 2, companies with paid up share capital at least 5 crores. Number 3, companies with turnover at least 100 crores. And lastly, all those companies whose financial statements have to be as per Ind AS. So XBRL is mandatory for these 4 companies, listed companies, their Indian subsidiaries, companies with paid up share capital at least 5 crores, companies with turnover at least 100 crores and companies who have to follow Ind AS. However, these 5 companies, even if they fall under this bucket, still XBRL is not required. XBRL is not allowed for these 5 companies. Which companies? Banking companies, insurance companies, electricity companies, NBFCs and housing finance companies. Why XBRL is not allowed? Because their format of financial statements is different from the format from the Schedule 3 format. XBRL taxonomy is as per Schedule 3 format, but these companies, their format will be different from Schedule 3 format. Therefore, XBRL will not be suitable for them. So these companies, XBRL is not allowed. Which companies? Banking companies, insurance companies, electricity companies, NBFCs and housing finance companies. Then we learned once a company files by XBRL, it has to forever follow XBRL. Then we learned what if the financials are not adopted at the AGM. It's okay. You file unadopted financials itself with ROC. ROC will accept it on provisional basis. Once you have adopted the financials, once again you have to file adopted financials with the ROC. Then we had learned what if AGM itself is not held. If AGM itself is not held, then the financials, the audit report, the board report, all of those documents, the financials of the foreign subsidiaries, all those documents along with fact that we did not hold AGM and reason why we did not hold the AGM, all of this has to be filed with the ROC within 30 days from the last day on which AGM should have been held. Understanding everybody? Yes. And then if it's a 1% company, we don't have any AGM in 1% company, so we can't say 30 days from AGM. So therefore for 1% company, it has to be filed within 180 days from the end of the financial year. This was our entire discussion with respect to filing of financials with ROC. I'll give you a second revision on this now. Section number 137. What has to be filed? Financial statements plus CFS, all attachments like audit report, board report and financials of foreign subsidiary. What kind of financials? They have to be audited and adopted. In what form number? Form number AOC 4. When should you submit? Within 30 days from the AGM. In XBRL form? Yes. Is XBRL for all companies? No. It's only for number 1 listed companies. Then number 2, all companies with paid up share capital at least 5 crores. Then all companies with turnover at least 100 crores. And all companies which have to follow Ind AS. For these companies which fulfill any one out of these criteria, for them only XBRL is mandatory. Is there any company for which XBRL is not allowed? Yes, there are 4 companies. There are 5 companies: banking companies, insurance companies, electricity companies, NBFCs and housing finance companies. Then we had learnt once XBRL is applicable, subsequently every year XBRL only we have to follow, no other option. Then we learnt what if AGM is held but in the AGM financials are not adopted. It's okay, in that case file adopted financials itself with ROC. If financials are not adopted, it's okay, you file unadopted financials itself with ROC. Within 30 days of the AGM, you file unadopted financials itself with ROC. ROC will accept them on provisional basis. Later, once you have adopted the financials, once again you file the adopted financials with ROC. Then we learned what if AGM itself is not held. Then in that case, all the documents along with reasons why we did not hold the AGM, we have to file with ROC within 30 days from the last day by which AGM should have been held. Alright, so this was a discussion with respect to section number 137, filing of financials with ROC. Here we learnt generally it has to be filed within 30 days from AGM, but if it's a 1% company, no AGM. So in 1% company, 30 days from AGM time limit will not apply. So for them the time limit is within 180 days from the end of the financial year. Okay, then we learnt who has to approve and sign the financial statements. We said it has to be approved by the board of directors and the board cannot delegate this to any committee. Then who has to sign the financial statements? We have 2 options. Option number 1, the chairperson will sign if he is authorized by the board of directors. Then CEO will sign, CFO and company secretary will sign. Then we learned if the chairperson is not authorized by the board of directors, 2 directors will sign, one of whom will be managing director. Then CEO, CFO and CS will sign. So CEO, CFO, CS, they will sign in every case. In addition to them, either the company's chairperson will sign or 2 directors will sign, one of whom is managing director. So 2 options. Option 1, company's chairperson if he is authorized by the board of directors, CFO, CS and CEO. Again. Option number 1, company's chairperson will sign if he is authorized by board of directors. Then CEO, CFO and CS. Option number 2, 2 directors will sign, one of whom is managing director, CEO, CFO and CS. So in both the options, CEO, CFO and CS will sign. Apart from them, in first option, chairperson if he is authorized by board of directors. Second option, 2 directors, one of whom is managing director. But if it's a 1% company, one single director only will sign. Alright, now taking you forward to the next part. But before I go to the next part, if you recall, board report who will sign? In board report signing, this part alone we had seen. For board report, either the chairperson will sign if he is authorized by the board. If he is not authorized by the board, 2 directors will sign, one of whom is managing director. In board report, we did not have all this. Okay, but in financial statements, this is signing of financial statements. Here CEO, CFO, CS will anyway sign. In addition to this, out of these 2, anyone, either company's chairperson or 2 directors, one of whom is managing director. Alright, then we had learnt about section 130. Section 130 which talks about reopening of books of accounts. Now is it voluntary reopening? No. Here we are not reopening the books of accounts because we want to reopen. No. Why are we reopening the books of accounts over here? Because central government, SEBI, income tax department, regulatory body, some concerned person, somebody has made an application to court or tribunal and court or tribunal is convinced that in the past year accounts were prepared in a fraudulent manner or there was mismanagement in the company because of which the financial statements cannot be relied on. So in this section 130, company is asked to reopen the books of accounts. It is not voluntary revision. Company is not voluntarily reopening over here. These 5 people, central government, SEBI, income tax department, regulatory body, concerned person, they are filing an application to court or tribunal. Once they file an application to court or tribunal, the court or tribunal will give a notice to the the same 5 people and will ask for representations. The court or the tribunal will consider the representations, and if the court or the tribunal is convinced that yes, the accounts were prepared in a fraudulent manner or there was mismanagement, if they are convinced, then they will ask the company to reopen the books of accounts and recast the financial statements. What's the language? The language is reopen the books of accounts and recast the financial statements. Please remember, this will be announced, this will be ordered only for the last 8 years, because in the current year company will be preserving last 8 years books only, no. But if central government has ordered investigation, in those cases company will be preserving books for earlier than 8 years also. So in that case, yes, the court or the NCLT can ask the company to reopen earlier than 8 years books also, but otherwise generally they can ask the company to reopen only last 8 years books. Like if I am right now in year 9, they can ask us to reopen only last 8 years books only in the current year. Alright, so this was section 130, reopening the books of accounts and recasting the financial statements. Please remember, this is not voluntary. We have 5 people over here. They are making an application to court or NCLT. Because of that application, NCLT is giving notice to the remaining 4 people and they are going to send their representations to NCLT. If NCLT is convinced that yes, there was fraud or there was mismanagement because of which the books of accounts and the financials cannot be relied upon, only then they will order the company to reopen the books of accounts, and if this reopening order is passed, then we can ask the company to reopen only last 8 years books of accounts. Then there is voluntary revision, wherein I am talking to you about section 131. Voluntary revision. In voluntary revision, we are talking about voluntary revision of financial statements and board report. Here the company is voluntarily wanting to revise. Nobody is forcing the company. Company voluntarily wants to revise. Here if you remember, we had seen the case of OMA Private Limited. Yes, section 130, I had given you the whole case study of IL&FS. In section 130, IL&FS case study I gave you because it was the first time in our country that this section was even applied in IL&FS case. Then in this section 131, I had given you the OMA Private Limited case. So in section 131, the company itself wants to voluntarily revise its financial statements. It wants to voluntarily revise its board report. To do this revision, first of all, they have to pass a board resolution. Once they pass a board resolution, from the date of the board resolution, within 14 days itself, they have to file an application to NCLT requesting NCLT, please give us permission, we want to revise the financial statements, we want to revise the board report. So they have to make an application to NCLT in form number NCLT1 within 14 days of passing the board resolution. Now once they make this and by the way, in this application what and all will they write, which year they want to revise, which years they can revise. By the way, they can revise only last 3 years, they can revise. So in the application they will mention which year's financials they want to revise, the name and contact details of the MD, CFO, directors, CS, officer of the company who is responsible for making and maintaining the books, the auditor, the former auditor, all of their name and contact details. Then in the application they will also put a copy of the board resolution which they just now passed. Then what are the reasons, why exactly do they want to revise, and recently if there has been a change of majority of directors or auditors, even this information has to be put in the application. For all this logic I had given you all in the regular class itself. So I am telling you now that under section 131 the company wants to voluntarily revise financial statements and board report. So to do this revision, company will be number 1 passing a board resolution. Number 2, once a board resolution is passed, within 14 days they will make an application to NCLT. Okay, once they make an application to NCLT, NCLT will give a notice to 2 people. NCLT will give a notice to central government and income tax department and will ask them for their representations. Whatever representations they give, NCLT will consider. Then number 4, NCLT will announce one hearing date. Before the hearing date, company should leave 14 days. Before hearing date, leave 14 days. Before 14 days itself, company has to give advertisement of the application. So whatever is the hearing date, before that leave 14 days. Before 14 days itself, company has to give advertisement of the application. Then after this we learned NCLT will pass an order allowing the company, okay company you can revise. Once NCLT passes an order, within 30 days copy of that order has to be filed with ROC. Now company has to call one shareholder meeting, company has to revise the financial statements, call shareholders meeting. In the shareholders meeting we have to show them the revised financial statements, because even the revised financial statements have to be adopted by the shareholders. Then once again the revised financial statements we have to file with ROC within the next 30 days. And in current year board report we have to put reasons that why exactly did we do this revision. Getting it? So this was section number 131, voluntary revision. We have to pass a board resolution. Then once a board resolution is passed, within 14 days the company will make an application to NCLT in form number NCLT1. Then NCLT will give a notice about this application to central government and income tax department. NCLT will consider the representations and announce a hearing date. Before hearing date, leave 14 days. Before 14 days itself, the company has to give an advertisement of the application. Then NCLT will pass an order allowing the company, okay you can revise. Once the order is passed, a copy of that order has to be filed with ROC within 30 days of receipt of the order. Then company will revise the financial statements. Then revised financial statements company will show to the shareholders for adoption in the general meeting, and then the revised financial statements have to be filed with ROC. Please remember, under section 130, not voluntary revision, section 130, under section 130 the NCLT can ask us to reopen last 8 years books of accounts also, but under section 131 we can ask for voluntary revision only of the last 3 years financial statements and board report. Okay, then after this we had learnt about NAFRA. We said NAFRA was formed by the central government. Earlier it was called National Advisory Committee on Accounting Standards. Head office is in New Delhi, but meetings can be anywhere in India. In NAFRA, number 1 we will have the chairperson, and we'll have other members, maximum 15 members, some part-time members, some full-time members. Try to recall, I had shown you the NAFRA website, I had shown you who exactly are the members, all the discussion we had. So we'll have the chairperson who is an expert member and expert who has expert knowledge in accounts, audit, finance, law, and other members maximum 15, some part-time, some full-time. Apart from this, secretary and other employees on need basis central government will keep appointing. Then we had learned that the chairperson and the members of NAFRA, they have to give a declaration that they are independent, that there is no conflict of interest, and they should not be connected with any audit firm for during appointment and 2 years after that. Then we learned within NAFRA there will be many divisions. Each function will be given to one division, and this division will be presided over by the chairperson or any other full-time member who will be authorized by the chairperson. Then the chairperson and all the full-time members, they will become the executive body. This executive body only will discharge NAFRA's functions. Then we had learnt about the functions and the duties of NAFRA. Number 1, we said that they will protect the public interest, the interest of the investors, by ensuring that accounting is happening properly and auditing is happening properly. Then we said that they will maintain details of auditors. But if you remember, I had also told you that NAFRA will not look at the auditing and accounting function of each and every company. I had given you one huge flow chart that only if the company falls under this flow chart, only on these companies NAFRA has jurisdiction. So these companies is accounting happening properly, these companies is auditing happening properly, that only NAFRA will be bothered about. Then ICI will give recommendations of accounting standards and auditing standards to NAFRA. If NAFRA is satisfied, NAFRA will pass it on to central government. Then NAFRA will monitor and enforce compliance of accounting standards. They will check whether company is following accounting standards or not. They can ask for information and explanation to check whether accounting standards are being followed or not. NAFRA can also publish its findings on its website, and if NAFRA thinks that accounting standards have not been complied with, then NAFRA can decide what should be the further course of investigation. Similarly, NAFRA can monitor and enforce compliance of auditing standards. So here NAFRA will check the work papers of the auditors. NAFRA will check whether auditors are ensuring that there is sufficient and appropriate audit evidence. They will check whether the quality control system is adequate or not. Then they will also they can also question the auditors, ask for information from auditors. If they find any non-compliance, they can publish their findings on the website. But if they find any confidential information, they should not put the confidential information on the website. Instead, they should directly send it to the central government in the form of a separate report. Then we learned NAFRA will also oversee the quality of service of professionals and will suggest improvements. NAFRA will check your audit quality, NAFRA will ask you to improve, NAFRA will suggest improvements, NAFRA will monitor whether you are actually improving or not. If NAFRA is of the view that you are still not improving, then NAFRA will refer your case to QRB. Remember QRB, Quality Review Board of ICI. Then we said NAFRA will also promote awareness of compliance with accounting and auditing standards, and they will cooperate with national and international organizations. If NAFRA concludes that there is professional or other misconduct, then NAFRA will punish. The punishment for individuals will be minimum 1 lakh, maximum 5 times the fees. For firms, minimum 5 lakhs, maximum 10 times the fees. Also, you will be debarred. You can't be auditor, internal auditor, or do valuation work for any company for minimum 6 months, maximum 10 years. And lastly, we learned NAFRA will have all the powers of civil court. So with respect to NAFRA, not spending too much time on the revision because we had spent a very good amount of time in the regular class itself. So listen, we're going to be revising CSR now. CSR and internal audit, only 2 concepts left. Don't lose your patience. Listen to me. CSR under section 135. So first of all, what exactly is CSR? It is activities which the company is doing because of a statutory obligation which is put on the company by section 135. But there are some activities which will not be considered as CSR. If the company does any activity in the ordinary course of business, or if the company makes a contribution to political party, it will not be considered as CSR. Because of the activity, if only the employees or their family members are getting benefited, even that will not be considered as CSR. If the company does any activity outside India, even that will not be considered as CSR. But here we had an exception. If company is undertaking sports training of Indian sports personnel, national or international level, even if the sport training is happening outside India, it will still be considered as CSR. Then after this, we had learned that if the company is doing any activity on sponsorship basis and is enjoying marketing benefit, even that will not be considered as CSR. And if the company does any activity because of a statutory obligation put by any other law, like for example, Income Tax Act is asking the company to pay tax. The Environment Protection Act is asking the company to not spoil the environment. So whatever the company does because of an obligation put by any other statute, that will not be considered as CSR. Then we learned CSR committee. CSR committee, is it required for every company? No, only those companies which have net worth at least 500 crores, turnover at least 1000 crores, or net profit at least 5 crore. 3 criteria. Out of the 3 criteria, any one criteria is fulfilled, that company will require a CSR committee. But the same concept is applicable for CSR obligation also. You remember I had shown you the BEAR Act. We had interconnected subsection 4.5 with subsection 1, and we had concluded that the same criteria is not only for CSR committee, also for CSR obligation. So the conclusion is CSR committee is not for every company. It's only for those companies which fulfill any one out of these criteria. The whole CSR obligation is also not for every company. It's only for those companies which fulfill any one out of these 3 criteria. Then we learned after this that the net worth is nothing but paid up share capital plus free reserves plus securities premium minus accumulated losses minus deferred expenses minus miscellaneous expenses not written off. Net profit is always before tax. Why? Because we want more expenditure on CSR. So net profit before tax is higher, net profit after tax is lesser. So CSR is always a percentage of net profit before tax, because only then the CSR expenditure will be higher. But in net profit, we should not consider profits of foreign branches. We should not consider dividend income from those Indian companies which have already complied with CSR. We had discussed the example with respect to dividend over here. If I am, let's say, a company, and let's say you are another company, you are properly doing CSR, I am a shareholder in your company. Now you will give me dividend income. This dividend income will form a part of my profits. So on that dividend income, again CSR is not required. So from my profits, I will subtract dividend income which I have received from another Indian company which is properly following CSR. I'll repeat again. From my profits, I will remove dividend income that I have received from those Indian companies which have properly followed CSR. I will remove only the balance profit only I will take. So from my profit number, two things will be removed: profit from overseas branches and dividend income from those Indian companies which have properly followed CSR. Then after this, we had learned that CSR obligation is applicable for which companies? Does every company have to spend money on CSR? No. We had read the BEAR Act and we had concluded, we had interpreted that CSR obligation is applicable only for those companies which require CSR committee. That is the same three criteria. Out of the three criteria, if any one criteria is fulfilled, that company will require CSR committee, that company will have to spend money on CSR. So if the company's net worth is at least 500 crore or turnover is at least 1000 crores or net profit is at least 5 crores, only those companies require CSR committee, only those companies will have to spend money on CSR. Now how much has to be spent? The board shall ensure. We had seen the significance of the word shall ensure. We said that the board shall ensure that minimum 2% is spent on CSR. We said it is not necessary that the board has to spend now itself. No, either spend now itself or ensure it is spent on CSR. Then apart from this, we had learnt that in case the company, all these are concept tests, and then after this we had learnt how much company has to spend on CSR. Minimum 2%. 2% of what? 2% of the average net profits of 3 preceding financial years. Company has to spend how much? Company has to spend minimum 2% of the average net profit of 3 preceding financial years. But if the company has been in existence for less than 3 years, then how many ever years company has been in existence, that many years average only you will take. But if it is the first year of my company's incorporation, first year CSR is not applicable. Okay, then we learned what if the company spends less than 2%. Then what is the reason? Company, why you spent less than 2%? It has to be disclosed in the board report. Then we will check, is it because of an ongoing project? If it is because of an ongoing project, then from the end of the year, within 30 days, company has to set aside that money in a separate bank account in a scheduled bank called the unspent CSR account. And once that money is transferred into unspent CSR account, within 3 years, it has to be utilized for CSR. Even after 3 years, if money is still lying over there, then within the next 30 days, company has to transfer the balance amount which is still lying over there into Schedule 7 fund. Understanding? But what if the reason is not ongoing project? If the reason is not ongoing project, then from the end of the year, within 6 months, whatever is a shortfall, it has to be transferred into Schedule 7 fund. Alright, so till here I'll give you a summary once. Till here whatever we've learned. Number one, we learned that CSR is something which the company does because of a statutory obligation put on the company because of section 135. Then we learned that there are some 6 transactions which are not considered as CSR. Like if the company does something in the ordinary course of business, if the company contributes to political party, if the company gets marketing benefits, if the company does activity outside India, or if the company does something just for the benefit of employees or their family members, or if the company is doing something because of a statutory obligation put by any other law, all of this is not considered as CSR. And then after this, we had learned that company which is spending money on CSR, those companies require CSR committee. But CSR committee is not required for every company. Only those companies which have net worth at least 500 crores, turnover at least 1000 crores or net profit at least 5 crores. 3 criteria. Any one criteria fulfilled, those companies only have to spend money on, those companies only require CSR committee. Then we had learned that every company does not have to spend money on CSR. 3 criteria, same 3 criteria only. Those companies which fulfill any one out of these 3 criteria, they shall either spend or they shall ensure that that money is spent on CSR. How much has to be spent on CSR? Minimum 2% of average net profit of 3 preceding financial years has to be spent on CSR. But if the company is in existence for less than 3 years, then how many ever years company is in existence, that much has to be, that many years average you will take. But if it's a first year CSR will not apply. Then we learned what if the company spends less than 2%. In that case, what is the reason why the company spent less than 2%? It has to be disclosed in the board report. Then we will see what is the reason. Is it because of an ongoing project or is it any other reason? If it is because of ongoing project, then from the end of the year, within 30 days, the company shall transfer the shortfall into unspent CSR account. Once money is transferred into unspent CSR account, within 3 years that money will be utilized for CSR, and from the expiry of after the expiry of 3 years, if money is still there in that account within the next 30 days, it will be transferred to Schedule 7 fund. But if the reason is not ongoing project, then in that case it has to be utilized, it has to be spent within the next 6 months. From the end of the year, within the next 6 months, it has to be transferred into Schedule 7 fund. What has to be transferred? The shortfall has to be transferred to Schedule 7 fund. Please remember this entire chart very clearly. We had spent a good amount of time understanding ongoing project. Remember, it's a multi-year project, year in which I commenced this year plus 3 more years. So 1 plus 3, in this much time this project should get over. That is multi-year project. Alright. And then we had learned that what if the company spends more than 2%, then whatever extra the company has spent, that extra can be set off against the requirement to spend in the next 3 years. But for that, board resolution is required. Even after 3 years, if some amount is still left unadjusted even after 3 years, then that will lapse. So whatever extra the company has spent, that extra can be set off across the next 3 years. Then we had learnt that whatever activity the company does under CSR, it is for the society's benefit. There is no profit motive. But still, by chance, if the company earns any profit through CSR activity, then in that case, that profit should not be set off against CSR requirement. You understood this part? One proper numerical example also we had seen over here. We had learnt that whatever profit the company makes out of CSR, that profit has to be spent back on CSR only. That profit will either the profit has to be put back into the same CSR project, or it has to be transferred into unspent CSR account and it has to be used for any CSR project, or it has to be transferred into Schedule 7 fund. So this profit also has to be used for CSR only. This profit is not considered as business profit. This profit has to be spent for CSR only. But you are spending it for CSR, but it will not be included in the 2% number. Like this profit, if I spent, let us say on CSR, current year 2% I have to spend. No, in that 2%, whatever profit I spent on CSR, it will not be included. Yes, this profit also has to be spent on CSR only, but in the 2% number, this profit which you spent on CSR will not be considered. That is, it will not be set off against the CSR requirement of the company. It will not be set off against the CSR requirement of the company. Then after this, we had learnt if the company has paid any salary to CSR staff or to the CSR volunteers, then that salary will also be considered as CSR expenditure. See, in case you did not understand this profit point, let me give you a reminder of the question that we had worked out. We had said that minimum company has to spend 100 rupees in a year. Company has surplus out of CSR. That is, company earned profit out of CSR 20 rupees, let us say. That 20 rupees company again spent on to CSR. 80 rupees company has put into PM Cares Fund. Current year minimum company has to spend 100. Company spent 20 rupees on CSR, company spent 80 rupees on CSR. This 80 rupees, yes, I will consider as CSR. This 20 rupees which the company has spent on CSR out of the profits, will this 20 rupees also be considered as current year CSR expenditure? No. Now you understood. Yes, so current year company has to spend 100, company has spent only 80, there is a shortfall of 20. That's how we will conclude. Whatever the company spends on CSR out of surplus, whatever the company spends on CSR out of profits of CSR project, out of surplus of CSR project, that will not be considered as CSR expenditure of the current year. Yes, this 20 is being spent on CSR only, but it will not be considered as current year's 2% number. Then we had learned that company has multiple options. Either the company can do CSR activity by itself, or the company can do through implementing agencies like registered trust, registered society, Section 8 company, any entity which is registered under Section 12A or Section 80G of Income Tax Act. They may be established, so they are called as implementing agency. So either the company can do CSR by itself, or the company can simply give money to implementing agency which is established by the company and ask this company to spend money on CSR. or the company can give money to implementing agency established by the government, or the company can give the CSR amount to any statutory body and ask them to spend on CSR, or the company can do CSR through implementing agency which is not established by the company, not established by the government, basically any other implementing agency having a track record of at least 3 years. So totally 5 options company is having. Either company can do CSR by itself, or company can do CSR through implementing agencies established by the company, or company can do CSR through implementing agency established by the government, or company can do CSR through statutory body, or company can do CSR through implementing agency, any other implementing agency which has a track record of at least 3 years. But we learned just giving money to implementing agency is not enough. Company also has to monitor and check whether money is properly being spent on CSR or not. Then we learned this implementing agency has to submit CSR1 to ROC, get CSR registration number from ROC. Then we had discussed after this that company CSR committee of the company, what's the composition? It should have at least 3 directors, one of whom should be independent director. But this provision will apply only if the company has independent directors, that is listed companies and some unlisted public companies which have independent directors, only for them this provision will apply. So listed company will have independent directors. So at least 3 directors, one of which is independent directors. If you are an unlisted company, you will either be a public company or a private company. Private company, there are no independent directors. If no independent directors, at least 2 directors will be there in the CSR committee. But if you are an unlisted public company, you may have independent directors, you may not have independent directors. If you don't have independent directors, same thing, 2 directors minimum. But if there are independent directors, then minimum 3 directors, one of whom is independent director. If you are a foreign company, there will be minimum 2 people in the CSR committee. One is a person nominated by foreign company, another is a resident who has been appointed by the foreign company to accept notices. This I had connected for you with the companies incorporated outside India. That chapter I had given you the linkage between this point and that chapter. Then after this we learnt if the company's amount to be spent on CSR is within 50 lakhs, then CSR committee is not required. If CSR committee is not required, roles and functions of CSR committee will be done by the board of directors. What is the role of the CSR committee? They will formulate and recommend the CSR policy. They will recommend how much amount has to be spent on CSR. They will monitor the CSR policy and they will formulate and recommend an annual action plan. Then what is CSR policy? It is a statement containing 3 things. Number 1, approach and direction given by the board of directors, guiding principles for selecting, implementing and monitoring CSR activity, and annual action plan. Annual action plan will contain 5 things. Number 1, list of CSR projects which we will do in the current year, manner of execution, modalities of execution, monitoring process and need and impact assessment. So this was a CSR committee and CSR policy discussion. Then we learned even board has a lot of responsibilities when it comes to CSR. They should consider the recommendations of CSR committee. They must approve the CSR policy. They must disclose the CSR policy in the board report. They must ensure whatever activities are put in the CSR policy are actually undertaken. They must ensure that the activities are as per Schedule 7. They must ensure whatever funds are disbursed for CSR, that fund is actually utilized for CSR. They should ensure minimum 2% is spent on CSR, and if less than 2% is spent, they have to ensure reasons are disclosed in board report. Then we learned, yes, company will be incurring admin overheads, but it should not exceed 5% of the total CSR expenditure. Then after this we had learned CSR reports. Totally 3 CSR reports company will be preparing. Do you remember? Summary, 3 CSR reports company will be preparing. Number 1, an annual report on CSR which will be a part of the board report itself. Then an impact assessment report has to be prepared, but impact assessment report every company need not prepare. Only if the average CSR spend of last 3 years was at least 10 crores, then company has to get impact assessment done for those CSR projects on which the company spent at least 1 crore and which got completed in the last 1 year. Do you remember that? See, I'll show you. Impact assessment is required when if last 3 years CSR obligation was at least 10 crores, then only impact assessment is applicable. But this impact assessment we have to do only for those projects for which we are spending at least 1 crore and which got completed in the last 1 year. Impact assessment is nothing but checking whether our CSR activity actually benefited the society or not. This has to be done through an independent agency, and on impact assessment, how much can we spend maximum? 2% of the CSR expenditure or 50 lakh rupees, whichever is higher. After all this discussion, we had learned totally 3 CSR reports. Number 1, annual report, which will form a part of the board report itself. Number 2, impact assessment report. This impact assessment report, just now we learned, this will be attached to this annual report. And number 3, a CSR report. CSR report, very special point. CSR report will be in form number CSR2, and this CSR report has to be attached to AOC4. Remember AOC4, just now we learnt filing financial statements with ROC, form number AOC4. So this CSR report has to be attached to this AOC4. Okay, then after this we had learnt that CSR project can multiple companies together. By the way, why is CSR report attached to AOC4? Because AOC4 will be filed with ROC. Along with that, even CSR report has to be filed with ROC. That is why CSR report is attached to AOC4. Then we learned, can multiple companies together do one project, big project. One company's 2% alone will not be enough. So multiple companies together, they are giving 2% number. Yes, this is allowed. Preference has to be given to local areas. It should not be a one-off event. It should be a planned project or program mode. Then we had learnt, if foreign holding company gives money to Indian subsidiary company to do CSR in India, it will be considered as CSR expenditure of the Indian subsidiary. This was a solid revision on the entire CSR discussion. Then we had learnt lastly about internal audit, section 138. Internal auditor, CA, CMA, any professional can be internal auditor. Practicing, not practicing, independent, not independent, employee, not employee, doesn't matter. Decided by the board of directors. Need not necessarily be a chartered accountant, can be any professional. Then we learnt that is internal audit mandatory for every company? No. It's mandatory for all listed companies. For those unlisted public companies with paid up share capital at least 50 crores in the preceding financial year, turnover at least 200 crores in the preceding financial year, outstanding loans and borrowings from banks and financial institutions at least 100 crores at any time in the preceding financial year, outstanding deposits at least 25 crores. And if you are a private company, then only the second and the third point will apply. Second and the third point. Here I had given you a big discussion with respect to this, that at any time in the preceding financial year, paid up share capital is at the end of the year. Turnover is for the year. But loans and deposits we will see any time in the preceding financial year. Okay, so this is it about our entire discussion on accounts of companies chapter. Totally sections involved: section 128 books of accounts, section 129 financial statements, section 129A periodical financial statements, section 130 reopening of books of accounts, 131 voluntary revision, 132 NAFRA, 133 accounting standards, 134 board report, 135 CSR, 136 circulation of financial statements to members, 137 filing financials with ROC, form number AOC4, 138 internal auditor. Yes guys, I think with this very confidently we can close this chapter. So we are now going to start a quick revision on this entire chapter. We're going to be discussing about the basic concepts, the features of the company and kinds of company. So we had first of all discussed that Companies Act 2013 did not come into force on one single date. We learned that it came into forces in bits and pieces. It came into force in phases. But the first set of sections came into force on 30th August 2013. Then we discussed the scope of the Act. We said that the Companies Act 2013 will apply to the whole of India. It will also apply to Jammu and Kashmir because Jammu and Kashmir does not enjoy any special status anymore. Then we had learned that we have from section 1 to section 470 and total we have 7 schedules, out of which we have learned 2 schedules already. Schedule 3 which is for financial statements format and schedule 7 which is for CSR. Then we learned that Companies Act 2013 will apply to totally 7 entities. Hint to remember was PICE PAB. P for companies incorporated under previous companies law, I for insurance company, E for electricity company, S for statutory companies, B for banking companies, A for companies incorporated under this act and B for other body corporates. Then after this, we had discussed what exactly is a company. The definition of company is given in section 2 clause 20 of your Companies Act. The section 2 clause 20 says that company means a company which is formed and registered under this act or an existing company which was formed and registered under any of the earlier under any of the previous Companies Act. So, but then this definition doesn't actually help us understand how a company looks like, because this definition is nothing. This definition is just saying that company means a company which is incorporated either under this act or incorporated under earlier Companies Act. But what exactly is a company? How does it look like? We started learning the features of a company to understand that. We said every company is a separate legal entity, which means company is a separate person altogether. Then company is an artificial person, which means that it is not a natural person. It did not come into existence by birth. Instead, it came into existence by following the incorporation process. But so what if it is an artificial person? It can still do everything that we human beings can do. Just that there are four things which an artificial person cannot do. A company, an artificial person cannot marry, it cannot be imprisoned, it cannot take an oath, and it cannot carry on a learned profession. Then we said company enjoys perpetual succession, that is, even if the shareholders die, the company still continues to exist. And then the shareholders have limited liability, which means that the shareholders, their liability is restricted to the amount which is remaining unpaid on shares. Once the shares are fully paid up, we cannot ask the shareholders to bring any further money. The shareholders' liability is limited liability. Then we learned that there is a common seal. This common seal is like the official signature of the company, but it is not mandatory for every company to have a common seal. If the company doesn't have a common seal, then in that case, any two directors of the company can sign on behalf of the company, or one director and company secretary can sign. Then we learned that if I am holding shares of a company, then these shares are transferable. These shares are transferable. Transferable means that I don't have to continue to own the shares forever. I can sell those shares to another person. But however, there's a catch. If it's a public company's shares, they are freely transferable, which means there are no restrictions. Even a private company's shares are transferable. Public company also transferable, private company shares also transferable. Only thing is, public company shares are freely transferable. Private companies' shares are transferable, but subject to restrictions. No prohibitions, I'm saying restrictions. Restrictions, by one restriction only, that is, before if I want to transfer shares of a private company, I must first offer the shares to the existing shareholders. Only if none of the existing shareholders are willing to buy the shares, only then I will offer the shares to the outsiders. Then we learned company does not have any citizenship. Yes, it has an address. Yes, it has a nationality, but it does not have citizenship. Then we learned audit is mandatory in all companies, which is called as statutory audit. And then company is always created for profit motive, but even charitable motive is allowed under Section 8. And then last feature was management and ownership are separated. These were the 10 features of a company. Then we started learning about the different kinds of companies. First, we learned about the kinds of companies on the basis of liability of members. Number one, we said we have limited companies. In limited companies, we said that the liability of the shareholders is limited to the amount which is remaining unpaid on shares. So once I pay whatever amount is due on the shares, over and above that, the company cannot ask me to contribute any further amount. Then we had learned about guarantee companies. Guarantee companies, here we had learned that these companies may have share capital or they may not have share capital. If they have share capital, the shareholder will have two liabilities. Number one, he'll have to pay whatever amount is unpaid on shares, and number two, he'll also have to pay the guarantee amount. But if the company doesn't have share capital, the shareholder will have only one liability, which is he has to pay the guarantee amount. But whatever may be the case, amount which is unpaid on shares, we can ask the shareholders to contribute at any point of time. But guarantee amount, we can ask the shareholders to pay only and only at the time of winding up, not before that. Guarantee amount only at the time of winding up. Then we had learned after this, generally guarantee companies are created with charitable objectives only. And what is a guarantee amount? It will be mentioned in the MOA. Then we had learned about unlimited companies. Here we learned that members' liability will be unlimited, which means the members will be liable for the debts of the company. But unlimited liability feature of the members will get activated only when the company goes into winding up. So till the company goes into winding up, till then the shareholders will enjoy limited liability only. Only when the company goes into winding up, only then the unlimited liability feature of the shareholders' liability will be activated. And even in this case, the creditors cannot directly approach the shareholders and ask them to pay. Only the creditors can only approach the company. It is a company that can approach the shareholders. But all of this drama will apply only at the time of winding up. Till then, shareholders will anyways enjoy limited liability only. And we had also seen the example of Alvar Trading Investment Company. I hope you recall. We had discussed that for these unlimited companies, it is not necessary that they should use the word limited. The name of the company can just end with the word company as well. So we have Alvar Trading and Investment Company. It's an unlimited company. It doesn't have the word limited in its name. It doesn't have the word unlimited in its name. Even this is allowed. And the word unlimited will anyways not be in the name, but the word limited can definitely be in the name even if it is an unlimited company. Then we had learned up after this about different types of companies on the basis of number of members. Here we learned three types of companies: one-person company, public company, and private company. In one-person company, there is only one member, not more, not less, only one member. And there is minimum one director. Yes, we can have more than one directors also. Then we learned in a one-person company, the name of the company will have OPC Private Limited, so that everybody who's dealing with the company knows that, okay, this is a one-person company. And by nature, one-person company is a private company. It has to be created only with a profit motive. It cannot be created with charitable motive. And we also learned that in a general meeting of shareholders, there is no general meeting of shareholders in a one-person company, because only one member, what meeting will he have with himself? And then we had learned in a one-person company, what if that one member dies? Confusion will arise. What will happen with the company? There will be some doubt. So that is why a nominee concept was introduced. This one-person company has this one member. This one member will appoint a nominee. In case a member dies or in case a member becomes incapable, the nominee will become a member. In the MOA of a one-person company, there's a special clause called the nomination clause. And in this nomination clause, the nominee's name will be written. To appoint a nominee, the nominee has to first of all give a written consent saying that he's willing to be appointed as a nominee. And also, the one-person company will have to file a copy of this written consent along with details about the nominee and fees with ROC at the time of incorporation itself. So this itself indicates to us that nominee is appointed at the time of incorporation itself and not later. He is appointed at the time of incorporation itself. Nominee will give a written consent to the OPC. OPC will file this written consent along with details of the nominee and fees with the ROC. Then we learned what if the nominee wants to withdraw his written consent. Yes, he can withdraw his written consent. He can inform the OPC. The member will appoint another nominee within 15 days itself, and member will inform OPC who is this new nominee, and OPC will file with the ROC details of the new nominee, his written consent and fees. Then we learned second situation, what if the member wants to change the nominee? Yes, a member can change the nominee. Member will inform OPC and OPC will inform ROC. Third situation, we learned what if the member dies? Now nominee will become a member. Once nominee becomes a member, now we don't have a nominee. So the new member will have to appoint a new nominee within 15 days. Then same thing, the member will inform OPC, OPC will inform ROC. In all these situations, we learned that there is a change in nominee. So in the MOA, in the nomination clause, where we've written the nominee name, there will be a change. But if the only change in the MOA is change in the nominee, then it will not be considered as alteration of MOA. And then we learned some common points which are applicable for both member and for nominee. Member and nominee both have to be a major, both have to be natural persons, and both have to be Indian citizens. But they may be a resident or a non-resident, it doesn't matter. Then we had learned that I can be a member only in one OPC. At a time, I can be a nominee only in one OPC. And at the same time, I can be a member here and nominee here. In the situation where I'm a nominee, there if the member dies, I will become a member here. So I'm already a member in one OPC. I've become a member in this OPC also because the member died. So now I'm a member in two OPCs. In such cases, I will get 180 days time to decide that in which of the two OPCs I want to continue. Within 180 days, I have to meet the eligibility criteria. Then we learned one-person company cannot be incorporated for charitable objectives. Also, one-person company cannot be converted into Section 8 company. It can be converted into public company, private company, but it cannot be converted into Section 8 company. Then we also learned one-person company cannot carry on investment activities and it cannot carry on NBFC activities. Then after all this, we had learned about private companies. Private companies will have the word private limited in its name, minimum 2 members, maximum 200 members, excluding past and present employee members. Minimum 2 directors, and in the AOA there will be 3 special clauses. Special clause number 1, limiting the maximum number of members to 200. Special clause number 2, restricting the transferability of shares. Special clause number 3, prohibiting the issue of prospectus. I had given you the logic of all of this during our regular class itself. And then we learned when we're counting the number of members, joint shareholders will be counted as one only. Then we learned about public company. Public companies are companies which are not private companies. Public companies will have the word limited in the name, minimum 7 members, maximum no limit, and minimum 3 directors. Then we learned the concept of deemed public companies. They are those companies which are actually private companies, but they are subsidiaries of a public company. So even though they are a private company, we will treat them as if they are a public company. Then we learned what if in a private company or in a public company, the total number of members falls below the minimum number. We will give the company how much time? We will give the company 6 months time to bring the number back to the minimum number. If the company is able to do this, great. But even after 6 months, if we have less than the minimum number, then whoever are the members of the company, they will now become personally liable for the company's debts. But which debts of the company? Those debts which were contracted by the company after the 6 months period. For those debts, these remaining members will become personally liable. Then we had learnt about member versus shareholder. This was a big discussion. This you know very well. Taking you straight away to the next set of companies, we had learned about the different types of companies on the basis of control. Here we spoke about holding subsidiary companies and associate companies. Holding subsidiary relationship is created in 3 methods. Number one company is controlling the composition of board of directors of the other company. That is, one company can appoint or remove majority of the directors of the other company. In the second method, one company is controlling more than half of the total voting power of the other company. When you're doing this checking, whatever shares are being held in fiduciary capacity, you will ignore that. Total voting power is generally only equity shares, but sometimes even preference shares do have voting right. Like for example, if 2 years continuously we have not paid preference shares any preference dividend, then even they will have voting power. In that case, you will take preference shares also. So generally total voting power is only equity shares, but if preference shares also have voting power, then you will consider preference shares as well. Then we learned after this that one company is controlling more than half of the total voting power in the other company. Either it can be on its own, just A Limited on its own alone is controlling more than half of the total voting power, or it can be indirect control, which is through subsidiaries. Then we had learnt the third method. In the third method, subsidiary will also become the holding company subsidiary. Remember chain holding, subsidiary will also become holding company subsidiary. Then we had learnt after this that can a subsidiary company purchase shares in holding company? We said no, subsidiary company generally cannot be a member of holding company. If holding company allots shares to subsidiary company, it will be void. But there are 3 exceptions. Number 1, if subsidiary company is holding shares in the holding company as a trustee, it is allowed. Second exception, if subsidiary company is holding shares in the holding company as a legal representative of a deceased member, even this is allowed. And third exception, if subsidiary company bought shares of the holding company even before the holding subsidiary relationship was formed, even this is allowed. But here, if you remember, we had learned about voting right as well. In the first 2 situations, trustee and legal representative exception. In these 2 exceptions, the subsidiary company will have voting right in the holding company. But in the third exception, that is when subsidiary company was holding shares even before the holding subsidiary relationship was formed, in that case, subsidiary company will not have voting right in the holding company. So generally, subsidiary company cannot become a member of a holding company, but there are 3 exceptions. In these 3 exceptional cases, subsidiary company can become a member of a holding company. First exception, subsidiary company can be holding shares in the holding company as a trustee. Second exception, subsidiary company can be holding shares in the holding company as a legal representative of a deceased member. In the third exception, subsidiary company can continue to own the shares which it had acquired even before the holding subsidiary relationship was formed. Alright, apart from these cases, in any other case, if the holding company allots any shares to subsidiary company, it will be fully void. If you remember, we had spoken about the bonus share discussion also in this whole concept. Then we learned about associate company. In associate company concept, we learned that one company is having significant influence over the other company. Significant influence means you're controlling at least 20% of the total voting power of the other company, but up to 50%. Because if it is more than 50%, it will become holding subsidiary relationship. So significant influence is either controlling at least 20% of the total voting power, or it is controlling, participating in the business decisions of the other company. Then we had learned after this about different types of companies on the basis of access to capital. Here we had learned about listed companies and unlisted companies. Listed companies are those companies whose securities are listed in some recognized stock exchange. Unlisted companies are those companies whose securities are not listed. Then we learned that there are 5 special scenarios where even though some security is listed, still the company will be considered as if it is an unlisted company. 5 situations. Situation number 1, there's a public company which has not listed its equity shares, but it has listed non-convertible debentures which were issued on a private placement basis. In the second situation, I'm a public company. I have not listed equity shares. I have listed non-convertible preference shares which were issued on a private placement basis. In the third situation, again I'm a public company. I have not listed my equity shares, but I have listed both non-convertible debentures and non-convertible preference shares which I had issued on a private placement basis. In the fourth situation, I am a public company. I have not listed my equity shares in a recognized stock exchange, but I have listed my equity shares in section 23(3) stock exchange. 23(3) stock exchange means a foreign stock exchange. I have not listed in India. I have listed outside India. Even this is allowed. We took a lot of practical examples to discuss this as well. And in the fifth situation, I am a private company. I have not listed my equity shares, but I have listed non-convertible debentures which were issued on private placement basis. I had given you the Tata Group example for this point. Alright, so these are your 5 situations where even though something is being listed, still I will treat the company as if it is an unlisted company. Then after all this discussion, we had discussed a lot of questions also relating to this. Then we spoke about small company. A small company means a company whose paid up share capital is within 50 lakhs and turnover is within 2 crores. But Companies Act has given power to the central government that the central government can increase the 50 lakh number up to 10 crore and the 2 crore number up to 100 crore. Central government has exercised this power and they have increased the paid up share capital number to 4 crore and turnover number to 40 crore. So today, if you see, a small company is a company whose paid up share capital is within 4 crore and turnover is within 40 crore. But there are 4 companies, even if they fulfill this criteria, they will still never be considered as small companies. The 4 companies are public companies, holding subsidiary companies, Section 8 companies, and statutory companies. These companies, even if they fulfill this criteria, they will not be considered as small companies. Then we learned about government companies. They are those companies wherein at least 51% of paid up share capital is held by central government or state government or both. Then we also have deemed government companies which are actually not government companies, but they are subsidiaries of a government company. So even though they are not a government company, they are treated as if they are government companies. Then we learned about Section 8 companies. Finally, these are those companies which have charitable objectives and by nature they are public companies. Unlike any other company, to create a Section 8 company, we actually need a license. That is why they are often also called as licensed companies. Then we learned that Section 8 company, first of all, they will not even make any profits. But by chance, by mistake, if they have any profit, they are prohibited from distributing the profit as dividend to shareholders. The only thing that they can do with the profit is use the profit for charitable objectives. Similarly, upon winding up during liquidation, if they have any surplus assets, they are prohibited from distributing the surplus assets to the shareholders. They can only donate the surplus assets to some other Section 8 company having similar objectives. Then for Section 8 company, like government companies, Section 8 companies and government companies, in these 2 companies, it is not mandatory to use the word private limited or limited in the name. You can use other words like foundation, club, chambers of commerce and all allowed. Then we learned Section 8 company enjoys a lot of exemptions. I connected this concept for you with small company and I gave you the reason why Section 8 company is excluded from small company discussion. Then we learned a partnership firm is not going to be, a partnership firm cannot be a member in other companies, but it can be a member in Section 8 companies. Then we learned in Section 8 company, the liability of members will either be limited or it will be limited to the guarantee amount, but it will never be unlimited. To alter the MOA of a Section 8 company, we need RD approval. To alter the AOA of a Section 8 company, we need ROC approval. Alright. Then after this, we had learned to incorporate a Section 8 company, what is the process? We first have to get a license from central government, which central government has delegated to ROC. Then we have to submit documents to the ROC like the application form and fees. Along with the application, we also have to give a copy of the MOA and AOA, an estimate of income and expenses for the next 3 years, and a declaration by CACS, CMA or an advocate saying that all the provisions relating to incorporation of a Section 8 company have been complied with. Then we learned license is given by ROC. But in 4 cases, this license can be revoked by the RD. What are the 4 cases? Number 1, if any terms and conditions are violated, or if the charitable object itself is violated, or if the company does some fraud, or if the company does something which is prejudicial to public interest. In these 4 cases, the license itself will get revoked. Then we learned what's the process for revocation. First, the central government or the RD, as the case may be, will give a written notice to the Section 8 company saying that they are going to be revoking the license and they'll give the Section 8 company an opportunity of being heard. Then they will revoke the license, and after that, 1 out of 3 orders they will pass. They will either pass an order converting the Section 8 company into a public company or a private company, or they will pass an order amalgamating the Section 8 company with some other Section 8 company having similar objectives, or they will simply wind up the company. Now, upon winding up the company, in case there are any surplus assets, either it will be donated to some other Section 8 company having similar objectives, or the company will sell away the assets, get money, and donate that money to Insolvency Bankruptcy Fund under Insolvency Bankruptcy Code 2016. Finally, we learned the whole process to convert a Section 8 company into a public company or a private company. First, special resolution has to be passed. To pass a special resolution, we have to call a meeting of shareholders. To call a meeting of shareholders, we will send a notice. To that notice, an explanatory statement will be attached. In this explanatory statement, we will put all the details, all the reasons of the conversion, that why exactly are we doing this conversion. This notice copy also has to be given to Chief Commissioner of Income Tax, Charity Commissioner, and Chief Secretary of the state. If any of these persons have any representations, they will send representations to the regional director within 60 days. Then company will have to file application with the regional director. Company will also have to give the regional director a copy of the special resolution, the notice, and the explanatory statement. Then once we submit all these documents to the RD, within 1 week, notice has to be published in 1 English newspaper and 1 vernacular newspaper. Finally, we learned once RD passes an order allowing the conversion, the company will call a meeting of shareholders and again pass a special resolution to alter the MOA and AOA. Altered copy of MOA and AOA will be filed with the ROC, and ROC will give the company a fresh certificate of incorporation. But if the RD decides to reject the application and reject the conversion, then before rejecting, RD will give the company an opportunity of being heard. All right, so this was our entire chapter on the different kinds of companies, the features of the company. Now, a lot of concepts which we have learned in this chapter, you will be seeing, in multiple places in the rest of your syllabus. So hereafter, whenever we talk about small company, you should be able to connect with what we've learned over here. In auditors chapter, when I talk to you about government company, you should be able to connect it with whatever we've learned over here. In your management and administration chapter, when you talk about Section 8 company 14 days concept, you should again be able to connect with what you've learned over here. All right, so with this, we're done learning with another important chapter. Now, in this chapter, let me tell you before I close, the most important concepts in this chapter, the concepts which are most often repetitively asked in the examination are: number 1, 1% company; number 2, holding and subsidiary company; number 3, small company; and number 4, your listed and unlisted companies. So these are the 4 most important concepts in this chapter. This is something which you have to be doing really well in this chapter. Your non-negotiables of this chapter. All right. So with this, I think we're good to close this chapter. I hope you're nice and confident. So now we'll do a revision of the entire incorporation chapter that we've learnt about. In this chapter, first of all, we learnt about promoters. Under promoters, we first had a general discussion that who exactly are promoters. We said that promoter, he is the one who first of all conceives the idea that let me start a company. He is a person who takes all the efforts to incorporate the company. He is the one who decides who will the subscribers to the MOA be. He is the one who decides who the first directors will be. He is the one who puts in the effort to prepare the MOA and AOA of the company. Then we learned that the promoter is neither a director nor an agent nor a trustee nor an employee of the company, because come on, company itself has not come into existence. So how can the company have a director, agent, trustee, employee and all? So promoter, he is none of this, but he is like an agent, like a trustee. That is, he has a fiduciary relationship with the company. That is, whatever he does should be in the best interest of the company. He has a relationship of trust and confidence with the company. He enjoys a fiduciary relationship with the company. But this entire discussion was just a general discussion. Then I told you after this that for the very first time in our Companies Act 2013, for the very first time promoter definition was given. I also told you why promoter definition is given. The reason is very simple. The reason is that we in so many places in Companies Act, promoter is punished. So we need to know who exactly has to be punished. We need to know that the whole responsibility has to be put on whose head. So that is why we have the promoter's definition given in section 2 clause 69. The definition says promoter means what? Means promoters will mean only the points which is given in the definition and nothing else. It will mean only whatever is given in the definition. So it is an exhaustive definition, it is a strict definition, it's a restrictive definition. Alright. So promoter means 1, 2, 3, 1, 2, 3 only. Now out of 1, 2, 3, do you have to fulfill all? No, you can fulfill any one. That is why we have the word or in between the definition points. Then promoter means a person. Does it say promoter means individual? No, it says promoter means person. That is why you remember we had learnt that promoter need not necessarily be an individual. Promoter can be any person, not necessarily individual. Can be an individual, can be an artificial person, can be an association, can be a partnership firm. Promoter can be any person. It says promoter can be a person. It does not say promoter has to be an individual. So it can be any person, even a non-individual can be a promoter. Then tell me, promoter means a person. So which means only one promoter? No. Remember we discussed that General Clauses Act says singular will include plural and plural will include singular, guys. So even though we say a person, we will include plural promoters. We can have more than one also. That we saw over here. Can we have two promoters? Can we have more than one promoters? Yes. Definition says promoter means a person. It says singular. But General Clauses Act says singular includes plural. So even though we are saying a person, it can have many persons also. What are the three parts? Part number 1, either your name is written in the prospectus or in the annual return as a promoter, or you are controlling the company's affairs directly or indirectly as a shareholder, director, or in any other form, or the board of directors is accustomed to act according to your advice and directions. Remember guys, the whole Jio Financial Services Limited example, Mr. Mukesh Ambani's name, even if it is not written in the prospectus or and in the annual return, even if he is neither shareholder nor director of the company, still the board will not take any major decision without taking his advice. So Mukesh Ambani will become the promoter of Jio Financial Services Limited. Even though he is not a shareholder or a director of the company, he can still become the promoter because of this point. And one very important point we had learnt, if you are giving advice, if you are giving directions in professional capacity, then will you ever be considered as promoter? No. Person who is acting merely in professional capacity will not be considered as promoter. So this was our entire promoter discussion revision. Then we had learnt about the incorporation process, which is given in section 7 read with Companies Incorporation Rules 2014. Now what are all the points we said over here? We said that the whole incorporation process they have made simplified. Remember we spoke about ease of doing business and all. The whole incorporation process they have simplified by bringing the SPICE plus form. This one form itself takes care of 10 services, guys. So for these 10 services, separate form is not required. 10 services are taken care of by this one form itself. This way the whole incorporation process is much easier and much faster and much simpler. Then we started learning what is a process. In the first step, name reservation. For name reservation, we will submit the SPICE plus form in form number INC 32 along with fees to the ROC. Now in this form, we will write what name do we want to keep for the company. Now for the name, we have to follow rules and regulations. The name should not be identical or similar to the name of another company. The name should not be connected to the government. The name should properly follow emblems and names. Prevention of Improper Use Act 1950. This law should be properly complied with when we choose the name of the company. What is the name of the law? Emblems and names, Prevention of Improper Use Act 1950. Then we learnt once all these conditions are fulfilled, if ROC thinks our name is proper, then ROC will reserve the name for how many days? For 20 days. Alright, within 20 days we have to incorporate the company and we have to start using the name. If we are not able to do that within 20 days, we can ask for another 20 days extension, and then again we can ask for 20 days extension, or we can straight away ask for 40 days extension. Now even after taking extension, if we are not able to start using the name of the company, then the name reservation will lapse and we'll have to restart the whole process. This was my first step. Inside this itself we learnt, if an existing company wants to change the name, then here also name reservation has to be done, but here name reservation is 60 days time. And why 60 days? I gave you the logic. For new company 20 days, for existing company 60 days. Why this partiality? Existing company, why are you giving so much time? Because existing company, if they want to change the name, there are lot of formalities. They have to pass special resolution, they have to get central government approval, they have to make changes in MOA, AOA, they have to file documents with ROC. All this will take time. So all this they have to complete within 60 days. So this was my first step in incorporation process, name reservation. In the second step, drafting, signing, stamping, MOA and AOA. In the third step, we are going to file documents with the ROC, but which ROC? That ROC who is having jurisdiction over the place where our registered office is situated. Now what are the documents? 5 documents. The hint to remember is AP DAM. A stands for address for correspondence till the RO is established. Temporary address, guys, till we have the registered office, till then a temporary address. Then P stands for particulars, particulars of subscribers, particulars of the first directors, and particulars of interest and written consent of the first directors. So particulars of subscribers, particulars of first directors, particulars of interest. You remember particulars of interest. This means, are the directors having an interest in some other entity? Is it wrong? No. But you're supposed to disclose. So particulars of interest in other entities and written consent, all this will be written in the particulars part. Then comes our next point, D. Declaration has to be given by whom? It has to be given by one insider and one outsider. Who is the insider? Director, manager, company secretary. Who is the outsider? Some practicing CA, CS, CMA or advocate who is involved in the entire incorporation process. So these two people have to give a declaration saying that all the rules and regulations of Companies Act relating to incorporation, everything we have complied with. Then A stands for affidavit, and affidavit has to be given by whom? The same two people whose particulars are required, subscribers and first directors, the same two people only have to give the affidavit also. Now what are the contents of the affidavit? What will be written in the affidavit? In the affidavit we will write totally 3 things. Point number 1, never in my life, never ever have I been ever convicted for any offense relating to PFM. What is PFM? Promotion, formation, management of the company. Then last 5 years if you see, I am not guilty of BFM. BFM is what? Breach of duty, fraud and misfeasance. And then whatever documents and information we have filed with ROC, all of it is CTC. CTC means what? Correct, true and complete. So A for address, P for particulars, D for declaration, A for affidavit and M for MOA and AOA. The MOA and AOA which we have already prepared in step 2, that MOA and AOA also has to be filed with ROC. Now this MOA and AOA has to be signed by the subscribers in the presence of a witness. The subscribers, do you remember? The subscribers will automatically become the members of the company. The subscribers, as soon as a company incorporates, upon incorporation, they will automatically become members of the company. After the company incorporates, shares will be allotted to them and then they will become shareholders of the company. So these subscribers have to sign the MOA AOA in the presence of one witness. Even the witness has to sign. But then we saw, what if the subscriber is illiterate? Then he will put thumb impression. What if subscriber is a company? Then director, officer or employee of the company will sign on behalf of the company. Then we learned, what if subscriber is LLP? Then some partner of the LLP will sign on behalf of the LLP. What if the subscriber is a foreign national and he is living outside India? Then his details have to be notarized by a notary public. But however, if he is a foreign national who is living outside India, but for incorporation if he is visiting India, then he himself can sign if he is coming on a business visa. But business visa is not required for person of Indian origin and overseas citizen of India. Not very important from examination point of view, but because we're not trying to skip any concept, I just put these points as well over here. Then we had learned that if the company is a bank, even RBI approval is required. If it's an insurance company, even IRDA approval is required. So like this, whatever other approvals are required, approvals also have to be obtained before incorporation itself. Then we learned, once all these documents we file with the ROC, once ROC is convinced, ROC will register the company, ROC will put the details of the company in the register, ROC will give a certificate of incorporation in which form number? number? In INC 11. Before this, which form number you know? Tell me. Spice Plus is which form number? Spice Plus is INC 32. Now one more form we learnt, INC 11. This is Certificate of Incorporation. In Certificate of Incorporation, there will be how many important points? There will be 2 important points. Number 1, date of incorporation, and number 2, corporate identification number. Number 1, date of incorporation, and number 2, corporate identification number. So from the date of incorporation, the company is said to have come into existence, and whatever is a corporate identification number, it's a unique number which is allocated to the company. Alright, corporate. So 2 things will be written in the certificate of incorporation: date of incorporation and corporate identification number. This corporate identification number, how to decode also we learned, and we also learned over here that corporate identification number may undergo a change as the company's form changes, as the company's nature changes. Even the corporate identification number will undergo a change. Then here we had learned a very important thing. Certificate of incorporation is a conclusive evidence that company is incorporated. It is a conclusive evidence that separate legal entity has come into existence, but it is not a conclusive evidence. It is not a conclusive evidence of everything that happened before incorporation. So for incorporation, if you will do fraud, you will get punished. If in the MOA you have written illegal objects, just because you have a certificate of incorporation will not legalize an illegal business. Alright, so certificate of incorporation is only an evidence that company has come into existence, but it is not an evidence that everything before incorporation you have done correctly. It is not an evidence for that. So if the company has been incorporated fraudulently, you can't say I have certificate of incorporation. You can't question. You can't say like that. I will question. If your MOA is containing illegal object, you can't say ROC gave me certificate of incorporation, I will do illegal business. What is your problem? You cannot say like that, because certificate of incorporation will not legalize an illegal business. Then after this, we had learnt about section 10A, a very important point. Here we said company, even though you are incorporated, even though you have certificate of incorporation, you cannot commence your business. You cannot borrow money. You have to fulfill 3 conditions. First, what are the 3 conditions? Condition number 1, the director has to give a declaration to the company, to the ROC, a declaration saying that the subscribers have fully paid for the shares. Within how much time, guys? Within 180 days, they have to do this declaration. You remember we had connected this point with the earlier discussion of member and shareholder. When we were discussing about the difference between member and shareholder, there also we had seen something similar. We had interconnected this point with that. We had learnt that member will become shareholder only after shares are allotted to him. So all this has to be completed within 180 days. So director, you have to give a declaration to the ROC, a declaration saying that subscribers have fully paid for the shares taken up by them. So subscribers, we have to allot the shares to them. They have to pay for the shares. Everything should be completed within 180 days. So listen guys, before incorporation, subscribers are nothing. Upon incorporation, subscribers will become members. Within 180 days, shares will be given to them. They will pay for the shares, and now they will become shareholders. You understood? 3 stages of subscribers. Before incorporation, they are nothing. After incorporation, upon incorporation, they become automatically members. Within 180 days, shares will be given to them. They will pay for the shares, and now they will become shareholders. Okay, then we learnt that within 180 days, if this declaration is not filed, then ROC will simply remove the company's name from the register. Once company's name is removed from the register, the company ceases to exist. Then we learnt whatever approvals are required, your RBI approvals, IRDA approvals, all that also has to be filed with the ROC when along with the declaration itself. Then we learnt the registered office address verification, that is your address verification, your registered office address verification has to be filed with the ROC within how many days, guys? Within 30 days from the date of incorporation, registered office address has to be, the verification has to be filed with ROC. Then we learnt what if section 10A is violated. Company will be punished with 50,000 fine, and directors and officers in default will be punished with 1,000 rupees per day, maximum 1 lakh. Then we had also learnt one more point. If directors are not giving this declaration within 180 days, then can ROC remove company's name from the register and put this punishment on you? We said yes, both can happen simultaneously. Both the punishments can happen simultaneously. If declaration is not given within 180 days, ROC will remove your name from the register also. ROC will put monetary penalty also on you. Then we had learnt about preservation of documents. We learnt whatever documents we have filed with ROC for incorporation, all those documents we are supposed to preserve. For how many days, guys? Till dissolution we have to preserve. Where do we have to preserve? At the registered office. Then we learnt after this that during incorporation process, if you give false information and if you are caught during the incorporation process itself, then whoever gave wrong information, 447 punishment. Then we learned what if we find out about the fraud after incorporation, then 3 people will be punished. Who are the 3 people, everybody? Promoters, first directors and persons who gave declaration. These 3 people will be punished. Are you able to recall my Chinese company example over here? Yes, Dotsky Chinese company example, Hugo loan, all that you will keep in your mind. Promoters, first directors declaration, they are going to be punished under section 447. You know why I have put this point also, right? Why we have put this also over here. Hugo loan example, we have learnt that. Then we learnt about NCLT's powers. We learnt that if the company has been incorporated fraudulently and if some person has gone and made an application to NCLT, then NCLT will first of all give you an opportunity of being heard and then NCLT will pass an order. What order, guys? NCLT has 5 options. NCLT can pass an order regulating the company's management, changing MOA AOA, or NCLT can pass an order saying members, your liability is going to be unlimited, or NCLT can pass an order removing the company's name from the register, or NCLT can simply pass an order winding up the company. NCLT can basically pass any order it deems fit. Alright, and lastly we had learnt section 9, which says what is the effect of registration. Once company registers, then once company has certificate of incorporation, from the date of incorporation a separate person has come into existence. Alright guys, so what are the section numbers, what are the form numbers? Tell me what are the form numbers first. INC 11, certificate of incorporation. INC 32, your Spice Plus form. Then what are the section numbers that you know? Tell me that also. You know about section 2, clause 69, promoter's definition. You know about section 7. What is section 7? Incorporation process. You know about section number 9, which talks about the effect of registration. You know about section number 10A, which talks about the 3 conditions. And finally, you also have heard about section 447 in this entire discussion. That's all. Let's start. We'll start with section 23. This was the first section that we had studied. Section 23 tells us that a company can issue securities in what methods? First of all, if I am a public company, I have 3 options. I can make a public offer, or I can issue securities by way of private placement, or I can also make an issue in the form of rights issue or bonus issue. Now be careful, if I am a public company, when I make a public offer, I am offering securities to the general public. But if I am a public company, is it mandatory that I have to make a public offer? The answer is no. If I want to, I can make a public offer. But if I am a public company, it doesn't mean that I can only raise money from the public. I can also issue securities to a selected group of people, which is called as private placement, or I can also issue securities to my existing shareholders in the form of rights issue and bonus issue. So point number 1, a public company can issue securities in 3 methods. Number 1, through public offer. Number 2, through private placement. And number 3, through rights issue and bonus issue. But however, if I'm a private company, I have only 2 options, guys. A private company, we all know, it cannot go to the general public. So a private company cannot make a public offer. It can only make a private placement wherein it goes to a selected group of people and offers securities only to that group. Either it can make a private placement or it can offer securities to existing shareholders in the form of rights issue and bonus issue. But a private company cannot make a public offer. Okay. Then coming to our next section, which is section 24. Now section 24 talks about the powers of SEBI and the powers of central government, NCLT, ROC. See, if SEBI, when it comes to SEBI, they can administer matters relating to three topics: issue of securities, transfer of securities, and dividend. But even in these three matters, SEBI will have a role to play only in listed companies and companies who intend to get listed. Here, if you remember, we had focused on the word intend. This was a key word. Intend to get listed means they are not listed right now, but they are in the process of getting listed, right guys? So SEBI can administer matters of issue of securities, transfer of securities, and non-payment of dividend. But even in these matters, SEBI can play a role only in listed companies and companies which intend to get listed. But however, central government, NCLT, ROC, these three have a role to play for all other matters. So remember, SEBI has a role only in three matters: issue of securities, transfer of securities, and dividend. And that too only in relation to listed companies and companies which intend to get listed. For all other companies, for all other matters, central government, NCLT, and ROC only. Okay, then so all of this was just preliminary discussion, and this is where we had started talking about the core prospectus chapter. We had learnt about the definition of prospectus, which was given in section 2 clause 70. Now the definition says that prospectus means any document described or issued as a prospectus and includes all these things. So the definition has two limbs: means and includes. Now when I say prospectus includes, it means any document. Document indicates it has to be in written, guys. It has to be in words. See, when I say in written, it's not necessary it has to be by pen on paper. It can also be a soft copy. It can also be a PDF. But it should not be an audio recording. It cannot be a radio advertisement. It has to be in a tangible form. It has to be written. It has to be written using words. Okay. And described or issued as a prospectus. Now for this, I had shown you a practical example as well. I had shown you that every prospectus, the heading itself, the word prospectus will be written. That way anybody who looks at the prospectus, they will know that it is, okay, this document is a prospectus. So every prospectus document should be described or issued as a prospectus, which means the heading itself should be that it is a prospectus. So the first limb is clear, guys. Prospectus means any document which is described or issued as a prospectus. Now it includes four things. It includes red herring prospectus, shelf prospectus, any notice, circular, advertisement, or any other document. So it includes red herring prospectus, shelf prospectus, notice, circular, advertisement, or any other document. But what is this document doing? This document is inviting offers. Inviting offers from whom? From the public. For what? For subscription or purchase of any securities of the body corporate. Now be careful over here, it is inviting offers. This, I remember we discussed that prospectus is an invitation to offer, not an offer. We had connected this with your CA Foundation Contract Act case. It's an invitation to offer. Now we are inviting offers from whom? If the company is making a private placement, will the company issue a prospectus? No. If the company is issuing securities to existing shareholders, will the company issue prospectus? No. Because in prospectus, company is inviting offers from the public. So when the company is making a public offer, only at that time the company will issue a prospectus. So prospectus comes into the picture only when the company wants to invite offers from the public. Now invite offers for subscription or purchase of any securities of the body corporate. So now come on, give this definition one last reading with me. So prospectus means any document which is described or issued as a prospectus and includes a red herring prospectus, a shelf prospectus, any notice, circular, or advertisement, or any other document inviting offers from the public for subscription or purchase of any securities of the body corporate. Then after this, we had also learnt about the whole matters, the contents of prospectus. This we had learnt in section 26. First of all, we learnt that every prospectus has to be dated. Now whatever date is written on the prospectus, we will treat as if the prospectus was published on that date only. So point number one, every prospectus has to be dated, and whatever date is written on the prospectus, we will treat as if that only is the date of publication of the prospectus. Point number one. Then point number two, what will be the contents of the prospectus? What will be written inside the prospectus? 4 boxes is what we've learned from the very beginning. Number one, prospectus will contain information. Number two, it will contain reports on financial information. Both are specified by whom? Remember? Both are specified by whom? SEBI plus central government. SEBI plus central government. SEBI in consultation with central government. Then prospectus will also contain a declaration a declaration that nothing in this prospectus is against the Companies Act. A declaration saying that all the provisions of Companies Act relating to prospectus, everything has been complied with. And lastly, prospectus will contain a statement saying that nothing in this prospectus is against three things. Nothing in this prospectus is against Companies Act, nothing in this prospectus is against SCRA, and nothing in this prospectus is against SEBI Act. Okay guys, so contents of prospectus, tell me last time, 4 boxes. Number 1, information. Number 2, reports and financial information. Specified by whom? SEBI. SEBI plus whom? Not SEBI plus ROC. SEBI plus central government. Then we learnt it will contain a declaration that all the provisions of this act relating to prospectus, everything has been complied with. And lastly, it will contain a statement that nothing in this prospectus is against the Companies Act, SCRA and SEBI Act. Okay guys, then after this we had learnt about signing and filing of prospectus. This was extremely important. We had learnt a sequence over here, a 4-step sequence, right guys? First of all, once a prospectus is prepared, the prospectus will be approved. First step guys, approved by whom? It will be approved by the board of directors. Then secondly, it will be signed. It will be signed by whom? Not majority directors. It will be signed by all the directors. Remember. Then number 3, it will be filed with the ROC, and only then this prospectus will be issued. So totally 4 steps guys. First, the prospectus will be approved. Approved by whom? Approved by the board as a whole. They'll pass a board resolution and they will approve the prospectus. Then secondly, it will be signed. It will be signed by all the directors. And then number 3, it will be filed with the ROC, and only then we can issue this prospectus to the public. So point number 1, the main point over here is about filing. Whenever we file the prospectus with the ROC, tell me, before this date, can I issue it to the public? Impossible guys. We can issue it to the public only after filing with ROC. But we had a 90 days time limit over here, a very important time limit over here. We discussed that here a lot of misinterpretation is possible. We said that once we file the prospectus with the ROC, from this date within 90 days we have to issue it to the public, which means once we file it with the ROC, we all know that after this only we can issue it to the public. But after this doesn't mean you can issue it to the public after 1 year. Once we file with the ROC, clock will start ticking. From this date within 90 days, we have to file it with the ROC. Right guys, we had learned that 90 days is not minimum time. 90 days is maximum time. From the date on which we file with the ROC, from that day within 90 days, we have to file the prospectus with the ROC. What am I saying? From the date on which I file it with the ROC, from that day within 90 days, we have to issue it to the public. Okay, so we cannot issue to the public after 90 days. We have to issue it within 90 days. We cannot issue before filing with the ROC. We can issue only after filing with ROC, but after filing we have to issue it to the public within 90 days. So 90 days becomes my maximum time limit. Okay guys, then after this we had learnt about the expert statement. Remember, we had discussed that in the prospectus, if an expert statement is included, the credibility of the prospectus will increase. But if you want to include expert statement in the prospectus, then 3 conditions have to be fulfilled. Condition 1, expert has to be little independent guys. Only then his statement we can trust. So expert should not be involved in PFM. He should not be involved in promotion, formation, management. The same hint we had in the incorporation discussion also. So expert should not be engaged in promotion, formation and management of the company. Number 2, the expert's consent should be obtained. What consent? That that he's okay that his statement will be included in the prospectus. And number 3, the expert should not have withdrawn his consent before filing the prospectus with the ROC. Before that, he should not have withdrawn the consent. So yes, expert statement can also be included in the prospectus, but for that 3 conditions have to be fulfilled. Condition number 1, expert should be at least to some extent independent guys. That is, he should not be involved in the promotion, formation or management of the company. Like if he's a director of the company, he is involved in the management of the company. Now he can't become an expert and give expert statement, because his statement will be biased in the favor of the company. It will not be a genuine statement. So that is why the expert should be to some extent independent. He should not be involved in promotion, formation, management of the company. He should give his consent that yes, put my statement in the prospectus. And number 3, he should not have withdrawn the consent before we file the prospectus with the ROC. Before that, he should not have withdrawn his consent. Okay, only if all these 3 conditions are fulfilled, only then we can put the expert statement inside the prospectus. And in the prospectus, we also have to mention that yes, like this, we received expert consent and he has not withdrawn the consent. Very easy. So this was my discussion about the contents of prospectus, section 26. We spoke about dating of prospectus, the 4 boxes, the contents of prospectus, signing, approving, signing and filing the prospectus. Only after we file it with ROC, only then we should issue it to the public, but we should issue it within 90 days. And then we spoke about expert statement. Okay. Then we moved to section 27. Here we spoke about variation in the terms of the contract or objects in a prospectus. A very simple example we took in this discussion. We said that let's say a company has issued prospectus. Now in the prospectus, company has to write that what is the company going to do with the money. The company is raising money from the public, right? What is the company going to do with the money? So in the prospectus, company has written that company is going to use this money to do paper business. Now company use the money for paper business only. If you start using the money for any other purpose, company, that will be ultra virus. That is beyond your powers. Company, whatever purpose you've raised the money, use the money for that purpose only. Natural guys, normal reason. The public has given money to the company thinking that company will be using the money for paper business. Now don't deviate. Now don't divert the funds into other purposes. But we also discussed sometimes in genuine cases, company might want to use the money for some other purpose. It's okay, company. You can do that also. You can use the money for some other purpose, but for that, 4 conditions you have to fulfill. Condition 1, SR has to be passed. But this is a big, huge thing you are doing, company. So maximum possible participation is required. So don't do SR in general meeting and all. People will not even turn up. What you should do, company? Pass SR through postal ballot. Then we learned the details about this SR along with justification that why are we changing this business. Details plus justification. We have to put in 2 newspapers, one English and one vernacular newspaper in form number PAS1. Then the details about the change along with justification we also have to put on the company's website. And lastly, okay, let us say SR is passed. SR means what? The number of shareholders who vote in favor is at least 3 times the number of shareholders who vote against. So we might have shareholders who are voting against. Shareholders who vote in favor, they are called consenting shareholders. Shareholders who vote against, they are called as dissenting shareholders. We can't force the dissenting shareholders to accept this change. So dissenting shareholders have to be given an exit opportunity. Straight away come to this diagram. Exit opportunity means what? The promoters and the controlling shareholders. Promoters and controlling shareholders, these 2 people, they will buy the shares of the dissenting shareholders. They will give exit price and they will buy the shares of the dissenting shareholders. Dissenting shareholders, now you can leave from the company. So dissenting shareholders will be given an exit opportunity. They will be given a recall option, which means the dissenting shareholders, if they want, they can sell their shares to the promoters and the controlling shareholders, take money and leave. Now how much money should be paid? Who will decide? How to calculate? That is as per SEBI regulations. Okay guys, so come on, once again, we discussed about section 27. Here we learned, company, you've raised money from the public telling them that you will use the money for paper. Now use it for paper only. If you use it for any other purpose, it is beyond your powers, company. It is ultra virus, the company. But however, there are 4 conditions. If all the 4 conditions are fulfilled, then it's okay, company. You can use the money for other purposes also. Number 1, you have to pass SR. SR how? Only through postal ballot. Number 2, company, you have to give details about this change along with justification that why are you doing this change in 2 newspapers, one English and one vernacular. Then put the details about the resolution along with justification on the website also. And lastly, the dissenting shareholders, the shareholders who are not okay with this change, we have to give them an exit opportunity. Who will buy their shares? Promoters, controlling shareholders. Write both. Don't choose. I am not saying promoters or controlling shareholders. Write both. Promoters, controlling shareholders. Both will give exit opportunity to dissenting shareholders. They'll pay the exit price. They'll take away their shares and dissenting shareholders can leave the company. But there was a very important point in this discussion which I have put in this box below. See, company, okay fine, you can fulfill these 4 conditions and you can change your object. But listen company, the new object should never ever be buying or trading in equity shares of another listed company. 4 keywords. Your new business should never ever be buying or trading in equity shares of another listed company. Company, see, if you fulfill these 4 conditions, then okay fine, you can change the object. Okay fine, you said you will use the money for paper. Okay fine, you can use it for steel. But can your new object be buying in equity shares of another company? Sorry, that is prohibited. This is a prohibition, guys. This is a blanket prohibition, guys. There are no exceptions to this prohibition. Company, in no case, your new objective should never ever be buying or trading equity shares of another listed company. Okay, this was section 27. Most important point, postal ballot. Okay, and exit opportunity. Then we had learnt about section 29. We spoke about demat shares. We learnt if a company is making public offer, that is listed company, or if the company is an unlisted company, then the shares have to be in demat form only. Alright, as soon as demat form comes into the picture, Depositories Act 1996 has to be complied with. Very simple, guys. So if the company is making a public offer, that is, the company is a listed company, or if it is certain unlisted company, then in that case securities have to be in demat form only. For the company, if demat is not mandatory, then company, it's optional. It's up to you whether you want to keep the securities in physical form, whether you want to convert into demat form, up to you, your decision. But however, listed companies and certain classes of unlisted companies, for these two demat is mandatory. Then we learned in unlisted companies, all unlisted companies are getting covered. Public, private, both are getting covered. So it got a little confusing if you remember that listed companies, for them, okay, demat is mandatory. But if you are an unlisted company, for you also demat is mandatory. Then all companies demat is mandatory. So for whom demat is not mandatory? There are 4 companies. 4 companies are excluded from unlisted companies. If an unlisted company happens to be any of these 4, if an unlisted company happens to be any of these 4, for these companies demat is not mandatory. Which companies, guys? Nidhi companies, government companies, wholly owned subsidiaries, and small companies. So to conclude, if it is a listed company, for listed company, yes, demat is mandatory, no choice. If it is an unlisted company, now unlisted company we'll have to see, is it coming in these 4 companies or is it any other unlisted company? If it is any other unlisted company, for that also demat is mandatory. But if it is these 4 unlisted companies, then demat is not mandatory. Which 4, guys? Nidhi companies, government companies, wholly owned subsidiaries, and small companies. Perfectly clear? All of you crystal clear? Yes. This was section 29. For listed companies, demat is mandatory. Unlisted companies, if they come in these 4 categories, then demat is not mandatory. All other unlisted companies, demat is mandatory. And as soon as you hear demat, which law comes to your mind? Depositories Act 1996. Then we had learnt about advertisement of prospectus. You remember TBI Con Limited, this company's advertisement. I showed you the prospectus advertisement. So the company will create a short advertisement about its prospectus, and in that advertisement, salient important things from the prospectus will come in the advertisement. Apart from that, some content from the MOA will also come in the advertisement, like what are the objects of the company, what is the liability of the members, then what is the share capital the company is already having, then who are the signatories. Signatory is nothing but subscribers to the MOA. Then you know, right, every subscriber has to take minimum 1 share in the company. So each subscriber, how many shares he has taken in the company. And lastly, capital structure of the company. All this has to be written where, guys? In the advertisement section 30. So in the advertisement of the prospectus, all these matters from the MOA will be written in the advertisement. Then we had discussed 2 very important sections, section 25 and section 28. We had seen that a lot of confusion is possible between the two. So we had spent a lot of time discussing both these sections in class. We had also made comparative analysis. Remember, we had drawn tables, we had made comparative analysis between these 2 sections. Let me give you a quick revision of these 2 sections. So in section 25, what happens is, there's a company. Now this company has allotted securities to this issue house with a view that the issue house will then offer the securities to the public. So there are 3 people involved: company, issue house, and public. So company is first allotting securities to the issue house with a view that issue house will then offer the same securities for sale to the public. Okay, repeat one last time. Company is allotting securities to the issue house with a view that the same securities issue house will later offer for sale to the public. Now, when the company and issue house, when they do this deal between them, they will create one contract. On the basis of that contract only, all this will be done. But when issue house offers the securities for sale to the public, when issue house comes to the public, when any person offers to the public, they will have to prepare a document containing all the details, guys. That document which issue house is preparing while offering the securities to the public, that document will be deemed to be prospectus, as if prospectus issued by whom? As if prospectus issued by the company. We had seen that, why would a company do like this? Remember, company wants to escape from the company is trying to be over smart. Company is trying to escape from the prospectus obligations. No, company, you can't do that. When the issue house goes to the public, when the issue house offers the same securities for sale to the public, issue house will prepare one document. That document will be deemed to be prospectus, as if it is a prospectus issued by the company. Right, guys? So this was your main point in section 25. Once again, company is allotting securities to the issue house with a view that issue house will offer the same securities for sale to the public. When issue house is offering the securities for sale to the public, issue house will prepare one document. The document will be deemed to be prospectus issued by the company. Okay. Then we learned this deemed prospectus concept will apply only if out of two conditions, at least one condition is fulfilled. This last part over here, let me explain this to you. So basically I told you that there are only two possibilities. Possibility number one, when company allotted the securities to the issue house, that time issue house gave full consideration to the company. So if issue house gave full consideration to the company, issue house bank account is empty. So what issue house will do? Immediately, within 6 months itself, immediately they will offer the securities to the public and get money from the public. So first condition is that securities will be offered to the public within 6 months after the date of allotment. This is the first possibility. When the company allotted the securities to issue house paid full consideration to the company. Now they want money. So immediately, within 6 months itself, they will offer to the public. This is one possibility. The second possibility is that when the company allotted the securities to the issue house, that time issue house did not pay full consideration. Full consideration not received. In that case, issue house will go to the public aram se, guys, because their bank account did not become empty. They did not pay full consideration to the company. So they still have money in the bank account. No urgency for them. So they will not go immediately within 6 months itself to the public. They will take their own sweet time. So there are only two possibilities. Possibility number one is that when the company issued securities to the issue house paid full consideration. So in that case, within 6 months itself, they will go to the general public and offer the securities. Or second possibility is that issue house has not given full consideration to the company. So out of the two possibilities, any one possibility only will arise. Only then this document which issue house is giving to the public will be deemed to be prospectus. The deemed prospectus concept will apply. This whole section will apply only if out of the two possibilities, any one possibility exists. Either issue house has given full consideration, so therefore within 6 months itself they will hurry to the public, or with the issue house has not given full consideration. In that case, they will go to the public later. So either they are going to the public within 6 months or full consideration has not been received by the company. Okay. Then after this, all these points we had discussed. Then coming to section 28. Section 28, remember the LIC example, guys. Offer for sale by certain members of the company. Section 28, LIC example. Here what happens is, company has already issued shares to existing members. LIC example, if you remember, company was LIC. Member of the company was central government. LIC has already issued shares to the central government. Central government is existing member of the company. Now central government wants to offload the shares to the public through the company. The existing members want to offer their shares to the public through the company. So what will happen is, the existing members, they will authorize the company that company, see, we are already having your shares, we want to sell the shares to the public, so please do the needful. So the company will offer securities to the public, but will it be new shares, guys? No, they will be already existing shares which were already held by the existing members. So over here, the company is not raising any money. Whatever money public gives to the company will give it to the existing members. Remember guys, when central government told LIC that we want to do the offer for sale, LIC was, when LIC came up with the IPO, LIC was offering to the public securities but not new securities. LIC was offering to the public the securities which were held by the central government. So whatever money we gave to LIC did not keep it. LIC gave it to the government. So because of the whole deal, who made money? Not LIC. It is the government who made money. It is the existing members who made money. Understanding guys? So existing members propose to offer to the public. The existing members, they want to offer to the public whole or part of their shareholding, but not directly through the company. In our example, in our LIC example, central government did not offer all their holding to the public. No, central government offered to the public only part of their holding. So it can either be whole or part of their shareholding. Understanding guys? Existing members of the company are offering to the public whole or part of their shareholding in consultation with the board. So the members will authorize the company that please sell our shares on our behalf, but don't worry, whatever expenses you incur for this, we will reimburse the expense to you. So company will do all the hard work. Company will come up with this public offer. Company will offer the existing shares on for sale to the public. Company will offer the shares of the existing members to the public. Company will collect money from the public and then give it to the existing members. Now even over here, when the company makes an offer to the public, okay fine, they are existing members' shares, but company is making an offer to the public. So of course company will have to prepare a document. That document will again be a deemed prospectus. All the provisions of prospectus will apply to it as if it is a normal usual prospectus. This was section 28. So the main difference in 25 and 28 is, in section 28, company allots securities to the issue house with a view that the issue house will then allot these securities to the public, with a view that issue house will then offer the same securities for sale to the public. Okay, in section 28, the company has already given the shares to existing members. The existing members want to offload the shares, which means they want to get rid of their shares, either all the shares or some of their shares, but not directly to the public, through the company. So when existing members are offering their shares to the public through the company, this becomes an offer for sale under section 28. So when company offers a shares to the public, company will obviously prepare a document. That document will be deemed to be prospectus. Okay, and please remember, over here company is not making money. The entire money is going to the existing members only. Okay, then we had learnt about the different types of prospectus. Section 31 talks about shelf prospectus. Here we learnt shelf prospectus is a prospectus which has a shelf life, which means it has a validity of 1 year. But 1 year from when? You remember the keyword, 1 year from the date of opening of the first offer of securities. Remember guys, repeat again, 1 year from the date of opening of the first offer of securities. So it has a validity period of 1 year. In this 1 year, company can make any number of issues of securities it wants. Again and again, prospectus is not required. But every time company offers security, at least insurance memorandum, information memorandum, company has to prepare information memorandum in form number PAS2. At least this the company has to prepare. Right guys? So once again, whatever is the date of opening of first offer of securities, from the date of opening of the first offer of securities, from that day, for 1 year this prospectus will be valid. In this 1 year, the company may issue securities in as many tranches as the company want. Company can issue securities as many times as it wants. But again and again, in this 1 year period, again and again prospectus is not required. The same prospectus will hold good. But however, whenever the company makes an issue of securities in this period, at least information memorandum company should prepare. This information memorandum will contain details of whatever changes have happened in the company since the time the company issued shelf prospectus. From then till now, what are the changes that have happened in the company? Any new charges created, any change in the financial position of the company, all that will be written in the information memorandum. So any person who is subscribing to the securities in this subsequent offer, for that person prospectus will include both the shelf prospectus plus information memorandum. Both will be considered as a prospectus. And of course, yes, the information memorandum also has to be filed with the ROC, right guys? Then we had learnt about red herring prospectus, section 32, the most common type of prospectus. Here we learnt this prospectus is an incomplete prospectus. This prospectus is something which is used whenever the company follows the book building method. In the book building method, the price is decided dependent upon the demand for the securities. If the demand is high, high price we select. If the demand is less, less price we select. So book building is a method of discovering price. It's a price discovery method. Through the book building method, we understand what should be the price of the securities on the basis of the demand for the securities. So we learned that red herring prospectus is a prospectus which contains a prospectus which does not contain complete particulars about two things. It does not contain complete particulars about the quantum of securities and the price of securities. Keyword. It does not contain complete particulars of quantum of securities and price per security. Please don't oversimplify this. Then we learnt whenever the company prepares a red herring prospectus, two prospectus it will prepare. First is red herring prospectus, incomplete prospectus. It will issue this prospectus. On the basis of this prospectus, public will subscribe, public will submit share application form, pay the share application money and all. Now on that basis, the company will be able to understand the demand for the company securities. Then the company will close the issue. Once the issue closes, now the company will be able to understand how much demand is there. On that basis, company will be able to determine the price, company will be able to determine the number of securities. Once all the particulars are ready, the final prospectus will be prepared. This will be a complete prospectus. Whatever information was missing in the red herring prospectus, whatever information was incomplete in the red herring prospectus, everything will be completed in the final prospectus and it will be filed with both ROC and SEBI. Right guys? So in red herring prospectus cases, company will prepare two prospectus. First, the company will prepare red herring prospectus, which is an incomplete prospectus. It does not contain complete particulars of price and quantum of securities. Then why has the company issued incomplete prospectus? Because company is following the book building method to discover the price. So company will not mention a price in the prospectus. Company will only mention a price range. Remember guys, on Grow, I had shown you so many IPO examples relating to this. Then I told you after this that once red herring prospectus is issued, on that basis public will subscribe. Then once the whole issue is closed, once a company has decided what is the demand, what is the price, what should be the quantum, once all the information is decided, once the issue is closed, then the company will prepare a final prospectus containing all the details, and red herring prospectus, final prospectus, both will be filed with ROC and SEBI. Coming to our next discussion now, abridged prospectus, which is covered in section 33. Now abridged prospectus means a memorandum containing salient features of a prospectus. Keywords guys, memorandum containing salient features of prospectus. If you remember, even for TBI Con, I had shown you the abridged prospectus. I had told you that it's very difficult for a common man to read a 600 pages, 700 pages prospectus. So people end up investing in shares or subscribing for shares without even reading the prospectus, because 700 pages looks like a very big document to read. So therefore, we have the concept of abridged prospectus, wherein the entire prospectus is summarized into 6 to 10 pages, hoping that much at least the common man will read before subscribing to the securities. And this abridged prospectus is attached to every application form. Alright, but however, we had learned that if the company is not offering securities to the public, or if company is offering securities to the members, or if the company is issuing the application form to the underwriters, in such cases abridged prospectus is not required. And we had also learned on the basis of abridged prospectus, if any person requests the company for the full prospectus, we have to give to that person the full prospectus. But the most important key point over here is it is a memorandum containing salient features of a prospectus, which means it is a summarized version of the entire prospectus containing the main points, hoping that much at least people will read before investing in the company. Okay. Then we had a very important discussion relating to misstatement in prospectus. We said that the prospectus is the only mode of communication between the company and the general public. The general public will decide to invest their hard-earned money in the company's shares only dependent upon what is written in the prospectus. So that is why prospectus should contain correct information, complete information. It should not contain any misstatement. It should not omit important facts. It should be complete. It should be correct. It should be true. It should not be misleading. Then at this stage, I had also connected the Indian Contract Act, which you learned in CA Foundation, with that misstatement concept. Remember, I told you that in Foundation you learned that silence is not fraud, but in prospectus cases, silence is equal to fraud because company has a responsibility to disclose all the details. If the company hides important information or if the company conceals material facts, then it will be considered as misstatement in prospectus. The prospectus will be considered to be misleading, and there are severe consequences. So two sections we learned under misstatement, section 34 and section 35. In section 34, I had given you three keywords, guys. ICD, right? So prospectus has been issued, circulated, distributed. Prospectus has been issued, circulated and distributed, and either it contains an untrue statement or it contains an omission because of which the prospectus has become misleading. Then who will be punished, guys? Every person who authorized the issue of prospectus will be punished under which section? Under section 447. Come on, again, prospectus is issued, circulated, distributed. Either it contains an untrue statement or it contains an omission because of which prospectus has become misleading. Then every person who authorized the issue of prospectus will be punished under section 447 because we are treating it like fraud. 447, what is the punishment? Imprisonment, minimum 6 months, maximum 10 years, and how much fine, guys? Fine up to 3 times the amount of fraud. We discussed all this in so much detail in class, not going more in detail now, just giving you a revision of the main point. Prospectus is issued, circulated and distributed. Either it contains an untrue statement or it contains an omission because of which prospectus has become misleading. Who will be punished? Every person who authorized the issue of prospectus. What will be the punishment? 447. What is 447 punishment? Imprisonment or fine? Imprisonment and fine. Imprisonment and fine. Imprisonment minimum 6 months, maximum 10 years. Fine minimum is the amount of the fraud, maximum is 3 times the amount of the fraud. But however, this person who authorized the issue of prospectus, he only is punished under section 34. This person will escape civil liability. He will not be punished if he proves either omission was immaterial or if he proves that he had a reason to believe and he did believe that the statement was true. See, guys, very simple. Criminal liability will come into the picture. Either there is an untrue statement or there is an omission, guys. So if this person proves, okay, there is an omission, but omission is not material. Or if this person proves, okay, there is an untrue statement, but I believed it was a true statement. I did not know it is an untrue statement. If he is able to prove that he did not have a guilty mind, if he is able to prove that he did not do this purposely, then he will be able to escape punishment. Either he should prove, okay, there is an omission, but it is not a material omission, or he will prove, okay, there is an untrue statement, but I did not know it is untrue. I had a reason to believe and I believed it is true. I didn't know it is untrue. If he proves one out of these two things, he will not be punished. This was section 34. Then we learnt about section 35, civil liability. In civil liability, we learnt that company will be liable and 5 people will be liable. Company and 5 people will be liable. This entire group will be liable to whom? To that person who read the prospectus, relied upon the prospectus. Which prospectus? Misleading prospectus. Relying upon the misleading prospectus, that person subscribed to the company's securities and suffered a loss. Keyword subscribed, not purchased. He subscribed, which means he directly got the shares from the company. See, let us say company allotted shares to A. A sold the shares to B. B cannot sue under section 35. Under section 35, only subscriber can sue. Subscriber means a person who directly got the securities from the company. Okay, so under section 35, company is liable and 5 people are liable. They are liable to whom? To that person who read the prospectus. Which prospectus? Misleading prospectus, relied upon that prospectus and subscribed to the company's securities and therefore suffered a loss. So for that loss, company and 5 people will be liable. So company and 5 people, they have to compensate that person for that loss. Okay guys, got it? Now who are the 5 people? Number 1, every director. Number 2, persons who have authorized themselves to be named in the prospectus as director. Remember this, I had connected with companies to be incorporated. It is not incorporated till now. It's going to be incorporated. Any person who has given written consent to the company that yes, I am willing to be appointed as your director, that person will get covered over here. Then every promoter of the company, then every person who has authorized the issue of prospectus, same like section 34, and expert. Totally 5 people. So company and these 5 people, they will be liable to compensate every person who subscribed to the securities relying on the misleading prospectus and suffered a loss. For that loss, company and 5 people have to compensate that subscriber. Okay guys, then we had learned under section 35 also, you can escape liability if you are first point is relating to directors. You earlier gave written consent that you are willing to be appointed as director. Later, you withdrew your written consent, which means you are not a director. If you are not a director, you should not be punished. Then number 2, any of the 5 people, they can say that the prospectus was issued without our knowledge. We didn't even know that prospectus was issued, and as soon as we came to know that the prospectus was issued, immediately we gave a reasonable public notice. So if they are able to prove that, again they will not be punished under section 35. Then thirdly, if the misstatement is in the expert statement, punish the expert. Why are you punishing the remaining 4? This was a third exception. So these are all exemptions from liability wherein you can escape from the civil liability. Okay. Then we had learned that the whole burden of proof is on the allottee, that is on the subscriber. He only has to prove that there was a misstatement, that the misstatement was material, he relied upon the misstatement and he suffered a loss. The whole burden of proof is on the allottee, not on the company. Okay. Then we learned about section 36. In section 36, we had spent a good amount of time, guys. We had seen so many practical examples. Remember that Hemant Ghai case. Then we had seen the CNBC Avas case, that BTST, buy today, sell tomorrow, all that we had discussed under section 36. So I'll give you a quick summary of section 36. Here there is a person. This person is making a statement, promise, forecast, SPF. He is making a statement, promise, forecast. Again, he is making a statement, promise or forecast, or he is concealing any fact. But why is he doing this, guys? Because he is trying to induce you to enter into an agreement to acquire securities. Like for example, I'll give you one example. He is giving a promise to you. He is telling you, listen, give me 1 lakh rupees, I will definitely make sure you get allotment in IPO. So he is making a promise to you and he's promising you that he will get you an allotment in IPO. Nobody can guarantee allotment in IPO like that. So he is giving you a false promise so that you enter into an agreement with him to buy securities. Or he's telling you, he's making a forecast. He's saying you watch and see, you wait and see, buy this particular company's shares, buy A Limited shares. You see in 3 months 1000% return you will get. Like that, he's making a forecast. He's predicting something. Why? Because he is thinking, if he predicts like this, if he tells you 1000% return you will get like this, if he forecasts, he's thinking that you will enter into an agreement through which you will try to make profit or you will try to make profit because of fluctuation. You will think, okay, I'll buy today, then I will sell at 1000% profit later. You will enter into that agreement. So to induce you to enter into that agreement, he is making a false forecast to you. Or let's say he is giving a statement to the bank with wrong numbers just to make the bank give him a loan. He's giving a statement, an incorrect statement to the bank so that the bank gives him credit, so that the bank gives him loan. All of these are clear-cut cases of fraud, guys. Obviously, 447 punishment will apply. He is making a statement, promise or forecast, or he is concealing any material facts to make you enter into an agreement to acquire securities, or to make you enter into an agreement to secure profit because of fluctuation in prices, or to make you enter into an agreement relating to credit facilities. Okay, then we had learnt about section 37. This was where we had spent a good interesting time we had over here, guys, where the whole Satyam scam we had discussed, right? In section 37 we had learnt that if you want to file a case under section 34, 35 or 36, okay, then let's say company gave a misleading prospectus. So because of the misleading prospectus, it is not like only one person will get affected, guys. Because of misleading prospectus, the entire group of subscribers will get affected. So all the subscribers, one by one, should they file independent case against the company? That will be pointless. So the subscribers who are suffering because of the misleading prospectus, they can form a class. You remember, class action suit. Class means a group of people. So all the subscribers can form a class, and together they can take action against a company. Together they can take legal action against a company. By filing a class action suit, good for the subscribers also, otherwise each of them will have to file one by one individually. Good for the courts also, lesser number of cases. Class action suits. We had learned that Companies Act 2013 for the very first time allowed class action suits, right guys, in class. But then here we had a very important point. I'm not sure if you remember, we had focused a lot on this word affected. We said that only a person who is affected because of the misleading statement, only a person who is affected because of the misstatement can file this class action suit, which means same thing guys, you must be a subscriber, you should not be a purchaser. Just now in section 35 I told you, no, you should be Mr. A, not Mr. B. You should be a subscriber and not purchaser. Only then we can say that you are affected because of the misstatement. Okay, then we had learnt about section 38. Here we had learnt about punishment for personation for acquisition of securities. We said that if you submit application form, share application form in a fictitious name, or if you submit multiple applications in different permutations and combinations of your name, so that your chances of getting allotment in an IPO increases, then in such cases you are going to be punished under section 447. Simple section guys, section 38, you are submitting share application form in a fictitious name, or you are submitting multiple application forms in different permutations and combinations of your name, hoping that your chances of getting allotment in the company's IPO increases. So here you will be punished under section 447. Then we had learnt about fraud. The whole definition of fraud, we concised it and learnt in a very easy manner in the form of this flowchart. Remember, fraud includes, it was an exhaustive definition, not means, includes. It includes 4 things: any act, omission, concealment of any fact or abuse of position. Again, any act, omission, concealment of any fact or abuse of position. Who is doing this? Any person. Why is he doing this? To deceive or to gain undue advantage or to injure the interest of whom? Company shareholders, creditors or any other person, whether or not there is any wrongful gain or wrongful loss. This was the whole meaning of fraud. Fraud includes any act, omission, concealment of any fact or abuse of position by any person to deceive, to gain undue advantage or to injure the interest of the company shareholders, creditors or any other person, whether or not there is any wrongful gain or wrongful loss. Here we had discussed that all this was easy. What does this mean? This means that if I have an intention to cheat you, whether you actually got cheated or not, whether I made a profit or not, whether you suffered a loss or not, that doesn't matter. What matters is I had an intention to cheat you. Whether there is wrongful gain or wrongful loss doesn't matter. Because of the fraud, whether I made unfair profit or because of fraud, whether you suffered unfair loss, doesn't matter. What matters is I had an intention to cheat you. What matters is I didn't act with an intention to deceive you. That is fraud. Now, if there is fraud, what is the punishment? Punishment is in section 447. It depends upon the value of the fraud. If the value of the fraud is below the threshold, then fine 50 lakhs or imprisonment 5 years or both. If the value of the fraud is equal to or more than the threshold, then what we just now saw, imprisonment and fine. Imprisonment minimum 6 months, maximum 10 years. Fine is minimum the amount of the fraud, maximum 3 times the amount of the fraud. But if in the fraud public interest is involved, everything else will remain the same. Only thing is imprisonment will not be minimum 6 months. Imprisonment will be minimum 3 years. Then we had learnt about section 39, a very important section again relating to allotment of securities. This section applies only and only to those cases of allotment which apply to public offer. In private placement, allotment will happen, section 39 will not apply. Rights issue allotment, section 39 will not apply. Section 39 will apply only when there is allotment relating to a public offer. So company is making a public offer on the basis of prospectus. In those cases, allotment will happen. That is where section 39 will apply. First of all, what do you mean by allotment? Here we had learnt that allotment means company is accepting your offer. One whole sequence we made. Remember, prospectus is invitation to offer. Then your share application form is offer, allotment is acceptance of the offer, right guys? CA Foundation, lot of connections we can make between prospectus chapter and your Indian Contract Act. So in prospectus is invitation to offer, your share application form is offer. When company allots the shares to you, that is company's acceptance of your offer. In allotment we learned new shares, untouched shares, unappropriated shares company is giving to you. So company is making an appropriation out of unappropriated capital, which means new shares, untouched shares, they are not second hand shares, new shares company is giving to you. Here we learned reissue of forfeited shares. Okay, company is directly issuing the shares to you, but they are not new shares guys, they are forfeited shares, so therefore their section 39 will not apply. Then we learned that under section 39 there are two main points. One is minimum subscription and the other is share application money. Minimum subscription, how much will be the minimum subscription? Minimum 90% of the number of shares issued. It is 90% of the number of shares. Like if the company is making a public offer of 1 lakh shares, then minimum 90%, minimum 90,000, minimum 90,000 shares the public should be willing to take up. Okay, so if the company is receiving share application form for 90,000 shares, then you can say that yes, company has reached minimum subscription. Now within how much time company should reach minimum subscription? Within 30 days from issue of prospectus, company should reach the minimum subscription. What if the company doesn't reach minimum subscription within 30 days? Then within the next 15 days, company should refund the money. If the company does not refund the money, then 15% interest will be applicable. At 15% interest, company will not pay. Directors and officers in default, they will be liable to pay. This was a minimum subscription point guys. See, listen carefully, I'll repeat again. First of all, what is the minimum subscription amount? Companies Act is not saying the 90% number. Beware, the 90% number is set by SEBI regulations, and whatever is the minimum subscription number, it should be written in the prospectus. As per SEBI regulations, it is 90% of the number of shares issued. So if we have offered to the public 1 lakh shares, then we must get share application form for minimum 90,000 shares. If the public subscribes for at least 90,000 shares, then we can say that yes, we have reached minimum subscription. But if the public is giving us share application form for less than 90,000 shares, then we did not reach minimum subscription. If we don't reach minimum subscription within 30 days, we'll have to refund guys. We'll have to refund whatever money we have received, we'll have to refund within 15 days time. If we don't refund within 15 days time, 15% per annum interest we'll have to pay. Company will not pay. Who will pay guys? Directors and officers in default will pay. So this was my entire point relating to minimum subscription. Similarly, the second important point in allotment is application money guys. Application money, see, whenever the company receives share application form, that share application form will be valid. Are you listening to me? That share application form will be valid only if with the share application form, company receives share application money. If company receives share application form without share application money, that application itself will be invalid. Point number 1. Point number 2, how much share application money we should receive? As per Companies Act, minimum 5% of face value. As per SEBI rules, minimum 25% of issue price. Both the numbers we have to remember. Then we learnt once the company finishes the allotment, within 30 days, company will have to file return of allotment in form number PAS3 with the ROC. Return of allotment, form number PAS3 within 30 days. Okay. So 3 points we learnt over here, meaning of allotment. Then under the restrictions we learnt 2 points. One was minimum subscription, one was application money, and now we spoke about return of allotment. Then after this we learnt that there are some cases which are coming under irregular allotment. Like for example, if the company did not even issue a prospectus, company made public offer without issue of prospectus, and in that case if the company allots securities, it will be irregular allotment. Or in the prospectus, if company is not writing all the details, or if the company is not filing prospectus with ROC, or minimum subscription is not received, application money is not properly received, in all such cases if the company makes an allotment, it is called as irregular allotment. Then we had a very important discussion again under section 40. Section 40, here remember we had discussed it practically. We spoke about in principle approval, final approval, all that terminology we had learnt, but then we said not to write it in our examination because that is SEBI terminology. So what is the whole concept? The concept is that whenever the company is making public offer, the company will first submit application form to recognized stock exchange, asking permission that please can we list our securities on your stock exchange. Section 40 will apply to companies which want to get listed. They will first of all submit a listing application to one or more RSE. One or more RSE means either to BSE or to NSE or to both. This was a keyword. You remember, one or more RSE. Okay, then company has to obtain permission. What kind of permission was this? This was in principle permission, which means temporary permission company will receive from the stock exchanges. Then the company will make the public offer, the company will receive the money. But whatever money is received, company has to keep that money in a separate bank account. Company should not use that money. Company has to get the final approval from the stock exchange. Only then the company can use the money. Right guys, so section 40 said, and one more important point that section 40 said is, if you have made application, let's say in both the stock exchanges, you can proceed with the allotment and all only if you get permission from both the stock exchanges. If you don't get permission from even one stock exchange, you can't proceed. See, if I made application only in BSE, I need permission from only BSE. If I made application in only NSE, I need permission only from NSE. But if I made application in BSE and NSE, I need permission from both BSE and NSE. Only then I can proceed. Okay guys, if I made application in both the stock exchanges, if even one stock exchange doesn't give me approval, we can't proceed with the public offer. Okay guys, so this is section 40. So if the company is making a public offer, and if first of all the company has to submit listing application to one or more recognized stock exchanges, then company has to get temporary approval from all the stock exchanges wherever the listing application was submitted. Then the company will issue the prospectus, receive the money, but company can't use the money. Company will receive the money, allot the securities and all, but company cannot use the money. Company has to get final approval from the stock exchanges. Again, we need final approval from all the stock exchanges where we submitted the listing application. If we get the final approval, then we can start utilizing the money. If we don't get the final approval, we'll have to refund the money. Okay, so this was section 40. Most important point, don't forget guys, we need permission from all the stock exchanges wherever we have submitted the application. Okay, this was section 40. Then after this we had learnt about section 41 GDR. I'll straight away take you to my diagram. I had given you the example of Reliance Industries Limited. So Reliance Industries Limited, an Indian company, wanted to raise funds from foreign investors. Remember Luxembourg Stock Exchange example. So Reliance Industries Limited, on this side we had ICICI Bank, which acted as domestic custodian bank, and then here we had Bank of New York Mellon, which acted as the overseas depository bank. And so what happened was, Reliance issued shares, Reliance issued equity shares in the name of the overseas depository bank, but Reliance can't give the shares to overseas depository bank. Reliance will give the shares to ICICI. ICICI will keep the shares carefully. That is why it is called custodian bank, because ICICI doesn't own the shares. The shares are in whose name? The shares are in ODB's name. The ICICI bank is only going to safely keep the shares. So Reliance, step 1, they will issue equity shares in the name of the overseas depository bank, but the shares will be kept in the custody of the domestic custodian bank. As soon as the domestic custodian bank receives the shares, the domestic custodian bank will acknowledge to Bank of New York Mellon that yes, I have received shares on your behalf. Then the Bank of New York Mellon, on the basis of the value of these shares, they will issue GDR. Now GDR by themselves, it has no value. GDR derives value from the equity shares. That is why equity share is called as the underlying asset. So the overseas depository bank will issue GDR to the foreign investors. These GDRs may be listed, may not be listed. In our example, the GDRs were listed in the Luxembourg Stock Exchange. These foreign investors will then give foreign currency funds to GDR, to ODB, and ODB will keep its charges and it will keep its expenses and will remit the balance money to Reliance Industries Limited. Here we learned that the shares are in the name of ODB. GDR holders, they are only holding a piece of paper. They are not shareholders. So it is the ODB who is a shareholder. So they only will have voting right. But GDR holders do have an option to convert the GDR into shares. Once GDRs are converted into shares, then even the GDR holders will become shareholders and even they will get voting right. Right guys? So the Indian company will allot shares, will issue shares in the name of ODB, but will not give the shares to ODB, will give the shares to DCB. DCB, once they receive the shares, they will acknowledge to ODB that yes, we received the shares. ODB will issue GDR certificates to foreign investors, which may be listed, may not be listed. The GDR certificates may be issued as public offer, maybe by private placement, depends upon the situation. So ODB will issue GDR certificates. They will raise money from the foreign investors. Who will raise money? ODB will raise money because they will issue GDR and they will raise the money. This GDR will derive value from the equity shares. Once they raise the money, that money they will remit to Reliance. This was your whole GDR discussion. Then we learned section 42, private placement. Second last concept, don't lose your patience. Section 42. In private placement, the company is not offering securities to the general public. No. Here company is picking and choosing people. Company is offering securities only to those selected persons. Who is selecting the persons, guys? Board of directors. Who is giving the selected persons the offer? The company. Now if the company has to send the offer to that selected group of people, then what document company will send? Company can't send prospectus, because just now we learned prospectus is only when we are inviting offers from the public. Here we are not going to the public, we are going to a selected group of persons. So company still has to give them some document. That document is called as POCA, private placement offer cum application. This has to be sent in form number PAS4. Then we learned when the company is sending POCA, the POCA will be sent by name, which means it will not be mentioned like hey there or hi, how are you. It will not be written like that. On the POCA, the name of the person will be written like dear Mr. John or dear Miss Anushree. The name of the person will be written. Why? Because the offer is only for that person. That person cannot renounce it to anybody else. So therefore, it will not be written that hey, hi investor or dear investor. Like that it will not be written. POCA will be properly addressed. That person's name will be written, the person to whom we are giving the offer. Only that person can accept the offer, nobody else can accept the offer. In Contract Act language, it is specific offer. Okay, then we learned that the company will maintain a proper record of all the details relating to private placement, because once company sends POCA to that selected group of people, within 30 days, company has to file all the details with ROC. So company will keep a proper record of all the private placement details in form number PAS5. Okay, then we had learned about conditions. The first condition was really important. The first condition said that the offer can be made by the company to maximum how many people, guys? The company can make the private placement offer. Company can send POCA to maximum 50 people in a year or such other number as may be prescribed. Which means Act itself is saying according to me 50. But if anywhere else any other number is given, follow that number. Now anywhere else is any other number given? Yes. Where? In companies PAS rules 2014. What number is given? 200. So 50 or 200, what will apply now? 200 only will apply. But we discussed when we are counting 200, we will not count qualified institutional buyers. We will not count employees to whom we are offering ESOPs. Right, guys? But this 200 limit itself will not apply to NBFCs and housing finance company. This limit will get reset every year because this limit is per annum limit and this limit is per security. So in 24-25, for example, we can issue POCA to 200 people for equity shares, 200 people for preference shares, 200 people for debentures. So per security per annum the limit is 200. Okay, but what will happen if we give POCA to more than 200 people? Then what will happen? Then gone, Govinda only. What will happen, guys? What will happen if we give POCA to more than 200 people? Company, you've done a blunder, because company, listen, you are making a private placement. See, if you are making public offer, you can give offer to unlimited people. You are making private placement. So you can give offer to limited people only, to 200. If you give to more than 200 people, we will treat it as if it is public offer. Now suffer, SEBI rules will also apply, SCRA rules will also apply, as if it is a public offer, deemed to be public offer. Okay, then we learned that the company sending offer to that selected group of people. Now that group of people will send money to the company. When they send money to the company, they can send only by check, DD, banking channel, not by cash. And we also learned if there are joint holders, money should come from that person's account whose name is written first in the application. Then we learned if already private placement offers are existing, company first close the existing private placement offers, only then you can make more private placement offers. Then we had also learned that whatever money company receives from the specified persons, company has to keep that entire money in a separate bank account. Company cannot use the money. Company has to first allot the securities. Allotment should be completed within 60 days from receipt of the money. Within 60 days, if the company is able to allot, great. File return of allotment form PAS3 within 15 days. Be careful. Just now we learnt and came section 39. In section 39, you get 30 days time to file return of allotment. Public offer cases. In private placement cases, section 42, you get 15 days time only to file return of allotment. Okay. So once you receive the application money, company, within 60 days, what you should do? You should allot the securities, and then within the next 15 days, you should file the return of allotment in form PAS3. Then you can start utilizing the money. But if you don't allot within 60 days, then within the next 15 days, you should refund the money. If you don't refund the money within the next 15 days, then 12% per annum interest will apply, but not from 75th day. From the 60th day itself, 12% interest will apply. At this stage, I had given you an important comparison between section 39 and section 42. Remember, in section 39 for PAS3, you get 30 days time. In section 42, only 15 days time. In section 39, interest rate is 15% per annum. In section 42, it is 12% per annum. So, we had discussed the differences. Anyways, going ahead. Then we learned that company, listen, we are not saying private placement is secret. We are not saying it is confidential. But don't go around advertising it, because public will unnecessarily get confused, because anyways this is not for the public. So don't give public advertisements, don't market about it, don't advertise about it. Okay. Then we had also learned that whenever the company is making a private placement, a special resolution has to be passed, and to pass the special resolution, we have to call a meeting, guys. To call the meeting, we have to send notice. Along with the notice, we have to attach an explanatory statement containing all the details about the private placement. Then we had learned that SR, first we have to pass the SR. Sequence is like this. First we have to pass the SR, then we have to file the SR with the ROC, then only the company will issue the POCA to that specified group of people. Okay. Then we learned if it is non-convertible debentures, if it is within the limit, then BR is enough, SR is not required. But if it is more than the limit, then only SR is required. But every time we make a private placement, again and again SR is not required. For non-convertible debentures, in a year, one SR is enough. Same for QIB also. And no renunciation, I already told you. Okay. So this was your private placement discussion. Then comes underwriting. In underwriting, we had learned over here, we said that underwriting concept comes into the picture only when the company is making a public offer. Okay. Here company has a risk that what if I don't reach minimum subscription? Just now in section 39, we learned that if minimum subscription is not received within 30 days, then whatever money company has received, company has to refund it within the next 15 days, guys. So it's a big risk. So that is why the company will go to the underwriter. Underwriter will give a guarantee to the company that company, don't worry, you will reach minimum subscription. If you don't reach minimum subscription, if there is a shortfall, I will take that shortfall. Like that, underwriter will give guarantee. So he is taking a big risk. So because he is taking a risk, we will reward the underwriter by giving him underwriting commission. As per both versus New Africander Gold Mining Company, this underwriting commission can be in kind also, it is fine. Now, whenever the company is filing the prospectus with the ROC, along with the prospectus, copy of the underwriting contract also has to be filed with the ROC. In the prospectus, we have to mention who are the underwriters, how much underwriting commission are we going to give them, and how many securities have they underwritten. To pay underwriting commission, we need money. We can pay out of proceeds of the issue or out of the profits or both, but we can pay underwriting commission only if authorized by AOA. Most important point, max to max, how much commission can you pay? Max to max, how much commission you can pay? It depends. Is it shares or is it debentures? If it is shares, maximum we can pay 5% of the issue price, or whatever is the AOA rate, whichever is lesser. For debentures, 2.5% of the issue price or AOA rate, whichever is lesser. Point to be noted, the percentages are not percentages of face value, they are percentages of the issue price. Got it, guys? This was about underwriting, and finally we learned about the definition of securities. Companies Act, instead of defining securities, it refers us to section 2 clause H of SCRA. SCRA gives a big definition. In this entire discussion, in the revision, what I want to focus on are some specific points. Point number 1, securities is not just shares. It will also include debentures. It will also include derivatives. It will also include mutual fund units. It will also include government securities, but it will not include ULIP. Okay, guys. So this is it. With this, we've completed our entire revision on the prospectus chapter. So starting with a revision on our share capital chapter, we've completed the entire chapter. We've seen a lot of numerical questions, especially in this chapter. We've done a lot of practical examples as well. We've done cumulative revisions as well. So by now you would be sort of comfortable with this chapter, but still let me revise the whole chapter once again for you so that you have all the concepts in one place, and then comfortably we'll move on to the next chapter. So we had started this chapter with some very basic points, like for example, we had discussed about shares and debentures. We said that shares represent ownership interest, whereas debentures represent lender's interest. Then we discussed that the total share capital of the company, both equity and preference put together, the total share capital of the company is divided into small units, and each unit is called as a share. So share is nothing but small units of the share capital, and share also includes stock. Then we had learnt about what is the meaning of stock. We said stock is nothing but a bundle of fully paid up shares. So stock is nothing but a bundle of fully paid up shares. Then we had learnt about the differentiation between shares and stock. We said when I talk about shares, I talk in numbers. Like I'll say give me 5 shares or give me 10 shares. But when I talk about stock, I'll talk in amount. Like give me stock for 1000 rupees or give me stock for 10,000 rupees. That was the first difference. Second difference, originally company will issue shares only. Company can't originally issue stock. Originally it will be shares only. Later if the shares are fully paid up, if the company thinks it is required, it will be converted into stock. Then third difference, we had learnt that whenever the company is issuing shares, the shares may be fully paid up or the shares may be partly paid up, but only fully paid up shares can be converted into stock. So stock will always be fully paid up. And then we learned shares, like for example, if MRF share price is so high and if I can't afford it, can I buy half of a share? No, we cannot buy or sell shares in fractions, but stock, yes, we can buy or sell in fractions also. Then we had learnt about 2 case laws relating to the basics of share capital. One was New London and Brazilian Bank versus Brockle Bank, wherein it was decided that share is not money, it is interest which is measured in money. And then we have Borland's Trustee versus Steel Brothers and Company Limited, the same case law which we had also learned in the MOA AOA chapter. So this case law says that between the company and the shareholders, there are mutual covenants, which means there are rights and duties of members to the company and there are rights and duties of the company to the members. So there are mutual covenants between the company and the shareholders. And where are they written, guys? Where are these mutual covenants written? Where are these rights and duties written? In 2 places, in Companies Act and in the AOA. Then we learned about the different types of capital. This was covered in section 43. Section 43 says that there are 2 kinds of capital, equity and preference. But here we had learnt a formula. We said that if the company happens to be a private company and if it is mentioned in the MOA or AOA of the company, then to this company section 43 will not apply. Which means these kind of companies can have their own kinds of capital, guys. They can have a third kind of capital, a fourth, fifth, sixth kind. For them, they have their own creativity, they have their own freedom. These kind of companies, they are not bound by section 43. They can have any kind of capital. But generally, section 43, whenever it applies, section 43 says that there are 2 kinds of capital, equity and preference. Equity capital is also called as ordinary capital, also called as common capital, and equity shares can be of 2 types. Your normal equity shares wherein which carry the same voting rights, or equity shares with differential rights. So this part, equity shares, we'll discuss a little later. Let's focus on preference share capital first. Preference shareholders enjoy 2 preferential rights, guys. Number 1, whenever the company declares dividend, the company will first pay preference dividend at the fixed rate and only then the company will pay equity dividend, guys. Similarly, whenever the company goes into winding up, one of the steps in winding up is liquidation. In the liquidation step, whatever assets the company has, company will utilize the assets to repay the liabilities. Even after repaying the liabilities, if the company is still left with assets, first of all, we call them as surplus assets. The company will use the surplus assets to first repay the preference share capital. Only after repaying preference share capital, if the company is still left with surplus assets, only the balance surplus assets will be to repay the equity capital. So preference shareholders enjoy 2 preferences. Number 1, preference dividend is paid to them first, and number 2, they get repayment of preference capital first. Then we spoke about the different kinds of preference shares. First of all, we spoke about participating and non-participating preference shares. Let's talk about participating preference shares first. These participating preference shares, guys, they are preference shares. So therefore, definitely they will enjoy these 2 benefits. They'll anyways enjoy. Apart from these 2 preferences, participating preference shares enjoy extra benefit. What is this extra benefit? Extra benefit means they anyways have these 2 preferences. In addition to that, they have 2 extra benefits. What are these extra benefits? Number 1, whenever the company declares dividend, okay, the company will first pay preference dividend dividend at the fixed rate, then the company will pay equity dividend at a certain rate. Generally, entire balance profits are for the equity shareholders only. But if the preference shares are participating preference shares, in the surplus profits of the company, the equity shareholders will anyways participate. The participating preference shareholders will also participate. So participating preference shares are getting an extra right. Not only will they get fixed preference dividend, but they will also participate along with the equity shareholders in the surplus profits. Similarly, when the company is winding up, when the company has surplus assets, company will first repay preference capital, then the company will repay equity capital. Generally, the entire balance surplus assets, after paying the preference capital, the entire balance surplus assets are for the equity shareholders only. But if the preference shares are participating preference shares, once a preference capital is repaid, once a equity capital is repaid, if the company is still having any surplus assets, in that equity shareholders will anyways participate. Even the participating preference shareholders will participate. So participating preference shareholders, to conclude, they have two extra rights, and that is they participate along with the equity shareholders in the surplus profits of the company. They participate along with the equity shareholder in the surplus assets of the company. Okay, but however, what about non-participating preference shares, guys? They will not have extra right, which means they just have to be satisfied with their preference dividend and with repayment of preference capital. Non-participating preference shares will not participate with the equity shareholders in the extra profits and extra assets. Okay, but what if nothing is mentioned? If nothing is mentioned, by default, all preference shares, by default, they are non-participating preference shares. This was held in the case of Scottish Insurance Corporation Limited versus Wilsons and Clyde Coal Company Limited, that by default preference shares are always non-participating only. Then we learned about cumulative and non-cumulative preference shares. The word cumulative comes from the word accumulate. Cumulative comes from the word accumulate. And what does accumulate mean, guys? Accumulate here refers to, in case company did not pay preference dividend in one particular year, let us say company was having losses, it didn't pay preference dividend. So company is having arrears of preference dividend, guys. Now if the preference shares are cumulative preference shares, this arrears of preference dividend will keep getting accumulated, which means we will wait and see that in the future, some year at least, company will make profit. So in the subsequent year, when the company makes profit, that profit will be used to first repay this arrears of dividend of the earlier years. So if the preference shares are cumulative preference shares, and if the company did not pay preference dividend in 1 year, the shareholders are not worried, because the arrears of dividend will keep getting accumulated, hoping that in the subsequent year, when the company makes profit, that profit will be used to pay off this arrears of dividend. But however, if your preference shares are non-cumulative preference shares, non-cumulative indicates that here the arrears of dividend will not accumulate. In non-cumulative preference shares, if the company did not pay preference dividend, that's all, guys. The arrears of dividend will simply lapse. There is no question of accumulating, no question of paying later and all. If the preference shares are non-cumulative preference shares, arrears of preference dividend will simply lapse. Now again the same question arises, what if nothing is mentioned? If nothing is mentioned, then preference shares will be considered to be cumulative only. By default, preference shares are cumulative, and this was held in the case of Staples versus Eastman Photographic Material Company Limited. Then we discussed that there are two more types of preference shares, redeemable and irredeemable, but companies are prohibited from issuing irredeemable preference shares. So preference shares will always be redeemable only. This we'll cover a little later in section 55, guys. Then we discussed that if the company wants to issue preference shares, then three conditions have to be fulfilled. Condition number 1, it has to be authorized in the AOA. Condition 2, to issue preference shareholders, to issue preference shares, we don't need permission of preference shareholders. To issue preference shares, we need permission of our equity shareholders. A prior special resolution is required. And the third condition is that there should not be any subsisting default relating to preference shares or payment of preference dividend. There should not be any subsisting default. Here I had explained to you the significance of the word subsisting. Subsisting means today when the company is issuing preference shares, today defaults should not be existing. In the past, if defaults were existing and if the company has rectified those defaults, then today company can issue preference shares. There should not be any subsisting default, means today default should not be existing. If in the past there was a default and if it got rectified, then not a problem, company can issue preference shares. So come on guys, once again, what are the three conditions? Condition number 1, if the company wants to issue preference shares, it should be authorized by AOA. Number 2, we need permission of our equity shareholders in the form of an SR. And number 3, there should not be any subsisting default relating to redemption of preference shares and payment of preference dividend. Okay, these were 3 conditions. Then under preference share capital, one more point we had learned, can the company have just preference share capital? No, company needs to have equity capital. So either company can have just equity capital or company can have equity plus preference both. But can the company have just a preference? No, that is not allowed. So this was our discussion relating to preference shares, guys. We spoke about the two preferential rights that they enjoy. We spoke about the different types of preference shares, the three conditions, and can the company have only preference share capital? We discussed no. Company, you need to have both. Either you need to have both equity and preference, or you need to have just equity. But can the company have just a preference? No, that is not allowed. Alright guys, now coming to our discussion on equity shares. So we've completed discussion on preference shares. Talking about equity shares now, we just learned that equity shares are of two types. Either they may have the same voting rights or they may have some differential rights. Now when I say differential rights, the different rights are relating to what? The differential rights may be different rights relating to either voting or dividend or both. Now there is one misunderstanding which students generally have over here. Students think that equity shares with differential rights means they are getting less voting right. It is not necessary, guys. Equity shares with differential rights means that these shareholders, their voting rights and their dividend rights are different. Now different can mean more also, different can mean less also. So equity shareholders with differential rights means shareholders where they are having different rights. The voting right and the dividend right is different. Can be less also, can be more also. It is not necessary that equity shares with differential rights will always have less voting right only. It is not necessary. They can have more voting right also, because different means less also, more also. Right guys? So if the company wants to issue equity shares with differential rights, 7 conditions have to be fulfilled. The first condition is that it has to be authorized by AOA. The second condition is that we need the permission of our existing equity shareholders in the form of an ordinary resolution. If the company is a listed company, this OR will be passed by way of postal ballot. If it's an unlisted company, this OR will be passed at the meeting. Then we discussed that these equity shares with differential rights, maximum they can have only 74% of the total voting power. It cannot be more than 74%. We had also discussed the reason for this. We discussed that if it becomes 75%, then equity shares with differential rights, they alone will be able to pass SR. Remember, but we don't want to give these shares power that they themselves can pass SR. That much power we don't want to give them. So that is why they cannot have 75% voting power. They can have maximum 74% voting power only. Then our fourth condition was this one. We said that we will look at the last 3 years. In the last 3 years, financial statement, annual return. Company in the last 3 years, in each of the 3 years, at least one you file. In each of the 3 years, at least one has to be filed, guys. Like for example, in this case, at least one is filed in each year, guys. Then in year 4, company can issue equity shares with differential rights. In the last 3 years, if there is any year in which company has neither filed financial statements nor filed annual return, then gone, in year 4 company you can't issue differential rights shares. So the fourth condition says, company listen, we will see last 3 years. In last 3 years, each year financial statement or annual return, at least one you file. In the last 3 years, if there is a year in which you have not filed both, then in year 4 you cannot issue equity shares with differential rights. Then my fifth condition was, again I will look at the last 3 years. Company should not have been penalized for any offence relating to SEBI Act, SCRA, FEMA and RBI Act. And then we said the sixth point. In the sixth point we said, company, please don't commit defaults. What defaults, guys? Company, you should not default in repayment of term loan to 3 people: public financial institution, PFI, SFI and scheduled bank. And company, you should also not default in paying interest on these loans. You should not default in statutory payment relating to employees. You should not default in payments to be made to IEPF, and you should not default in preference dividend. Totally 5 things. There should not be any default in repayment of term loan to PFI, SFI and scheduled banks, interest on the term loans, then statutory payments relating to employees, amount to be credited to IPF, and lastly preference dividend. What if there is a default? Company, listen, if there is a default, you can't issue equity shares with differential rights. You first rectify the default. After rectifying also, immediately you can't issue these shares. After rectifying, we will see what is the end of the financial year of rectification. To that date, we will add 5 years. Till that date, you can't issue equity shares with differential rights. Only after that, you can issue equity shares with differential rights. Which means, company, if you've committed this default, you can't issue equity shares with differential rights. You first rectify, and after rectifying, we'll see what was the year in which the rectification happened. What is the end of the year plus 5 years. Till then, company cannot issue equity shares with differential rights. After that only company can issue. Point to be noted, guys, 5 years are calculated not from the date of rectification, but 5 years are calculated from the end of the year of rectification. Okay, so but don't forget, here 3 years, but here 5 years. Okay, and the last point, there should not be any subsisting default. You know what is subsisting default? There should not be any existing default relating to D for dividend, D for deposits, D for debentures. Wherever we talk about debentures, we'll also talk about preference shares. So there should not be any subsisting default relating to payment of dividend, relating to repayment of deposits, redemption of debentures and redemption of preference shares. Totally there are 7 conditions, guys. Company, you have to fulfill all the 7 conditions, only then you can issue equity shares with differential rights. Then we learnt if the company is issuing equity shares with differential rights, and to these shareholders, if the company is announcing bonus shares or rights shares, even bonus shares and rights shares will be of the same class, which means even they will carry differential rights. Then the company cannot convert normal shares into differential shares and differential shares into normal shares. That conversion is not allowed. Then proper disclosure has to be made in the board report about this issue, and when the company is maintaining the register of members under section 88, in that register of members all the particulars about these kind of shareholders also has to be written. So this was a discussion regarding equity shares with differential rights. Now comes our next section, guys, section 47, a very important section but a very simple section, the section which talks about voting right of shareholders. Now my shareholders are of 2 types, equity shareholders and preference shareholders. Preference shareholders, generally they don't get voting right. Preference shareholders can vote only in these 4 cases. What are the 4 cases? Number 1, all the matters which directly affect their right. Matters which directly affect their rights. For example, if I'm going to change preference dividend rate, or if I'm going to change the redemption period of the preference shares, I'm coming up with a matter which is going to directly affect the preference shareholders' rights. So in these cases, I will give preference shareholders the voting right. Then in winding up resolutions, equity shareholders also can vote, preference shareholders also can vote. Similarly, in reduction of capital, remember guys, reduction of capital, section 66. If in section 66, an SR has to be passed, remember. To pass this SR, we had learnt in section 66 as well, to pass this SR, equity shareholders, preference shareholders, both will vote, guys. And lastly, we discussed if for the last 2 years continuously, if the company has not paid any preference dividend for last 2 years continuously, then thereafter we will start treating the preference shareholders as if they are equity shareholders. That is, just like how equity shareholders can vote on all resolutions, similarly even preference shareholders in such cases can vote on all resolutions. Understanding? So preference shareholders generally, do they have voting right? No, but they do have voting right in 4 cases. What are the 4 cases? Number 1, all those matters which directly affect the rights of the preference shareholders. Number 2, matters relating to winding up of the company. Number 3, in reduction of capital resolutions. And number 4, if preference dividend has not been paid for 2 years continuously, then preference shareholders can vote just like equity shareholders on all resolutions. Then we discussed that if there is a matter on which equity shareholders and preference shareholders both have voting right, then both will share voting right in the same ratio in which equity share capital is to preference share capital. Guys, I hope you remember in this part especially we had done multiple numerical questions. If you remember, even that Sarvodaya Nidhi Company Limited, even that we had done, guys. I'll repeat once again, like for example, let us say there is a company which has equity share capital of 12 lakh rupees, okay, and it has preference share capital of 3 lakh rupees. Now what I'm telling you over here is in amounts. So 3 lakh rupees of preference share capital and 12 lakh rupees of equity share capital. Now if I am a shareholder, having 1,20,000 rupees of equity share capital, total equity share capital is 12 lakh and I am having 1,20,000 rupees of equity share capital. So my voting right is going to be 10%, guys. So if only the equity shareholders are going to vote, then my voting power is going to be 10%. But let's say there's a matter where both are having voting right. If both are having voting right, my voting percentage will reduce. If only equity shareholders are voting, I have 10% voting right. But if both will vote, then my voting power will reduce, guys, because we equity shareholders will now have to share our voting power with preference shareholders also. So our voting power will reduce. But it will be reducing in what ratio? See, if both are voting, the ratio of the votes will be in the same ratio that equity share capital is to preference share capital, that is 12:3, that is 4:1, guys. This indicates if only equity shareholders are voting, I am going to have 10% voting power in my example. But however, if equity and preference both are voting, then my voting percentage will reduce 10% into 4/5. That is, my voting percentage will now become 8%. So my voting percentage will be in the same ratio in which equity share capital is to preference share capital. Understanding? If only the equity shareholders are voting, I am having 10% shares of the company. So I'll have 10% voting power. But if equity and preference both are voting, then my voting power will reduce, because now equity shareholders have to share their voting power with preference shareholders also. So it will reduce and it will be in the same ratio in which equity share capital is to preference share capital, which means over here in the ratio 4:1. So 10% into 4/5, I simply applied the ratio, guys. If there's a matter in which equity and preference both are having voting right, then my voting power will be 8% only. Okay, then we spoke about equity shareholders. They can vote on every resolution. If voting is by poll, each share will get one vote, which means more the number of shares I have, more the number of votes I will get. But if voting is by show of hand, then one member will get only one vote. Then we discussed if calls are in arrear, I am still a member of the company, so I will still get voting right. But in the AOA, if it is mentioned no voting right, then no voting right. But if calls are in advance, will I get any extra voting right? No extra voting right and all. And we also discussed if the company is a Nidhi company, over here a shareholder can have maximum how much voting right. In Nidhi companies, a shareholder can have maximum 5% voting power only. Try to recall Sarvodaya Nidhi Urban Company Limited. Please mark that question. You have to see that question before your examination as well. Then we discussed about variation of shareholders' rights. Section 48 we learnt about. In section 48, what happens is we are saying that company will have multiple classes of shares, guys, like equity shares fully paid up, equity shares 9 rupees paid up, equity shares 6 rupees paid up, differential rights shares, 6% preference shares, 10% preference shares. Like this, company will have different classes of shares. Now each class of shares will have its own rights. The company wants to vary the rights of one particular class alone. What does the company want to do? Company wants to change the rights of one particular class alone. So first of all, we'll have to check that does the company have the right to vary or not. And where will we check that, guys? First, we will look at MOA and AOA. Try to recall your keywords. We will check does MOA, AOA, does it allow variation or not? If it allows variation, you can straight away go to step 2, guys. But if it doesn't allow variation, then you will not lose hope. You will look at the terms of issue. Terms of issue, what's a keyword? You will see does the terms of issue prohibit variation. If it prohibits variation, then you can't vary company. But if it is not prohibiting, then you can vary. So remember the keywords. I will first look at MOA, AOA. Does it allow variation? If it allows variation, I'll straight away go to step 2. But if MOA, AOA is not allowing variation, then I will look at the terms of issue. Terms of issue, does it prohibit the variation? If it prohibits the variation, then we can't vary. But if it doesn't prohibit the variation, then we will go to step 2. Now in step 2, listen, if you want to vary the rights of shareholders of one particular class, of course we need their permission, guys. So company has two options. Option 1, company can call a separate meeting of just those shareholders whose rights the company is going to vary, and company can ask them to pass a special resolution. Or option 2, company can ask the shareholders, no need to come for the meeting, stay where you are, just send me written consent. In that case, we need written consent of shareholders who are holding at least 3/4 of the shares of that particular class. So once we conclude that the company can vary, now we come to step 2. In step 2, company needs permission of the shareholders. Which shareholders? Only those shareholders whose rights we are going to vary. How many options company has? 2 options. Option 1, company can call a separate meeting of just those shareholders whose rights the company wants to vary, and company can ask them to pass an SR. Or company can ask for a written consent of just those shareholders whose rights the company can vary. What's the difference between these two? In the first option, we are asking the shareholders to come for the meeting and here pass the SR. In the second option, no meeting and all. We are not calling any meeting. We are telling the shareholders stay at home, just send us written consent. Okay guys, then sometimes what happens is that, let's say there's a class of shareholders and they're passing a resolution to vary their rights. Understandable, go ahead, you can do it. But sometimes what happens is this class is passing a resolution because of which the rights of another class will also get affected. So if that happens, of course, we need the permission of this other class also. In simple words, if the shareholders are passing a resolution to affect their rights, which will also end up changing the rights of another class, then we have to get permission of that other class also. Now listen, let us say company was eligible to vary the rights. Then company, asked the shareholders to pass this resolution and all that also was done. Resolution was passed, company varied the rights. But still, some shareholders will agree for the resolution, some shareholders will not agree, guys. The shareholders who vote in favor, they are called as the consenting shareholders, but the shareholders who voted against the resolution, they are called as dissenting shareholders, guys. So even though some shareholders voted against, but because SR was passed, because we got consent from shareholders holding 3/4 of the shares of that particular class, company will go ahead with the variation. But what about the dissenting shareholders? If the dissenting shareholders, the shareholders who are not okay with the variation, put together, if they are holding at least 10% shares of the company, then these dissenting shareholders, they will go to whom? They will go to NCLT. When will they go to NCLT? Within 21 days. Within 21 days from when? Within 21 days from the date of resolution. And what will they go to the NCLT and do? They will file an application. What application? Requesting NCLT, please cancel the variation. Then we learnt as soon as they go to the NCLT, immediately company will have to pause the whole variation. We'll have to wait and see when does the NCLT pass an order. If the NCLT passes an order saying company you can go ahead with variation, then we will resume the variation. But if NCLT passes an order company cancel the variation, no option, we'll have to cancel the variation. Here we had learnt two more keywords. We said NCLT's order will be binding and final, and whatever order NCLT passes, that order has to be filed with ROC also within 30 days. So this was the power given to dissenting shareholders, but dissenting shareholders will have this power only if put together they are holding at least 10% of the shares of that particular class. Then we learned that this whole section 48 will not apply in three cases. If it is cancellation of shares, we have a separate section altogether, section 61. Apply that, don't apply section 48. Similarly, if it's a case of reduction of share capital, we have a separate section for that, section 66. Apply that, don't apply section 48. And this was very interesting. You remember, if the company is issuing more preference shares, yes, it will affect the existing preference shareholders, but do we get their consent, guys, to issue preference shares in the company? No. So even if the company is issuing more preference shares, even if they are pari passu, even if they are equal to the existing preference shareholders, even if existing preference shareholders will be affected because of the issue of more preference shares, still this doesn't come under variation. We don't need the permission of the existing preference shareholders. We only need SR from the equity shareholders. Right, guys? So this was section 48. Section 48, remember the steps. First of all, we have to check whether the company has the right to vary or not. How will we check that? We'll check in the MOA AOA, does it allow variation? If it allows variation, great, company will go ahead and vary. But if it doesn't allow variation, we will not lose hope. We will look at the terms of issue. Does it prohibit variation? If it prohibits variation, company you can't vary. If it doesn't prohibit variation, company you can vary. Welcome to step 2. In step 2, we will ask permission from the shareholders of that particular class whose rights we want to vary. We have two options. Either call a meeting and ask them to pass SR, or no, don't come for meeting. Stay where you are. Stay at home. Just to send written consent. Then we learned because of this variation, if another class will also get affected, then we need consent of that other class also. And lastly, we learned about dissenting shareholders. Dissenting shareholders alone, will you answer correctly once again? Come on, guys. Let's do like a rapid fire question round. I'll keep asking questions. You keep giving answers. Dissenting shareholders. Question number 1. Dissenting shareholders should hold how many shares? They should hold at least 10% of the shares of that particular class. They will go to whom? NCLT. Within how many days? 21 days. 21 days from what? 21 days from passing the special resolution. And what will they do with NCLT? They will file an application. What application? Application to cancel the variation. As soon as they go to NCLT, what will happen to the company? Company will have to pause the variation. We'll have to wait and see what order NCLT passes. If NCLT passes an order allowing the company to continue with the variation, then we will resume. We'll go ahead with the variation. But if NCLT passes an order asking the company to cancel the variation, then we'll have to cancel the variation. And tell me the two keywords. NCLT's order will be binding and final. And lastly, NCLT's order has to be filed with whom? ROC. Within how many days? Within 30 days. Story over, guys. This was section 48. Then we learnt about section 49, which spoke about calls on shares. Here we had only one important point, which was about uniform basis. We'll come to that. Let's go point by point. First of all, in section 49, calls on shares, we know the meaning of calls, guys. Like for example, if it is a 10 rupees share but only 6 rupees is paid up, then shareholders still have the liability to pay 4 rupees. So when will the shareholders pay this money, guys? Whenever the company makes a share call. Share call is nothing but a demand which the company is making, asking the shareholders to pay this balance 4 rupees. Now here there are two options. Either the company can make a call, either the company can demand the entire 4 rupees, or the company can demand even a part of it. So share call is nothing but a demand made by the company asking the shareholders to pay the whole or part of the balance amount remaining unpaid on the shares. Okay, now listen, this share call, when can the company make this share call? At any time during the continuance of the company. We discussed even in winding up process, company is still existing. So that time also company can make a share call. But once the company is wound up, after that share call cannot be made. Till the company is existing, till then share call can be made. Then we learned company, whenever you make a share call, please make the share call on a uniform basis, which means in one particular class, if there are 10 shareholders, you can't ask one shareholder alone to pay 4 rupees and other shareholders to pay 2 rupees. Like that, it is not allowed. All the shares which are belonging to one particular class, a uniform call has to be made, which means all the shares belonging to one particular class, the same share call only has to be made. Here we had an important case law, guys, Galloway versus Hall Concert Society. Just because the directors are fed up of one particular shareholder, we can't ask him alone to pay the entire amount. See, if that one particular shareholder is belonging to a separate class altogether, then okay, we can make a separate share call. But if in his class there are other shareholders also, then all the shares belonging to that particular class, uniform call has to be made. Then we learned that whenever the company makes a share call, it's an indivisible debt. In simple words, whenever the company makes a share call, now the shareholder owes that money to the company, guys. Like for example, if the company is asking the shareholder to pay 10 rupees, okay, now the shareholder owes 10 rupees to the company. Out of the 10 rupees, let's say the shareholder is paying 6 rupees, he is paying to the company. That time, can the company say, no, pay 10 rupees or don't pay anything at all? No, the company cannot say that. Company, listen, whatever the shareholder is giving you, accept. You asked him for 10 rupees. He owes you 10 rupees. If he is giving you 6 rupees, you accept 6 rupees. Okay, fine, call the balance 4 as calls in arrear. But accept whatever he is paying. Accept that at least, because calls are indivisible debt. Then we learned who makes the share call, who decides when to call, who decides how much to call. All this decision is made by board of directors. It's a huge power that they have. They can decide when to make the share call, for how much money to call, all that they can decide. But board of directors, please exercise this power only in the best interest of the company we discussed. And company can make any number of share calls. And remember, we spoke about one extra point. We spoke about call notice also. We discussed whenever the board of directors make this share call on behalf of the company, they will issue a call notice to the shareholders, telling the shareholders what is the time limit within which they have to pay, how much they have to pay. All that information will be put in the call notice, and in the call notice there should not be any mistake also, we had discussed. So this was section number 49, guys, calls on shares. Most important point over here is that calls have to be made on a uniform basis against all the shares of that particular class. Remember the case law, Galloway versus Hall Concert Society. Then we discussed about calls in advance, section 50. First of all, can the company accept calls in advance? Yes, if it is authorized by AOA, company can accept. Now on the calls in advance, will the shareholder get extra voting right? Terrible, no extra voting right and all. Then on the calls in advance, do we have to pay any interest to that shareholder? Yes, if it is authorized by AOA. But what if company is not having any profit? Then can company escape from this interest obligation? No, company. Interest is a charge on your profits, which means if you have profits, pay the interest out of profits. If you don't have profits, you still have to pay this interest, pay out of capital, but you still have to pay. Then shareholder is asking for refund of the advance money. Will we give him a refund? No, shareholder, sorry, calls in advance are not refundable. Calls in advance are not refundable. But however, there is one exception. Remember, when the company goes into winding up, company will first repay the outsiders, then the company will refund the calls in advance, only then the company will repay the capital. So generally, calls in advance are not refundable, but they are refundable only in one situation, and that is when the company winds up. When the company winds up, whatever calls in advance money we have, company will refund that, but only after repaying the outsiders. So this was section 50, calls in advance. Company can accept calls in advance? Yes, if it is authorized by AOA. Will company give interest on calls in advance? Yes, if it is provided in the AOA. This interest is a charge on profits, which means if company doesn't have profits, company still has to pay this interest out of capital. And this advance money is not refundable except when the company goes in winding up, and that time also company will first pay the outsiders, only then company will refund the calls in advance, but before repaying the capital. Now coming to our next section, which is section 52, simple section, guys, talks about issue of shares at a premium. Can we issue shares at a premium? Yes. Is there any limit on how much premium we can collect on the shares? There is no limit. But is there a restriction on what the premium money can be used for? Yes. So shares can be issued at a premium. Above face value, whatever the company collects for the shares, that's called as premium. There's no limit on the premium. It can be how much ever the company wants it to be. But however, once the premium money is collected, what does the company do with the premium money? On that there is a restriction. If the company wants to issue shares at a premium, no AOA authorization is required, guys. Whether AOA is silent, whether AOA authorizes, it doesn't matter. And premium money can be collected in cash also. It can be collected in kind also. Now let's talk about the restrictions. Whatever premium money has been collected, premium money can be used for what purposes? It can be used only for 5 purposes. Number 1, to issue bonus shares. Number 2, to write off preliminary expenses. Number 3, to write off share issue expenses like underwriting commission and all. Number 3, to pay the premium on redemption of preference shares and debentures. Please know that we can use securities premium only to pay the premium on redemption of preference shares and debentures. We can't use a securities premium money to pay the entire amount which is due on redemption. Only the premium on redemption we can take from here. And lastly, we can use money from securities premium account for buyback of shares also. So whatever money is there in securities premium account, that money can be used only for these 5 purposes. But if the company falls under the category of prescribed classes of companies whose financial statements have to be as per accounting standards mentioned in section 133, now these kind of companies can use the securities premium money only for 3 purposes: bonus shares, to write off share issue expenses, and for buyback of securities. Got it, guys? Simple section 52. Now what will happen if you start using the premium money for other purposes? If the company starts using the premium money for other purposes, it will amount to reduction of capital, and section 66 will come into the picture. Okay, so can the company issue shares at a premium? Yes. Is there any limit on the premium? No. If AOI doesn't authorize, can the company still issue shares at a premium? Yes. Now there's no limit on the premium amount, but once the premium money is collected, company can use that premium money only for these 5 purposes. These 5 purposes we had discussed along with the accounting entries. Remember the journal entries, guys? Keep that in your mind. That will ensure that you never misinterpret the concept. Totally 5 purposes only. Number 1, to issue bonus shares. Number 2, to write off preliminary expenses. Number 3, to meet the share issue expenses. Number 4, when the company is redeeming the preference shares and the debentures, for the entire redemption value, you cannot take the money from securities premium account. You can take money only the premium on redemption from here. Only the premium on redemption can be paid out of this securities premium account. And lastly, we can use this money for buyback of shares also. Okay. Now coming to the next discussion, section 53, discount. Can the company issue shares at a discount? Company, it is prohibited. See, debentures, yes, you can issue at a discount. Bonds, yes, you can issue at a discount. But equity shares, preference shares, these two company cannot issue at a discount. And if the company still issues equity shares or preference shares at a discount, it's going to be void. But guys, there are 2 exceptional cases where company can issue equity shares at a discount. One is sweat equity shares, and the second one only has a lot of keywords. If you remember, in the second one, company is issuing equity shares to creditors under 2 things: SRP, DRS, Statutory Resolution Plan, SRP, DRS, Debt Restructuring Scheme, as per RBI Act or as per Banking Regulation Act. Once again, generally company cannot issue equity shares at a discount, but there are 2 exceptional cases where equity shares can be issued at a discount. Generally, only bonds and debentures can be issued at a discount. Equity shares, preference shares cannot be issued at a discount. If equity or preference shares are issued at a discount, it is considered to be void. But there are 2 exceptional cases where equity shares can be issued at a discount. One is sweat equity shares, and the other is when company is not able to repay creditors. Instead of repaying them in money, company will repay them by issuing equity shares to them. Those equity shares can be issued at a discount provided this whole arrangement is under DRS, Debt Restructuring Scheme, SRP, Statutory Resolution Plan, under RBI Act or as per the Banking Regulation Act. So the second exception, tell me one last time, to whom are we issuing equity shares? To the creditors. Why are we issuing equity shares to them? Because we are not able to repay them. So therefore, instead of repaying in money, we are repaying them by giving them more equity shares. Can those equity shares be at a discount? Yes. This whole arrangement is under dash or dash, SRP or DRS. What is SRP? Statutory Resolution Plan. What is DRS? Debt Restructuring Scheme. Under which act is all this? RBI Act or Banking Regulation Act. Okay, this was section 53, discount. Then comes section 54, guys, sweat equity shares. Now this is important. Here we learned that whenever the company wants to issue sweat equity shares, first of all, what are sweat equity shares? They are equity shares which are issued at a discount or for consideration other than cash. To whom? To directors or employees. Why? What are they giving us in return? 3 things, guys. Either they are giving to us know-how in return, or intellectual property rights in return, or value addition by whatever name called. So in sweat equity shares, company is giving to the employees or company is giving to the directors equity shares either at a discount or for consideration other than cash. And what are the employees or directors giving in return to the company? Either they are giving in return to the company know-how or intellectual property rights or value additions by whatever name called. Now these employees, remember, they can be employees of the company, holding company or subsidiary company, but the employees have to be permanent employees, which means whether they are working in India or outside India, they must be permanent employees. They must not be interns, they must not be employees who are still in probation and all. No, they should be temporary, they should be permanent employees working in India, outside India, doesn't matter. Employees of company, holding company, subsidiary company, doesn't matter. Directors may be whole-time directors, part-time directors, independent, not independent, executive, not executive, executive, it doesn't matter. Directors can be any kind of directors, just that they must be directors of the company, holding company or subsidiary company. Now listen to the next point under sweat equity shares. If the company is issuing sweat equity shares, they should be of a class that is already existing, which means sweat equity shares by itself should not become a separate class altogether. Sweat equity shares should be of a class which is already existing. To issue sweat equity shares, we first need permission of our shareholders, and SR has to be passed. But this SR will have validity period, guys. It will have a validity period of only 12 months. So within 12 months from the date of passing the SR, company should allot the sweat equity shares. And of course, if the company is a listed company, SEBI regulations also have to be followed. Okay, so sweat equity shares should be of a class which is already existing. Prior special resolution has to be passed. Then the special resolution will have a validity period of 12 months. Within 12 months period, the sweat equity shares should be allotted. And if the company is a listed company, SEBI regulations also have to be followed. Then when we were discussing sweat equity shares, if you remember, the most amount that we spent was on this part, that's a limit. How many sweat equity shares can the company issue? There's a limit. Now the limit depends, that there are two limits. One is a per annum limit and the other is a total overall limit. How many limits, guys? Two limits. One is a per annum limit, the other is a total overall limit. First of all, talking about the per annum limit, in a year, company can issue how many sweat equity shares in a year? 15% of paid up equity share capital or issue value 5 crore, whichever is higher. If you recall, we had spoken a lot about this. This is issue value and not face value. So sweat equity shares in a year we can issue 15% of existing paid up equity share capital or issue value of 5 crore, whichever is higher. But what is the overall limit, guys? What do you mean by overall limit? Company is not going to see, maybe company is issuing sweat equity shares in the current year. There may be a case where even in the past company has issued sweat equity shares. Total, everything put together, what the company has already issued plus what the company is going to issue now, everything put together should be within a certain limit. What is the limit? For startups, the limit is 50% of paid up share capital. For other companies, it is 25% of paid up equity share capital. Right, guys? So here we have to be little careful. The per annum limit is 15% of existing paid up equity share capital or 5 crore, whichever is higher. The overall limit for startups is 50% of paid up share capital. For other companies, it is 25% of paid up equity share capital. Right, guys? So this was our discussion on the limits. Keep in mind, here you have paid up equity share capital. For other companies also paid up equity share capital. For startups alone, it is just paid up share capital, which means for startups, when you're doing this calculation, you will take equity preference both. Okay, then we had discussed about the lock-in period. We said that once a company issues sweat equity shares, they will have the same rights, duties, responsibilities as other shareholders. They will be pari passu with the other shareholders. They will be equal to the other shareholders except one thing, which is that one thing? Lock-in period. Sweat equity shares have a lock-in period of 3 years, which means within the first 3 years, the person to whom the sweat equity shares were given, that person cannot transfer. Lock-in period is 3 years. Then see, don't you think we need to know that company should give the employee how many sweat equity shares? Because see, the shareholders, the existing shareholders of the company, they will want to ensure that company is not unnecessarily giving the employees too many shares also. So that is why we have to get valuation done. The company will go to a registered valuer and get two valuations. Number one, valuation of what we received from the employees. What we received from the employees? Remember, we received 3 things from the employees: know-how, intellectual property rights, value addition. So what is the value of what we received from the employees? For that, we'll go to the registered valuer. We'll also go to the registered valuer to understand what is the value of our shares. On that basis, the company will decide how many sweat equity shares is to be given to the directors and employees. You understood the reason for this, right? Because if we don't get valuation done, if company gives unnecessarily too many shares to directors and employees, existing shareholders will not like it. So therefore, existing shareholders will want to ensure that company is not unnecessarily giving them too many shares. So that is why we have to get a valuation done so that correctly we can calculate how many shares to give. And then we had learned company maintains a separate register of sweat equity shares in form SH3. This register is kept either at the RO or any other place which the board of directors will decide. Whenever the company issues sweat equity shares, details have to be put in the board report. And lastly, we had spoken about the accounting treatment, guys. This is very important. So here we had discussed that sweat equity shares, there can be two possibilities. Possibility number one is that company gave sweat equity shares to the employee and in return the sweat equity shares gave an asset to the company. The asset may be either either a depreciable asset or an amortizable asset. We use the word depreciable asset for tangible assets. We use the word amortizable for intangible assets. So the first possibility is company gives sweat equity shares to directors and employees, and in return they gave an asset which is depreciable or amortizable. In this case, we will debit the asset account and we will credit share capital, guys. We are crediting share capital because we are issuing shares, and this asset will go to the balance sheet. Okay, but the other possibility is that company is giving sweat equity shares to the directors or employees, and in return we are not getting an asset from them, guys. Company is giving sweat equity shares to the directors or employees, and in return maybe we are getting services from them. In return maybe we are getting services from them, not an asset. In that case, we will treat it like an employee expense, which means we will debit salary account and we will credit share capital, and the salary account will go into the P&L account. So there are two possibilities in the accounting treatment. Either we gave sweat equity shares to the directors and employees and in return we got an asset, in which case we will put the asset into the balance sheet, or the second possibility is that we give sweat equity shares to our directors and employees and in return we are not getting an asset. For example, we are getting services. In that case, it will become an employee expense and we will debit it to the P&L. So this was our entire discussion on sweat equity shares, guys. Once again telling you the most important points. Point number 1, the employees have to be permanent employees. Companies employees, holdings employees or subsidiaries employees, doesn't matter, but they have to be permanent employees, which means they should not be employees on probation and all. Directors can be any kind of directors, whole-time directors, part-time directors. We can have executive directors, non-executive directors, doesn't matter. They can be directors of the company, holding company or subsidiary company, doesn't matter. Second important point, sweat equity shares itself cannot be a separate class altogether. Sweat equity shares have to be of a class which is already issued. Then to issue sweat equity shares, before that prior special resolution is to be passed. That special resolution will have a validity period of 12 months. Within 12 months, company should complete the allotment of sweat equity shares. Then remember the limits, guys. What are the limits? Tell me once again. Tell me the limits. Let's put the limits down here once again. What are the limits? We have two limits. Number 1, we have a per annum limit, and number 2, we have overall limit. The per annum limit is how much, guys? The per annum limit is 15% of the existing paid up equity share capital or issue value of rupees 5 crore, whichever is higher. What is the overall limit? Overall limit means whatever sweat equity shares company is issuing now plus sweat equity shares already issued, everything put together should not exceed a certain limit. What is the limit? The limit depends upon are you a startup or are you any other company. For startup, the limit is 50% of paid up share capital, which means both equity and preference we will consider. For other companies, the limit is 25% of paid up equity share capital, which means only equity capital we will consider. And also remember, for startups you have this increased limit only for the first 10 years. And then we discussed that company has to get a valuation done to know how many sweat equity shares exactly we should issue. Sweat equity shares have a lock-in period of 3 years, and then whatever sweat equity shares company has issued, a proper disclosure has to be made in the director's report. Register has to be maintained in form number SH3, and finally we spoke about the accounting treatment. Just know that this accounting treatment part, it's been a long time they have not asked this. So be prepared. Then after this, we learned about section 55, wherein we spoke about redeemable preference shares. Even earlier, even in the revision, we said that preference shares cannot be irredeemable. If the company is issuing preference shares, they have to be redeemable only. And they have to be redeemed within how many years, guys? They have to be redeemed within 20 years. But remember, if the company is issuing preference shares because the company wants to raise money for infrastructure projects, here alone the redemption period can be up to 30 years also. You remember the reason? The reason I gave you was because infrastructure projects have a long gestation period. We spoke about this with examples. So coming again, preference shares have to be redeemed within 20 years. But if the company is issuing preference shares because the company wants to raise money for infrastructure projects, here the redemption period can be up to 30 years also. Okay. But however, the 21st year onwards, company should start redeeming 10% every year. Company should start redeeming. Before redeeming the preference shares, company should ensure that the preference shares are fully paid up. Only then the company can redeem them. Then to redeem the preference shares, company needs money. Company has how many places from where company can take money? 3 places. Number 1, company you can take money out of distributable profits. Number 2, company you can make a fresh issue of shares and take money from that. But you can't take money out of proceeds of earlier issue. You can take money only out of proceeds of fresh issue, or company can take money out of securities premium section 52. But company, listen, you cannot take the entire money from securities premium. Only the premium on redemption, only the extra, only the premium on redemption you can take from securities premium. So company can can take money from how many places? 3 places. Number 1, distributable profits. Number 2, proceeds of fresh issue. And number 3, securities premium. Then we had learnt that we will see from distributable profits alone, we will see how much money the company took. Using that money, how many preference shares did the company redeem? That many preference shares into face value, company will have to transfer into CRR, capital redemption reserve. That capital redemption reserve cannot be used for any other purpose. It can be used only to issue fully paid bonus shares. I hope you remember the whole logic. Mr. Tom, bank, the whole thing we had discussed. We had discussed that if the company is redeeming preference shares without issuing more shares, if the company redeems preference shares by taking money from here, then the total capital in the company reduces. If the total capital in the company reduces, creditors will be unhappy because creditors don't want company to do money only using creditors' money. Creditors want the capital amount to stay intact. So if we redeem preference shares and because of redemption, if the total capital in the company falls, then to reinstate the capital amount, we transfer money into CRR, right guys? But don't forget, do we transfer the entire amount we take from here into CRR? No. We will see how much money we took from here. Using that much money, how many preference shares we redeemed, that many preference shares face value, that is what we will transfer into CRR, capital redemption reserve. Then once we redeem the preference shares, within 30 days we have to inform ROC, which we will study in section 64 later. And then we had also discussed that whenever the company has to redeem preference shares, and if the company doesn't have any money to redeem preference shares, company can redeem preference shares in such cases by issuing further preference shares. These further preference shares should be of what value? Whatever amount is due on redemption plus preference dividend due. But to do this, here what is the company doing? There is no outflow of money for the company. Company has no money. So instead of redeeming the preference shares by giving money, company is redeeming them by giving them more preference shares. So for this company, you first need permission of the preference shareholders. You need consent of preference shareholders holding at least 3/4 of the preference shares, and you also need NCLT's consent. In case there are any dissenting preference shareholders, we have to redeem them in cash forthwith. Immediately we have to redeem them in cash. And if the company does like this, that is instead of redeeming in money, if the company redeems the preference shares by giving more preference shares, it will be considered as if the company has properly redeemed the preference shares. Okay, this was section 55 guys, redemption of preference shares, talking about the most important points. Company cannot issue irredeemable preference shares. They have to be redeemable only, redeemed within 20 years. Infrastructure projects alone can go up to 30 years, but even over the 21st year onwards, we have to start redeeming 10% every year. Only fully paid up shares can be redeemed. To redeem preference shares, company can take money out of distributable profits or proceeds of fresh issue of shares or from securities premium account. But company, if you take money from distributable profits, we'll see how much money you took. Using that much money, how many shares you redeemed, that many shares face value will be transferred to CRR. And then company should inform ROC within 30 days after redemption. And lastly guys, this is important. It's been only in May 2022 they had asked this. They've not asked this point ever since then. Remember the main point. What is the point? Company, listen, whenever you're redeeming preference shares, if you don't have money to redeem preference shares, you can redeem the preference shares by giving them more preference shares. For what value? For whatever amount is due on redemption plus preference dividend. For this much amount, we can issue more preference shares with the permission of preference shareholders holding at least 3/4 of the preference shares, and we also need the consent of NCLT. But in case we have dissenting preference shareholders, we have to redeem them forthwith, we have to give them money and redeem them immediately. Then we spoke about section 46, share certificate. Share certificate, first of all we discussed, it is a prima facie evidence of title. Prima facie evidence means it's not a conclusive evidence. It's only a prima facie evidence of title, which means if there's a share certificate which contains my name, your first impression will be that, your first thought will be that, looks like ma'am is a shareholder of the company. So share certificate is a prima facie evidence of title. It's not a conclusive evidence, it's only a prima facie evidence. Then before the company issues share certificate, two things have to be done. Before issuing the share certificate, number 1, board resolution has to be passed, and number 2, the shareholder has to surrender the letter of allotment to the company. But if fractional coupons are involved, do you remember fractional coupons guys? I told you in merger cases, in demerger cases and all, this concept of fractional coupons comes into the picture. Like for example, let's say upon merger, I am supposed to get 1.25 shares of the merged entity. Now 0.25 shares, how will I get? So the company will give me a coupon for 0.25 shares. Like that, others also will get a coupon. Those coupons will be bought and sold. So let's say there's another person who has coupon for 0.5 share. Another person has coupon for 0.10 share. Another person has coupon for 0.15 share. So like this, I will accumulate coupons for 1 share. I will submit this coupon to the company, and in return company will give me shares and share certificate. So we had spoken that if the company, if we want share certificate from the company, 2 conditions have to be fulfilled. First of all, board resolution has to be passed. Secondly, the shareholder has to submit to the company letter of allotment or fractional coupons as the case may be. Then what will be written in the share certificate? Share certificate will be first of all in form number SH1. On the share certificate, it will be written, what and all will be written? The names of the shareholders, then what is the amount paid up per share, how many shares, all this will be written on the share certificate. Now, will the share certificate contain names in plural? Yes. If there are joint shareholders, we discussed, like for example, if there are 3 joint shareholders, then should the company give 3 separate share certificates? No. We said company will give 1 single share certificate which will contain the name of all the 3 people. It will be as if the company has given to each of them. So if there are joint shareholders, all the joint shareholders' name will appear on 1 share certificate. Company will issue 1 share certificate only, not separate for each joint shareholder. Then we discussed that on each share certificate, the company's common seal has to be affixed, but we know common seal is not mandatory anymore. So company, if you don't have a common seal, then in that case, the share certificate will be signed by minimum 2 directors, out of which one of them should be neither managing director nor whole-time director, or it can be signed by 1 director and 1 company secretary. Again guys, on the share certificate, the company's common seal has to be affixed, but if the company doesn't have a common seal, then in that case, on the share certificate, we will put the signature of 2 directors, out of which 1 director is neither managing director nor whole-time director, or we can put signature of 1 director and company secretary of the company. Then details of the share certificate also have to be put in the register of members. We spoke about register of members already in section 43. Remember details about differential shares. If company has issued shares with differential rights, those details also have to be written over here, we learnt. And now one more point we are learning, share certificate details also have to be written over here. Then if the company is having books which contain details about share certificates, those books have to be preserved for at least 30 years. But if dispute is going on, those books will be preserved permanently. Then we discussed, yes, company can print blank forms also. But for that, Companies Act has given 3 precautions. Remember, precaution number 1, a board resolution has to be passed. Only then the blank share certificate forms can be printed. Number 2, the blank forms will be machine numbered so that in between, if any form gets stolen away, we will be able to track better. And lastly, all these blank share certificate forms have to be kept in the custody of company secretary or any other person who is authorized by the board of directors. Then we learned, in case we are surrendering our share certificate to the company, first of all, when will we surrender? Remember, like for example, if the shares are physical shares, but if we want the shares to get converted into demat form, we'll have to surrender the physical share certificate to the company. Now, what will the company do with the surrendered physical share certificate? Will the company throw it away? No, company, wait. You have to do 2 things, company. 2 Ds. First of all, you have to deface the share certificate. Deface means what? On the face, on the front of the share certificate itself, company has to stamp the word cancelled, and then company, you have to destroy it. Destroy immediately. No, wait for 3 years. After 3 years, a board resolution will be passed. Then only the share certificate will be destroyed. That too in the presence of a person who is appointed by the board. Alright guys, so the surrendered share certificates, 2 things. They have to be defaced immediately by stamping the word cancelled on the face of the share certificate, and number 2, they have to be destroyed, but only after 3 years. And then we learned share certificate concept and all will not apply in demat securities, and we also learned that share certificates will have the same amount of significance as currency notes. So if there is any fraud relating to share certificate, it's going to be considered as a severe fraud and it will be punished under section 447. Like remember, we had seen examples where the board of directors are printing fake share certificates to create fake shareholders. All that will get punished under section 447. Then under section 46, we also spoke about duplicate share certificates. In duplicate share certificate, 5 keywords I told you. If the original share certificate is lost or destroyed or defaced or torn or mutilated, in all these cases, we can request the company to give us a duplicate share certificate. Tell me the 5 words: lost, destroyed, defaced, torn, mutilated. Again, lost, destroyed, defaced, torn, mutilated. certificate. In these 5 cases, we can request the company to give us a duplicate share certificate, but we have to prove that this has happened. How will we prove it, guys? In these 3 cases, we will surrender the original share certificate to the company. We will surrender the torn pieces. We will surrender the mutilated, the defaced original share certificate. We will surrender it to the company. But in these 2 cases, how will we prove that the share certificate is lost? How will we prove that the share certificate got destroyed in a fire? We will prove it by filing an FIR. Okay, then we learned for duplicate share certificates, the company can charge a fee, but maximum how much? Maximum 50. And who will decide? The board will decide. Then on the duplicate share certificate, it should be clearly written that it is a duplicate share certificate. And within how much time will the company issue duplicate share certificate, guys? In unlisted companies within 3 months, in listed companies within 45 days. Earlier, ICI material wrongly gave 15 days and now it is corrected to 45 days. Alright, so this was a duplicate share certificate discussion. When does the company issue duplicate certificate? If the original is lost, destroyed, defaced, torn, mutilated. All the 5 words have to be written in your answer. Maximum 50 rupees company can charge for the duplicate certificate. On the duplicate certificate, it should be written that this is a duplicate one. And within how much time will the company issue this? If it's an unlisted company, within 3 months, listed companies within 45 days. Then we had renewed share certificate, for which I had shown you one example as well. Renewed share certificate concept comes into the picture when the subdivision or consolidation of shares, merger or demerger or any other reconstitution. All this is okay, we will remember. But what is the most special point of renewed share certificate, guys? Whenever the company issues renewed share certificate, do we have to surrender our original certificate? No. That was a key point over here. In renewed share certificate, surrender of old certificates is not required, because as soon as the company gives us a renewed one, the old one, the original one, automatically becomes a useless piece of paper with which we can just make a rocket and fly it off. Alright, guys. And even for renewed share certificate, the company can charge a fee. How much? Maximum 50 rupees. Then we discussed company you will keep a separate register, a register of duplicate and renewed share certificates, where either at the registered office or wherever the register of members is kept. In form number SH2, this register has to be preserved permanently in the custody of company secretary or any other person authorized by board of directors. So this was section 46, guys, a big section about share certificate, just highlighting some important points over here. Point number 1, the first important point, in the share certificate, will the company write the name of all the joint shareholders? Yes. Will the company give a separate share certificate to each joint shareholder? No. Then we had learned that can the company print blank share certificate forms? Yes. How many precautions has Companies Act given in that regard? 3 precautions. Precaution number 1, board resolution has to be passed. Only then blank share certificate forms can be printed. Each blank form has to be machine numbered and it has to be kept in the custody of company secretary or any other person appointed by the board. Then remember, books containing details about share certificates have to be preserved for 30 years. If dispute is going on, they have to be preserved forever. And then we had learned duplicate and renewed share certificate. Just tell me the key words, guys. Duplicate share certificate, tell me the key words. When will the company issue duplicate share certificate? If original is lost, destroyed, defaced, torn or mutilated. And when will the company issue renewed share certificate? If there is subdivision of shares, consolidation of shares, merger, demerger or any other reconstitution. Okay, and also remember, in renewed share certificate, we don't have to surrender the original share certificate. Alright, come on everybody, let's go ahead. Let's go to section 56 now, which talks about transfer and transmission, a very simple yet a very important section. First, let's talk about transfer and then we'll go to transmission. See, transfer is nothing but a voluntary conveyance of rights and duties of a member by a shareholder who wishes to cease to be a member to a person who is desirous of becoming a member. First of all, it is voluntary, which means if I'm transferring the securities to you, it's because I want to sell the shares to you and you want to buy it from me. So it's not automatic. It's not that law is doing this movement. It happens voluntarily. It's a voluntary conveyance of rights and duties of a member, which means till yesterday I was the owner of the shares. I was enjoying the rights and I was fulfilling the duties of a member. But I don't want to continue as a member anymore and you want to become a member. So I'll transfer my shares to you. Now you will enjoy the rights and you will fulfill the duties of a member. So tell me the definition again. Transfer is nothing but voluntary conveyance of rights and duties of a member by a shareholder who wishes to cease to be a member to a person who is desirous of becoming a member. Now, can shares be transferred? Yes, they are movable. They can be transferred. The right to transfer is an absolute right. It's an inherent right. AOA cannot take away this right from us. If it's a public company, shares are freely transferable. In a private company, also shares are transferable, only that there is a restriction. And what is the restriction? If I am a shareholder of a private company and if I want to transfer the shares, I have to first offer the shares to the existing shareholders. Only if none of the existing shareholders are willing to buy the shares, only then I can transfer the shares to the outsiders. Then after this, we had learnt that whenever the company, if I am a shareholder of the company and if I want to transfer the shares, what's the procedure? The transferor or transferee, one of us will submit two documents to the company. Repeat again, transferor or transferee, one of us will submit two documents to the company. Number one, instrument of transfer in form number SH4, and number two, the share certificate containing the transferor's name. So this SH4, this instrument of transfer, has to be stamped, which means stamp duty has to be paid. It has to be signed by both transferor and transferee, and it has to contain all the details about the transferee, like his name, address and occupation. A very important point in SH4 is that it has to be submitted by whom? Transferor or transferee. But it has to be signed by whom? Transferor and transferee. And another important point about SH4 is that it has a validity period of 60 days, which means we will see when was this SH4 executed. From the date of execution, within 60 days itself, it has to be submitted to the company. We had learnt about the logic also behind the 60 days. We had discussed that if we don't have the 60 days criteria, then people will not even write the transferee's name. They'll keep making blank transfers one after the other, and because of these blank transfers, company will lose stamp duty and company will also lose capital gains income tax. So that is why within 60 days itself it has to be submitted to the company. Guys, something similar we had in prospectus chapter also. Remember, in prospectus chapter we had learned that once we file the prospectus with the ROC, within 90 days it has to be issued to the public. So same way, even SH4, once it is executed, from the date of execution, within 60 days itself it has to be submitted to the company. Okay, so 60 days is a maximum time limit, not minimum time limit. Alright, then so therefore what is transfer? Transfer is nothing but voluntary conveyance of rights and duties of a member by a shareholder who wishes to be a member to a person who is desirous of becoming a member. To transfer the securities, what is the process? The transferor or transferee, one of us will submit two documents to the company. Number one, SH4, instrument of transfer, and number two, share certificate. The SH4, the instrument of transfer, has to be stamped. It has to be in this particular form only. It will contain the transferee's name, address, occupation. It has to be signed by both. From the date of execution, within 60 days itself, it has to be submitted to the company. Then we learnt about transmission. Wait, before transmission, we had also spoken about one equation. I told you if the SH4 is submitted by the transferor and if the shares are partly paid up shares, then SH5 process will apply. You remember this equation, guys? I'll repeat again. If the documents, we just learned, right, that the documents will be submitted by transferor or transferee. So if the documents are submitted by transferor and the shares are partly paid up shares, then the company will become a little alert. Company will inform the transferee. Company will send a notice to the transferee, inform SH5, informing the transferee. The transferee, do you know these are partly paid shares? So therefore, later whenever I make a share call, you only will have the liability to pay the amount which is due on the shares. The transferee has to send no objection within 2 weeks. Only then company will go ahead and register the transfer. But try to recall, will SH5 process apply every time the shares are partly paid up? No. SH5 process will apply only if the SH4 was submitted by transferor. Only then, if the shares are partly paid up shares, company will send SH5 notice to the transferee informing him that the shares are partly paid up shares, asking him for no objection certificate within 2 weeks. Then we learned about transmission. Transmission, we said this is not voluntary. Transmission happens by operation of law. Transmission happens automatically in some cases, whether you like it or not, automatically it will happen. Like when the shareholder dies, automatically the shares will go to his legal representative. When the shareholder becomes insolvent, automatically the shares will go to the official receiver. When the shareholder becomes lunatic, automatically the shares will go to the administrator. But in transmission, there is no concept of instrument of transfer. Instead, we have intimation of transmission. And remember, for instrument of transfer we have a form, but for intimation of transmission we don't have any form. So which means we will simply take one A4 size paper, write about transmission and submit it to the company. There is no form over here, no stamping requirement is there over here, no 60 days criteria. All this is not applicable in transmission. So in transmission, the movement is happening from one person to another person, not voluntarily. It is happening automatically by the operation of law. Here the document is called intimation of transmission. there is no prescribed form for this, no stamping is required, and 60 days criteria is also not applicable over here. Then over here in relation to transmission, you remember two stories I gave you, and I told you that both the stories are right. In the first story, like for example, let's say the shareholder died. So the legal representative informed the company about the transmission, got his name entered into the register of members, became the member of the company, and only then transferred subsequently to another person. In the second story, if you remember, the legal representative did not even inform the company about the transmission. He did not even become a member of the company. Without becoming the member of the company, he directly transferred the shares to another person. We said both are right. We said legal representative, even though you did not get your name entered in the register of members, as if the legal representative is a holder of shares, he can transfer. Even though he has not become the member of the company, even though in the register of members his name is not written, even though his name is not written in the register of members, still he can transfer shares to whomever he wants. It will be as if the owner of the shares has transferred. Okay, so this was transmission, doesn't happen voluntarily, happens automatically, no instrument of transfer. Instead we have intimation of transmission over here, no stamping requirement, 60 days requirement is also not there. Then we spoke about the time limit within which the share certificate has to be issued. We discussed that at the time of incorporation, we prepared the MOA, guys. In the MOA we have the subscription clause, guys, and the persons who sign the subscription clause, they are called as subscribers, and each subscriber has to take minimum one share in the company. So these subscribers have to be sent a share certificate within 2 months from the date of incorporation. In allotment cases also the time limit is 2 months from the date of allotment. In transfer transmission cases the time limit is 1 month, 1 month from the date on which the company receives the instrument of transfer, 1 month within which the company receives the intimation of transmission, and for debentures we have 6 months time. Okay, then comes section 57, personation of shareholder. Very simple section. Section 57 says there's a person. He is actually not owning any shares, but he is personating to be the owner, which means he is pretending to be the owner so that he can enjoy the securities, he can enjoy share warrants, or he can enjoy any money which is actually due to the shareholders. So in such cases we will say that he is personating and he will be punished under section 57. Important punishment we discussed: imprisonment minimum 1 year, maximum 3 years, and how much fine? Fine minimum 1 lakh, maximum 5 lakhs. This is personation of shareholder. Then we discussed that there is a concept called as forged transfer also. Now forged transfer, I'll straight away come to this diagram, guys. We have this shareholder Mr. Green. So in the company's register of members, whose name is written? Green's name is written. Okay, now Green, he's owning shares of the company. Purple comes to Green and asks Green to transfer the shares to him. But Green says, I have no interest in transferring the shares right now. So what does Purple do? Purple does two things, guys. Number one, Purple steals the share certificate containing Green's name, and number two, Purple takes SH4. In SH4 he puts all his details as if Green is transferring to Purple, but just now we learnt in game SH4 has to be signed by whom? Transferor and transferee. So he puts his own signature, but now Green's signature is also required, but Green is not willing to sell away the shares. So Purple puts Green's signature, which means Purple forges Green's signature. So SH4 becomes a forged document, and both of this he submits to the company. Company doesn't know that there is forgery over here. On the basis of these two documents, company registers the transfer, which means company removes Green's name from the register. Company puts Purple's name in the register. Company gives to Purple a new share certificate containing whose name? Containing Purple's name, and Purple becomes a member of the company. And Green has no idea that all this has happened. Then enters into a story another person, Mr. Red, who is a genuine buyer, which means he has no idea that all this has happened. He looks at this share certificate. He relies upon this share certificate. Come on, guys, a share certificate is issued by the company saying Purple is the owner of the shares. So of course Red can rely upon the share certificate. He trusts this share certificate. He believes that Purple is a member of the company, and he buys the shares from Purple, gives consideration for the shares, again submits all the documents to the company. Company removes Purple's name. Company puts Red's name in the register, and company gives to Red a new share certificate containing Red Red's name. Now after all these days, Green wakes up and Green wonders that why has the company not given him dividend for all these days? Why is the company not sending him notices all these days? So Green comes to the company and tells company, what did you forget? I am your shareholder. Where is my dividend? Where are my notices? Company says, what Mr. Green? You sold the shares to Purple. Purple sold to Red. Red only is the owner. You are not the owner anymore. That is when Green realizes everything that has happened. Green comes to the company. Green proves to the company on SH4 that signature is not my signature. That signature is forged. Green proves forged transfer. Once the forgery is proved, remember, forgery is a nullity. Forgery is going to be void, which means once Green proves that his signature is forged, it is as if his signature is not even there. Guys, if on SH4 transferor's signature is not there, that SH4 will become invalid. If SH4 is invalid, Green to Purple transfer will become invalid. If transfer is invalid, Purple will not have any rights in the shares. If Purple doesn't have any rights in the shares, he can't give any rights to Red. So Green only is the owner of the shares. Green will have the right to get his name back into the register. Okay, so once Green's name comes back in the register, also in this entire period, whatever dividend he has lost, also all the dividend company will give to Green. But now who will be sad, guys? Red will be upset. Red will think, company, you only gave a share certificate saying Purple is the owner. I relied upon that share certificate which you gave. I bought shares from Purple. I gave him consideration, and now you are saying I am not a member of the company. You are saying Green only is a member. What nonsense. So company will have no choice. Company will have to compensate Red because Red has suffered a loss because he relied upon the share certificate issued by the company only. So company will have to compensate Red. Now who is upset? Now company is upset. Company is wondering, what is my fault? Why did I have to give compensation to Red? Because of giving compensation to Red, I have suffered a loss, and everything is because of whom? Because of this Mr. Purple. So whatever loss the company has incurred, company will ask for indemnity. Indemnity means what? Reimbursement. Company will ask for reimbursement, compensation from Purple. Alright, and also Purple, he is the one who has tried to be a shareholder. He has tried to pretend to be a shareholder. He will be punished under section 57. Personation punishment also will apply over here on Purple. And the transfer between Green to Purple is called as forged transfer. Why? Because this transfer happened on the basis of a forged signature. So this was our entire discussion on forged transfer, guys. Remember, forgery is a nullity. And by the way, can Red take protection under doctrine of indoor management? Doctrine of indoor management says, outsider, you can assume all internal rules are fulfilled. So can Red take protection under doctrine of indoor management? No. When we learnt about doctrine of indoor management, we had learnt that forgery is an exception. When there is forgery, it will result in nullity. It will be void. No doctrine can protect you. It's a universal principle across every law, across every country, that forgery is equal to nullity. Alright, so this was our discussion regarding forged transfer. Then we learnt about section 58, where we learnt about refusal to register the transfer. I'll straight away come to the diagram. I told you that once we submit all the documents to the company for transfer or transmission, as the case may be, same concept only will apply for both. Once we submit the documents to the company like SH4, intimation of transmission, share certificate, once we submit all this to the company for registering the transfer or the transmission, there are two possibilities. Either company will accept the documents and the company will register the transfer or transmission, or the company will refuse to register, guys. If company accepts the transfer or transmission, company will send new share certificate. Remember, we learned in transfer transmission cases, company will send new share certificate within 1 month. So if once we submit all the documents to the company, if the company accepts the document, if the company is willing to register the transfer, company will send new share certificate to the transferee within 1 month. But if the company refuses to register the transfer, company has to send refusal notice to whom? To both transferor and transferee. Within how much time? Within 30 days. So if you notice, it's more or less going to be the same only. If the company wants to accept the transfer or transmission, company will send new share certificate to the transferee within 1 month. Within 1 month. But if the company wants to refuse to register the transfer, company will send refusal notice to transferor and transferee within 30 days. So the time limit is 1 month for share certificate, 30 days is for refusal notice. Now once a company sends refusal notice, once a transferee receives the refusal notice, the transferee can file an appeal before NCLT within 30 days in private companies, within 60 days in public companies. You remember this whole thing, guys? Yes, so the whole time limit is pretty simple. Listen to me everybody. What are we discussing about right now? We are discussing about the time limits relating to refusal to register the transfer. So point number 1, if the company registers the transfer, once we submit the documents, there are only two possibilities. Either company registers the transfer or the company refuses to register the transfer. If the company registers the transfer, company will send a new share certificate, SH1, a new share certificate in whose name? In the transferee's name. To whom? To the transferee. Within how much time? Within 1 month. Within 1 month from the date on which the company received the documents. Then if the company wants to refuse to register the transfer, company will have to send refusal notice. But refusal notice company will send to whom? To both, to transferor and to transferee, to both company will send within how much time? Within 30 days from the date on which the company received all the documents. Once the company sends refusal notice, who can appeal? Transferor can't appeal. Only the transferee can appeal because he only is the aggrieved party, and the transferee has to appeal within the next 30 days before the NCLT. Okay, if it's a public company, 30 days will be read as 60 days. Okay, but what if we waited, company neither registered the transfer nor sent refusal notice? Then in that case, it will be deemed refusal. We will assume as if the company has refused and the transferee can file appeal. Within how much time, guys? We had learned 30 plus 30, within 60 days the transferee can file appeal. But if it's a public company, 30 plus 60, within 90 days the transferee can file appeal. Understanding? If the company neither registers a transfer nor sends refusal notice, then we will assume the company has refused. It is deemed refusal. In deemed refusal cases, the transferee can file appeal before NCLT. Within how much time? See, I had given you the logic behind this as well. Within how much time transferee will file appeal before the NCLT? See, we had discussed that if the company had actually sent refusal notice, company would have sent within 30 days, and within next 30 days transferee could have filed appeal. So transferee would have had 60 days time. So within those 60 days, the transferee has to file appeal before NCLT if it is deemed refusal. But if it is a public company, then how would the time limit would have been? Company would have sent refusal notice within 30 days, transferee would have filed appeal within 60 days. So within 30 plus 60, within 90 days in deemed refusal cases, in public companies, appeal can be filed before NCLT. But do not forget, refusal notice company will send to both, but appeal can be filed only by the transferee. Within 30 days in private companies, within 60 days in public companies. But if company is neither sending share certificate nor sending refusal notice, we will assume refusal, and in that case appeal has to be filed within 60 days in private companies, within 90 days in public companies. In deemed refusal cases, the time limit will start when? The time limit will start on the date on which all the documents were delivered to the company. Okay, then once we file an appeal before NCLT, what will NCLT do? Either NCLT will dismiss the appeal, or NCLT will ask the company to go ahead and register the transfer or transmission within 10 days, or NCLT will order rectification of register. Then we had discussed that when will NCLT order rectification of register? Only in 3 cases. Either I am not a member of the company, but unnecessarily company has put my name in the register. Or if I am a member of the company, but why is my name not in the register of members? Or we have submitted all the documents to the company for transfer or transmission. Now company is supposed to remove in the register of members the transferor's name and put the transferee's name. Unnecessary delay the company is doing in this changing of name in the register. So in these 3 cases, we can ask the company to rectify the register. And remember, guys, who can ask for rectification of the register? Not just that person who is suffering. Any member can go to the NCLT and ask for rectification of register. Not just the member who is suffering because of the wrong register. Any member can go and ask for rectification, because every member has interest in ensuring that the register is properly maintained. Alright, then we had started learning about kinds of share capital. So transfer, transmission, refusal to register the transfer, transmission, NCLT's order, then rectification of register. All this is clear. Rectification of register only in 3 cases. Who can ask for rectification? Not just the person who is affected because of the wrong register. Any member can ask for rectification of register because every member has interest in ensuring that the register is properly maintained. Okay. Now coming to the different kinds of capital, we learned that nominal capital, also called as authorized capital, is a maximum amount of capital which the company can have. Stamp duty and all is paid on the basis of this nominal capital only at the time of incorporation. Issued capital is out of the nominal capital, how many shares company has issued for subscription. Out of issued capital, how many shares have been subscribed for, is subscribed capital. This is the main amount of capital we discussed. This is the amount which the company has a right to receive in the name of capital. Then this much money company has a right to receive, but out of that how much has the company demanded, that is called as called up capital, and out of that how much has been paid by the shareholders, that is paid up capital. So called up capital minus calls in arrears will give us paid up capital. Now coming to our next discussion, which is section 61. Section 61 talks about alteration of share capital. Before we revise about this section, let me give you the background information which I had given you even earlier. See, we write in our MOA. In our MOA, we have starting again. Okay, so starting with another section now, section 61, which talks about alteration of share capital. Before we dive into the section, let me give you some basic points. See, we have the memorandum of association. In the memorandum of association, we have several clauses. One of the clauses is the capital clause, guys. Now, in the capital clause, we write the authorized capital of the company, but we don't straight away write the amount. We write the breakup, right? Like for example, we write 1 lakh shares of 10 rupees each, total 10 lakhs. Like this, we will give the breakup of authorized capital in the capital clause, right guys? Now, in this MOA, name clause, situation clause, objects clause, anything else if you want to alter. We learned section 13 in MOA AOA chapter, right guys? So if you want to alter any clause of MOA, we pass SR. But if alteration of capital clause, we did not learn in the MOA AOA chapter because alteration of capital clause is covered in section 61. If you want to alter either the authorized capital or if you want to alter this breakup, welcome to section 61. Okay, so first of all, you know what you're learning about? You're learning about alteration of the capital clause in the MOA. In the MOA capital clause, we write the authorized capital. We don't write issued capital, paid up capital and all over here. Only authorized capital we write. So if you're doing a change because of which either the breakup is going to change or the amount is going to change, for that change, we have to follow section 61. Any other change you want to do in MOA, SR is required to be passed. But capital clause, this if you want to change, only an OR, ordinary resolution only is required. With this basic understanding, now let's dive into section 61. There are totally 5 situations only when section 61 will apply. In all these 5 situations, if you see, the point will be common. Either this number will be changing or this breakup will be changing. The first situation, we want to increase the authorized capital, increase or decrease the authorized capital. This number will change, breakup also will change, fully it will change. Number 2, we want to consolidate shares. We want to subdivide shares. When we want to consolidate shares, what are we doing in consolidation? We are grouping shares together. Like earlier, 1 lakh shares of 10 rupees each. Now we are consolidating shares together. Now let's say we are having 10,000 shares of 100 rupees each. So we are grouping shares together. We are consolidating shares together. That is consolidation of shares. In consolidation of shares, the total amount doesn't change. Only this breakup changes. Earlier it is 1 lakh shares of 10 rupees each. Now it will become 10,000 shares of 100 rupees each. Example. In subdivision of shares, what do? We break the shares into smaller parts. Subdivision of shares also called as stock split. Consolidation of shares also called as reverse stock split. Remember, in subdivision of shares, I am breaking my shares into smaller part. Like earlier, 1 lakh shares of 10 rupees each. Now I am breaking it into smaller parts. I am saying that this will now be 10 lakh shares of 1 rupee each. So even in subdivision, even in consolidation, in both of these, the total capital number doesn't change. Only the breakup changes. In consolidation, the number of shares will reduce. We will group the shares together. In subdivision, the number of shares will increase. We will break the shares into smaller parts. Okay. Then this is nothing but converting fully paid shares into stock. We learnt even in the initial part of the chapter, converting fully paid up shares into stock or vice versa. And this is the most important, guys. Here we are cancelling shares which have not been taken up by any person. That is, we are cancelling unsubscribed capital. What are we cancelling? Tell me. We're cancelling unsubscribed capital. We're cancelling this unsubscribed capital from where? From two places. From issued capital also, from authorized capital also. From both the places we are removing unsubscribed capital. That will also come under section 61, last box. We're cancelling unsubscribed share capital. We're cancelling the shares which have not been taken up by any person. Where are we cancelling this from? From authorized capital also, from issued capital also. So the authorized capital number will change. We are reducing the issued capital also, but section 66, reduction of capital, will not apply. Section 61 only will apply. So this is your alteration of capital, guys. 5 situations. In all these 5 situations, either your total number will change or the breakup will change. Only an ordinary resolution is required. Okay. In all these 5, only the authorized capital number only is going through a change. Paid up capital, subscribed capital, called up capital, issued capital, and all is not changing. Only in the last box, issued capital is also changing. But still section 66 will not apply. Section 61 only will apply. Okay. Now coming to our next discussion, section 62, rights issue. Simple point, guys, very simple point. Whenever the company wants to raise more money by issuing more shares, company has multiple options. But company should first go to existing shareholders only and offer them rights shares. Only if the existing shareholders don't agree to give more money to the company, only then company will make a private placement or make a public offer or go to the employees and all. But if the company wants to raise more money by issuing equity shares, company should first go to existing shareholders only. This is called as a preemptive right of the existing shareholders. Now when the company is offering shares to the existing shareholders, it will always be on a proportionate basis. So company will first of all have to send the offer to the existing shareholders. The document is called as letter of offer. In the letter of offer, company will mention that how many shares are we going to offer and what's the time period within which the offer should be accepted. The time period we learned, it should not be less than 15 days, it should not be more than 30 days, but as per rules, it should not be less than 7 days. If you remember, Godavari's letter of offer with all the time limits I showed you, it should not be less than 15 days, should not be more than 30 days. As per rules, it should not be less than 7 days. Now in this calculation, what about Sunday? What about holidays? I showed you, even if Sunday is included, you will count Sunday also. Even Sunday is included. We are not saying 7 working days, we are saying 7 days. Okay, so in rights issue, companies offering shares to existing shareholders for free. Definitely not. The shareholders have to pay a price. Company is making rights issue because company wants to raise funds. It is not for free. For free will be called as bonus shares. Section 63, next section. In section 62, company is raising funds. So rights issue is also for a price. It's called rights price. Generally, the rights price is below the market price. The company is offering shares to the existing shareholders for a price called rights price, proportionate to the number of shares that they are already holding. So company will send to the existing shareholders a document called letter of offer containing all the details about the rights issue. Now in the letter of offer, it will be mentioned that shareholders have 3 rights. They have 3 options. Either they can accept the right and they can subscribe to the shares, or they can reject the right. They can say, company, we are already fed up since the time we bought your shares. We don't want more shares. They can reject the right, or they can also renounce the right. Remember renunciation. They can renounce the right to another person. Whether that other person is a member of the company or not doesn't matter. Okay, and then we also learned the letter of offer. When should it be sent to the shareholders? We will see what is the date of opening the issue. Before that, leave 3 days. Before 3 days itself, company should send the letter of offer to all the existing shareholders, either by registered post or by speed post or by email or by any other mode having proof of delivery when at least 3 days before opening the issue. Okay, then after this we had discussed that the 3 options I told you, reject, accept, reject or renounce. The person to whom you are renouncing, that person can be any person, shareholder or not a shareholder, doesn't matter. Now what if the shareholder is neither accepting nor rejecting nor renouncing? What if he doesn't do anything within the time period? Time period is over. Now what will happen? We will assume that he has rejected the shares. Now what will happen with the rejected shares? The rejected shares can be disposed by the board of directors. Board of directors may dispose them in the manner which is most advantageous to the company. In the manner which is most advantageous to the company, the board can dispose the shares. When the board is disposing the shares, does the board again need shareholders' permission? No. Shareholders, you only know rejected the shares. Those shares only we are disposing. We will not again ask you permission before disposing. Then we discussed about this very important point, is renunciation right automatic? Guys, in AOA, nothing is written. In the letter of offer, nothing is written about renunciation. Do I have renunciation or not? By default, you will have renunciation. Only if AOA is silent, only if in AOA it is mentioned, only then no renunciation. By default, we will all have renunciation right. And then we learned whatever time limits we saw over here, 15 days, 30 days, 3 days, all of these are not applicable to private companies. But which private companies? Those private companies in which they get permission from at least 90% of the members, written permission either in writing or by mail. They need permission from 90% of members at least, then these time limits they can change. So this was about rights issue. So giving you one quick recap once again. Listen to me. I'm giving you a revision of the revision. Listen to me again. So we're talking about section 62. In section 62, company wants to raise more money by issuing more shares. So company, whenever you're issuing more shares to raise more money, you first offer shares to existing shareholders. This is a preemptive right of the existing shareholders. Only if the existing shareholders are not willing to give more money to you, only then you go and offer the shares to the outsiders, like public offer, private placement and all. You do only if existing shareholders are not giving you the money that you need. So when the company is offering shares to the existing shareholders for a price which is called as rights price, which is generally lesser than the market price, proportionate to the number of shares which the shareholders are already holding, the company will send them this offer through a document called as letter of offer. Now the letter of offer will contain all the details like what price, how much do the shareholders have to pay for the shares, then how many shares can they subscribe for. All this information will be put in the letter of offer itself. Letter of offer will also contain the issue opening date and the issue closing date. This time gap can be minimum 15 days, maximum 30 days. The time limit also will be written in the letter of offer only. As per the rules, it should not be less than 7 days. Then we learned the date of opening the issue. Before that, leave 3 days. Before 3 days itself, the company should send the letter of offer to all the members by registered post, speed post, email or any other mode having proof of delivery. Then we learned shareholders, just because the company is giving you rights issue doesn't mean you have to buy the shares. It's not an obligation, it's an option. How many options? 3 options. Shareholder, either you can accept the right and buy the company's shares and give the company money, or you can reject the right, or you can renounce it to another person. You can renounce it means when you're renouncing, are you selling the shares to another person? No, you're only selling the right to buy rights share to another person. In capital, I'm getting reminded of capital gains. Capital gains also we had done questions from here. Anyways, coming back. Then we discussed, what if the shareholder is neither accepting nor rejecting nor renouncing? We'll assume that he has rejected. And if he has rejected, what will we do with the rejected shares? Who will decide what to do? The board will decide. Board will disperse them in a manner which is most advantageous to the company and shareholders. Then we discussed, if the letter of offer is silent about renunciation, then by default shareholders, you do have renunciation right. If renunciation right is not available for you, it will be mentioned in the AOA. Only then not available for you. And lastly, we discussed that all the time limits that we saw over here, none of these time limits will apply to private companies provided they get written consent or email consent from how many members? At least 90% of the members. Story over. This is it about rights issue. But section 62 is not over. One whole class we spent on section 62. So in section 62, the main point is rights issue. But rights issue is not the only way in which company will raise money by issuing further shares. Rights issue is one of the methods. But if the existing members are not willing to give more money to the company, then we have other options, guys. We can give ESOPs to employees. Remember, ESOPs, employee stock option plans. Here we are giving an option, not obligation. We are giving an option to the employee. Today we are giving an option telling the employees that employees, if you want in the future, you can buy the company's shares. So here, if you remember, we had multiple terminologies. We will see what is the date of grant of option. But immediately the employees cannot exercise the option. There will be a time gap. That time gap is called as vesting period. So this will be the date of vesting of the option. This vesting period will be minimum 1 year. It can be more than 1 year also, minimum 1 year. Don't get confused now. In sweat equity shares, section 54, there we had lock-in period. Lock-in period was equal to 3 years. We did not say at least 3 years. We said equal to 3 years. Lock-in period is 3 years. But now in ESOPs, here no lock-in period, guys. Here we have vesting period. Vesting period has to be minimum 1 year. Can be more than 1 year also. In ESOPs, then what is the lock-in period? Lock-in period, exercise period and all this Companies Act is silent. All these things we're telling the company, you decide. Now what is this exercise period? What is this vesting period? Listen, come back to this now. We will see when did the company give you the ESOPs. That is the date of granting the options. But when can you start exercising? There will be a time gap. This time gap is called as vesting period. Once a vesting period is over, the ESOPs will vest in you. ESOPs will vest in you means this is the date when you will have the right to exercise the option. But there will be an exercise period. It's not necessary that on this date itself, exactly on this date itself, you have to exercise. Like that, no. You will have an exercise period. Once a vesting period is over, then the options will vest in you. Once the options vest in you, you have the right to exercise the option now. So there will be an exercise period. In this exercise period, on any day you can exercise the option. Exercise the option means you will pay money and you will get shares. Now how much you will pay? What is the exercise price? It's a predetermined price, which means on this date when the company is granting the option to you, that time itself company will tell you that in the future whenever you exercise on that day how much you have to pay. Today itself we will tell you. That is why it is called as predetermined price. Now you employee, you have to continue to work for me till you exercise. Only then you can exercise. If you leave in between, if you are fired in between, or if you resign in between, then the options will also lapse along with you. Understanding everybody? So in ESOPs, company is giving ESOPs to directors, officers or employees of company, holding company or subsidiary company. Here lock-in period, the law doesn't say anything. The exercise period, the law doesn't say anything. So lock-in period and exercise period, company you decide. But vesting period, the law says minimum 1 year. Law doesn't say equal to 1 year. Law says it will be minimum 1 year, which means company you decide what should the exercise period be. And what should the vesting period be. And this terminology you understood? This is the date on which the company is giving the option to you. But immediately and all you can't exercise. You have to continue to work for one period. Then only you will become eligible to exercise. When you become eligible to exercise, that is called as state of vesting of option. Once you become eligible to exercise, not necessarily on that day itself you have to exercise. No, you will get one exercise period. In this period, any time you can go and exercise. When you exercise, you will not get the shares for free. You have to pay exercise price. But how much price I have to pay? How will I know? When the ESOPs are granted to you, that day itself the exercise price will also be decided. That is why it is called as predetermined price. Understood all the points, guys? Now, if the company is issuing ESOPs to employees, before this we have to get special resolution from the shareholders, because without giving shares to shareholders, we are going to employees and we are giving ESOPs. So we have to get consent from our existing shareholders in the form of special resolution. Then we learned ESOPs cannot be given to independent directors because independent directors are independent, which means they are not having any connection with the company. But if we give them ESOPs, later they will become shareholders. So later a connection will get created between us and independent directors. So they will not be independent anymore. So we can't give ESOPs to independent directors. We also can't give ESOPs to promoters. We also can't give ESOPs to those directors who are already holding more than 10% shares. They are already holding more than 10% shares. If you give them ESOPs also, they'll start having major control over the company, and that we don't want. Then we discussed, right now I am having only ESOPs in my hand. I didn't exercise till now. I am only having ESOPs in my hand. These ESOPs I can't transfer. On these ESOPs I will not get voting right, dividend right and all. I am not shareholder of the company till now. Once I exercise the option and get the shares, now I have shares in my hands. Now I become a member of the company. Now I'll get voting right, dividend right and all, and I will get. I have to keep the shares with me during the lock-in period. After the lock-in period I can transfer. And then we discussed, during the vesting period, if the employee dies, then the ESOPs will go to his legal representative. During the vesting period, if the employee suffers from a permanent incapacity, like if he goes into coma or if he gets paralyzed, then on that day itself the ESOPs will vest in him. But if he resigns or if the company fires him, then the ESOPs will lapse. And if it's a listed company, SEBI regulation also has to be followed, and to issue ESOPs, I just told you special resolution is required. But if it's a private company, an ordinary resolution will be enough. So this was our discussion on ESOPs, right guys? So all the terminology is also clear and the time limits are also clear. Remember, vesting period is minimum 1 year. Then, so under section 62, there are totally 4 things. One is we are offering shares to our existing shareholders, rights issue. Second is ESOPs to employees. In the third issue, the third is nothing but your entire prospectus chapter, guys. The company is offering shares to outsiders. That is, either company is making a public offer or company is making a private placement. Even over here, company has to get a prior special resolution passed. Then when the company issues convertible debentures or convertible preference shares, see today, okay, not a problem. But in the future, when the debentures are converted into equity shares, there will be more number of equity shareholders in the company. So existing equity shareholders, their control over the company will become lesser. So today when we are issuing the convertible debentures, that time itself we need to get special resolution from the shareholders. See, don't make a mistake. When is SR required? Is SR required at the time of issue of convertible debentures, or is SR required at the time of conversion? Not at the time of conversion, guys. Only at the time of issue of the convertible debentures. Then we came to the fourth part, the fourth limb, the most important limb of section 62, wherein the government on one side This government can be central government or the government can be state government. We have government on one side and on the other side we have company. Company owes money to the government. Now company is unable to repay that money. That money which the company owes to the government, originally it is not convertible and all. Company just owes money to the government. Okay. Now government is thinking it is required in the best interest of the public to convert the loan which company owes to the government into shares. In reality, originally it is not a convertible loan. There is no convertible point in the terms and conditions and all. But company is unable to repay. So government will put unnecessary pressure on this company to repay. So instead of doing that, government is thinking it is better in public interest if that loan gets converted into equity. So in such cases, government will pass an order converting the loan into equity. What are the terms and conditions? It will be converted into how many shares? All the terms and conditions the government will tell to the company. See, can the company appeal against the conversion? No. The company can appeal only against the terms and conditions of the conversion. If the company is not okay with this conversion, the company cannot appeal against the conversion. Company cannot say no, don't convert like that. Like that company cannot say. But if company is not okay with the terms and conditions of conversion, that company can appeal. Within how much time? Within 60 days. Within 60 days of the government's order. Then if the loan is converted into equity shares, total number of equity shares in the company will increase. To that extent, authorized capital is deemed to be increased. Section 61 OR and all doesn't have to be passed. The authorized capital is deemed to be increased. Alright. So this is section 62 subsection 4. In this particular point alone, I want you to remember the subsection number also. It's simple to remember, guys. It's the fourth limb of section 62 subsection 4. Okay guys, so total 4 things we have in section 62. In the first limb, the company is raising more money by issuing more shares to existing shareholders. In the second limb, company is raising money from the employees by giving ESOPs to them. In the third limb, company is offering shares to outsiders in the form of public offer or in the form of private placement. In the fourth method, company has a loan which the company owes to the government. Company is unable to repay. So instead of putting pressure on the company to repay, the government is telling the company in public interest to convert those loans into shares, even though originally that was not a convertible loan. Okay, so going to the next section now, which is section 63, which talks about bonus issue. Even in bonus issue, like rights issue, the company is offering more shares to whom? To the existing equity shareholders of the company. But the difference is in rights issue, in return the company is getting the rights price. But bonus issue is made for free, which means we are not charging anything from the shareholders. So in bonus issue also, the company is offering more shares to the existing shareholders of the company on a proportionate basis. So because the company is issuing more shares, we will credit share capital. But what will we debit? We can't debit money, we can't debit cash or bank because no money is coming in. So what will we debit? We will debit our reserves like free reserves, securities premium or CRR. Any of these we can debit, but we can't debit revaluation reserve. Then we discussed that whenever the company wants to make a bonus issue, like dividend, it is recommended by the board and it is authorized by the shareholders in the meeting by passing an ordinary resolution. Then company can make a bonus issue only if it is authorized by the AOA. There should not be any subsisting default with respect to repayment of deposits or debentures. There should not be any subsisting default relating to statutory dues of employees. The outstanding partly paid up shares should be fully paid up. Only then the company can issue more bonus shares. We learnt logic also for this. What's the point? The point is if the company is issuing bonus shares, the existing shares should be fully paid up. Only then the company can issue bonus shares. And lastly, if the company has declared dividend, company should pay dividend. If company has declared bonus shares, company should issue bonus shares. Company can't declare dividend and give bonus shares instead. Company can't declare bonus shares and give dividend instead. Bonus shares and dividend, yes, both are distributions for shareholders, but there's a difference. In dividend, money is coming in for the shareholders. In bonus shares, more shares are only flowing in for the shareholders. So bonus shares cannot be issued in lieu of dividend. So this was section 63, guys. Simple section. Company is offering more shares to existing shareholders proportionate to the shares which they are already holding in the company. So share capital will be credited. What will we debit? Free reserves, securities premium or CRR. In fact, we learned CRR can't be used for any other purpose except to issue bonus shares. Revaluation reserves and all we can't debit. Then we learned that bonus share is nothing but capitalization of profits because we are simply taking money from the reserves account and putting money into the share capital account. So we are simply capitalizing the reserves. This was also held in the case of Standard Chartered Bank versus Custodian. And then we saw the conditions. It has to be authorized by AOA. It should be recommended by the board and authorized by the shareholders in the general meeting by passing an ordinary resolution, then there should be no subsisting default relating to repayment of deposits and debentures. There should not be any subsisting default relating to statutory dues of employees. The outstanding partly paid shares should be made fully paid up, and lastly, bonus shares cannot be issued in lieu of dividend. Then we learnt about section 64. Section 64 comes into the picture in three situations. Number 1, whenever the company redeems preference shares. Number 2, alteration of share capital. And number 3, section 62 subsection 4, remember just now we learnt Government of India, company. Government of India can be central government or state government, and company. Company owes a loan to the government. Company is unable to repay. So in public interest, the government is converting this loan into equity shares and becoming the shareholder of the company. So three situations we're talking about, guys: redemption of preference shares, alteration of capital, and 62 subsection 4. In all these three cases, we have to inform the ROC about it. We have to inform the ROC within 30 days in form number SH7. In all the three, there's going to be a change in the capital clause. See, there's a reason why all the three are combined into section 64, because in all the three, your capital clause is going to change. Like when we redeem preference share capital the number will go down, so authorized capital will change. When we alter the share capital, this we know very well, this in fact section 61 targets authorized capital only, targets capital clause only. In 62 subsection 4, we learned that whenever the loan gets converted into equity shares, in all those cases, it's as if, see, the total number of equity shares in the company will increase upon this conversion. To that extent, authorized capital is deemed to be increased. So in all the three cases, if you see, my authorized capital number is getting attacked. So that is why these three concepts are combined together in section 64. In all the three concepts, we are supposed to inform the ROC after this happens. Within 30 days, we are supposed to inform in form number SH7 along with the altered MOA. Why altered MOA? Because capital clause is going to get changed in all the three sections. So therefore, with the altered MOA with form SH7, ROC has to be informed within 30 days. You understood the logic why all the three we are talking about in one section? Because in all the three, our capital clause, our MOA does get attacked. Okay. So coming to the next concept now, section 66, reduction of share capital. Now this is a concept which you will never forget for the rest of your life, but still let me give you a quick revision once again. See, in section 66, first of all, we had learned the three methods in which we can reduce capital. In the first method, the precondition is that the shares must be partly paid up shares, right? In the first method, the shares must be partly paid up shares, and here what happens is, like for example, let's say 10 rupees share, and let's say 6 rupees is paid up. So what is the liability of the shareholders? Shareholders still have to pay 4 rupees per share, they still have to pay, guys. But the company is telling the members, go members, enjoy. You don't have to pay this 4 rupees per share. So we are reducing or we are extinguishing the liability of the members. This is the first method in section 66, guys. Read the English over here. We are extinguishing or we are reducing the liability of members with respect to capital not paid up. Capital not paid up means what? In our example, 4 rupees is a capital not paid up. That much is still the liability of the members, right? So the company is telling the members, you don't have to pay that 4 rupees per share. You have paid 6 rupees, right? We will reduce the face value also to 6 rupees. So it will be as if 6 rupees share, 6 rupees fully paid up. Shareholders, you don't have any liability anymore. This is the first method. In the first method, the company is extinguishing or reducing the liability of members with respect to capital not paid up. This method will apply only if the shares are partly paid up shares. In the second method, the precondition is that the company is having P&L debit balance, which means the company is having losses. Alright, so here I had given you the balance sheet example. The same example I'll give you again. Let's say in the company's balance sheet, paid up share capital is 1 lakh. So ideally, on the asset side also we should have 1 lakh, but asset side we are having only 80,000. So I asked the company, what happened to the balance 20,000? Company is saying that is my P&L debit balance, which means this is my accumulated loss, which means out of 1 lakh capital, companies right now having only 80,000 left. Balance 20,000 is lost. So now in such case, the real capital of the company is not really 1 lakh because 20,000 out of that 1 lakh is lost. So company will simply pass the entry share capital account debit to P&L account 20,000. So when the company does this, from the balance sheet, P&L will disappear and paid up share capital will reduce. Paid up share capital will reduce from 1 lakh to 80,000, guys. This is the second method where the company is writing off or cancelling the lost paid up share capital. Lost paid up share capital means what? Paid up share capital which is not represented by assets. In our example, 20,000 was the paid up share capital which was not represented by assets, guys. So company is writing off or cancelling the lost paid up share capital. This is the most common method of reduction of capital. This is what you do in advanced accounts and internal reconstruction also. Then here I had told you, if the company keeps the face value as 10, let's say earlier face value, before all this, okay, before all this face value was 10 and the paid up value also was 10. Now, after doing all this, the paid up value is reduced to 8 because for 2 rupees per share, we did not have assets. So, we wrote off that paid up share capital. So, paid up value has reduced, guys. In the second method, paid up capital is reducing. So, paid up value per share, let's say it has reduced to 8. Now, if the company lets the face value stay 10 itself, then the liability of members is not extinguished. But if the face value is also reduced to 8, then the liability of members will be extinguished. So, if you look at the methods, in the first method, the liability of members will always reduce. In the second method, if you see, the liability of members may be extinguished, it may not be extinguished, it depends. If the company reduces the face value also to the same extent, then the liability will reduce. If the company doesn't reduce the face value to the same extent, then the liability will not reduce. Then in the third method, the company is returning the excess paid up share capital, which is more than the needs of the company. So in the first method, the precondition is that the shares must be partly paid up shares. That's your precondition, that the shares are partly paid up shares. Only then the first method can apply. In the second method, the precondition is companies having P&L debit balance. In the third method, the precondition is that companies having excess money. Companies saying, oh shareholders, you have given me so much money. Money everywhere. What do I do with so much money? Let me return 2 rupees back to you per share. So let's say it was 10 rupees share and let's say full 10 rupees was paid up. Company saying, I'm going to return 2 rupees back to you. So paid up value will reduce to 8 rupees, guys. Same thing even over here. Now if the company lets the face value stay 10 rupees itself, it means company saying, listen shareholders, right now I'm returning 2 rupees to you, but later whenever need arises, I will ask you to give me the money back. So in that situation, if the face value remains 10, then the liability of members is not reducing. Liability of members is still staying. But if the company reduces the face value also to 8, then the liability of members is extinguished. So in the first method, the liability of members will reduce. But in the second and in the third method, the liability of members may reduce, may not reduce, depends upon is the company reducing the face value also or not. Remember guys? Yes. So first method, extinguishing or reducing the liability of members with respect to capital not paid up. Here the company is having some over here company is having partly paid up shares. Precondition is partly paid up shares. In the second method, company is writing off the lost paid up share capital which is not represented by assets in the company. So in the second method, company is basically having some P&L debit balance. In the third method, company is paying off paid up share capital which is in excess of the needs of the company. Company is returning the excess capital back to the members. So in the second and in the third method, the liability of members may reduce, may not reduce. Then we had learnt about the entire process with respect to reduction. First of all, special resolution has to be passed. To pass the special resolution, equity shareholders, preference shareholders, both will get voting right, because we've already spoken about this point in section 47, voting right of shareholders. Then there should not be any subsisting default relating to deposits, and to do this reduction of capital, we also need NCLT's approval. So for this, we had drawn one nice diagram. We said that first of all, the company will submit application to NCLT. Wait, let me show you the diagram itself. Look at this guys, this is the diagram I was discussing with you about. So first of all, SR will be passed. In the SR, equity shareholders, preference shareholders, both will vote. Once the SR is passed, company will file an application with NCLT. NCLT will immediately give a notice of the application to 4 people. Central government, who has delegated this work to regional director, ROC, SEBI. NCLT will give notice to SEBI only if the company is a listed company, and NCLT will also give a notice to the creditors. We had discussed at stretch that why creditors are important in section 66. Same reason guys, in reduction of capital in section 66, the capital of the company is reducing. Wherever capital of the company reduces, the creditors will become unhappy. So we have to get their consent also. So NCLT will give a notice to creditors also. To all these 4 people, NCLT will give notice, and NCLT will tell them, if you have any objections, send us the objections. We will not use the word objection, we will use the word representation. So NCLT will tell these 4 people that this is the reduction of capital that is being proposed by the company. If you have any representation, send the representation within 3 months. Now if these 4 people are not sending any representations, okay, then NCLT will assume that they are not having any objections, and NCLT will go ahead with a reduction. So if they have representations, they should send, because if they don't send representations, NCLT will assume that these 4 people don't have any objections. Okay, But with respect to creditors, here we have a special point. From creditors, either we have to get their consent, or we have to discharge them, which means repay them, or we have to give them security. For creditors, the rule is a little strict. Either somehow get their consent, or discharge them, or get security. So once these 4 people are settled, once they are happy, then NCLT will now be worried about the accounting treatment. So auditor will give a certificate saying that the proposed accounting treatment is as per the applicable accounting standards. That auditor certificate the company will file with NCLT. Now NCLT will pass an order confirming the reduction, telling the company, yes company, you can go ahead with the reduction. But the process doesn't end here. Company will have to file with the ROC a copy of NCLT's order confirming the reduction. Company will also have to file with the ROC minutes which are approved by the NCLT. Then ROC will register these documents, and ROC will also issue a certificate in this regard. And finally, we had learned that after all this is done, company will have to publish in newspapers 2 things. Number 1, the fact that company did this reduction process, and number 2, the reason that why did the company do this reduction process. Then we learned that where it has to be published, in which newspaper, within how much time. Companies Act is not saying all that. Companies Act is giving power to NCLT. That NCLT, when you give the order, no, in the order itself you have to mention that where should the publication be made, in which newspaper, when should it be made, how many times, all that NCLT will mention in the order itself. So this was the whole process, guys. Company will give application to NCLT, NCLT will give notice to 4 people, these 4 people will send representations within 3 months. If they don't send representation, it is as if they don't have objection, but creditor special treatment, either get their consent or discharge them or give them security. Then after all of this, the auditor will give a certificate saying that accounting treatment is as per applicable accounting standards. Then NCLT will pass an order confirming the reduction. Company will file documents with ROC. Company will file 2 things with ROC within 30 days. Number 1, NCLT's order, copy of that, and minutes approved by NCLT. And finally, company will have to publish the reasons for the reduction and also the fact that the reduction happened. Both both company will publish where, how many times, in which newspaper, all that NCLT will mention in its order. So this was the whole process of reduction. Then we learned that in all of these 6 situations, yes, no doubt, some form of capital is getting reduced, but section 66 will not apply. Surrender of shares, forfeiture of shares, diminution of shares, nothing but cancellation of shares. Remember we spoke about this in section 61. So section 61 will apply, don't apply section 66. Redemption of preference shares, section 55 will apply, don't apply section 66. Then purchase of shares of a member by an order of the court, apply the court order, don't apply section 66. Buyback of shares, even here capital reduces, apply section 68, don't apply section 66. Coming to the next section now, section 67. Section 67 is a small, simple, sweet little section sandwiched between 2 big ones. Section 66 on one side, section 68 buyback on another side. In between we have one cutie little section which very often gets compromised, but you will not compromise. Listen to me everybody. Sit up straight and listen. Don't lose your patience. We are almost towards the end. We are almost coming to an end. Listen. So section 67 puts 2 prohibitions, guys. Prohibition number 1, section 67 says that any company, every company, you cannot buy your own shares. Reliance can't be its own shareholder. So point number 1, company, you cannot purchase your own shares. The second prohibition is only for public company. That public company, you cannot give financial assistance for purchase of your own shares or for shares of holding company. But there are 3 exceptional cases. In these 3 exceptional cases, even public company can give financial assistance. What are the 3 cases? Number 1, banking company can give a loan in ordinary course of business. Now, even if the borrower uses that loan to buy the same banking company's shares, then it will not be considered as a violation. It is allowed because the banking company has lent loan in the ordinary course of business. But, if the banking company lends loan for the purpose of purchase of its shares, that will not be ordinary course of business. That is not allowed. Okay, so banking company is giving loan in ordinary course of business and the borrower happens to use that loan to buy the same banking company's shares, it is not a violation. But if the banking company is giving loan for the purpose of purchase of its shares, that is going to be a violation. Then the second exception, public company can give financial assistance for purchase of fully paid up shares. Whose shares? Its shares or holding company's shares. To whom? To trustee. Trustee means who is the beneficiary? The employees. But for this, prior SR is to be passed. So in the second part, the public company can give financial assistance for purchase of its shares or its holding company's shares to the trustee for the benefit of employees, provided a prior SR is passed. In the third exception, company is not giving to trustee for benefit of employees. In the third part, company is directly giving the loan to employees. Which employee? Any employee other than director or KMP. How much loan company can give maximum here? 6 months salary. Understanding? So the company can give loan to employees other than directors or KMP to purchase fully paid shares of the company or holding company, but not more than 6 months salary of the employee. Okay. Now coming to the next point, section, we just said that the financial assistance cannot be given by public company, which means it can be given by private company. It can be given by which private company? You're listening to me. Financial assistance, we said, can't be given by public company. To purchase its own shares, public company cannot give financial assistance, which means it can be given by private company. So it can be given by which private company? Only that private company which fulfills 4 conditions. Condition number 1, no default in filing financial statements annual return. Condition number 2, no other body corporate should have invested in this company's shares. Number 3, borrowings from 3 people, banks, financial institutions and body corporates should not exceed the limit. What is the limit? 2 times of paid up share capital or 50 crore, whichever is less, and no subsisting default in repayment of the borrowings. Try to recall Jan 25 question paper question on this section 67 we had worked out as well in class, exactly targeting this point. So yes, financial assistance cannot be given by public companies, which means it can be given by private companies. It can be given by those private companies which fulfill these 4 conditions. Okay guys, simple section 67, 2 prohibitions. Prohibition number 1, company you can't purchase your own shares. This prohibition is for every company. Then prohibition number 2, public company, you cannot give financial assistance for purchase of your shares or for the purchase of shares of your holding company. But 3 exceptional cases where even a public company can give financial assistance. Number 1, banking company is giving loan in ordinary course of business. Number 2, public company can give loan to a trustee for purchase of fully paid shares of the company or holding company for the benefit of employees, but this should be supported by a prior SR. Third exception, company can give loan to employees other than directors or KMP up to 6 months salary for the purchase of fully paid shares of company or holding company. And then finally we learned that yes, private company can give financial assistance, but which private company? Only that private company which fulfills all of these conditions. Okay. Then coming to buyback, section 68 and section 69, and the last part will be section 70 as well. So buyback of securities, we'll go through the points one by one. Point number 1, if the company wants to buy back securities, from whom is the company going to buy back? Company can buy back from the existing shareholders on a proportionate basis, like what TCS did, or company can buy back shares from the open market, which means company can go to the open market and whoever is willing to sell the shares, company can buy the shares from all the persons who are willing to sell the shares till the company reaches a certain target. Like company will go with the target, I want to buy back 5,000 shares. So till the company reaches the target, company will keep buying the shares from whoever is willing to sell the shares. That is from the open market, or company can buy back shares just from the employees. How did employees get the shares? Either through sweat equity or through ESOPs. So point number 1, company can buy back securities from whom? Either from the existing shareholders on a proportionate basis or from the open market, or company can buy back securities back from the employees who got shares either through ESOPs or through sweat equity. Then we learned to buy back, company needs money. So company will take money from where? Company, you have 3 options. You can take money from free reserves, from securities premium, or you can make a fresh issue of shares and take money from that. But you cannot take money out of earlier issue. You can take money out of fresh issue. Then we learned whatever money company takes from these 2 boxes, free reserves and securities premium, we'll see how much money company took from here. Using this much money, how many shares company bought back? That many shares into face value, company will transfer into CRR. Same thing we had even in section 55, redemption of preference shares. But there we see only how much money company took from free reserves. We don't see the securities premium bucket, because over there securities premium money you can use only to pay premium on redemption. Here there is no restriction like that. So we will see how much money company has taken from both these boxes put together. I am not saying transfer that much money into CRR. No. Using that much money, how many shares company bought back? That many shares into face value. That is what will be transferred into CRR. Try to recall the numerical question we did on this point. Okay. Then after this we had learned If the company wants to buy back, it has to be authorized by AOA, and then board resolution is required. SR is also required. But SR is not required in every case. If the company is spending on buyback not more than 10% of paid up equity capital plus free reserves, if the company is spending not more than this much money, then just BR is enough, SR is not required. But if the company is spending more than this much, then SR is required. But maximum how much money company can spend? Maximum company can spend 25% of paid up share capital plus free reserves. In buyback, wherever we talk about free reserves, even securities premium will come into the picture. Now for this BR SR point, I will once again draw the diagram for you, which I drew for you in the class as well. See, I told you 0 to 10% of paid up equity share capital plus free reserves plus securities premium. If the company is spending not more than this much, if this is all the money that the company is spending, if the company is spending in this bracket, then company, you just have to pass a board resolution. If the company is spending more than this, company, you have to pass BR, you also have to pass special resolution. But maximum how much company can spend? 25%. 25% of what? Paid up share capital plus free reserves plus securities premium. The point to be noted is, for BR, the limit is paid up equity share capital, but total amount that you can spend, there the limit is paid up share capital. Tiny point, guys, not tested till now much in the exam. Be careful with all these little points, okay? So if the company is spending up to 10% of paid up equity capital plus free reserves plus securities premium, BR alone is enough. But if the company is spending more than 10%, SR is also required. But how much maximum company can spend? Maximum company can spend 25% of paid up share capital plus free reserves plus securities premium. And maximum how many shares the company can buy back in a year, guys? 25% of total paid up equity share capital. And after buyback, debt can be more than equity, but debt should not be more than 2 times of equity. Debt by equity should be less than or equal to 2. And when you're calculating the debt equity ratio, equity will mean paid up share capital plus free reserves plus securities premium. So this was our 3 limits, guys. First of all, how much maximum the company can spend on buyback? 25% of paid up share capital plus free reserves plus securities premium. Then limit number 2, how many shares company can buy back maximum? Maximum company can buy back 25% of the total paid up equity share capital. And number 3, after buyback, yes, debt can be more, equity can be less. But it can't be like debt is very high. Debt should not be more than 2 times of equity. So debt by equity should be less than or equal to 2. It should not be more than 2. When you're doing this debt equity calculation, remember this calculation is done post buyback. And also remember, equity, the denominator will be equity share capital plus free reserves plus securities premium. Okay. Then after this, we spoke about the explanatory statement. We discussed that when the company is doing a buyback of securities, SR is to be passed. To pass the SR, company has to call a meeting. To call the meeting, company has to send a notice. Now to that notice, company will attach an explanatory statement, and in that explanatory statement, company will put 5 things. The hint to remember is stand. S for which shares, which securities is the company buying back, time limit within which the buyback will be completed, amount which the company is going to spend on buyback, necessity, need for buyback, and disclosure of all material facts. Then before buying back, the securities have to be fully paid up. Only then the securities can be bought back. This fully paid up point, where and all we have seen, tell me. Number 1, only fully paid up shares can be converted into stock. Number 2, when we are redeeming the preference shares, before redeeming they have to be fully paid up. Only then we can redeem them. Then number 3, bonus shares. Before we issue bonus shares, those shares should be, the existing shares should be fully paid up. Only then we can issue bonus shares. And number 4, when we are buying back the shares, before buying back they should be fully paid up. Only then we can buy back. So in your one share capital chapter, in 4 places you are finding this one condition of fully paid up. Learn like this, guys. Make lists like these. As many lists as you can, make them. Makes revision much easier day before the exam. Then, if the company is a listed company, of course, SEBI regulations also have to be followed. If you've understood till here, the process for buyback, this part onwards, let me take you directly into the classroom notes. We'll revise it from there. Yeah, so let's discuss the process from here. Whatever points we've discussed till here, I'm hoping you're clear, guys. We spoke about the contents of explanatory statement, the limits, and we discussed if the company is a listed company, company has to follow SEBI regulations as well. Now come to the process, guys. Let's focus on the process. So first of all, company will prepare a document for buyback. The document is called letter of offer. For whenever the company is making a public offer, company prepares a document called prospectus. In private placement, the document is called POCA, private placement offer cum application. In rights issue and in buyback, in both the document is called as letter of offer. So company will prepare letter of offer in form number SH8 and file it with ROC. Okay. Now from that date, the clock will start ticking. Within 20 days itself, company has to dispatch the letter letter of offer to shareholders. Remember, this 20 days is the maximum time limit. Within 20 days itself, it has to be dispatched to the security holders. Once it is dispatched to the security holders, the buyback offer period will open. It will remain open for a certain period. So let's say this is a buyback offer open date and this is a buyback offer closing date. Now in between, what will the time gap be? The time gap can be anywhere between 15 days to 30 days. Okay. Then after this, we learned that in this offer period, the shareholders are offering their shares for buyback to the company. So when the shareholders are offering the shares for buyback to the company, sometimes there is oversubscription. Like in TCS, I told you, it was 6 to 7 times oversubscribed. Oversubscription means, see, to understand oversubscription and to understand the next point, first of all, you have to understand that this SH8, this letter of offer that we are talking about, is an invitation to offer. It's not an offer. Through SH8, the company is telling the shareholders that, see, I'm willing to buy back shares, and at this much price, I will buy back shares. Let me know if you want to offer your shares for buyback. So SH8 is only an invitation to offer. Then in this period, when the buyback offer is staying open, in this period, the shareholders will offer for buyback their securities. Okay, so it is the shareholders who will give an offer to the company that, company, listen, we will offer these many shares for buyback. Alright, now sometimes what happens is the shareholders offer too many shares for buyback. Like when TCS buyback happened, I was showing you how per share around 600 rupees profit the shareholders could have made if they offered the share for buyback. So sometimes when the shareholders are offering their shares for buyback, they offer too many shares. Oversubscription happens. When oversubscription happens, that is where this next step, acceptance ratio, comes into the picture. The company accepts the offer of the shareholders on a proportionate basis. So this is what my next point is. When the number of securities which is offered for buyback by the shareholders is more than the number of securities which the company wants to buy back, in that case, company will come up with an acceptance ratio. Company will accept the shares offered for buyback on a proportionate basis. Okay, so SH8 is an invitation to offer. I'm just connecting Companies Act with Contract Act over here because this is a language which you understand very well. So through SH8, company is telling the shareholders that, see, I'm thinking of buying back shares and this is the price at which I'm going to buy back shares, and totally this many shares I want to buy back. If you're holding 10 shares, you can offer 5 shares to me for buyback. Like that, company will prepare SH8 and give to the shareholders. Then the buyback offer period will open. When the buyback offer period is open, it will stay open for minimum 15 days, maximum 30 days. The time limit will be written in SH8 itself. In that period, the shareholders will offer their shares for buyback. Sometimes they offer too many shares. Sometimes when the shareholders are offering their shares for buyback, it results in an oversubscription of the buyback offer. So when that happens, the company will accept the shares for buyback only on a proportionate basis. Got it, guys? So nothing much, very easy only. If you remember it this way, this invitation to offer this way, if you remember, you will definitely not make a mistake. So therefore, coming back to the process now, company will prepare letter of offer in form SH8. The company will file it with ROC first. Within 20 days from that date, company will dispatch it to the shareholders. That day, the buyback offer period will open. It will remain open for a certain period. This period shall not be more than 30 days. It shall not be less than 15 days. In this period, the shareholders will offer their shares for buyback. If the number of shares which the shareholders have offered for buyback is more than the number of shares which the company wants to buy back, then the company will buy back your shares on proportionate basis only. Okay. Then look at this next part, guys. This straight away come over here. Once this, I already told you, letter of offer, once it is filed with ROC, within 20 days, company will dispatch it to the security holders. Now that is the day when the buyback offer will open and it will stay open for a certain period. So till here you understood. Now once the buyback period closes, listen carefully, this is where the next point is. So once a buyback offer closes, within the next 15 days, company will verify the buyback offers received. What is this buyback offer received? I just told you, right? The shareholders will send their offer to the company that how many shares they are willing to offer for buyback. So company will verify the buyback offers received from the shareholders. Now either the company will accept the buyback offer and company will buy back the shares, or company will reject the buyback offer. If the company is accepting the buyback offer, it means company saying, okay fine, I'll buy back your shares. So company will send buyback price to those shareholders within 7 days. But if company is rejecting the buyback offer, then the company will send refusal notice within 7 days. So once the buyback offer closes, within the next 15 days, company will verify the buyback offers received. Either the company will accept those offers or reject those offers. If the company is accepting the buyback offers, company will buy back the shares and send the buyback price to the shareholders within 7 days. If company is rejecting, company will send refusal notice within the next 7 days. Now what if the company is not sending refusal notice? If company doesn't send refusal notice, it is assumed as if the company has accepted the buyback offer. Okay. Then after this, our next concept is about declaration of solvency. This is an important point I told you. Through the declaration of solvency, we are giving some sort of assurance to the creditors that creditors, yes, we know we are not repaying you, and without repaying you, we are returning the money back to the shareholders. But don't worry, creditors, we have done a good inquiry into the affairs of our company, and company has enough money for you also. So on that note, one declaration will be given. So in this declaration, two things will be written. Number one, board has made a full inquiry into the affairs of the company, and on the basis of the inquiry, board is of the opinion that the company is capable of meeting its liabilities and company will not go insolvent at least for the next 1 year. So don't worry creditors, we have enough money for you also. That's the whole context of this declaration. This declaration has to be filed with both ROC and SEBI. We will file it with SEBI only if the company is a listed company. This declaration will be in form SH9. It has to be signed by at least 2 directors, one of whom will be managing director. Then we learned that the company has to maintain a separate register of buyback in form SH10, which will contain all the details about the buyback, like how many shares the company bought back, at what price, why did the company buy back, on which date the company cancelled the shares. All the details about buyback will be written in the buyback register. It will be kept at the registered office in the custody of the company secretary or any other person authorized by the board of directors. Then company has to file buyback return also with ROC or SEBI as the case may be. SEBI if the company is a listed company. This buyback return has to be filed within 30 days of completion of buyback. Now to this buyback return, form SH15 has to be attached, which will be a certificate given by 2 directors, out of which one of will be a managing director. So to the buyback return, a certificate will be attached, a certificate by the directors saying that all the provisions relating to buyback given in the Companies Act, all those provisions have been complied with. So to the buyback return, a certificate of compliance will be attached. Okay, so in the process, what are the points we learned? First of all, we learned that SH8 will be filed by the company with ROC. Then within 20 days, company will dispatch SH8 to the security holders. Then the buyback period will open. Buyback period will remain open for minimum 15 days, maximum 30 days. Time limit and all will be written in SH8. In that period, the shareholders will offer their shares for buyback. Once a period is over, within the next 15 days, company will verify the buyback offers received. Either the company will accept your buyback offer and give you the buyback price within 7 days, or company will reject the buyback offer and give you the refusal notice within 7 days. Then if the number of securities offered for buyback is more than the number of securities which the company wants to buy back, then company will accept your shares offered on a proportionate basis. Then we learned if refusal notice we don't get, it means company has accepted the buyback offer. Then we learned about declaration of solvency. This is to give assurance to creditors that we will not go insolvent, we are capable of meeting our liabilities, we have enough money for you also. Register of buyback will be maintained. Buyback return will be filed with ROC within 30 days of completion of buyback. To the buyback return, one director's certificate will be attached in which the directors are saying that all the provisions given in Companies Act relating to buyback, everything we have complied with. Okay. Then coming to the next part of our buyback discussion, there are some time limits. I have drawn this diagram for you over here. Once the resolution is passed, within 12 months the buyback has to be completed. Same 12 months point we had in sweat equity shares also, guys. There also we said that the special resolution will have validity period of 12 months. Within 12 months, the sweat equity shares have to be allotted. So here also the resolution will have validity period of 12 months. Within 12 months, company should complete the buyback. Once buyback is completed, if the company wants to make another buyback, the time gap between 2 buybacks should be minimum 1 year. Then once the company completes the buyback, the company has to file buyback return within 30 days. Just now we saw, once a company completes a buyback, within the next 7 days, the securities have to be extinguished, but this point is applicable only the shares are physical shares. And lastly, once a company completes a buyback, if you want to raise funds by issuing the same kind of securities again, if you want to raise funds, you have to wait for 6 months. 6 months cooling period is applicable. In 6 months, you cannot issue securities of the same kind. Like company can issue other kind of securities, but once a company completes buyback, for the next 6 months, the same kind of securities company cannot issue and raise funds. But in this, by the way, the 6 months period is called as cooling period. Now in this 6 months period, company can issue bonus shares, because through bonus shares, company is not raising funds. Company can convert preference shares into equity, loans into equity, debentures into equity. That conversion company can do, because company is not raising funds because of conversion. Company can also issue ESOPs. But in these 6 months, you understood what company should not do. In the 6 months, company should not issue more securities of the same kind and raise funds. Okay. Then we learned that section 70 says that this whole concept of buyback, company cannot do any buyback if there's any default relating to deposits or interest, debentures or interest thereon, preference shares or dividend thereon, or repayment of loan, interest thereon. If any of these defaults exist, then company first rectify the default, wait for 3 years, only then you can buy back. Also, if there's any subsisting default relating to annual return, financial statements or dividend, company cannot buy back securities, and company cannot buy back securities through investment companies also. So this was your entire buyback discussion. And now coming to the last concept in your share capital chapter, debentures, covered in section 71. Very simple points, guys. I'll just highlight the main points over here. Debentures are of debt nature. We saw the definition, two parts, debentures include and debentures does not include. So what does debentures include? It includes debenture stock, bonds or any other instrument of the company evidencing debt, whether constituting a charge on the assets of the company or not, but does not include those instruments which are mentioned in chapter 3D of RBI Act, like derivatives and money market instruments and all. Also doesn't include those instruments which are prescribed by central government in consultation with RBI. Then for debentures, company will have to issue a debenture certificate within 6 months. This point we already know. Like shares, even over here in debentures also, company has to file return of allotment within 30 days from allotment. Then debentures will carry a prefixed interest rate. They are movable, they are transferable, and they will not have voting right. Then section 181C we spoke about. In section 181C we discussed that there's a limit. The company can borrow maximum how much money? There's a limit. The total borrowings should not exceed paid up share capital plus free reserves plus securities premium. Now borrowings will also include debentures. So company should issue debentures in such a way that the total debentures issued along with the total borrowings in the company is not exceeding the limit. What is the limit? Paid up share capital plus free reserves plus securities premium. Company, if you want to issue debentures for more than the limit, then you just have to pass one special resolution. Then you can issue debentures for more than the limit. Then we had learnt about debenture redemption reserve. Here we said company 10% of the outstanding debentures has to be transferred into DRR every year. There is no money outflow. We are just taking money from one reserve and putting it into another reserve. But in debenture redemption investment, there will be a money outflow. By 30th April of the current year, company should see how many debentures are maturing in the current year. That much amount into 15% company has to take from the bank account and put into debenture redemption investment. So here we said that there will be an outflow. Okay. Then we had learnt about the different types of debentures: convertible, non-convertible, redeemable, irredeemable, secured, unsecured. Redeemable debentures have to be redeemed within 10 years, but same thing, if the money is raised for infrastructure projects, they will be redeemed within 30 years. Then if they are secured debentures, we have to give some collateral, we have to give some asset, but the asset should be enough to meet not only the amount which is due on debentures, but also to meet the interest amount. Then whose asset can we give as security? Company's asset, associate company's asset, subsidiary's asset, holding company's asset, any of these assets we can give as security. But if there are many debenture holders, then this charge will be created, the security will be given in whose favor? See, they are secured debentures, right? So company will create a charge on the assets. Now the charge has to be created in whose favor? If there are one or two debenture holders, we can create the charge in favor of those one or two debenture holders. But if the company is having multiple debenture holders, thousands and thousands of debenture holders, then in whose favor will the company create the charge on the assets if they are secured debenture holders? So that is where the trustee, debenture trustee comes into the picture. So if they are secured debentures, then company will create the charge in the name of the debenture trustee. He is like a representative of the debenture holders. Then we started learning about debenture trustee. Debenture trustee concept comes into the picture only if we have many debenture holders. If there are few debenture holders, we don't need a representative. When there are many debenture holders, that is when we need a representative. So either the company is making a public offer of debentures or company is issuing debentures to more than 500 members. That is when the company needs debenture trustee. And the debenture trustee has to be appointed even before the company issues a document, because in the document the debenture trustee's name has to be written. Then debenture trustee has to give a prior written consent that he is willing to be appointed as debenture trustee. Then we discussed who cannot be appointed as debenture trustee. We saw any person who beneficially holds shares in the company cannot be appointed as debenture trustee. Then promoters, directors, KMP, employees, their relatives, then any person to whom company owes money, or any person who owes money to cash, any person who has pecuniary relationship with the company, any person who has given a guarantee to the debenture holders that don't worry, company will repay your debenture money, any person who has given this kind of guarantee, such kind of persons can't be appointed as debenture trustee. Then after this we had learnt if the assets of the company are insufficient to redeem the debentures, then debenture trustee will file a petition to NCLT that NCLT company's asset value is less, liabilities are more. Then NCLT will pass an order asking the company not to take further liabilities. But if the company fails to redeem the debentures or fails to pay the interest on debentures, again an application has to be filed with NCLT. NCLT will order the company to redeem the debentures forthwith. Right? So this was a discussion on debentures. Now listen, before I close this chapter, I just want to give you the sequence. I told you that before I end this chapter, I will tell you in what sequence you should be learning this chapter whenever you do revisions. Always remember this basic rule. You never start with the different kinds of capital and all. Whenever you start a new chapter, your energy level is very high. So you should capitalize that energy level to finish the difficult concepts first, the more important concepts first. So whenever you're learning buyback, you should first finish buyback. Whenever you're doing the share capital chapter, you must first finish buyback. Then you must finish debentures. Then you must finish section 66. Then you must finish section 61, and then you can finish everything else in whatever order you want. Okay, but you should first be doing these 4 things, only then you come to everything else. Understanding, everybody? Finish buyback first, debentures, section 66 reduction of capital, section 61 alteration of capital, only then do everything else. Alright guys, so with this we are finally done with this big lengthy chapter. I am hoping you are as confident as I am imagining you to be. When I started this chapter for you, I first explained to you that what exactly do you even mean by deposits. We had arrived at a conclusion, if you remember. The conclusion was, if the company has received money, that money is of debt nature, that money has a repayment period, that money carries interest, maybe secured, maybe unsecured, doesn't matter. Point is, company is receiving money of debt nature. We will first call it deposits. But however, there is a list of exclusions given in Rule 21C of Companies Acceptance of Deposit Rules 2014. So if the money received by the company comes in that list of exclusions, then it is not a deposit. Otherwise, every money which is received by the company, which is in the nature of debt, you will put it under the deposit concept. Right guys? So we had a definition for deposits. The definition is given in section 2 clause 31. It says deposit includes. So yes, it is an extensive definition. Deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amount as may be prescribed in consultation with RBI. So here we learned that first of all, deposit, yes, it is a receipt of money. Who is receiving the money? Company is receiving the money. What name is the company giving to this? Whether the company is calling it deposit, loan, or whether company is calling it anything else, I don't care. Point is, company is receiving money of debt nature, I will immediately call it as deposit. However, if the money received is something which is mentioned in the list of exclusions, where is the list of exclusions given? The list of exclusions is given in Rule 21C of Companies Acceptance of Deposit Rules 2014. So, if the money received is given in this list of exclusions, then it is not going to be considered as deposit. Okay, then we had learned that just like loans, even deposits have a repayment period. Just like loans, even deposits can be secured or unsecured. But if they are unsecured, everywhere we have to keep quoting that they are unsecured, unsecured, unsecured. And then we also said that just like loans, even deposits carry a fixed rate of interest. Okay, then we had learned that from whom can the company accept deposits? If I am a private company, I can accept deposits only from the members. If I'm a public company, we'll have to see, am I an eligible public company or not? If I'm an eligible public company, I can accept deposits from members also, from the public also. But other public companies can accept only from the members. So then we made a summary. We said that from members, every company can accept, whether you're a private company, public company, eligible company, not an eligible company, doesn't matter. But who can accept deposits from the public, guys? Only one company. Which company? Eligible public company. Okay. Then we had learnt after all of this the list of exclusions. This was the most important concept in your entire deposits chapter, guys. And here each of these 15 exclusions we learnt with the logic that why is it excluded. But now in the revision session, I'm not bringing the logic once again. I'm just quickly reminding you of these 15 exclusions. Exclusion number 1. Company has received money from central government, state government, local authority, statutory authority. Exclusion number 2. Company has received money from any other person, but central government or state government has given guarantee to this person that hey, don't worry, company will receive money. So any money, repayment of which is guaranteed by the central government or state government is not a deposit. Then number 3, money received by the company from foreign government, foreign banks, foreign institutions, multilateral financial institutions like World Bank or Asian Development Bank, foreign citizens, all this money will not be considered as deposit. First 3 exclusions done. Fourth exclusion, company is receiving money from an Indian bank or a cooperative bank or from public financial institution or from regional financial institution or from an insurance company or from a scheduled bank. This money will also not be considered as deposit. Then fifth exclusion, company has issued commercial paper. Against commercial paper, company has raised money. Even that money will not be considered as deposit. Then our sixth point, this was important, remember, we had learned that company has received share application money. It is not a deposit as of now. Company allot the shares within 60 days of receipt of share application money. If company does that, great. If company doesn't do it, it's okay company, we understand it happens. Refund within the next 15 days. If company refunds within the next 15 days, great. If the company does not refund within the next 15 days, the next day onwards, that share application money, we will start treating it as if it is deposit. Then in the seventh exclusion, company is receiving money from directors. If it's a public company, whatever money it has received from directors, it is not a deposit. If it's a private company, whatever money the company has received from directors or from the relatives, it is not a deposit. So once again, any money which the public company has received from directors, any money which private company has received from directors or relatives, it is not a deposit. However, for this money not to be a deposit, for this exclusion to apply, two conditions have to be fulfilled. Condition number one, the directors, the relatives, as a case may be, they have to give a declaration to the company that whatever money they are giving to the company, the money is out of own funds and not out of borrowed funds. And number two, whatever money is so received by the company, proper disclosure about it has to be put in the board report, guys, under section 134. This is a very important exclusion, and hence giving you a revision one last time. I am a public company, I have received money from directors. I am a private company, I have received money from directors or from the relatives. This money will not be deposit provided the directors or the relatives, as a case may be, have given a declaration saying that the money is out of own funds and not out of borrowed funds. And one more condition, the directors have made a proper disclosure in the board report. If these conditions are not fulfilled, then this money will be considered as deposit. If these conditions are fulfilled, then this money will not be considered as deposit. Right, guys? Coming to the eighth exclusion now. Here company has issued debentures or bonds. Against this company is receiving money. Now this money which the company has received against debentures or bonds is not a deposit, provided the debentures, they are either secured, and that too secured by a first charge by giving tangible asset as security, or it should be listed debentures listed on a recognized stock exchange, or it should be compulsorily convertible. Once again, I will stress upon the word or, guys. I am not saying that they should be listed also, convertible also, secured also. I am not saying like that. I am saying either they should be listed or they should be compulsorily convertible, or they should be secured. So out of the three, even one condition fulfilled, guys, that money will not be considered as deposit. What are the three conditions? Either the debentures have to be secured, that was secured by a first charge by giving some tangible asset as security, or they should be compulsorily convertible debentures, or they should be listed, that too listed in a recognized stock exchange. Then comes our ninth exclusion, guys. In the ninth exclusion, company has received money from employees. How much money? Not more than their annual salary. Why? It is under the contract of employment, and will it carry interest? No, it is non-interest bearing security deposit. You can't change the language over here, guys. It is non-interest bearing security deposit. So once again, in the ninth situation, company has received money from whom? Employees. How much money? Not more than their annual salary. And why? It is as per the contract of employment. And what name will we give to this money? Non-interest bearing security deposit. If these conditions are fulfilled, then whatever money the company has received from employees, it will not be considered as deposit. Remember, it is in the form of security deposit, which means we are worried that the employee might misuse our confidential information. We are worried that the employee might misuse our high value raw materials. We don't want him to do that. So that is why we are collecting some security deposit from him, saying, employee, listen, if you misuse our confidential information, then we will forfeit this deposit. So this deposit will not be considered as this security deposit will not be considered as deposit. Alright, then 10th exclusion. If the company receiving the money is a nidhi company, or a chit fund company, or a collective investment scheme like forestry funds and all, or alternate investment funds, or real estate investment trusts, or venture capital fund, if the company receiving the money happens to be any of these, then the money that they have received will not be considered as deposit. Then comes your 11th exclusion. This time the company has received money in the capacity of trustee. trustee, and on that money no interest also will be given. So it is non-interest bearing money which the company has received in the capacity of a trustee. It will not be considered as deposit. Then if any company gives money to another company, even this will not be considered as deposit because this will get covered under intercorporate loans covered in section 186. Then 13th exclusion, this was important. Here the company has received unsecured loan from promoters or from their relatives. Company has received what? Unsecured loan. From whom? Promoters or their relatives. Why? Because of a stipulation put by bank or financial institution. So if the company receives any unsecured loan from promoters or from their relatives, because of a stipulation put by bank or financial institution, then that unsecured loan will not be considered as deposit. However, once a company repays to the bank, then the stipulation will not exist anymore. Once stipulation is not existing anymore, company does not require the unsecured loan of the promoters or relatives. So come on company, repay that loan. If you don't repay that loan, that unsecured loan will now be considered as deposit. Right guys? Then our 14th exclusion was all about advance money. If the company has received any advance against goods or services and provided that advance is adjusted against the goods or services within 365 days, then that advance money will not be considered as deposit. Or any advance which the company has received against immovable property, or any advance which the company has received relating to warranty or maintenance services, all this will not be considered as deposit. But we had learnt one important point over here. We had learnt that once the advance money becomes refundable, because of some reason, if the advance money becomes refundable, company refund the money within 15 days. If you don't refund the money within 15 days, then 16th day onwards, now it will get considered as deposit. Okay. Then comes our 15th concept, convertible note. We spent quite a lot of time over here connecting it with startups and Shark Tank and all, if you remember, but giving you the main points over here. In convertible note, there are 4 conditions. Condition number 1 is that the company is a startup company. Startup company means it's a private company recognized as a startup by Department of Industrial Policy and Promotion. So here we said that only a private company can be startup, a public company can't be startup. So condition number 1, the company is a startup company. Condition number 2, company has issued a convertible note. Convertible note means what? Convertible note means an instrument which will either be converted into equity shares or it will be repaid within 10 years. Either it will be converted or it will be repaid, which means, tell me, are convertible notes compulsorily convertible notes? No, they are optionally convertible notes. Condition number 3, company has issued convertible note. So against it, how much money the company received? Minimum 25 lakh rupees. And condition 4, this 25 lakh rupees company did not receive in bits and pieces. Company received this entire money in one single tranche, in one single transaction. If these 4 conditions are fulfilled, whatever money the company has received against convertible note, this money will not be considered as deposit. So these were your 15 exclusions, guys. Whatever money the company receives in the form of debt, we will first call it deposit. But if the money comes in this list of exclusions that we just learned, then it is not a deposit. And where is this list given? This list is given in rule 21C of Companies Acceptance of Deposit Rules 2014. Okay, then we learned that there are some exempted companies like banks, NBFCs, housing finance companies and other companies prescribed by central government in consultation with RBI. These companies are exempted companies, which means these companies can AIR. These companies can accept, invite and renew deposits without following the deposits chapter. Then we learned some special provisions which are applicable if the company is accepting deposits from members. First of all, which company can accept deposit from members, guys? Any company, every company, any company can accept deposit from members. But before accepting deposit from members, the company, number 1, please pass a resolution at the general meeting. Number 1, pass a resolution. Number 2, company, you want to accept deposit from members. So company, don't you think you will have to prepare a document to communicate about this to the members? You will have to tell the members, no, that how much money you want, why you want, when you will repay, what interest rate you will give, all the details you have to put. You have to prepare a document, company. That document will be called as circular. It will be prepared in form number DPT1. It will be sent to each and every member either by registered post acknowledgement due or by speed post or by email. And on which date is the company dispatching it to the members? That date is very important because the date on which the company dispatches it to the members, that will be considered as the date of issue of the circular. Okay. Then we learned that what will be written in the circular. 4 things, guys. Number 1, the financial position of the company. Number 2, credit rating that the company has obtained. Number 3, as of now total amount of outstanding deposits, and number 4 as of now total number of depositors in the company. Okay, and then we discussed that this circular will be issued in the name of board of directors. So relating to acceptance of deposits from members, we had 7 points. So our first point is resolution is required. Second point is circular has to be prepared by the company and sent to all the members. Now listen guys, third point, interesting point. Third point says, listen company, it is not necessary that this is the first time you are accepting deposits. In the past also you may have accepted deposits. Now those deposits, there are two possibilities only. In the past, whatever deposit you have accepted, possibility number 1, you properly repaid, which means there is no default, pakka, good company. Second possibility is that in the past, whatever deposits the company has accepted, company has done default in those deposits. In that case, company rectify the default, wait for 5 years, only then you can accept more deposit. So company, there are only two possibilities. Either in the past you have no default relating to deposits, or in the past if you have defaulted, then you have rectified the default and since then 5 years have lapsed. So out of the two possibilities, which possibility is applicable to our company, the auditor will give a certificate in this regard, and this auditor certificate has to be attached to the circular. So the auditor will give a certificate saying either that the company has never committed a default, or no, company defaulted in the past, but don't worry, default is rectified and since then 5 years have lapsed. So this auditor certificate along with the circular will be filed with the ROC. But listen guys, once it is filed with the ROC, from that day within 30 days it should be dispatched to the members. From the date on which it is filed with the ROC, from that day within 30 days the circular should be issued. Circular should be issued means what? Issued over here means the circular should be dispatched to the members within 30 days. Okay, so your first point was about resolution, second point was about circular, third point was about auditor certificate, fourth point was about filing with ROC. Now comes my fifth point, deposits can be secured or they can be unsecured guys. Just that if they are unsecured, then in CFA we have to mention that it is unsecured. In circular forms and advertisements we have to mention that it is unsecured. But however, if the deposits are secured, then in that case the company can give only tangible asset as security, and the asset should be enough to meet not only the amount which is due on deposit but also to meet the interest amount. So we can give only tangible asset as security, no intangible asset. And number 2, the asset that we are giving as security, the value of the asset should be enough to meet not only the amount which is due on deposit but also to meet interest thereon. So I had given you an example over here. If the total deposit plus interest amount is 136, but if the value of the asset is 120, then you can't call the deposits as partially secured. We discussed that there is nothing called partially secured deposit, either secured or unsecured. Tell me, is a security enough to meet the entire deposit plus interest? Is 120 enough to meet 136? No. So I can't call it secured, therefore I will call it unsecured. If the value of the asset which is given as security is lesser than deposit plus interest, then we will consider the deposits as if they are unsecured deposits. This was your fifth point in the discussion of accepting deposits from members. Coming to the sixth point now, see what is the maximum amount of deposits which the company can accept from the members. That depends upon what kind of a company is it. If it's a private company can accept maximum 100% of paid up share capital plus fee reserves plus securities premium. Eligible public companies 10%, other companies 35%. Don't forget this limit is applicable to what? I mean, when do you calculate this limit? We will see total how much deposits are already outstanding in the company plus the deposits to be accepted now. Everything put together should not exceed this limit. But then we learned, listen, if you're a private company, then this limit is not applicable, which means private company can accept more than 100% also if the private company comes under any one out of these two buckets. Either the private company is a startup. In that case, for the first 10 years after incorporation, that company can have deposits more than this limit also. Or the private company is neither an associate of another company nor is it a subsidiary of another company. Also, this private company's borrowings from 3 people, banks, financial institutions and body corporates, is less than the limit. What's the limit? 2 times the paid up share capital of 50 crore rupees, whichever is lesser, and the company has not made any default with respect to the subsisting borrowings. So if the company comes under either this bucket or the company comes under this bucket, then this private company can accept deposits more than the 100% limit as well. Important guys, limit is not applicable to which private company. Then we learned that whatever we spoke about circular, whatever we spoke about filing the circular with ROC, whatever we spoke about the auditor certificate, and later what we will be discussing about deposit repayment reserve, None of these are applicable to those private companies which either accept deposits within the limit or they are accepting deposits more than the limit. Now, which company can accept deposits more than the limit? Startups, those companies which are not associate, not subsidiary of another company, borrowings are less than the limit, and default is, there is no default in the subsisting borrowings. So, if the private company is either accepting deposits within the limit or it is a startup, or it is a startup, or it is not an associate company, also not a subsidiary of another company, also borrowings are less than the limit, also no default with respect to the subsisting borrowings. If a private company comes under any out of these three buckets, then to that private company, the circular provisions, the auditor certificate provisions, the provisions relating to filing documents with the ROC, the provisions relating to deposit repayment reserve, which you will be learning a little later, none of these concepts will apply to these private companies. Okay, so this was our entire discussion relating to accepting deposits from members. Now coming to acceptance of deposits from the public. Here simple only guys, we have some 6 points only over here. We will see them one by one. First of all, which company can accept deposits from the public guys? Only eligible public companies, only they can accept deposits from the public. Eligible public companies. Number 2, who are these eligible public companies? They are those companies which fulfill 3 conditions. Number 1, they are public company. Number 2, either the net worth is at least 100 crores or the turnover is at least 500 crores. And condition 3, the deposits which they have accepted is either within section 181C limit or it is more than section 181C limit. If it is within section 181C limit, then OR is enough. If it is more than the limit, then SR should have been filed by the company and that SR should have been filed with ROC. Alright, so point number 1, if the company wants to accept deposits from public, first of all the company should be eligible public company, only then you can accept deposits from the public. Number 2, this eligible public company means first of all it's a public company. Condition number 2, the net worth is at least 100 crores or turnover is at least 500 crores. Condition number 3, if the deposits are within section 181C limit, OR is enough. If it is more than section 181C limit, SR is to be passed, and if SR is passed, that SR has to be filed with the ROC. Then comes the third point, this company which is accepting deposits from the public requires credit rating from a recognized credit rating agency every year during the tenure of the deposit. Minimum how much credit rating the company should get guys? That same minimum investment grade rating which is prescribed for banks if they want to accept FD. That same minimum investment grade rating even the company should get if it wants to accept deposit from public. Then we learned every year company is going to get this credit rating. Every year it has to be filed with the ROC along with a deposit return. Then our fourth point was maximum how much amount of deposit can the company accept from the public. Eligible public company, listen, when you are accepting deposit from the public, maximum you can accept 25% of paid up share capital plus free reserves plus securities premium. Okay, again the same thing, already how much deposits are outstanding plus deposits to be accepted put together should not exceed this limit. But if the eligible public company happens to be a government company, then for them the limit will be 35%. Then we learned even over here same thing guys, deposits may be secured or they may be unsecured. Same thing, if they are unsecured we have to quote everywhere, but if they are unsecured, but if they are secured, same thing, we can give only tangible assets as security. The value of assets which we give as security should be enough to meet not only the amount due on deposits but also to meet the interest on the deposits. Then the charge has to be created within 30 days of acceptance, and here charge has to be created in the name of a deposit trustee. Okay, and then we had learned that eligible public company, you want to accept deposits from public. So don't you think eligible public company, you will have to prepare a document in which you will tell the public that how much money you want, when do you want, when will you repay, how much interest will it carry. So eligible public company, you have to prepare a document. The document here also will be called as circular, same form DPT1. Now how will the company issue it to the public? Company will issue it to the public by giving it as an advertisement. Advertisement where one English newspaper, one vernacular newspaper having wide circulation in the state where the RO is situated. Then even this circular will be issued in the name of board of directors. On which date was the advertisement published? That's an important date. That will be considered as a date of issue of the circular. Even over here it has to be filed with ROC. Even over here, once it is filed with the ROC, within 30 days the advertisement has to be issued in the newspaper. Okay, so circular form DPT1, it has to be given as an advertisement in one English newspaper, one vernacular newspaper having wide circulation in the state where the RO is situated. It should be issued in the name of the board of directors. On whichever date the advertisement is published in the newspaper, on that day we will consider as if the circular has been issued by the company. Once the company files it with the ROC, from that day within 30 days it has to be issued to the public. That is, once a company files it with the ROC, from that day within 30 days company has to give the advertisement in the newspaper. Okay, so this was your discussion relating to accepting deposits from public. So we learned only eligible public companies can accept deposit from public? Eligible public company means you're a public company, your net worth is at least 100 crores or your turnover is at least 500 crores, and the deposits, either it is within the limit, in that case you've passed an OR, or if it is more than the limit, you've passed SR, and if you've passed SR, that SR you should file with the ROC. Credit rating is required every year during the tenure of deposits. Minimum investment grade rating, which is prescribed by RBI for banks if they want to accept FD, that same minimum investment minimum investment grade rating even companies should get if they want to accept deposit from the public. Then we learned the maximum amount of deposit for eligible companies is 25%, and for government companies it is 35%, and then secured, unsecured, and lastly about the circular. Then we spoke about the common points. We had 11 common points here, guys. Whether the company is accepting deposits from public, whether the company is accepting deposits from members, these common 11 points will apply. The first common point is about tenure of deposit. Generally, the tenure of deposit is 6 months to 36 months. It cannot be more than 36 months. So, but then, however, if the company needs money for even less than 6 months, okay, fine company, you can raise money for short-term requirements also, but it should not be lesser than 3 months. So 3 months to 6 months we will call as short-term requirement. Now in short-term requirement, maximum how much money the company can raise? 10% of paid up share capital plus free reserves plus securities premium. So this means whatever limits we have learned till now, 100%, 10%, 35%, 25%, whatever limits we have learned till now will apply only if the deposits are from 6 months to 36 months. Because if the company is accepting deposits for less than 6 months, then in that case we will call it as short-term deposit, and that cannot be more than 10%. Okay, and can the deposit be less than 3 months also? No, it can't be less than 3 months. Then we spoke about deposit repayment reserve. Here we said we will see how much deposits are maturing in the current year. That into 20%, the company will take that much money from the bank account, go to a scheduled bank, open a separate bank account, call it the deposit repayment reserve account, and put this 20% over there. Alright, so 20% of the deposits maturing in the current year will be invested in a separate bank account in a scheduled bank called the deposit repayment reserve account, and all this drama will be completed within 30th April of the current year. But don't forget, guys, we just now learnt and came, the DRR concept will not apply to private companies which are either accepting deposits within the limit, or they are startups, or they are not an associate company, not a subsidiary company, loans are less than the limit, and there is no default in these subsisting borrowings. Remember, I just spoke to you about that point over here, that circular point, auditor certificate point, DRR point. All these points will not apply to some private companies. So don't forget about that when it comes to DRR. The DRR concept will not apply to every company. It will not apply to those private companies which come under any out of these 3 buckets. Okay, then comes my third point, the maximum interest rate. How much maximum interest rate can the company pay on deposits? Is there a maximum interest rate? Yes. The same interest rate which RBI has prescribed for NBFCs, that same interest rate will be the maximum interest rate which the company can pay on deposits also. Then the depositor will submit a deposit application form in which he will put the details about the nominee as well. Then from the date on which the company receives the deposit money, from that day within 21 days, the company has to give deposit receipt to the depositor. In the deposit receipt, 5 things will be written: the date of the deposit, the rate of interest, address and name of the depositor, maturity date and amount of deposit. Drama: D for date of deposit, R for rate of interest, A for address and name of the depositor, M for maturity date, and A for amount of deposit. So once a company receives the deposit money, from that day within 21 days, the company has to give this deposit receipt to the depositor. Once a company gives the deposit receipt to the depositor, from that day within 7 days, the company has to make an entry in the deposit register. Okay, this deposit register has to be kept at the registered office of the company. It has to be preserved for at least 8 years. I told you it is not enough to remember 8 years. You should also remember 8 years from when? 8 years from the date on which the last entry is made in the register, right guys? So the timeline is like this. Once a company receives the deposit money, from that day within 21 days, the company will issue deposit receipt to the depositor. Then from that day within 7 days, the company will make an entry in the register. You remember I told you why is this entry connected to the deposit receipt? It is because in the deposit register, when we are making the entry, we also have to write the deposit receipt number. So therefore we can make an entry in the deposit register only after issuing the deposit receipt. That is why they are all interconnected. Okay, then we had learnt that can we have deposits in joint names? Yes, but maximum 3 people only. And then we had an interesting discussion relating to premature repayment of deposit. First of all, will we allow premature repayment? Premature repayment means even before the maturity period, you are coming and you are asking for repayment. Will we allow premature repayment? Yes, we will allow premature repayment, but don't come before 6 months. For 6 months at least let the company enjoy the money. So the depositor can come and ask for premature repayment after 6 months, but before the maturity of deposit, yes, he can come and ask. But in that case, we will give him interest only for the period for which the deposit has actually been enjoyed by the company. But if in that period there is a fraction, and if the fraction is less than 6 months, we will ignore. If the fraction is more than or equal to 6 months, we will round off to the next number. Okay, and remember 1% lesser interest we will pay. But we will not reduce 1% interest if the company is making a premature repayment of deposit because of company's fault. Company accepted deposit more than the limit. So to bring the deposits within the limit, company is making a premature repayment of the excess deposit. Then company don't reduce 1% interest. And also in war situations, when company is making a premature repayment to army people, navy people or air force people or their relatives, there also the company will not reduce 1% interest. Then we learned, however, if the depositor is asking for premature repayment, but he is also making a renewal. So he is making a premature withdrawal and then he is giving that same money back to the company. So he is doing two things. He is making a premature withdrawal and then he is renewing. But he is renewing in such a way that the renewal period is more than the unexpired period. Here I had given you this example. I told you that if the company continues to enjoy the deposit, company would have enjoyed the deposit for 12 months more. Right now we are at the end of 24 months, and if the company had continued to enjoy the deposit, company would have kept it for another 12 months. But however, what the depositor did is at 24 months he asked for premature withdrawal, he took the money and then he gave the same money back to the company for 15 months. So the renewal period over here is 15 months, which is more than the unexpired period of 12 months. It's good for the company because company, if the depositor had not done this, you would have enjoyed his money only for another 12 months. But because he has done this, you will enjoy his money for another 15 months. So here the renewal period is more than the unexpired period. In such cases, company don't reduce the 1% interest rate, instead give him more interest, give him a higher return of higher rate of interest. Then we spoke about deposit return, form number DPT3. Audited deposit return plus fees has to be filed with the ROC by 30th June of the next year. Remember, we file the return in the next year. We accept the deposits in the current year and file the return in the next year. Then we learned, if in case a company does not repay the deposits on time, then company will have to pay penal interest at the rate of 18% per annum. And then we discussed about deposit trustee appointed by the company. Yes, we can have more than one deposit trustee also. We have to get a written consent from him before we appoint him, saying that he is willing to be appointed, and then a deposit trust deed has to be executed. Then we learned who cannot be appointed as deposit trustee. We said companies which are providing trusteeship service, then directors, KMP, officers, employees of cash, their relatives, depositors, any person who owes money to cash, any person who has given a guarantee that deposits will be repaid, any person who has material pecuniary relationship, all of these parties cannot be appointed as deposit trustee. Then the deposit trustee will call a meeting of the deposit holders. When will he call a meeting, guys? Either when a written request is received by him from depositors who are holding at least 10% of the outstanding deposits in the company, or if any BED happens in the company, any breach, any event or any default happens in the company which is going to affect the deposit holders. Then deposit trustee, yes, he can be removed. He can be removed by the members? No. Can he removed by the depositors? No. He can be removed only by the board of directors at the board meeting by passing board resolution. In that board resolution, whichever director is present in the meeting, every director has to vote in favor. Not even one director has to vote against, which means a unanimous resolution has to be passed. Only then we can remove the deposit trustee, and in that meeting at least one independent director should be present. And the last concept we learned, guys, once a company accepts a deposit, company should not alter the terms and conditions of the deposit in such a way that it is disadvantageous to the depositor. That's all. So these were your 11 common points which are applicable to both whether the company is accepting deposit from members or whether it is accepting from the public. With this, we are wrapping up this chapter, and next session we'll start off our next chapter on charges. Hello guys, let's do a super quick revision of this chapter on charges now. So here we had learned that the story is pretty simple. There's a company and there is a lender. The lender has lent to the company a secured loan. So obviously the company has to give to the lender some asset as security, some collateral. So whenever the company gives an asset as security to the lender, under Companies Act, we say that on the asset a charge is created. But just creating the charge is not enough. This charge also has to be registered with ROC. So the whole chapter of charges focuses on this point, registration of charges. So first of all, we learned what exactly is charge. The definition is given in section 2 clause 16. We said charge is an interest or lien created on the property or assets of the company or any of its undertakings or both as security, and charge includes mortgage. So if you have to nicely dissect the definition, it is an interest or lien, which means company continues to own the asset, only interest in the property is created in favor of the lender, but company only continues to be the owner. This interest is created on the property or assets of the company or any of its undertakings or both. So the subject matter of the charge is a property or the assets on which the charge is created. The property can be in India, outside India, it can be tangible, it can be intangible, movable, immovable, they can be fixed assets, they can be current assets, it doesn't matter. So the company is creating a charge in the favor of the charge holder, in the favor of the creditor, and it includes a mortgage. But I told you should not get misled by this. You should not think that charge means only mortgage. No, it says it includes a mortgage, which means charge also includes mortgage, pledge, hypothecation, all that will anyways come under charge. It will also include mortgage. Okay, so definition one last time, section 2 clause 16. Charge is an interest or lien created on the property or assets of the company or any of its undertakings or both as security, and charge includes mortgage. Then we learned that this lender in whose favor the charge is created, we call him as a charge holder. Okay, then we learned that there are two types of charges, fixed charge and floating charge. In fixed charge, we are giving permanent assets, we are giving fixed assets as security. One specific asset like land and building or plant and machinery, one specific asset we are giving as security, permanent asset, some fixed asset we are giving as security. And this fixed charge will remain fixed charge only. It will never get converted into floating charge and all. Fixed charge will remain fixed charge only. Company can continue to use the asset, but can the company sell the asset, guys? Generally no, but with the consent of the charge holder, yes, the company can sell away the asset. Then we learned about floating charge. Here the company is creating a charge on current assets of the company. That is, company is creating a charge on those assets which have a fluctuating nature, which have a changing nature. I gave you an example. I said cash converts into raw material. Raw material converts into finished goods. Finished goods will get converted into debtors. Debtors will get converted into cash. This is a normal working capital cycle, guys. So in this example, all your assets, all your current assets, they are fluctuating in nature. They keep changing in nature. So company can create a charge on its current assets, and that will be called as floating charge. If it is a floating charge, the company will not even feel the impact of the charge because the charge remains dormant. Floating charge is by nature a dormant charge, which means company can use the asset, company can sell away the asset, nobody's permission is required. Even though the charge is created, company will continue with life as usual. However, there are three situations where this floating charge crystallizes. Number one, when the terms and conditions of the charge are violated by the company. Number two, when the company goes into winding up. And number three, when the creditors enforce security. Creditors enforce security means company is unable to repay the loan, so the creditors are taking away the security. If any of these three situations arise, the floating charge will crystallize. Floating charge will crystallize means the floating charge will get converted into fixed charge. Once it gets converted into fixed charge, once a floating charge crystallizes, it is not dormant anymore. It will get converted into fixed charge, and now the asset will be available for realization. You remember this key word, guys? The asset will now become available for realization by the charge holder, and now the company cannot sell away the asset, the company cannot use the asset, company will just have to pause the whole process because now the charge holder can come take the asset and go. It's available for realization. So this was floating charge. By nature, it is a dormant charge. Generally, the charge remains dormant. But however, in these three cases alone, we learned that the charge will crystallize. Charge will crystallize means that the fixed charge, the floating charge will now not be dormant anymore. It will get converted into fixed charge. Once the floating charge gets converted into fixed charge, the asset will be available for realization. Company can't sell the asset, and now the company can't use the asset. So this was a discussion of the two types of charges, floating charge and fixed charge. Then we spoke about registration of charge. We discussed that in our Companies Act, there are 3 sections which talk about registration of charge. Section 77 which talks about registration of charge by the company, Section 78 which talks about registration of charge by the charge holder, and Section 79 is registration of charge by an acquiring company. We will see these 3 sections one by one. These are the 3 most important sections in our charges chapter. First of all, Section 77 which talks about registration of charge by the company. See, the primary duty, I just told you, right, over here also I told you, just creating the charge is not enough. The charge also has to be registered, and the whole chapter is about this only. So who has a primary duty to register the charge, guys? It is a company who has primary duty to register the charge. So here I told you that company will submit to the ROC how many things? 2 things, particulars of charge and the instrument creating the charge. Tell me the terminology, everybody. Particulars of charge and the instrument creating the charge in which form number? Form number CHG1 along with the fees with the ROC within 30 days of creation. Tell me once again, what does Section 77 say? Who has responsibility? Company. What will the company submit? 2 things, particulars of charge, instrument creating the charge. Which form number? CHG1. To whom will the company submit? To the ROC. Within how much time? Within 30 days of the date of creation. With what? With fees. But however, company, if you are not able to register within these 30 days, remember we spoke about extension of time limit. We said if you are not able to register within 30 days from the date of creation, you can register within 60 days from the date of creation. That is, you will get a grace period of 30 days. If you are running, but however, if you are registering in this grace period of 30 days, you will have to pay additional fees. And then we learned, company, if you are unable to register within this much time also, it's okay. You can register within another 60 days, but now you will have to pay ad valorem fees. Remember ad valorem fees, fees which is dependent upon the value of the charge. Fees which depends upon the amount of the loan. Okay, so this was Section 77 which talks about registration of charge by the company. We do have a lot more points under Section 77. The main point is clear. The main point is who will register the charge? Company. Company will register the charge with whom? With the ROC within 30 days. Within 30 days of the date of creation with the fees. What and all will the company send to the ROC? 2 things, particulars of the charge and the instrument creating the charge in form number CHG1 within 30 days. Within 30 days of the date of creation. If unable to do it within 30 days, company will get a grace period of another 30 days. That is within 60 days of the date of creation. If you are unable to do within these 60 days also, company you have another 60 days also. But here you will have to pay ad valorem fees. Okay. Then what will happen if the company doesn't register the charge? I told you there are 3 to 4 consequences. If the company doesn't register the charge, either the creditor will be treated as if he is an unsecured creditor. Remember? And number 2, the creditor, the loan will still be valid. The loan will still be valid, but however, the charge will become void, guys. Company, you still have to repay the loan. Okay, unsecured loan, but you still have to repay the loan. The loan does not become void. Only the charge becomes void. And here we had discussed one very important point. Remember, if a subsequent creditor gets his charge registered first, then he will get priority. If the company did not register the charge, okay, and if another creditor's charge got registered first, that creditor will get priority. We discussed over here that which creditor gave the loan first. That doesn't matter. What matters is which creditor's charge was registered first. Whichever creditor's charge is registered first, that creditor becomes a first charge holder, and that creditor only will get priority. Alright, then after this we had learned that if the company wants to register the charge within the extra time limit, which extra time limit? The extra 30 days with additional fees, the extra 60 days with ad valorem fees. So if the company wants to register the charge in the extra time limit, then 3 steps company has to follow. Number 1, company has to submit an application to ROC. Number 2, company has to submit a declaration to the ROC saying that company listen, that ROC listen, yes, we are doing belated filing. Yes, we are doing late filing, but even though we are doing a belated filing, we don't have any intervening creditor. You remember this key word, guys, intervening creditor. Intervening creditor means what? An in-between creditor. In-between means in between what? When did the company create the charge? When did the company register the charge? In between these 2 dates, if the company took loan from another creditor by giving the same asset as security, that creditor will become intervening creditor. So in the declaration, the company has to write that yes, even though we are registering the charge late, we are not adversely affecting the rights of any intervening creditor. And lastly, the third conclusion, the third point is that even though, yes, we are coming late, but there's a justifiable reason, there's a sufficient cause. So 3 keywords we had over here, guys, 3 steps. Number 1, company will file application. registration. Number 2, company will file a declaration with ROC. And number 3, company will also give to ROC a sufficient cause, a justifiable reason that why didn't the company come on time. Only after all these 3 steps are fulfilled, only then the ROC will allow the company to do the late registration. Then once the registration and all is done, ROC will give a certificate of registration of charge in form number CHG2 to whom? To both, to the company and to the charge holder. Try to recall, guys, in section 77, CHG1 is submitted by whom? Submitted by the company. CHG1 is signed by whom? Signed by both company and charge holder, both sign it. And ROC gives the certificate to whom? To both, to company and to charge holder, to both the ROC will give certificate. So filing CHG1 is a duty of the company. Once a company files CHG1, CHG1 has to be signed by both company and charge holder. And once a company files it with ROC will give certificate of registration of charge. That certificate ROC will give to both, to company also, to charge holder also, to both. Okay. Then after this we had learnt about section 78. In section 78 we learnt that section 77 is actually a little unfair. We said that section 77 is putting full responsibility of registering the charge on whom? The responsibility is on the company. But if the company is not registering the charge, who is going to suffer from the consequence? It is a creditor who will suffer from the consequence, because he will now be treated as unsecured creditor. So if the company is not fulfilling its duty, if the company is not registering the charge, the creditor is suffering unfair. So that is why we said section 78 was introduced. Section 78 said, listen charge holder, let's give the company 30 days time. Listen creditor, let's give the company 30 days time. Within 30 days time, if the company does not register the charge, then charge holder, creditor, you itself register the charge. You itself file the particulars of the charge and the instrument creating the charge with the ROC. You itself file form CHG1 with the ROC with the fees. You itself file. Understanding? Creditor, you can't do this within first 30 days, but first 30 days we have to give time to company. If company does not register the charge within 30 days, then after that, the creditor, he himself can register with ROC. But ROC will not listen to him, guys. ROC will send a notice to the company saying, company, you did not inform me about any charge. Charge holder is coming and telling me about the charge. Do you have any objection? If company has objection, company should send objection within 14 days. If company does not send any objection within 14 days, then the charge holder will go, then the ROC will go ahead and register the charge, and ROC will, as usual, give the certificate of registration of charge form CHG1 to both. But however, because of this whole process, who ended up paying the fees, guys? Charge holder ended up paying the fees. So every company will do like this. To escape from the fees, they will not even register the charge, thinking anyways later charge holder will go and register the charge. To stop companies from doing that, section 78 says whatever fees was paid by the charge holder to register the charge on his own, whether fees, additional fees, ad valorem fees, whatever fees he has paid, that fees he can get reimbursement from the company. Okay, so this was section 78. Company, if the company doesn't register the charge within 30 days of creation, then thereafter the creditor, he himself can submit the particulars of charge and the instrument creating the charge to the ROC, and he himself can get the charge registered. But just because he has submitted the documents, the ROC will not listen to him. ROC will send a notice to the company asking for confirmation. ROC will send a notice to the company asking the company if you have any objection. If ROC has any objection, ROC will send a notice to the company asking for any objection. If company has objection, company should send objection within 14 days. If no objection comes within 14 days, then ROC will go ahead and register, and whatever fees the charge holder ended up paying, charge holder can take reimbursement of that fees from the company. This was section 78. Then we spoke about section 79. Section 79 has two limbs, guys. Limb number 1, remember X limited and Y limited example. In limb number 1, there's a company. This company is acquiring an asset. That asset is already subject to a charge with the consent of the charge holder. Tell me again, there's a company. The company is acquiring an asset. The asset is already subject to a charge. The charge is already registered with the ROC with the consent of the charge holder. If all these conditions are fulfilled, then the acquiring company has to inform the ROC. I'll re-explain the example I had given to you over here. X limited and Y limited. We have two people in the story. X Limited had borrowed a loan from HDFC Bank, for example, and X Limited had given some land as security to HDFC Bank. On this land, charge was created and charge was registered. That same land X Limited sold to Y Limited, guys. So Y Limited becomes a company which is acquiring an asset which is already subject to a charge with the consent of the charge holder, right guys? Y Limited becomes a company which is acquiring an asset which is already subject to a charge with the consent of the charge holder. When this happens, this Y Limited within 30 days following section 77 process, Y Limited within 30 days using CHG1 has to inform ROC that ROC like this, that land I have purchased. What ROC will do, guys? ROC will vacate the charge from X Limited's register and ROC will register the charge in Y Limited's register. So the company which is acquiring an asset which is already subject to charge has to inform ROC about this within 30 days following section 77 process, filing the same CHG1 with the fees within 30 days. Y Limited will inform ROC. ROC will vacate the charge from X Limited's register and register the charge in Y Limited's register. This was the first limb of section 79. In the second limb, there is some variation happening in the charge. Either the terms of agreement are changing or there is a change in the operation of charge. You remember the limit, the security cover was changing over here, or there's a change in rate of interest. The change in rate of interest, if it is because of bank rate, for that section 79 will not apply. If there's a change of rate of interest but not because of change in bank rate, that only will come under section 79. Or if the charge holder is assigning his rights to the third party, like for example the lender is selling the loan to somebody else or increasing, decreasing the limits, ceding a pari passu charge. Remember, ceding a pari passu charge means you're giving up the pari passu charge, so therefore you will become a second charge holder now. Do you remember this point, guys? You were earlier a pari passu charge holder, which means two creditors were having the same proportionate right over one asset, but you are giving up your pari passu charge, you are giving up your equal right, which means you are willing to now have second priority. You are giving the other creditor first priority and you will have only second priority now. That is ceding a pari passu charge. Earlier we had two creditors and both the creditors were having pari passu charge, which means both the creditors were having equal right over the asset. Now one of the creditors is giving up his pari passu charge, which means one of the creditors is saying I am okay with second charge. He is willing to have second priority. Then there is a change in repayment schedule, release of the charged asset or mutual agreement. In all of these cases there is a modification of charge. Whenever there is a modification of charge, same thing guys, within 30 days of the modification, company is supposed to inform ROC in the same form CHG1. Same form CHG1, ROC will give a certificate called Certificate of Registration of Modification of Charge in form number CHG3. Okay, so within 30 days we have to inform ROC whether first limb or second limb. We have to inform ROC within 30 days whenever there is any modification, and ROC will give us a Certificate of Registration of Modification of Charge in form number CHG3. Okay, now that interest point, that bank rate point is very important, so I will explain it to you once again over here. Let us say the bank, let us say the interest rate which was applicable was bank rate plus 3%. So this is what the creditor and the company had decided, that company will pay interest which is bank rate plus 3%. Okay, so and let's say the bank rate was 10%. So 10% plus 3%, company was paying 13% interest rate. Later what happened is RBI changed the bank rate to 9%. So 9% plus 3%, now the company will pay 12%. So is there a change in interest rate? Yes, but the change in interest rate is because of the change in bank rate. This will not come under modification of charge. Here section 79 will not apply. If the change in interest rate is because of the change in bank rate, we will not call it as modification of charge. Section 79 will not apply. Are we understanding, everybody? So this was section 79. Either the company is acquiring an asset which is already subject to charge. Remember, Y Limited, either Y Limited is acquiring an asset which is already subject to charge, or there is some case of modification of charge. In both of these, we have to inform ROC within 30 days following the same section 77 process. Using the same form CHG1, we have to inform ROC. So which means the same form CHG1 is used for both, for registration of charge, also for modification of of charge also. Then ROC will make a note and ROC will give CHG3. What is CHG3? Certificate of Registration of Modification of Charge. That certificate will be a conclusive evidence that all the provisions of Companies Act relating to modification, everything company has complied with. Okay. Then we had section 80 which spoke about deemed notice of charge. Here we said that whenever a person enters into a contract with the company, either he is buying an asset from the company or he is lending a loan to the company, we will assume that every person who is entering into a contract with a company like this has read the register of charges prepared by the ROC for the company. So every person, if you are lending a loan to the company or if you are buying an asset from the company, before you do that, first go to MCA website, download this particular company's register of charges, check over there whether on the asset charge is already existing or not. Only then lend a loan, only then buy the asset from the company. Outsider, if you don't do this checking, later you cannot blame the company that company, why didn't you tell me about the charge earlier? You cannot blame the company, because once the charge is registered with the ROC, it becomes a public document, which means everybody is deemed to have notice. Remember, we linked it with doctrine of constructive notice. We said every outsider is deemed to have knowledge. We will assume that every outsider has knowledge about which asset, how much charge is created. But also remember, in section 80, what's the most important date? The date of registration. The deemed notice concept, section 80 will apply only on and after the date of registration of the charge, not from the date of creation. We said charge holders' rights will start on the date of creation of charge, but deemed notice of charge is only from the date of registration of charge, because only once the charge is registered, only then the documents will become public documents. Only then we will assume that everybody has knowledge about the charge. Okay, so once a charge is registered, now if the company is borrowing loan from a person by giving an asset as security, or if the company is selling its asset to another person, company has no responsibility of informing the other person about the existence of charges. Even if the company doesn't inform about the existence of charges, it is a responsibility of the other party, it is a responsibility of the outsider. He has to check the company's register of charges, he has to go to MCA website, download the company's register of charges and check whether on this asset a charge is existing or not. Whether he does this checking or not, section 80 says that we will assume that this person has knowledge of the charge. So even if we don't tell him about the existence of charge, it is not our fault. It is not the company's responsibility to disclose about the existence of charges. It is the responsibility of the outsider dealing with the company that he is supposed to check the register of charges and he is supposed to check whether charge is existing or not, because we will assume that he has knowledge about the existence of charges. This was section 80. Then we spoke about two registers, section 81 register and section 85 register. Both are registers of charges. Section 81 register is maintained by the ROC. It can be inspected by any person. Whoever is inspecting, they have to pay fees. But section 85 register is maintained by the company. The company maintains two things: the register of charges in form CHG7, and the company also maintains the instruments creating the charge. Both the things company will maintain under section 85. The register of charges will be preserved permanently by the company. Instruments creating the charge will be maintained by the company for 8 years from the date of satisfaction of charge. Even these two documents anybody can inspect, but however, if the members and creditors are inspecting, we will not charge any fees. If anybody else is inspecting, we will charge fees. That's all, guys. So section 81 register is maintained by ROC. Section 85 register is maintained by the company. Section 81 register also can be inspected by anybody. 85 register also can be inspected by anybody. But in section 81, member and creditor, even they have to pay fees. Whoever is inspecting, everybody has to pay fees under section 81. But under section 85, if member and creditor are inspecting, they don't have to pay any fees. If anybody else is inspecting, only then they'll have to pay fees. And also remember, in section 85, we are not talking only about the register. We are also talking about the instrument creating the charge. So under section 85, company will prepare two things. Company will maintain two things. Number one, register of charges, and number two, instrument creating the charge. Both the company will maintain at the registered office. The registered company will preserve forever, permanently, and the instrument creating the charge company will preserve for 8 years, 8 years from the date of satisfaction of charge. Then we spoke about section 82, satisfaction of charge. With respect to satisfaction of charge, we said we have two sections, section 82 and section 83. In section 82, company is informing the ROC about satisfaction of charge. In section 83, company is not informing ROC, but ROC is getting to know from other sources. So let's talk about section 82 first. In section 82, either there is a satisfaction of charge or the loan is repaid. Once that happens, from that date, within 30 days, the company is supposed to inform ROC about the satisfaction, inform CHG4 within 30 days. Okay, but if the company is unable to inform within 30 days, we give the company a grace period of 270 days, which means total 300 days we give to the company. But if the company is doing the filing in the grace period of 270 days, company you have to pay additional fees. So in section 82, they're telling the company that, listen company, once a charge is satisfied, you have to file form CHG4 with the ROC and inform the ROC about the satisfaction of charge. But once company files it with ROC, ROC will check CHG4. In CHG4 has a charge holder also signed. If charge holder has also signed, ROC will simply go ahead and register the satisfaction, guys. But if the charge holder has not signed form CHG4, then ROC will send a notice to the charge holder saying, charge holder, listen, like this, company has filed form CHG4, company is saying that the charge is satisfied or the loan is repaid, company is saying like that, do you have any objection? If the charge holder has objection, charge holder should send objection within 14 days. If charge holder does not send any objection within 14 days, then ROC will go ahead and register the charge. Register the charge means ROC will make an entry in his register. The entry is the key word over here. The entry is called memorandum of satisfaction of charge, and then the ROC will give a certificate of registration of satisfaction of charge in form number CHG5. So this was section 82. In section 82, we are putting responsibility on whom? On the company. That company, you have to go to the ROC within 30 days of satisfaction of charge. You have to go to the ROC and inform the ROC that ROC, the charge is satisfied, the loan is repaid. Remember this, guys, if the company doesn't inform within 30 days, company you can go within the next 270 days also. But in form number CHG4, you have to inform the ROC. And just giving you one small reminder, if the company doesn't go within 300 days also, what if 300 days also have lapsed? There also one option is there, section 87, which we will be discussing a little later. So this section will talk about only till 300 days. So company will file CHG4 with the ROC. Company will inform ROC about the satisfaction or repayment as a case may be. ROC will check CHG4. If it is signed by charge holder also, then ROC will go ahead and register the satisfaction. If it is not signed by the charge holder, we need charge holder's consent also. So ROC will send a notice to the charge holder saying, if you have objection, send objection within 14 days. If no objection is received within 14 days, ROC will go ahead and register. Register means what? Register means in the register of charges, ROC will make an entry. What do you call the entry? Memorandum of satisfaction. This memorandum of satisfaction, once it is done, then ROC will give a certificate of registration of satisfaction of charge in form number CHG5. This was section 82. Then we learned about section 83. In 83, we learned that even if the company is not informing ROC about the satisfaction, even if company is not informing ROC about the repayment of loan, ROC can come to know about this from other departments, like from property department, from SARFAESI authorities, from IBC authorities. All these examples I gave you. From other authorities also, ROC can come to know about the satisfaction and repayment. So even if company did not inform ROC, if ROC gets evidence to his satisfaction, keyword, ROC is getting evidence to his satisfaction, then what can ROC do, guys? Even though company didn't inform ROC in CHG4, if ROC gets evidence to his satisfaction that either the loan has been repaid or the charged asset has been released or the asset is not a part of the company's asset anymore, if the ROC gets evidence to his satisfaction, then without the company informing him, he will himself make the entry. He will himself make the memorandum of satisfaction. He will himself issue the certificate of registration of satisfaction of charge in form number CHG5. So even if the company is not filing with the ROC form number CHG4, if the ROC gets evidence to his satisfaction from some other source that either the loan is repaid or the charged asset is released or the asset is not a part of the company's assets anymore. 3 points, guys. Either the loan loan is repaid or the charged asset is released. 2 R's. Either the loan is repaid or the charged asset is released or the charged asset is not a part of the company's asset anymore if the ROC gets evidence to his satisfaction from other sources without waiting for company to file CHG4. ROC will himself make the memorandum of satisfaction in the register. He will himself issue the certificate of registration of satisfaction of charge in form CHG5. Then section 84, this was a simple section, guys. Here we said if manager or receiver is appointed, two people we are talking about here, manager or receiver, if they are appointed either because of court order or because of loan agreement, within 30 days ROC has to be informed about this appointment. Similarly, when this person's role is over in the company, when he ceases to hold the office, again we have to inform the ROC about it. Then section 86 was the penalty section. Now coming to section 87, in section 87 there are two defaults we discussed. Default number 1, 300 days have lapsed. 300 days have lapsed. CHG4 company has not filed. What is CHG4, guys? Either the loan is repaid or there is a satisfaction of charge. Just now we learnt and came, no? Section 82. Section 82 says within 30 days we should inform the ROC in CHG4. If company is unable to inform within 30 days, inform within the grace period of 270 days. So if the company doesn't inform within 300 days, the loan has been repaid, guys. The charge has been satisfied, guys. But 300 days have lapsed. In 300 days, company has not gone and informed the ROC. After 300 days, if company comes to ROC, ROC will ask the company to get out only. So in such cases, the company will come to central government and will request the central government, please condone the delay, please excuse the delay. If central government is satisfied that yes, the delay was justified or the delay was accidental, then central government will ask the ROC, it's okay ROC, let's extend the time. This was our first default. In the second default, for registering the charge, for modifying the charge, we are filing form CHG1. For satisfaction of charge, we are filing form CHG4. Now, in these forms, if there is any misstatement or in these forms, if there is an omission, again, the company will come to the central government and will request central government, please let us correct the mistake. If central government thinks it was accidental, it was inadvertent, it was justifiable, creditors and the shareholders and all are not getting affected, then the central government will pass an order asking the ROC, it's okay, let's rectify the register, let's rectify the mistake. Okay guys, so section 87 will apply in two situations. Either the company has delayed in registering the satisfaction of charge. Either the company has delayed, 300 days have lapsed, company has still not filed CHG4 with the ROC. First situation. Second situation, in CHG1 or in CHG4, there is a misstatement. I want you to notice, again I am bringing to your attention, we come to section 87 if there is a delay only under section 82. If there is a delay under section 77, if there is a delay under section 79, that is, if there is a delay in registering the creation of charge, if there is a delay in registering the modification of charge, for all that we will not come under section 87. Right guys, under section 87 we will come in, we will request central government for condonation only if the delay is in registering with ROC about the satisfaction of charge. If there is a delay in registering with the ROC, the creation of charge or the modification of charge, for that we will not come to section 87. So section 87 only in two situations. Either company did not register the satisfaction of charge on time, or second possibility is company has filed CHG1, CHG4 but there is a misstatement. Okay, then we come to central government will condone the delay, and also remember this application can be filed not only by the company, can be filed by any other interested person also, which means it can be filed by the charge holder also. Alright, that's all guys, this was section 87, that's it. So this was your charges chapter, the most important being section 77, 78, 79. Okay, we'll close the session over here. I'm hoping you are confident. Thank you guys, bye-bye. So let's begin. Now the very first section that we had learned in our management and administration chapter was section 88. Here we had learned that every company shall maintain a separate register. Section 88 applies to every company, private, public, listed, unlisted, doesn't matter, it applies to every company. Every company will maintain a separate register of members, a separate register of debenture holders and a separate register of each type of security holders, a separate register of members, a separate register of debenture holders, a separate register of each type of security holders. Now these these registers will be maintained by the company from the date of incorporation itself. The register of members will be maintained in form MGT1, the register of debenture holders in form MGT2. So point number 1, every company will have to maintain a separate register of members, a separate register of debenture holders and a separate register of each type of security holders from the date of incorporation itself. The register of members will be in form MGT1, the register of debenture holders will be in form MGT2. Now where are these registers going to be kept? Company, you have three options. Either these registers can be kept at the registered office itself, or the registers can be kept at any other place but in the same city where the registered office is situated, or in any other city provided more than 1/10 of the members reside over there. So company, you have three options: at the registered office, or at any other place but in the same city where the registered office is situated, or in some other city but in India where more than 1/10 of your members reside. But listen company, if you don't want to keep the registers at the registered office, if you want to keep at any other place, then for that you have to pass an SR. Okay, then we had learned that you will become a shareholder of the company, or you will become a debenture holder of the company, either if the company allots the securities to you, or if somebody else transfers the securities to you. There are only two methods: either the company will allot the security to you, or somebody else will transfer the security to you. Whether it is allotment, whether it is transfer, both have to be approved by either the board of directors or a committee of the board, as the case may be. From the date of that approval, within 7 days itself, entry has to be made in this register. Then we learned that nominee details also have to be written in this register, and we learned if the company has at least 50 members, then index also has to be maintained, which means if the company has less than 50 members, index is not required. Then we learned that whenever an entry is made in this register, the entry has to be authenticated by the company secretary of the company, but we learned every company will not have company secretary. So if the company does not have a company secretary, it will be authenticated by any other person who is authorized by the board of directors. So who will authenticate the entries, guys? Company secretary. And if the company doesn't have a company secretary, then any other person who is authorized by the board of directors. Then we had learned if any judicial authority like a court, or any revenue authority like income tax department or GST department or SEBI, if any of them have passed any order attaching the shares, then a copy of this order has to be given to the company, and company will make a note about this order in the register within 15 days. Similarly, if the securities are listed securities and if they have been pledged, which means the security holder wants a loan, but if you want to get a loan, you have to give some asset as collateral. So he has given to the money lender the shares of this company as collateral. Against that collateral, the money lender has given him a loan. So if the security holder has pledged the securities, and if the securities are listed securities, details about that pledge also have to be written in this register. So 2 points, guys. Point number 1, if any order has been passed by any judicial authority, revenue authority or SEBI attaching the shares, attaching the securities, then details about that have to be mentioned in the register within 15 days. Similarly, if the securities are listed securities and if they have been pledged, or if they have been hypothecated, or if any charge has been created over them, details about that also has to be entered into the register within 15 days. So 2 points, guys. Point number 1, attachment of securities, and point number 2, pledge of listed securities. Please don't forget, the pledge point will apply only and only to listed securities. Then we had learned that if the securities happen to be in demat form, then in that case, the company's register of members will be useless, because in the company's register of members, only the details of the depositories will be written. So that is why instead of taking the company's register of members, we will consider the register of beneficial owners, which is maintained by the depository, and that register will be deemed to be registered under section 88. Remember the name of the register, guys? Register of beneficial owners. Who maintains this register, guys? Depository. And when do we think about this register? Only if the securities are in demat form. So this is important. If the securities are in demat form, we will disregard the register of members which is maintained by the company. Instead, we will consider the register of beneficial owners which is maintained by the depository. That will be deemed to be registered under section 88. Then after this, we had learned that if the shares are held in the name of joint shareholders, if there are joint shareholders, then each and every joint shareholder's name should appear into the register of members. Now, whichever joint shareholder's name appears first, that joint shareholder will be considered to be the senior most joint shareholder. But can the joint shareholders tell the company in what sequence, in what order the names should be written? Yes. They can tell the company in which order the names should be written. In that same order only, the company will put the names in the register, and now whoever's name appears first in the register, that member will be the senior most joint shareholder. And if you're the senior most joint shareholder, if you're the first named joint shareholder, you get a lot of preferences under the Companies Act. Like for example, when the company sends notice, company will send a notice only to the first named joint shareholder. Similarly, when voting happens, we will give priority to the vote of the first named joint shareholder. So yes, he does get a lot of preferences. So that is why if the joint shareholders find it unfair, they can also split the shares. You remember, like for example, I had told you, if A, B, C, they are 3 joint shareholders together owning 30 shares in the company. They can tell the company that for 10 shares, write A's name first. For another 10 shares, write B's name first. For another 10 shares, write C's name first. This way, for these 10 shares, A will be the first named shareholder. For these 10 shares, B will be the first named shareholder. And for these 10 shares, C will be the first named shareholders. This is called as splitting of shares by joint shareholders. And is this allowed? Yes, this is allowed. Got it, guys? So these were the discussions under the first part of section 88, guys. We learned that every company has to maintain a separate register of members in form MGT1, a separate register of debenture holders in form MGT2, and a separate register of each security holder from the date of incorporation itself, either at the registered office itself or at any other place but in the same city where the RO is situated, or in any other city but in India where more than 1/10 of the members reside. And if the company is not keeping the registers at the RO and is keeping at any other place, for that SR has to be passed. Then we also learned that either you will become a security holder because the company allotted the securities to you, or because somebody transferred the securities to you. In both of these cases, it will be approved. The allotment or the transfer will be approved by the board of directors or committee of the board, as a case may be. From the date of approval, within 7 days, an entry has to be made in the register. Index is required to be maintained if the company is having at least 50 members. The authentication of the entries will be done by company secretary. If no company secretary, by any other person authorized by the board. Then 2 orders, 2 things have to be mentioned in the register of members in addition to all what we learned already. Thing number 1, any order passed attaching the securities. Thing number 2, pledge of listed securities. Pledge is only of listed securities, okay? Any order attaching the securities or pledge of listed securities, these orders have to be entered in the register of members within 15 days. Alright, and then we learned if the securities are in demat form, we will disregard the register which is maintained by the company. Instead, we will consider the register which is prepared by the depository. And what do we call it? We call it as a register of beneficial owners, which is maintained by the depository. That register will be deemed to be registered under section 88. And finally, we learned if the shares are jointly held by multiple people together, that is, if there are joint shareholders, then whichever joint shareholder's name is written first, that joint shareholder gets a lot of preferences. Now coming to our revision on foreign register, this we will revise from the classroom notes. Foreign register, this concept we learnt, it's an entirely optional concept. Listen company, you will anyways be maintaining a principal register in India. This is mandatory, here no option. But over and above this, in addition to this, company, if you want, you can maintain foreign registers outside India. So the principal register, the main register is maintained in India and foreign registers are maintained outside India. Can the company have multiple foreign registers? Yes, one in New York, one in London, one in Sydney, allowed. Now these foreign registers will only contain details of those security holders who reside outside India. Okay, then we learned company, you can maintain this foreign register only if it is authorized by the AOA, and the foreign register has to be in the same format as a principal register. Then we learned that company, listen, you're supposed to inform the ROC about 4 things. You're supposed to inform the ROC about 3 things. Number 1, whenever you open the foreign register, you're supposed to inform ROC within 30 days that ROC, I have opened a foreign register in London. Then whenever you change the situation of your foreign register, again within 30 days, you're supposed to inform ROC that, listen ROC, it was in London and now I'm moving it to New York. Then whenever you discontinue the foreign register, again you're supposed to inform ROC within 30 days. So 3 things will be informed to the ROC. For all the 3 things, the time limit is 30 days. What are the 3 things? Whenever you open the foreign register, whenever you change the situation of the foreign register, and whenever you discontinue the foreign register. Here I told you not to use the word closing. You should use the word discontinuing, because when you close the register, it's a different meaning altogether, which is covered in section 90 one which will come a little later. So you will have to say that the company, whenever you are discontinuing the foreign register, you have to inform ROC. So 3 events we have to inform ROC: when we open the foreign register, when we change the situation of the foreign register, and we close the foreign register. For all the 3, the time limit is the same, 30 days only. Now what happens when we discontinue the foreign register? When we discontinue the foreign register, what do we do with all the entries in the foreign register? We have 2 options. Either those entries can be transferred to some other foreign register of the company, or those entries can be transferred to the principal register in India. 2 options. Okay. Then we had also learned that whenever an entry is made in the foreign register, from that date, within 15 days itself, a copy of that entry has to be transmitted to the registered office in India. We understood the logic also for this. The logic was that in India, we are going to be maintaining a duplicate of the foreign register. Now this duplicate of the foreign register also has to be updated from time to time. Now we will be able to update this duplicate only if we get to know that what entries are happening in the foreign register outside India. So as soon as an entry is made in the foreign register outside India, a copy of the entry has to be sent to the RO in India, and with that copy we will be able to update our duplicate foreign register. So now in India, what will we have? In India we will have 2 registers. Number 1, we will have the principal register, and number 2, we will have a copy or a duplicate of the foreign register. But why are we doing like this? You remember the logic, guys, because just imagine if we have only the principal register. Now this will contain only the details of those members who live in India, because members who live outside India, their details are in the foreign register. So if any member comes to the company to inspect the register, they will get only half information. So therefore, details of the foreign register, contents of the foreign register, okay fine, keep the foreign register outside India, but let's maintain one copy, let's maintain one duplicate also in India. So in India, if you ask me what is a register, the register will be the principal register plus the duplicate of the foreign register. That is why we learned that the duplicate of the foreign register is deemed to be a part of the principal register, because half of the details are over here and details of the members who reside outside India are over here. But we have to keep this foreign register copy also updated at all times. So how will we be able to update it? Only if we get to know what entry is happening in the foreign register outside India. So whenever an entry happens in the foreign register outside India, within 15 days itself, a copy of that entry has to be sent to the RO in India. Got it, guys? So this was our entire discussion on foreign registers, and with this we've completed section 88. Remember, foreign registers totally optional. Company will anyways be maintaining a principal register in India. If you want, in addition to this, you can also maintain a foreign register outside India. You can have multiple foreign registers, but inform ROC whenever you open the foreign register, when you change the situation of the foreign register, and when you discontinue the foreign register. And also remember, when you discontinue the foreign register, what do you do with the entries over here? You either transfer the entries to some other foreign register, or you transfer the entries to principal register in India. Alright, guys, now coming to the next section, section 89. So we've completed one big section, section 88. Coming to section 89 now, which talks about declaration of beneficial interest. First of all, what do you mean by beneficial interest? We saw the definition. Beneficial interest includes the right to exercise rights attached to shares. It includes the right to receive dividends with respect to the shares, and it includes the right to participate in other distributions like bonus, buyback and all with respect to the shares. So beneficial interest means the right to exercise rights attached to the shares, the right to receive dividends in relation to the shares, and right to participate in other distributions with respect to the shares. Then we had also learned how this whole section works. We said, let's say Mr. Blue is a foreigner. I'm not saying a foreigner cannot become a shareholder of a company, but then he has to comply with FEMA rules and regulations and all. It becomes a little complicated. So let's say he wants to avoid all that hassle. So what he does is he tells Mr. Red, listen, I'll give you money, okay? You use this money and you buy the shares of this particular company. Alright. Now when this happens, whose name will appear into the register of members, guys? Red's name will only appear in the register of members. He only will become the registered member of the company. But who is the person who actually gave the money for these shares? Mr. Blue. So who is the person who is actually going to enjoy the benefits of these shares? Mr. Blue. He is the one who is going to enjoy the dividend money, the distributions. He is the one who is going to enjoy the appreciation in the value of the shares. It is his money, guys. He is the real owner behind the shares. He is the real person behind the shares. Red is only namesake. So in this situation, we say that Mr. Red is a registered member because his name is appearing in the register of members, but the real owner, the person who is having beneficial interest, is Mr. Blue. See, we are not saying that having this kind of a relationship is wrong. No, it's fine. It happens. It is fine. Whatever be your reason, it's fine that there is this relationship. But if there is this relationship, then please disclose. So what's wrong is not disclosing this relationship. If this relationship exists, just disclose. That is, if one person is a registered member but he is not having beneficial interest. See, in an ideal situation, the person who is a registered member, he only should be having beneficial interest as well. In an ideal situation, the registered member and the beneficial owner are supposed to be the same person only. But if this kind of a relationship exists where one person is a registered member but beneficial interest is with another person, then please disclose. Alright, now how to disclose? What are the steps? Listen to me guys, 3 simple steps. Step number 1, the registered member. In our example, registered member is Mr. Red. He will inform the company, he will give a declaration to the company in form MGT4 within 30 days saying that, listen company, I am a registered member but beneficial ownership is with Mr. Blue. So the registered member will file a declaration with the company in form MGT4 within 30 days informing the company the details, the particulars of the beneficial owner. Similarly, the beneficial owner, who in our example is Mr. Blue, he will also file a declaration with the company within 30 days telling the company that even though Red is a registered member, but I am the one who is having beneficial interest. So are you understanding, are you noticing? Red, the registered member, he will also inform the company about Blue, and Blue, who is a beneficial owner, even he will inform the company about Red. So Red will inform the company about Blue and Blue will inform the company about Red. Okay, then we learned what will the company do. Company will make a note about this in the register of members and the company will have to inform about all of this drama to the ROC within 30 days in form number MGT6. Alright guys, then we learned if there is any change in this beneficial ownership, even that change has to be informed to the company within 30 days. And we learned a very important point that even though all of this process has done, company will still give dividend to whom? Even though company knows now that even though Red is a registered member, the real owner, the person with beneficial ownership is Mr. Blue. Even though the company knows that now, company will still give dividends to whom? To the member. And who is a member? Red. Company will still give bonus shares to whom? To the member. And who is a member? Red. Company will still give rights shares to whom? To the member. And who is a member? Mr. Red. So even though all this procedure has been followed, even though we have informed to the company that Red is a registered member but the real beneficial owner is Mr. Blue, still the company will make all the distributions to the registered member and to the registered member only. But however, when it comes to dividend, the registered member can direct the company that company don't pay dividend to me, instead pay to the beneficial owner. Then company will pay to beneficial owner. But when it comes to bonus shares and rights shares, company will give it to the registered member only. If he wants, he can later transfer it to the beneficial owner. That depends upon the relationship, the agreement, the contract between Red and Blue. So point is, company will first make distribution to the registered member only. If the registered member wants, depending upon his contract with the beneficial owner, he will do all the transfers to the beneficial owner. Okay. Then we had learned that the company has to designate one person who will be to whom the ROC will reach out to if ROC wants any information about beneficial interest in shares. Company has to designate a person. That person will either be the company secretary of the company or a KMP of the company or a director of the company. This person's name has to be mentioned in the annual return. This person is that person to whom ROC will reach out to if ROC wants any information or clarification about beneficial interest. So this was about section 89. Here we said, first of all, what is beneficial interest? It means the right to exercise rights attached to the shares, the right to receive dividend in respect of the shares, and the right to participate in other distributions relating to the shares. Then we discussed that over here in section 89, there is one person who is a registered member but beneficial interest is with another person. Doing this is not wrong, but if this kind of a relation exists, please disclose. So Red will have to inform the company about Blue, Blue will have to inform company about Red, both will inform within 30 days, and company will inform ROC within the next 30 days. And any change in this beneficial ownership also has to be informed to the company, and even though this has been informed to the company, company will still make all distributions to the registered member only. And then we learned finally, company will have to designate a person. ROC will reach out to this person if they want any information or clarification about beneficial interest. And who is this person? His name has to be mentioned in the annual return as well. Okay, so this was section 89. So two sections were done, section 88 and section 89. Then our next section that we had learnt was section 90, significant beneficial owner, SBO. As soon as I talk about SBO, immediately a word comes to your mind, which is the word indirect. Remember guys, so first let me tell you the same background which I created for you even earlier. Let's say there is this person SBO, he is an individual, he has majority stake over this entity, and it is this entity who has 10% stake in the company. So tell me, does the SBO directly have 10% stake in the company? No. Over here, he has 10% stake in the company indirectly through this entity Okay guys, so this is the most important element in SBO, that there has to be some indirect element. The SBO should indirectly have at least 10% stake in the company. The SBO should indirectly have significant influence over the company. Okay, so either it's going to be indirectly or it's going to be indirectly plus directly. So just indirect, yes, will come under SBO. Indirect plus direct, yes, even this will come under SBO. But if it is just a direct, if it's directly 10%, then that will not come under SBO. Okay guys, so SBO means an individual who has at least 10% stake in the company, either indirectly or indirectly plus directly, or he has 10% voting rights in the company, either indirectly or indirectly plus directly, or he has the right to receive at least 10% dividend from the company, either indirectly or indirectly plus directly, or he has significant influence over the company, either indirectly or indirectly plus directly. So in all the four, what is mandatory guys? An indirect element is mandatory. Indirect element means he has majority stake in an entity, and it is this entity which has 10% stake. It is this entity which has significant influence over the company. He doesn't have directly shares over here. He doesn't directly influence his company. He is only indirectly influencing the company. He is only indirectly having stake in the company. It may be directly also, but if it is directly, then the indirect element also is mandatory. So it is either just indirectly or indirectly plus directly. If it is only directly, then it will not come under SBO. Okay guys, then we had learnt what do you mean by direct. Direct means the SBO is owning shares in the company in his own name, or the shares are held by somebody else, but he is a beneficial owner of the shares. So directly means either he is owning shares in the company in his own name, or the shares are registered in the name of somebody else, but he is a beneficial owner under section 89 declaration and all has been filed. So in that, so all that beneficial owner and in own name, both of this will come under direct interest, alright, direct holding. Okay, so SBO means an individual who has at least 10% shares in the company, either indirectly or indirectly plus directly, or he has at least 10% voting rights in the company, either indirectly or indirectly plus directly, or he has a right to receive at least 10% dividend from the company, either just indirectly or indirectly plus directly, or he exercises significant influence over the company, either indirectly or indirectly plus directly. So the indirect element is important, and directly means he owns shares in the company in his own name, or the shares are registered in somebody else's name, but he is a beneficial owner of these shares. So own name will come under direct holdings, even beneficial owner will come under direct holdings. Okay, then what do you mean by significant influence? Significant influence does not mean you are making decisions. It does not mean you are making decisions. Significant influence means you are participating in the decision making process. What kind of decisions? F and OP, financial and operating policy decisions. Key word guys, financial and operating policy decisions. So significant influence does not mean you're making the decisions. Significant influence means you're participating in the decision making process. So you got the whole point about SBO guys. So he's an individual. He can't be a company, he can't be a firm. SBO is an individual who has at least 10% stake in the company, either just indirectly or indirectly plus directly, or he has significant influence over the company indirectly, just indirectly, or indirectly plus directly. And over here directly means either he is owning stake in the company in his own name, or he is or somebody else's name. The shares are registered, but he is a beneficial owner. Both will come under direct holdings. And significant influence does not mean you are making decisions. Significant influence means you are only participating in the decision making process. What decisions? Financial and operating policy decisions. Then we learned if you are a significant beneficial owner, it's not wrong to be a significant beneficial owner. Just that if you are an SBO, you have to disclose. So if you are an SBO, you have to give a declaration to the company in form Ben 1 within 30 days saying that you are an SBO. Company will file a return of SBOs with the ROC in Ben 2 within 30 days. And company will also maintain a register of SBOs in form number Ben 3, and this register can be inspected by any member for a fee. Then we learned that listen, if there is any change in SBO, even that has to be informed to the company within 30 days. Then we learned that whatever we learned till now, we are putting responsibility on the SBO. That SBO, you have to give declaration to the company. Only then company will get to know that you are an SBO. Only then company will file return with the ROC. And then company will maintain register also. So totally 3 steps we said. But all of this starts with SBO making a declaration to the company guys. Only then company will get to know that he is an SBO. Only then company will file a return with the ROC. Only then company will make an an entry in the register. So this entire process is putting full responsibility on the SBO that you have to make a declaration to the company. But however, we learned company, even you have a responsibility, even you have to identify persons who have significant beneficial ownership. If you identify a person is an SBO, check whether this person has submitted form Ben 1 to you or not. If there is a person who you think is an SBO but he has not submitted this form Ben 1 to you till now, then you can give a notice to him in form Ben 4 and ask for information. So company can give notice like this to whom? To a person who is an SBO, or to a person who was an SBO in the last 3 years, or a person who himself is not an SBO but he knows an SBO, or to a person who knows a person who knows an SBO. So company can give a notice in form Ben 4 to these people and ask for information. So through this point we are putting responsibility on the company also. Now, once this notice is given by the company to this person asking for information, this person to whom the notice was given, he has to give the information within 30 days. So, company is giving notice to whom, guys? To a person whom the company is thinking that he is an SBO, but he has not given Ben 1 and all, he is not registered as an SBO. So, company will give him notice in form Ben 4, ask him for information. This person has to give information within 30 days. If he doesn't provide the information within 30 days, or he has provided information but that information is not satisfactory, then in that case within the next 15 days company will file an appeal with the NCLT. Once a company files an appeal with the NCLT, NCLT will first give an opportunity of being heard to this person, and then the NCLT will pass an order within 60 days itself restricting his rights with respect to his shares, saying that with respect to his shares he cannot exercise voting rights, he will not have dividend rights, he cannot transfer the shares. So NCLT will pass an order restricting his rights with respect to the shares. So of course this person is aggrieved by the order, so he will file an appeal before the NCLT, and he has to file the appeal within 1 year itself. But if he doesn't file the appeal, then his shares will be simply transferred to IEPF. Got it, guys? So once a company gives notice to this person asking for information, he should, by the way, company is giving notice to whom? Company is giving notice to a person whom according to the company is an SBO, but he is not registered as an SBO yet, which means this person has himself not filed Ben 1 yet. So therefore the company is giving notice to this person and is asking for information. But if this person does not provide information within 30 days, then company can file an appeal before the NCLT within the next 15 days. NCLT will pass an order within 60 days restricting his rights. This person against whom the order is passed, he can file an appeal within 1 year from the date of the order, and if he does not file an appeal within 1 year from the date of the order, then after this 1 year is over, his shares will be transferred to IEPF. Okay, so this was a discussion on section 90 SBO. Remember, SBO, the most important point is indirect. Okay, now coming to our next section, which is section 91, a very simple section, guys, closing the register of members. First of all, when does a company close the register of members, guys? Like for example, if the company is declaring bonus shares, now company will distribute the bonus shares to the existing shareholders. So company needs to know the list of the existing shareholders of the company. But I had shown you Godrej Industries Limited example, remember? Every second the list of members keeps changing because somebody is buying, somebody is selling, somebody is buying, somebody is selling. So company needs to freeze the list. So company will close the register of members and freeze the list. See, even after the company closes the register of members, people can keep buying and selling the shares of the company, but it will not keep getting updated in the register immediately. It will have to wait. So whenever the company wants to make a distribution like bonus shares or dividend, the company needs a list of members, and for that the company will close the register of members. The date on which the register of members is closed, that is called the record date, also called as the cutoff date. So company can close the register of members like this at a time for maximum 30 days and total in a year for not more than 45 days. But whenever the company closes the register of members like this, before 7 days itself, the company should give a notice to the members saying that the company is going to close the register of members. So before the date of closing, before the record date, leave 7 days. Before 7 days itself, a notice has to be given to the members saying that like this, I will be closing the register of members on so and so date. This notice also has to be given as an advertisement in one vernacular newspaper, one English newspaper having wide circulation in the place where RO is situated, and this also has to be uploaded onto the company's website. But this advertisement and website point is not applicable to private companies. In private companies, it is enough if the company has sent a notice to the members. Got it, guys? So section 91, closing the register of members. The date on which the register of members is closed, that's called the record date, also called as the cutoff date. At a time, the register can be closed for 30 days and totally in a year it can be closed for 45 days. But before the cutoff date, before the record date, leave 7 days. Before 7 days itself, the company should inform the members. The company should give a notice to the members informing the members about the cutoff date. And this also has to be given as an advertisement and also has to be uploaded into the website. Now coming to our next discussion about annual return, section 92. This we will discuss straight away from the material. Coming to our next discussion now guys about annual return section 92. Here we learned that through annual return we are informing the ROC about all the significant events which happened in the company during the last year, right guys. So over here first of all we learned the contents of the annual return. There are around 10 contents and the hint to remember is shrimp MRPCF where I has been removed. So S stands for shares, debentures, other securities in the company. H stands for does the company have a holding company, subsidiary company or an associate company. Then R, where is the company's registered office situated and what are the principal business activities of the company. Then I is removed. Then M, who are the members of the company, who are the debenture holders of the company, and in the last year was there any major change therein. Then P, who are the promoters of the company, who are the directors and KMP of the company, and in the last year was there any change therein. Then another M for meetings, board meetings, committee meetings, members meetings and all. R for remuneration, how much remuneration are we giving to our directors. P stands for penalty. In the last year was any penalty or punishment imposed on the companies, on the directors of the company, on the officers of the company. C stands for compliance, that is the company complying with all the applicable rules and regulations or not. And F stands for foreign institutional investors in the company, are foreign institutional investors holding any shares or not. So these are the contents of the annual return. Okay, and this annual return has to be filed with the ROC within 60 days from the date of the AGM. But in case the company is not conducting the AGM, we will see the last day by which the company should have held the AGM. From that day within 60 days it has to be filed with the ROC. Here I had told you that there's another point which we learned in accounts of companies chapter, which generally students mix up. That point was filing financial statements with ROC. We file financial statements with the ROC within 30 days from the date of the AGM. We file annual return with the ROC within 60 days from the date of AGM. So financial statements are also filed with ROC. The annual return is also filed with the ROC. Financial statements, when we file the audited and adopted financial statements guys, that is within 30 days from the date of AGM. When we file the annual return with the ROC, that is within 60 days from the date of AGM. Now this annual return has to be signed by whom? It depends. If it's a one-person company, small company or a startup, it has to be signed by the company secretary. If the company doesn't have a company secretary, it will be signed by a director. If the company happens to be any other company, it will be signed by company secretary and director. If the company doesn't have a company secretary, then we'll have to go to a practicing company secretary. Then here we had learned a very special point guys, certificate of annual return. Now company has prepared this annual return guys containing all this information, but what is the guarantee that the information is correct or not? So that is why the annual return has to be certified by a practicing company secretary in form MGT 8 saying that all the facts are correctly and adequately disclosed. Remember C and A, all the facts are correctly and adequately disclosed. Okay, so this certificate of annual return has to be given by a practicing company secretary in form MGT 8 saying that yes, the annual return is disclosing all the facts correctly and adequately, and all the provisions given in this act relating to annual return, everything has been complied with. But this certification is not required in every company. It is required only in listed companies and those companies which have paid up share capital of at least 10 crores or turnover of at least 50 crores. This was about certification of annual return. And then one more point we had learned, that the company secretary who is signing the annual return and the company secretary who is giving the certificate, both have to be different company secretaries, because if they are same, then there is a self-review threat. And then after this we had learned that a copy of the annual return has to be put onto the company's website also, and that website address has to be put in the board report given under section 134. Then we learned that so many contents of annual return, 10 contents of annual return will not make sense for 1% companies and small companies. So for them we have a summarized version of the annual return, we have an abridged version of the annual return. The general annual return form is MGT 7 which contains all these 10 points. But however, if it's a 1% company or a small company, for them the abridged version is enough, the summarized version is enough, which is given in form MGT 7A. So this was your section 92 guys, annual return. We learnt about the contents to be filed with ROC within 60 days from the date of AGM. If AGM is not held, it should be filed within 60 days from the last day by which the AGM should have been held. This annual return has to be signed by whom we studied. Certification of annual return, important guys, applicable only to listed companies and to those companies which have paid up share capital of at least 10 crore or turnover of at least 50 crores. So in these companies, a practicing CS will give a certificate in form MGT 8 saying that number one, the annual return discloses all the facts correctly and adequately. And number 2, it complies with all the applicable rules and regulations. The practicing CS who is giving this certificate and the CS who is signing the annual return, they have to be two different people. And finally, we learned if it's a one-person company or if it's a small company, then a summarized annual return, an abridged annual return is enough in form MGT7A. So other companies will file the detailed annual return in MGT7, but one-person company and small company, for them MGT7A only. Okay, this was section 92. Then coming to section 94, which talks about the preservation and the inspection of register of members and the annual return. So first of all, register of members has to be preserved permanently. The register of debenture holders has to be preserved for 8 years. But just remembering 8 years is not enough. You have to remember 8 years from when. Register of deposits was 8 years from the date on which the last entry is made in the register. Register of charges was forever, but the instrument creating the charge, that was for 8 years from the date of satisfaction of charge. Similarly, debenture holders register has to be preserved for 8 years from the date of redemption of debentures. Now all this preservation will be done in whose custody? In the custody of company secretary. But if the company doesn't have a company secretary, it will be preserved in the custody of any other person who is authorized by the board of directors. Then we learned that the annual return has to be preserved for 8 years from the date on which it was filed with the ROC. Now annual return will be kept where? See, where should the registers be kept? We already learned in section 88, remember 3 boxes we had, guys. We had the registered office of the company or any other place but in the same city where RO is situated, or any other city in India where more than 1/10 of the members reside. And for the second and the third box, we had a common arrow. We said SR is required. So for registers, where should the registers be kept? That we've already covered in section 88. Now annual return, they have to be preserved for 8 years from the date of filing. Now where will you keep them? Where will you preserve them? Either at the registered office or at any other place in India where more than 1/10 of the members reside. That box in between which says any other place but in the same city where RO is situated, that option is not there for annual return. Okay, and if you want to keep the register over here, SR has to be passed. Now who can inspect, guys? Who can inspect the register of members, the annual return? Who can inspect? Anybody can inspect, but if the members, debenture holders and other security holders or beneficial owners, if these 4 people are inspecting, which 4? Members, debenture holders, other security holders, beneficial owners. If these 4 are inspecting, for inspection we will not charge any fee from them. If anybody else is inspecting, we will charge an inspection fee from them. Of course, inspection can be done during business hours only, on a working day only, but under section 91, when the register is closed, in that period inspection is not allowed. So, we spoke about inspection, but what about taking copies? Like the people who are coming to inspect the registers, to inspect the annual return, can they also take copies? Yes. Like for example, guys, when we talk about inspection of books of accounts in your accounts of companies chapter, there we learn that books of accounts can be inspected by the directors, but they can't take a photocopy. But over here, not only are we allowing inspection, we are allowing copies also. So inspection, if it is done by these 4 people, then no fees. Anybody else is doing inspection, we will charge a fee. But when it comes to taking a copy, no matter who is taking a copy, we will charge a fees and we will give them the copy within 7 days. Okay, so this is it with a simple section, guys, section 94. Now coming to the next set of concepts, guys. First of all, what are the different types of businesses which are transacted in the meeting? Businesses are nothing but the matters which are discussed in the meeting. There are 2 types of matters, guys. We have special businesses and ordinary businesses. We have 4 ordinary businesses. Apart from these 4 ordinary businesses, everything else is special business. Special business can be discussed in AGM also, in EGM also, but ordinary business can be discussed only in the AGM. So in AGM, if a matter is discussed, it can be ordinary business also, it can be special business also. But in EGM, if any matter is discussed, it has to be special business only, because ordinary businesses can be discussed only at the AGM. So what are the 4 ordinary businesses? Number 1, consideration of financial statements, audit report and board report, declaration of dividend, appointment of directors in the place of those who are retiring, appointment of auditors and fixing their remuneration. Tell me the 4 ordinary businesses, guys. Consideration of financial statements, board report and audit report, declaration of dividend, appointing directors in the place of those who are retiring, appointing auditors and fixing the remuneration. So these are your 4 ordinary businesses. And where are these ordinary businesses discussed? only in the AGM. Everything else is going to be special business, and whereas special business is discussed in AGM also, in EGM also. So at AGM, if any matter is being discussed, it can be ordinary business also, it can be special business also. But in AGM, if any matter is being discussed, it has to be special business only, because ordinary businesses are only 4 and they are all discussed in the AGM only. Okay, now listen guys, we're going to be discussing about notice of meeting section 101. Very important concept. We spent one whole class on notice of meeting. Let us revise the concepts quickly. Notice section 101. So notice is given by whom? Notice is given by the proper authority. And who is proper authority? Board of directors. What if the notice is given by an improper authority? Like what if one director gives a notice? What if managing director gives a notice? What happens if notice is given by improper authority? Then 3 conditions guys. Condition number 1, this improper notice has to be ratified. It has to be ratified by whom? Condition 2, by the proper authority. It has to be ratified by the proper authority when? Condition 3, before the meeting. So even if the notice is given by improper authority, if it is ratified by the proper authority before the meeting, then even though it was issued by improper authority, the notice will still be valid, the meeting will still be valid. But if we are not able to get this kind of ratification, then notice is invalid, the meeting also is invalid. So in that meeting, whatever resolutions are passed, that also is invalid. So notice has to be given by proper authority. Proper authority is board of directors. If the notice is given by anybody else, we will say notice is given by improper authority. If notice is given by improper authority, but if we are able to get ratification from proper authority before the meeting, then the notice will become valid, meeting will become valid. But if you are not able to get ratification like that, the notice is invalid, the meeting also will be invalid. So now this notice has to be given to whom? The notice has to be given by whom? We've understood, proper authority, board. But the notice has to be given to whom? To every member of the company guys. Whether that member has voting right, does not have voting right, I don't care. Every member of the company should be receiving the notice, even if calls are in arrear, even if that person doesn't have voting right, still that member has to get the notice. Then if the member has died, his legal representative will get the notice. If the member has become insolvent, his official assignee will get the notice. Apart from the members, even the auditors of the company and the directors of the company, even they have the obligation to attend the meeting. So even they will receive the notice. But will we give the notice to the beneficial owners? No. We will give the notice to the registered members, but not to the beneficial owners. Okay, so the notice will be given by whom? By the proper authority. To whom? To members, whether they have voting right or not, I don't care. To the members, auditors and directors. If the member has died, to his legal representative. If the member is insolvent, to his official assignee. Should the notice be given to the beneficial owner also? No, we will give it to the registered member and not to the beneficial owner. Now when should this notice be given? Leave the date of the meeting, leave the date of service of notice. In between, there must be 21 clear days gap. But if it's a section 8 company, 14 clear days is enough guys. And if this notice is being sent by way of post, then we will assume that the service happened only after 48 hours. See, whether the post reached you within 48 hours or after 48 hours, I don't care. Irrespective of when the post reached you, once we post the letter to you within 48 hours, we will assume that the service has happened. So leave the date of service, leave the date of meeting. In between there has to be 21 clear days gap. But please remember guys, this 48 hours point is applicable only if the notice is being sent by post and not in email and all. And can the AOA change this 21 days requirement? See, AOA can make it stricter. AOA can say in our company 30 days is required. That AOA can say. But can AOA say no, in our company 10 days is enough? No, it can't be relaxed, it can't be reduced, but it can be increased. Very important guys, giving you a revision of the revision once again. So here we had learned that leave the date of the meeting, leave the date of service of notice. In between there has to be minimum 21 clear days gap. But if it's a section 8 company, in between only minimum 14 clear days gap is enough. Now if the notice is being sent by way of post, we will assume that the service happened only after 48 hours from the date of post. So from the date of post, after 48 hours only service has happened. So leave the date of service, leave the date of meeting, in between 21 clear days gap. Okay, so if the notice is being sent by post, then 21 clear days gap, how will you calculate? You will first see what was the date of post. From that date you will not calculate 21 days. No, you will see what was the date of post. After 48 hours only you will assume that the notice got served. So that will become the date of service of notice. After 48 hours, no, that will become the date of service of notice. So leave the date of service of notice, leave the date of meeting, in between 21 clear days gap. Okay. Now, what if the gap is less than 21 days? If it is less than 21 days, it will be called as shorter notice. Now, if it is shorter notice, it will not immediately become an invalid notice. No, wait. If it is a shorter notice, we'll have to go to our members. If the members are willing to give us consent, then even though it was a shorter notice, it will still be a valid notice, valid meeting. But if the members don't give consent, then shorter notice will become an invalid notice and invalid meeting. So, shorter notice, if it's a shorter notice, that is, if the gap is less than 21 days, we need consent of our members. We need consent of how many members? That depends upon, is it an AGM or is it an EGM. If it is AGM, we need consent of 95% of the members who have the right to vote, and if it is EGM, we need the consent of shareholders, majority of the shareholders who put together are holding at least 95% of the paid up share capital having voting right. So once again, if the time gap between the date of service and the date of meeting, if I leave these two dates, if the in between time gap is less than 21 days, we will call the notice as a shorter notice. If it is a shorter notice, we will come to the members and we'll try to ask their consent. Now, how many members should consent? That depends upon, is it an AGM or is it an EGM. If it is an AGM, we need the consent of 95% of the members who have the right to vote. If it is an EGM, we need the consent of majority of the members who put together are holding at least 95% of the paid up share capital having voting right. So if we are able to get this consent, then even though it was a shorter notice, it will still be a valid notice and the meeting will still be a valid meeting. But if we are not able to get this kind of consent, then the shorter notice will become an invalid notice and the meeting will become invalid meeting. We need the consent of how many members? One last time, guys. If it is AGM, we need the consent of 95% of the members who are entitled to vote, and if it is EGM, we need consent of majority of the members who put together are holding at least 95% of the paid up share capital carrying voting rights. Okay, now listen, in what mode is a company going to send the notice to the members? See, we learnt who will send the notice. Proper authority, board of directors. To whom will the notice be sent? To the members of the company, all the members, whether they have voting right or not, auditors of the company, directors of the company. Now, how will this notice be sent? There are three options. Either it can be sent personally by hand, or it can be sent through post, or it can be sent electronically. Electronically means it can be sent through email. Now, if it is being sent through post, it has to be sent to which address? To the registered address of the member. Now, that address has to be an Indian address. If it is a foreign address, we will request that member, please give some Indian address for the purpose of sending the notice. If he is not giving an Indian address, we don't have to send it to foreign address outside India. No. If he is not giving the Indian address, we will simply give the notice as an advertisement in one newspaper, one local newspaper having circulation in the neighborhood. It will be as if we have sent the notice to that member. Understanding, guys? So there are three modes in which the notice can be sent. Number one, personally, that is by hand, or it can be sent through post, speed post, registered post, courier and all, or it can be sent through email. Please notice, it can be sent through normal post also. In normal post, there is no proof of delivery, but it can be sent through normal post also. Okay, or it can be sent through email. Email means electronically means email. Electronically does not include WhatsApp, Telegram and all. It electronically means only email. Okay, so if it is being sent through post, it has to be sent to which address? To the member's registered address. That registered address has to be in India. If it happens to be outside India, we will request that member, please give some address in India for the purpose of sending the notice to you. If he gives you some address in India, we will send it to that Indian address. If he doesn't give any Indian address, we will not send to foreign address. So in that case, just formality's sake, we will just give an advertisement of the notice in one newspaper having circulation in that particular neighborhood. That itself will be considered as if we have served the notice on that particular member. Then we learned sometimes members request the company to send notices only by a specific mode, and for that they also deposit money with the company. So in that case, the company should send the notice to that particular member by that particular mode only. If we send it to him by any other mode, then you will say that the notice was not duly served. Then we had learned that whenever the notices are sent electronically by email, the email has to be addressed to the member. In the subject itself, we have to put the kind of meeting, whether it is AGM, whether it is EGM, the company's name, the date of the meeting, the time of the meeting, the place of the meeting. Remember, I showed you the notice of 361, ma'am, right? So there in the subject itself, we had put all this information, guys. Then if the notice is being sent by way of email, then either in the email, it can be a case where as soon as you open the email, in the body of the email itself, you find the notice, or it will be a link. When you open the email, there will be a link. Click on this link to see the PDF or to see the notice. Or in the mail, when when you scroll below, there will be a PDF attachment. So if the notice is being sent by way of attachment, it can't be a Word document. It can't be a notepad document. It has to be only a PDF document. Okay. Then once the company sends the email to you, the company's work is over. Now after this, whether the mail reached you, did not reach you, your inbox was full, it didn't reach you, or it reached you but went into the spam folder, all that is not the company's fault. Company's responsibility ends once a company transmits the email. Once a company clicks on the send button, company's responsibility is over. Then we also learnt over here that company will give you an opportunity every year to change your email ID or to update your email ID. Now if you don't use that opportunity, even that is not the company's fault. And we also learnt that company can use bulk email facility also. Alright, then we had learned that what will happen if the company does not send notice to you. We'll see, was it accidental omission or was it deliberate omission. If it is deliberate omission, then the notice is invalid, the meeting will become invalid. But if it is accidental omission, then it's okay, the meeting will be valid, the notice will be valid. If they are joint shareholders, we will send the notice only to the first mentioned joint shareholder. And in the notice, what will we write, guys? The place of the meeting, the date of the meeting, the day of the meeting, the time of the meeting, and we will also write the statement of business. Statement of business is nothing but the agenda, that what are all the matters that are going to be discussed in the meeting. Now in the statement of business, some will be ordinary businesses, some will be special business, guys. For ordinary business, no explanatory statement is required, but for each special business, an explanatory statement is required. Explanatory statement we learned from section 102. In the explanatory statement, totally 4 points we learned. 2 were common points, and these 2 were special points. The first one is whether the directors, managers, KMP and their relatives have any concern or interest in the special business. We said it is not wrong if our directors and managers and KMP have connection with the matter. But what is wrong is if they don't disclose it. So the first point is, in that special business, is there any concern or interest of our directors, managers, KMP and their relatives? Second point is any other information which will help the members understand MIS. Any other information which will help the members understand the meaning of the transaction, the implications of the transaction and the scope of the transaction. With this information, the members will be able to take a decision. Then, if that special business is relating to another company, whether in that company our directors, managers, KMD and promoters put together have at least 2% of the paid up share capital. Again the same thing, it's not wrong to have this shareholding, just that if there is a shareholding, please disclose. And lastly, if the special business is relating to a document, then when and where can the document be inspected? Then we learned, what if the directors, promoters, KMP and all, what if they don't disclose their interest? Then in that case, because of this special business, did they or their relatives make any profit? If yes, that profit they have to reimburse to the company, and also they will be punished with 50,000 rupees or 5 times of the benefit that they enjoyed, whichever is higher. Understanding, guys? Understanding, guys? So in case of promoters, directors, managers or KMP, if they don't disclose their interest, okay, and because of this special business, if they or their relatives make any profit, then that profit has to be compensated to the company, and in addition to that, they will also be punished with 50,000 rupees or 5 times the benefit which they enjoyed, whichever is higher. So this was our entire discussion on section 101 notice and section 102 explanatory statement. Now coming to section 103, which talks about quorum. Now this whole concept of quorum is nothing but the minimum number of members that must be personally present. Only then the meeting is said to be validly constituted, only then we can transact business at the meeting. So here when I was discussing this quorum with you, I told you that there are 3 elements. Number 1, quorum refers to members who are personally present, and these members must have voting right. Now I am not saying voting right at the meeting, I am just saying that these members must have voting right. So quorum, in when you are talking about quorum, whom will you count? Those people who fulfill these 3 boxes. Number 1, they must be members of the company. Number 2, they must be personally present in the company, and number 3, they must be having voting right. If all these 3 points are fulfilled, these kind of people only will be counted in the quorum, and this quorum has to be present within half an hour, only then we will say that the meeting is validly constituted. Now what if this quorum, what if this minimum number is not present within half an hour, guys? Then the meeting will get adjourned to same day, same time, same place in the next week, or some other date, time, place which the board will decide. Even for this adjourned meeting, a notice has to be given, a 3 days notice has to be given, but if it is impractical for the company, there is a way out, there is a solution. If it is not possible for the company to give the 3 days notice, company can simply give an advertisement in the newspaper, one English and one vernacular, having wide circulation in the place where RO is situated. But however, we learned, if there is no quorum in a meeting which was called by requisitionists themselves, in that meeting if there is no quorum, then we will not adjourn the meeting, we will simply cancel the meeting. Understanding, guys? So, quorum is nothing but the minimum number of members who have voting right, who must be personally present at the meeting. Only then the meeting is said to be validly constituted. Quorum is nothing but the minimum number of members who have voting right and they must be personally present at the meeting. Only then you will say that the meeting is validly constituted. Then this minimum number should be present within half an hour. If it is not present within half an hour, we will adjourn the meeting to same day, same time, same place in the next week or any other date, time, place which the board of directors will decide. For this adjourned meeting also notice has to be given. 3 days notice is enough. Either this 3 days notice has to be sent to each member individually, or if company finds it expensive or inconvenient, company can simply give an advertisement in 2 newspapers, one English and one vernacular, having wide circulation in the place where the RO is situated. But we learned if the meeting is called by requisitionists, and in that itself if there is no quorum, then we will not adjourn the meeting, we will simply cancel the meeting. Then we learned what if in the adjourned meeting also there is no quorum, then in that case how many ever members are present, we will consider that itself as quorum and we will continue with the meeting. But however, in that adjourned meeting, there should be at least 2 people, guys, because only one person is present, we can't call it as meeting. Okay, now see, here you have to remember one small point, okay. Whenever you are checking the adjourned meeting, in the adjourned meeting is quorum there or not, whenever you're checking that, you will see why is it an adjourned meeting? What happened to the original meeting? See, if it's an adjourned meeting, then there would be an original meeting, only that meeting will be adjourned. So why was this original meeting adjourned? What was the problem? In the original meeting there was no quorum, that is why it was adjourned. Now in the adjourned meeting, even if there is no quorum, it doesn't matter how many ever members are present, we can still continue with the meeting, just that at least 2 members should be present. Okay, but however, if the original meeting there was quorum, so if the original meeting was adjourned, you will again see, guys, see, we are talking about adjourned meeting, so you will check the original meeting, that why was it adjourned? It was adjourned because of some other reason, guys. There was quorum, it was adjourned because of lack of time. In that case, in the adjourned meeting you need quorum, guys. In the adjourned meeting, if there is no quorum, you will once again adjourn the meeting. Now in this meeting, when you are checking quorum, you will see why was the earlier meeting adjourned? Oh, earlier meeting was adjourned because of no quorum. So in this adjourned meeting, even if there is no quorum, it's okay. You're getting the point. Basically, if there's an adjourned meeting, you will see why was the earlier meeting adjourned. If the earlier meeting was adjourned because of lack of quorum, now in the adjourned meeting, we don't need quorum. Even if no quorum is present, it's okay. We can still continue. But if the earlier meeting was adjourned because of some other reason, then in the adjourned meeting, we need quorum. Okay, guys, then listen. Quorum should be present not only when we start the meeting, quorum should be present throughout the meeting. Then what is this minimum number? For private company, quorum is 2. For public company, it will depend upon the number of members. If the public company has up to 1000 members only, quorum is 5. If the number of members in a public company is more than 1000 but up to 5000, here the quorum will be 15. And if the public company has more than 5000 members, the quorum will be 30. Okay, now when you're counting this quorum, you will count only those members who are personally present and have voting right. So see this, will you count members who are personally present? Yes. Will you count proxies? No, because in proxies, members are not personally present. They are sending somebody else on their behalf. Will you count persons who are representing corporate shareholders, persons who are representing presidents and governors? Yes, you will count them, because persons who represent companies, persons who represent president and governors, when these representatives, when they come to the meeting, it's as if the shareholder himself has come to the meeting. So we will count them. Then preference shareholders, when they don't have voting right, we will not count, because we will count only those members who are personally present and have voting right, guys. So if preference shareholders don't have voting right, we will not count them. But if preference shareholders have voting right, they are members, let's say they are personally present and they do have voting right, then we will count them. Okay, now listen, the most important point. There's a member. That member is personally present, but he has already voted electronically. E-voting, section 108, we will be discussing it a little later. See, listen to me. In e-voting, the member has already voted electronically, but e-voting is always followed by a meeting. In the meeting, even though he has voted electronically, he can still attend the meeting, guys. Just that he can't vote again, but he can still attend the meeting. So there is a member. He is personally present at the meeting, but he can't vote at the meeting because he has already voted electronically. Now, will you count that member in quorum or not? He is a member. He is personally present in the meeting. He does have voting right. Okay, he has already voted electronically. Okay, he cannot vote at the meeting, but he is a person with voting right. No, he does have voting right, guys. The fact that he has already exercised the voting right is irrelevant. He is a person who has voting right. So yes, even he will be counted in quorum. Okay. then can the AOA prescribe a larger quorum? Like for private companies, quorum is 2 only. Can AOA say no, we need 10? Yes, AOA can prescribe for a larger quorum, not a problem. Then can one single member be considered as quorum? Generally no, because meeting means meeting of people, and people means we need minimum 2 guys. But however, there are 2 exceptional cases where one single member present, even that will be considered as quorum. Number 1, when it is a class meeting and all the shares of that particular class are held by only one member. And number 2, when NCLT is giving directions to call the AGM or to call the EGM under section 97, 98, which we will be seeing a little later as well. So when the AGM or the EGM is called because of the directions of NCLT, NCLT can give any directions it thinks fit. NCLT can also give a direction that just one person present, even that will be considered as quorum. So generally no, one single member will not be considered as quorum. Generally no, one single member cannot be a meeting, because meeting means meeting of at least 2 people. One person cannot meet with himself. But however, there are 2 exceptional cases where only one single member present will still be fine. Number 1, if it's a class meeting and all the shares of that particular class are held by only one person. And number 2, when the NCLT is calling the AGM or EGM, NCLT can give any directions it thinks fit. It can also give a direction that just one single member present, even that is enough. So if NCLT gives that direction, then we will go ahead with that direction. Then after this we learned that in case the total number of members in the company is, for example, 7, okay, and the quorum for this particular company is 2 as per the act, but AOA is saying no, in our company 10. So we just now discussed, can AOA prescribe a larger number? We said yes, AOA can prescribe a larger number, guys. So therefore, what will be the quorum of the company? Quorum will be 10. Alright, now how many members are we having in the company? 7. So is it ever possible for the quorum to be met? No, the quorum is 10, okay, but total company is having only 7 members. So if all the 7 members are present, then in that case we will ignore the quorum. So if the quorum 10 is more than the total number of members 7, then, and if all the 7 members are present in the meeting, then we will ignore the quorum. Quorum will become immaterial. You understood, guys? Because very obvious, if the quorum is 10, but if we are having only 7 members, it is impossible for the quorum condition to be met. So in that case, if all the 7 members are present, we will ignore quorum. Then if they are joint shareholders, like for example, if A, B, C are joint shareholders, and if all the 3 have come to the meeting, we will count them as 3 members. Okay. Then after this, this was an interesting point. If there is a person, let's say Mr. Red, he is representing 5 companies. Okay. He is representing A Limited, B Limited, C Limited, D Limited, and E Limited. He is representing 5 companies. So he is a representative of a corporate shareholder. Will we count him in quorum? Just now we discussed that these representatives are considered as if the company, as if the member itself has come. So yes, representative will be counted in quorum. But if he is representing 5 companies, we will count as if 5 people have come. Okay. So therefore, tell me guys, let us say this is a public company, okay, and this public company is having up to 1000 members only. So what will be the quorum applicable for this public company? The quorum will be 5, guys, and Mr. Red is present. He is representing 5 corporate shareholders. So we will count him as if 5 people are present. So only Mr. Red has come. So can we say that in this company there is quorum? Only Mr. Red has come and he is representing 5 people. So we will count him as if 5 people have come. So can we say quorum 5 has met? No. Why no? Because only one person has come. Only one individual has come and he cannot have a meeting with himself. So therefore, even though he is counted as 5, only one single individual is sitting in the meeting, we cannot consider him as quorum. But however, if one more individual, just one more individual, if he also comes, then in that case we will say that the quorum is met. Alright guys, so this was one interesting point. Now listen, this I have already spoken to you about, that members who have already voted electronically, if they also come to the meeting, we will count them in quorum because they are members, they are personally present and they do have the voting right. Okay, they have already exercised voting right, but they do have voting right. Okay, and then we learned that when it comes to postal ballot, in postal ballot, there is no meeting. So, if there is no meeting, there will be no concept of quorum. So, this was section 103 guys covering quorum. Quorum is a minimum number of members with voting right who must be personally present within half an hour. Only then we will say that the meeting is validly transacted. If no quorum, we will adjourn the meeting to same day, same time, same place in the next week or any other date, time, place which the board of directors will decide. For this adjourned meeting also 3 days notice has to be given either individually to each member or as an advertisement in one English paper, one vernacular newspaper having wide circulation in the place where RO is situated. But if it was a meeting called by requisitionists and in that itself if there is no quorum, we will not adjourn the meeting, we will simply cancel the meeting. Then we learned that in the adjourned meeting also if there is no quorum, we will have to see why was he earlier meeting adjourned? If the earlier meeting was adjourned because of no quorum, then in the adjourned meeting, even if there is no quorum, it's fine. How many of our members are present? We'll assume that itself is quorum. But if the earlier meeting was adjourned because of some other reason, then in the adjourned meeting also we need quorum. Then we learned quorum should be present not only when we start the meeting, it must be present throughout the meeting. And then what is the prescribed quorum for private companies too? For public companies, it depends upon the number of members. If the number of members is up to 1000 to 5015 and more than 5030. And then we discussed over here that single member will never be considered as quorum. However, only in 2 exceptional cases, even single member will be enough. Number 1, if it's a class meeting and all the shares of that particular class are held by one single member. And number 2, if the meeting is being called because of the instructions of NCLT. In that case, NCLT can give any instruction. NCLT can also give an instruction that one member present, that itself will be enough. Then we learned if the total number of members is less and the quorum is high, and if all the members are present, then in that case quorum will become immaterial. And finally we learned these 2-3 extra points. Now coming to chairperson, guys, section 104. Every meeting of the company should have a chairperson, and generally the AOA says that whoever is the chairperson of the board of directors, he itself will become the chairperson of the meeting also. But if the AOA is silent, then in that case members have to appoint a chairperson from amongst themselves, and they will do this appointment by show of hands only. Okay, but however, if the members are not okay with the result by show of hands, they will demand a poll. And generally when a poll is demanded, we get 48 hours to arrange for the poll, guys, remember. But when the poll is demanded for appointment of chairperson, this poll has to be taken up immediately. So to conduct this poll, the same chairperson who was appointed by show of hands, he will be the chairperson to conduct this poll. Then whoever is appointed as chairperson because of the poll, that person will be the chairperson for the rest of the meeting. Simple, guys. So whoever is the chairperson of the board of directors, he itself will be considered as chairperson of the meeting. This is generally written in the AOA. But if the AOA is silent, then members have to select one person from amongst themselves who will be the chairperson of that particular meeting. They will appoint by show of hands. But if the members are not okay with the result by show of hands, they can demand a poll. If poll is demanded, the poll has to be taken up immediately. The poll will be conducted by the same chairperson who was appointed by show of hands. Alright, but because of the poll, another chairperson will be appointed. That person will be the chairperson for the rest of the meeting. Now the chairperson has totally 5 powers, guys. Number 1, he manages the meeting. Number 2, he maintains decorum in the meeting. Number 3, he executes the minutes, which means he signs the minutes after the meeting is over. Then he is the one who decides what questions will be taken up in the meeting, and he also has a casting vote. This is the most interesting point, guys. Casting vote. He will have the casting vote only if it is authorized in the AOA. By default, the chairperson will not have casting vote. Only if it is authorized in the AOA, he will have casting vote. Casting vote means the chairperson will get 1 extra vote. That is, in case an ordinary resolution has to be passed, and if the number of votes in favor is equal to the number of votes against, that is, if there is a tie, to break the tie, the chairperson will get 1 extra vote, which is called as a casting vote. But please remember, he will get this casting vote only if it is authorized by AOA. And also remember, casting vote is used to break the tie only in OR. In SR, this casting vote is useless. Then after this, we had learnt about proxies, guys, section 105. So coming to proxies now, proxies covered in section 105. Who can appoint a proxy? Those members who have the right to attend the general meeting and also have the right to vote at the general meeting, only they can appoint a proxy. Who can appoint a proxy, guys? Only those members who have the right to attend the general meeting and also vote at the general meeting, only these members can appoint a proxy. Now they can appoint anybody as a proxy. The proxy may be a member of the company, may not be a member of the company, it doesn't matter. But in a section 8 company, proxies have to be a member only. Okay, then we had learned, can the same person be appointed as a proxy for multiple people? Yes, the same person can be a proxy for multiple members, but the same person cannot be a proxy of more than 50 members, and all these members put together, he should not hold more than 10% of the total voting power. But this point will not apply if you are a proxy of only one member. This point will apply only if you are a proxy of multiple members. So you can be a proxy of maximum 50 members, and all these members put together, you should not be holding more than 10% of the voting power. Then we learned a proxy can attend the meeting on behalf of the member. He can vote in poll on behalf of the member. He can also demand a poll, but he cannot be counted in quorum. He cannot be voted in show. He cannot vote in show of hands, and he also can't speak at the meeting. For all of these, I had discussed reasons with you in the regular class itself, not going too much in depth in the revision session. So the proxy can attend the meeting. He can vote in the poll. He can also demand a poll, but he cannot be counted in quorum, because in quorum we only count members who are personally present. Okay, we will not count him in voting by show of hands. We will not let him speak at the meeting also. Okay, now whenever the company is sending a notice for the meeting, the section 101 notice, in that notice company company has to clearly write 2 points about proxy. Point number 1, member listen, you do have the right to appoint 1 or more proxies, and number 2, the person whom you are appointing as proxy, that person may or may not be a member, doesn't matter. Now listen guys, to appoint a proxy, the member will have to use this form called MGT11. Through MGT11, the member will appoint the proxy, and this MGT11 is called as the instrument appointing the proxy. This MGT11, this instrument appointing the proxy, has to be submitted by the member to the company at least 48 hours before the meeting. Okay, in this 48 hours, Sunday also will be included, and remember this 48 hours limit is so rigid that it cannot be changed even by the AOA. AOA can either increase it, not decrease it. 48 hours will remain 48 hours only. Okay. So once again, the member will appoint the proxy through MGT11. This MGT11 will be also called as the instrument appointing the proxy. This instrument appointing the proxy, this MGT11 has to be deposited by the member with the company at least 48 hours before the meeting, which means before the meeting, leave 48 hours. Before 48 hours itself, this MGT11 has to be deposited with the company. Now, if this MGT11 is deposited late, that proxy's appointment itself will become invalid, and this 48 hours is a rigid time limit. It can neither be increased nor can it be decreased by the AOA. Okay, now listen, if any member wants to inspect the proxies which are submitted by other members, these members can inspect. I'll repeat again, members, let's say I'm a member of the company, I am curious to know that which other member has appointed whom as a proxy. So I can inspect the proxy forms which are submitted by other members, but for this I have to give a 3 days notice to the company, which means before the company leave 3 days, even before 3 days I have to give a notice to the company telling the company that I have an intention of inspecting the proxy forms like this. We had also discussed in the regular class that why would a member want to do this inspection. But if the member wants to inspect like this, when can he inspect guys? He can inspect during 24 hours before the meeting. He can also inspect after the meeting has started till the conclusion of the meeting he can inspect. Okay, so this part is a very important part of a proxy discussion. If the member wants to appoint the proxy, he will do the appointment through MGT11, which is called as instrument appointing the proxy. This MGT11 he will deposit with the company at least 48 hours before the meeting. That is, before the meeting, leave 48 hours. Before 48 hours itself, he will deposit it with the company, and this 48 hours number cannot be changed even by the AOA. AOA can either increase it nor decrease it. And if the member deposits MGT11 late, that proxy's appointment itself is invalid. Then we learned other members, they can inspect the proxy forms which have been submitted by the members. But for that, they have to give 3 days notice to the company, and they can do this inspection during 24 hours before the meeting, and they can continue to do this inspection till the meeting gets over. But of course, they can do this inspection only during business hours. Then we learned that between the member and the proxy, there is a simple principal-agent relationship. If the agent's appointment can be revoked, even the proxy's appointment can be revoked, guys. So the proxy's appointment can be revoked in a very simple manner. Before the proxy can vote, if the member votes, automatically the proxy's appointment is revoked. But once the proxy has done the work, once the proxy has voted, after that we cannot revoke his appointment. We also learned that if we already appointed a proxy, and then if the same member for the same shares, if he is appointing another proxy, then automatically the earlier proxy's appointment will get revoked. Okay, and finally we had learned that the company at its own expense, it cannot send an invitation to the members saying, members, you all don't come. Instead, appoint proxy, and these are all the persons who are willing to be appointed as proxy. Like that, the company at its own expense should not send to the members the list of members who are willing to be appointed as proxies. But remember, if the member is requesting the company, that company, I want to appoint a proxy, give me list of some members give me list of some persons who are willing to be appointed as proxy, then the company can send the list of persons who are willing to be appointed as proxy. But company on its own, at its own expense, it should not send the list of persons who are willing to be appointed as proxy. And lastly, tell me, can a member who has already done e-voting, can this member appoint a proxy, guys? Try to recall, what did I tell you? Who can appoint a proxy? Only that member who has the right to attend the general meeting and also has the right to vote at the general meeting, only he can appoint a proxy, guys. Now this person who has already voted electronically, yes, he is a member of the company. Yes, he can, even though he has voted electronically, he can still attend the meeting. But can he vote again at the meeting, guys? No. So therefore, can he appoint a proxy? No. So this person, he will be counted in quorum, but this person cannot appoint a proxy. Okay guys, so this was it about our entire discussion regarding proxy covered in section 105. So proxy over here, first of all, who can appoint a proxy? Only that member who has the right to attend the meeting and also vote at the meeting, only he can appoint a proxy. So a member who has already voted electronically, he does not have the right to vote again at the meeting, so he cannot appoint a proxy. The proxy may be a member, may not be a member, doesn't matter, but in a section 8 company, the proxy has to be a member only. Then the same person can be appointed as proxy by multiple members, but all these members put together, they should not be more than 50, and also all these members put together should not be holding more than 10% of the total voting power in the company. Then proxy can attend the meeting, he can vote in a poll, he can also demand a poll, but he cannot vote in show of hands, he can't speak at the meeting, and he will not be counted in quorum. Then in the notice it should be clearly written that members, if you want, you can appoint at least one proxy, and the proxy may or may not be a member, doesn't matter. Then if the member wants to appoint a proxy, the member will use MGT 11, instrument appointing the proxy, and deposit this MGT 11 with the company at least 48 hours before the meeting. But if the member submits this MGT 11 late, then the proxy's appointment itself will be invalid. And mind you, the 48 hours limit cannot be changed by the AOA. The AOA can either increase it nor decrease it. Then we learned that the members can also inspect the proxies which are submitted by other members. For that, they have to give a 3 days notice to the company, and they can inspect during 24 hours before the meeting, and they can keep inspecting till the conclusion of the meeting. But of course, they can inspect only during business hours. Then we learned that yes, the proxy's appointment can be revoked. Before the proxy can vote, if the member votes, the proxy's appointment will automatically get revoked. But if the proxy has already voted, then the member cannot revoke his appointment. And then finally we discussed that the company at its own expense cannot send a list of persons who are willing to be appointed as proxy to the members. But if the members are requesting the company, please send the list, then the company will send the list. And then we had also learned that a member who has already voted electronically, yes, he can again attend the meeting. Yes, he will be counted in quorum, but he cannot appoint a proxy because he cannot again vote at the meeting. Okay, so this was section 105 proxy, guys. And then this representatives point we have already discussed, that representative of corporate shareholders, representatives of presidents and governors, if they come to the meeting, we will consider them as if the company, as if the shareholder has itself come for the meeting. Understanding, if representative of the president or representative of the governor or representative of the corporate shareholder, if these representatives come to the meeting, we will treat as if the member himself has come to the meeting. So will we count him in quorum? Yes. Can he appoint a proxy? Yes. Can he speak at the meeting? Yes. Can he vote in show of hands? Yes. Can he demand a poll? Yes. Basically, this representative will be treated as if the member itself has come to the meeting. So whatever rights you will give to any other member in the meeting, all those rights you will give to this representative also. This representative can further appoint proxy also. Okay. Then coming to our voting discussion. Voting is covered across 5 to 6 sections, guys. Section 106, section 107, section 108, 109 and 110. There are totally 5 sections which talk about voting. First of all, talking about section 106. Section 106 says that every member has a right to vote, and it's a statutory right of the member, and we cannot take away this right to vote from the member. But however, if calls are in arrear, and if it is mentioned in the AOA that if calls are in arrear, then no voting right, then no voting right. But otherwise, if calls are in arrear, you are still a member of the company, so you still get voting right. But only if it is mentioned in the AOA that if calls are in arrear, no voting right, only then no voting right. Then section 106 also talks about splitting of votes. Section 106 identifies that your right to vote is your personal right. It's up to you how you exercise the right. Like for example, if you have the right to cast 10 votes, out of these 10 votes, 6 votes you can use to vote yes, and 4 votes you can use to vote no. It's your personal right. You can vote in however way you want. Okay. Then after this, we had learnt about how if you are a member of the company and if you're also a director of the company, then how will you vote? When you're voting in the general meeting, you will vote keeping only your interest in mind. But when you're voting in the board meeting, okay, when you're voting in the board meeting, you are a director of the company. So when you're voting in the general meeting, you will vote as a member. So you will keep only your personal interest in mind. But if you're voting in the board meeting, you will vote as a director. As a director, you have a fiduciary relationship with the company, a relationship of trust and confidence. So whatever you do should be only for the company's benefit. So in the board meeting, whenever you're voting, you will vote with the company's interest in mind. In the general meeting, when you're voting, you will vote with your personal interest in mind. Okay. Then we had learned that there are different methods of voting. We have section 107, voting by show of hands. Then we have section 108, voting by electronic means. Section 109, voting by poll, and section 110, postal ballot. Here we learned that section 107 and section 109, these are your traditional methods of voting. So these two methods will be used if the voting is happening only at the meeting. Only then we will talk about these two, if the voting is happening only at the meeting. In these two, in the traditional methods of voting, we don't give public notice and all of our notice. Whatever is our notice, we will only give it to the members. We will not give public notice, we will not give advertisement and all. But section 108 and section 110, these two are your modern methods of voting. In these two, the voting is not only at the meeting. The voting can be from home also. Remote voting is also possible over here. In the modern methods of voting, in these two, the participation of the members is much more, because here you can vote from home also. And in the modern methods of voting, there is public notice concept also, which means the notice that we issue, section 101 notice, also has to be given as advertisement in the newspapers. Were you able to recall this point, guys? This was a very important observation that we had made. I'll repeat again. Voting by show of hands and voting by poll, these are your traditional methods of voting. These two methods of voting happen only at the general meeting, and over here the notice is simply sent to the members. We don't publicize the notice, we don't give a public notice and all, we don't give advertisement of the notice and all. But section 108 and section 110, that is electronic voting and postal ballot, these are your modern methods of voting, where the voting will not only happen at the meeting, but the voting will happen at home also. In fact, in postal ballot, there is no meeting only, the whole voting is happening from home only. So because in section 108 and section 110, there is a concept of remote voting, that is why in these two sections, the participation of the members is much higher. And in these two sections we learned we have to publicize the notice also, which means the notice has to be given in advertisements and newspapers also. So 4 sections, guys, we will see them one by one. First, let's talk about section 107, voting by show of hands. This is simple, guys. In voting by show of hands, we learned that one member will get one vote. Irrespective of how many shares you own, one member will get only one vote in voting by show of hands. Whenever voting is done at the general meeting, voting will first always happen by show of hands only. Only if the members demand a poll, only then poll will be taken up. But otherwise, in a traditional method of voting, if voting is happening only at the general meeting, then voting will always be done by show of hands only first. Keep in mind, voting by show of hands does not come into the picture if it is e-voting or if it is postal ballot. In these two and all, voting by show of hands doesn't even come into the picture. So voting by show of hands is something that we will do only if the voting is happening only at the meeting. Okay, so in that case, if the voting is happening only at the meeting, that is no voting from home. Voting is happening only at the meeting. In that case, the resolution will be first put to vote by show of hands. If the members are not okay with the result of voting by show of hands, if they demand a poll, only then a poll will be taken up. That's all, guys. That is it about section 107, voting by show of hands. And by the way, in section 107, we also learned what is the evidence that the resolution has been passed. We learned that the declaration made by the chairperson plus an entry in the minutes book, these two put together will become an evidence that the resolution has been passed. Coming to our next discussion, guys, this is going to be about e-voting covered in section 108. Now in section 108, there are multiple points, but before we go into all these points, let's understand the basic premise of section 108. There are 2 steps in section 108, guys. In step number 1, there is remote e-voting. Now understand the words that I've used over here. Why am I using the word remote? The word remote indicates you're not voting at the meeting, you're voting from home. That's why I'm using the word remote. Remote indicates voting from home. And why am I saying e-voting? What does the letter E indicate? E stands for electronic voting. So remote e-voting means the member is voting from home using the internet. But we know that in a country like India, not everybody is computer literate. Not everybody will know how to vote using the internet. So don't worry, members, if you are not able to vote electronically, there will anyways be a general meeting. You can come to the general meeting and you can vote at the general meeting also. Okay, so there will be totally 2 steps over here. Number 1, remote e-voting, which will happen from home, and number 2, there will be voting at the meeting also. So in remote e-voting, in electronic voting, in section 108, yes, there is a general meeting also. There are totally 2 steps. Okay, now because of these 2 steps, don't you think there will now be 2 kinds of members. Number 1, those members who already voted electronically from home. Now those members who have already voted electronically at home, can they attend the general meeting, guys? Yes, they can attend the general meeting. Will they be counted in quorum, guys? We already spoke about this. In quorum, we count those members who are personally present and have voting right. Yes, they are members if they are personally present and they do have voting right, so even they will be counted in quorum. But can they appoint a proxy, guys? For even this point we have covered already. For proxy we learned only those members who have the right to attend the meeting and vote at the meeting, only they can appoint proxies. Now those members who have already voted electronically, yes, they have the right to attend the meeting, but they don't have the right to vote again at the meeting. No, they can't change their vote, so therefore they can't appoint a proxy. But however, the second category of members will be those members who did not vote electronically. Now these members, yes, they can attend the meeting, yes, they will be counted in quorum also if they come personally, yes, they can appoint proxy also, and these members, because they did not do remote e-voting, they can come to the meeting and they can vote at the meeting. So this is the basic premise of e-voting, guys. Section 108, through section 108 there is maximum possible participation, because members who are able to vote from home, they will vote from home. If they are not able to vote from home, they can come to the meeting and vote. So here there is maximum possible participation. You understood the whole point, right? There are totally two steps. Number one, remote e-voting, where the members are voting from home using the internet. But don't worry members, if you are not able to vote electronically from home, there will be a meeting. You can come to the meeting and you can vote at the meeting also. Now members who have already done remote e-voting, they can again attend the meeting, but they can't vote again at the meeting. But members who did not vote electronically, they can also come to the meeting and they of course can vote at the meeting. Okay. The remaining points of e-voting we will see from our classroom notes straight away. So let me take you to the classroom notes now. First of all, tell me, is this remote e-voting mandatory for all companies? No. This e-voting, this section 108 is mandatory, number one, for those companies which are listed companies, that is, which have listed their equity shares in a recognized stock exchange, and it's also mandatory for all those companies which have at least 1000 members. Now in these cases, in section 108, even over here, notice will go right, because even in section 108, later there is a general meeting. In the second step, there is a general meeting. So a notice will anyways go. Section 101 notice will anyways go. Now whatever is usually written in the notice, all that will be written. The place of the meeting, the date of the meeting, the time of the meeting, the statement of business, explanatory statements, all that will anyways be there. But over and above that, in the notice, some extra points will also be written about e-voting. First of all, it will be mentioned the fact that e-voting facility is available. Second point, the process and the manner, how will you do this e-voting. Then time schedule. Time schedule is nothing but when can you start e-voting and by when you should finish this e-voting. Then how will you generate your login ID, how will you generate your password, and then the fact that if you are not able to vote electronically, don't worry, you can come to the meeting and you can vote at the meeting also. This point also should be written in the notice, and it should also be written in the notice that once you cast your vote electronically, you can't change your vote later on. Okay, so in section 108 also there is a general meeting, so therefore notice will anyways be issued. Now in that section 101 notice, whatever you generally write, all that will also be written. In addition to that, these extra points will also be mentioned. Okay, now the special point in section 108, which I told you even a little earlier in the revision itself, just a little earlier I told you, this is a modern method. There are two modern methods, e-voting and postal ballot. In both the modern methods, we publicize the notice. That is, the same notice we give as an advertisement in the newspaper also. So there will be totally two steps. Not only will we give the notice as usual to all the members of the company, to the directors of the company, to the auditors of the company. Remember, we learnt this in section 101. Not only will we do the usual, we will also give a public notice. Now the public notice has to be given as an advertisement in one English newspaper and one vernacular newspaper. The vernacular newspaper should have wide circulation in the district where the RO is situated, and the English newspaper should have wide circulation in the whole country itself. Now in this advertisement, what will we write? Whatever are the additional contents of the notice that we just now learned, all that we will write. We will also write about the time schedule, that is, when will the e-voting facility open and when will the e-voting facility close. Even that has to be written in the public notice. We also have to mention the record date, and one very important point, guys, in the public notice we have to write the contact details of some officer of the company. In case any member is facing any problem in the e-voting facility in casting their vote electronically from home, those members can reach out to this particular officer. So his name, his designation, his contact details, this officer's details also have to be given in the public notice. Okay, so point number one, we learned that in remote e-voting in section 108 there are totally two steps. Number one, there is remote e-voting which happens from home electronically using the internet, and number two, there is general meeting also. So members who were able to cast their vote from home electronically, great. Even you can attend the meeting, but you can't cast your vote again at the meeting. But members, if you were not able to vote from home, don't worry, you can come to the meeting and you can vote at the meeting. This remote e-voting important, this section 108 is not mandatory for all companies. Number one, it is mandatory for those companies which have listed their equity shares in a recognized stock exchange, and number two, it is mandatory for all those companies which have at least 1,000 members. Then in this in this e-voting, in section 108, in the second step, there is a general meeting. So for the general meeting, the notice will anyways be issued. In the notice, in the section 101 notice, whatever is generally written in notice, all that you will anyways write. You will also write all these extra points about e-voting, the fact that e-voting facility is available, when will the e-voting facility start, when will it end, then how to generate your login ID, how to generate your password. If you are not able to vote, don't worry, you can vote at the meeting. All these points will be written in the notice. Now, in addition to sending this notice, company will anyway send this notice to the members, to the directors, to the auditors. In addition to that, a public notice also has to be given as an advertisement in one vernacular newspaper having wide circulation in the district where the RO is situated, one English newspaper having country-wide circulation. In this public notice, whatever we have written in the additional contents of the notice, all that will be written. Apart from that, the most important point, we will also write the contact details of an officer of the company. In case anybody is facing any issue in e-voting, you can reach out to this person. Okay, please remember one small tiny point over here, that this notice, this section 101 notice which the company is sending in e-voting cases, it cannot be sent by normal post. It can be sent on, see, either it can be sent personally or it can be sent by email. If it is being sent by post, it can be sent by speed post, by registered post acknowledgement due, or by courier. But normal post, it cannot be sent by normal post because there is no proof of delivery. See, generally notice can be sent through normal post. No problem. Generally, section 101 notice can be sent through normal post, not a problem. But in section 108, in e-voting, here we need proof of delivery because important information is there in the notice. So that is why this notice cannot be sent by normal post, because in normal post there is no proof of delivery. Same point I will be telling you in postal ballot also. In both of these modern methods, you cannot send the notice by normal post where there is no proof of delivery. Okay. Then when will the e-voting facility open and when will it close? We will see when is a meeting going to be held. Preceding day 5 p.m. the e-voting facility will close. The e-voting facility has to remain open for minimum 3 days. Preceding day 5 p.m. it will be closed. Once the e-voting facility is closed, the e-voting facility will be blocked, which means after this nobody will be able to cast their vote electronically. Okay. Then for e-voting, scrutinizers will be appointed. Scrutinizers will be appointed by the board of directors. A practicing CA, practicing CS, a practicing CMA, a practicing advocate, or any other reputed person will be appointed as scrutinizer, who will conduct the whole e-voting process in a very fair and transparent manner. But the company's employee itself cannot be appointed as scrutinizer. Now, what will the scrutinizer do? What will be the entire process? See, once the e-voting facility is closed, when will the e-voting facility be closed, guys? It will remain open for minimum 3 days. And preceding day 5 p.m. it will be closed. Now, once it is closed, the company will give to the scrutinizer details of the members who have already voted electronically. The company will only give to the scrutinizers the name, the client ID, the folio ID. Only all that information the company will give to the scrutinizer. Company will not tell the scrutinizer whether these members have voted yes or no. We will only give to the scrutinizer the name and the number of the members who have already voted electronically. Why? So that the scrutinizer can ensure that these same members don't vote again at the meeting. Okay. Then at the meeting, who will vote, guys? All the members who did not vote electronically, all of them will vote in the meeting. After this voting is over, the members will go home. Now, there will be two kinds of vote. Number one, votes which have been cast electronically from home in remote e-voting, and number two, votes which are cast in the meeting. Now, all of these votes have to be counted. So, what the scrutinizer will do is, first he will count the votes which are cast at the meeting. Then he will count the votes which are cast through remote e-voting. But remote e-voting facility though, we already blocked. Remember, in the preceding day, 5 p.m. when we closed the remote e-voting facility, we blocked it. So now if the remote e-voting votes have to be counted, first the remote e-voting facility has to be unblocked. So it will be unblocked in the presence of at least 2 witnesses, and then the scrutinizer will count the votes. So now so what he'll do, he'll first count the votes cast at the meeting, and then he will count the votes which were cast electronically. So now he will have 2 sets of votes, guys. He will have votes which were cast at the meeting, yes or no, he'll have that votes, and votes which were cast through remote e-voting, yes or no, he'll have those votes also. Everything put together, he will prepare one consolidated scrutinizer's report, and he will submit this to the chairperson of the meeting within 3 days from the conclusion of the meeting. Now in this report, beware, he will simply write that how many votes were in favor and totally how many votes were against. He will not write in his report whether the resolution is passed or not passed, because that is the chairperson's work. Now as soon as the chairperson receives the scrutinizer's report, on this basis he will forthwith, immediately he will declare the result. Now this results declared plus scrutinizer's report, both will be uploaded onto the company's website and will also be sent to the stock exchange. Now a question will arise that what will be the date of the resolution? Will it be the date of the meeting? Will it be the date on which the remote e-voting closed? Will it be the date on which the scrutinizer prepared the report? Will it be the date on which the chairperson declared the result? What will be the date of resolution? The law very clearly says in e-voting cases, the date of resolution will be the date of the meeting in which the voting happened. The date of the meeting. The date of the meeting will be the date of the resolution. Got it, guys? That's it with your entire section 108. So the most important point, please remember, in section 108 there are two steps. In step number 1, there is remote e-voting, where voting is happening from home using the internet, and in the second step there is a meeting which is going to be conducted. Members, if you have already voted electronically, you can come to the meeting, you can attend the meeting, you will also be counted in quorum, but you cannot vote again at the meeting. But members, if you were not able to vote electronically, don't worry, you can come to the meeting and you can vote at the meeting. And also please don't forget that e-voting is not mandatory in every company. It is mandatory only in listed companies which have listed equity shares in a recognized stock exchange, and it's also mandatory in all those companies which have at least 1000 members. And also recall that in section 108, in the notice, additional contents have to be written about this e-voting, and this notice also has to be publicized. We also have to give an advertisement in newspapers. So we not only will we send the notice to the members, directors and auditors, we will also give an advertisement in two newspapers, one vernacular and one English newspaper. And also recall, in the advertisement, in this newspaper advertisement, we have to write the contact details of the officer to whom you will reach out to in case you have any issue with respect to e-voting. The remote e-voting facility will stay open for minimum 3 days. On the date of the meeting, the preceding day 5 PM, it will be closed. Once the remote e-voting facility is closed, it will be blocked. Thereafter, nobody will be able to cast their vote electronically from home. Then we learned that scrutinizers will be appointed. The scrutinizers will be given information about the members who have already voted electronically. But we will not tell them whether they voted yes or no. We will just tell the scrutinizer that which member has voted electronically already, so that the scrutinizer can ensure that these people don't vote again at the meeting. And then voting will happen at the meeting. Members who did not vote earlier, they will vote now in the meeting. Now once all this is done, the scrutinizer will start counting the votes. He will first count the votes cast at the meeting. Then he will count the votes cast through e-voting. Now everything put together, he will prepare a consolidated scrutinizer report. And please remember the time limit, guys. Within 3 days, he will submit this report to the chairperson. The chairperson will forthwith declare the result, and the date of resolution will be the date of meeting. Got it, guys? And also don't forget, the scrutinizer over here is appointed by whom? He is appointed by the board of directors. Okay, so this was section 108. Now coming to section 109, wherein we are talking about voting by poll. This is also a traditional method of voting. Here the voting is happening only at the general meeting. Voting by poll, voting is happening only at the general meeting. Now whenever voting is happening at the general meeting, I've already told you, first voting will happen by show of hands only. Only if the members are not okay with the result of voting by show of hands, only then they will demand a poll, and only when a poll is demanded, a poll will be taken up. So poll will be ordered by the chairperson of the meeting, either suo moto on his own or on a demand made by members. But will one or two members making a demand, will the chairperson listen to them? No. So demand for poll has to be made by how many members? See, even members can demand for a poll, even proxies can demand for a poll. So members and proxies put together must be having at least 1/10 of the total voting power, or they must be holding at least 5 lakh rupees of paid up share capital. Are you listening, everybody? Poll has to be demanded by whom? By members and proxies put together holding at least 1/10 of the total voting power, or 5 lakh rupees paid up share capital. Now when they demand a poll, if the poll is relating to adjournment of meeting, or if the poll is relating to appointment of chairperson, these polls will be taken up immediately. For all other polls, we will be given 48 hours time to arrange for the poll. Even in poll, we need scrutinizer. Here the scrutinizer will be appointed by chairperson of the meeting. Scrutinizer in section 108 in e-voting was appointed by the board, but the scrutinizer for poll will be appointed by the chairperson of the meeting. Now this scrutinizer will ensure proper conduct of the polling process. He will ensure proper records are maintained with respect to the polling process. He will also ensure a proper report is prepared of the polling process. The scrutinizer will prepare a report over here within 7 days from the completion of the poll. If you remember, in e-voting we gave him 3 days time. Here we will give him only 7 days time. He will prepare the report and he will give it to the chairperson. Okay, so scrutinizer will first arrange for the polling paper, which will be in form number MGT12. I hope you remember I had shown you the sample of the polling paper. The scrutinizer will distribute this polling paper to all the members of the company, to also to the proxies, because even proxies can vote in poll, and if they're joint shareholders, he will give the polling paper only to the first named joint shareholder. The scrutinizer will then lock and seal the polling box in front of all the members, and after the voting is over, the members will go home and scrutinizer will open the polling box in the presence of at least 2 witnesses, and he will start counting the votes. Once he has completed the counting of votes, he'll prepare the report within 7 days from the date of the poll, and he will give it to the he'll give it to the chairperson. The chairperson will declare the result forthwith. Even over here, the date of resolution will be the date on which this poll was taken up, that is the date of the meeting. So that is it with our entire discussion with respect to voting on poll, guys. Section 109. See, section 107 was voting by show of hands, 108 was e-voting, and 109 is voting by poll. So over here, remember, voting by poll, it's a traditional method. So voting is happening only at the meeting over here. But first voting will be taken up by show of hands. In show of hands, one shareholder will get one vote irrespective of the number of shares he owns. But if the shareholders are not happy with the result of voting by show of hands, then they will demand a poll. Only then the poll will be taken up, and in poll, one share will get one vote, which means more the number of shares I have, more the number of votes I will get. Also remember, the poll will be ordered by the chairperson either on his own, or if a demand is made by members and proxies put together holding at least 1/10 of the total voting power, or 5 lakhs paid up share capital. Then once the poll is demanded, if the poll is relating to adjournment of meeting or chairperson appointment, the poll will be taken up immediately. But if the poll is relating to any other matter, then the poll will be taken within 48 hours. Then even over here we have scrutinizers, guys. Even in section 108, e-voting, there also we had scrutinizers. In e-voting, the scrutinizer was appointed by the board of directors. In poll, the scrutinizer is appointed by the chairperson of the meeting. In e-voting, the scrutinizer submitted the report within 3 days. Within 3 days from the date of the meeting. In section 109, in poll, the scrutinizer will take 7 days time to prepare the report and give it to the chairperson. Okay, guys, now even over here we have a process. In the process, we said first of all the scrutinizer will arrange for the polling paper. He will distribute the polling paper to each member who is present at the meeting. He will also give the polling paper to the proxies, because even proxies can vote in poll, and if there are joint shareholders, he will give the polling paper only to the senior most joint shareholder. Then in the presence of all the members, he will lock the polling box. Alright, he will lock and seal the polling box, and then the members will cast their vote and they'll go home. Then the then the scrutinizer, in the presence of at least 2 witnesses, he will unlock the polling box and he will count the votes, prepare scrutinizer's report, and submit the report to the chairperson within 7 days. Okay, so this was voting by poll. So we have completed voting by show of hands, voting by electronic means, and voting by poll. Now only one last section in voting we are left with, and that is section 110, which talks about voting by postal ballot. Now this is also a modern method of voting, and therefore even over here there will be very high participation of shareholders. Even over here there will be an element of remote voting, wherein the members can vote from home itself. Even over here, because it is modern method of voting, voting by show of hands and all will not come into the picture. Even over here, because it is a modern method of voting, there will be a public notice element as well. Okay, listen to me, guys, let's discuss postal ballot in full detail. Now in postal ballot, the most special point is here there is no meeting. Here members are voting from home, full stop. Either they are voting from home using electronic means, or they are voting from home using postal services, but they are not voting at the meeting at all, because there is no meeting only. Okay, see, in e-voting, the members are voting from home only electronically, not by postal service, and then it is followed by a meeting. In postal ballot, the members are voting from home either through electronic means or through postal ballot, but they are not coming to the meeting because there is no meeting only. Alright, so in postal ballot, unlike e-voting, the members are doing only remote voting over here, and unlike e-voting where they had only one option, which is voting electronically, in postal ballot they have 2 options, guys. Either they can vote electronically or they can vote through postal mode. But remember, in postal ballot, the most important point is that here there is no meeting at all. Now postal ballot, is it mandatory? Is it not mandatory? Let's discuss. There are 2 matters, guys. For those 2 matters, doesn't matter what kind of a company. postal ballot is prohibited. Those two matters are number 1, ordinary businesses, and number 2, matters where we have to give directors and auditors an opportunity of being heard, like when you're removing them and all. So in these cases, we cannot do these two matters through postal ballot. These two have to be done at the meeting only. For other matters, it's up to the company whether the company wants to do it through postal ballot or not. It's up to the company. But there are 10 matters. For these 10 matters, postal ballot is mandatory. But even for these 10 matters, if the company happens to be a one-person company, or the company is having up to 200 members only, for these kind of companies, even for those 10 matters, postal ballot is not mandatory. Okay. Now what are these 10 matters? Number 1, altering the objects clause. Number 2, electing small shareholders directors. Number 3, changing the registered office address. Changing the registered office address across cities, changing the city itself. Then buyback of shares. Issue of shares with differential rights, variation of shareholders' rights, then giving loans or guarantees or securities more than section 186 limit, sale of the company's undertaking, changing the object for which money was raised by issue of prospectus, section 27, then altering the AOA to add or remove the 3 special clauses, that is to convert public company to private company or vice versa. For these 10 matters, postal ballot is mandatory. But even for these 10 matters, if the company is a one-person company or if the company is having up to 200 members, even for these 10 matters, postal ballot is not mandatory. So point number 1, in postal ballot, the voting is only remote voting from home. You have two options, e-voting or voting through postal service. But there is no concept of meeting at all over here. If you know how to use the internet, vote electronically. If you don't know how to use the internet, go to the nearest post office and send your vote through post. But there is no concept of meeting at all over here. There are two matters for which postal ballot is prohibited, which means those two matters will be done only at the meeting. Number 1, ordinary businesses, and number 2, all those matters where we have to give directors and auditors the right of being heard. Then there are 10 matters. For these 10 matters, postal ballot is mandatory. But even for these 10 matters, if the company is a one-person company or if the company is a company which is having up to 200 members, even for these 10 matters, postal ballot is not mandatory. Okay. Then after this, we had learned that over here, notice has to be sent. Yes, there is no meeting, but still notice has to be sent. That is why we don't call it as notice of meeting over here. We call it as notice of postal ballot. This notice will be sent to all the members, but we will not send it to directors and auditors. See, understand, notice of general meeting is an invitation to, it's an invitation that please come for the meeting. Now, who and all has the right to come for the meeting? The members have the right to come for the meeting. The directors and the auditors, all these persons have the right to attend the meeting. But when you talk about notice of postal ballot, this is not an invitation for meeting because there is no meeting only. Notice of postal ballot is only to inform about the voting, right? So we will give this notice only to those persons who have the right to vote. So we will give it only to the members. We will not give it to directors and auditors because directors and auditors can't vote at the members, can't vote in members' resolutions. So notice of postal ballot will be given to only those people who have the right to vote. We will give it only to the members. We will not give it to the directors and auditors because here there is no meeting. Then in the notice of postal ballot, we will very clearly mention that listen members, we will see when did the company dispatch the postal ballot notice. From that day, within 30 days, the company should receive your vote. Understanding, we will see when did the company dispatch the postal ballot notice. From that day, within 30 days itself, company should receive your vote. If the company receives your vote after the 30 days period, that vote will not be considered. Then even in postal ballot, like e-voting, a public notice has to be given as an advertisement in one English newspaper, in one vernacular newspaper, having wide circulation in the district where RO is situated. In this public notice, we will have to write, first of all, the fact that we are going to do voting through postal ballot. Then when did we dispatch the notice? Very clearly it should be mentioned here also that if we receive your vote after the 30 days period, we will not consider your vote. Even over here, we have to put the contact details of the officer. In case you have any issues with postal ballot voting, you can reach out to this particular officer. Same officer point we had in e-voting also. Okay. Then after this, even over here, we have to appoint a scrutinizer. The scrutinizer is appointed by board of directors. In e-voting, the scrutinizer was appointed by board of directors. In poll, the scrutinizer was appointed by chairperson of the meeting. In postal ballot, the scrutinizer is appointed by the board of directors. Here, the scrutinizer will give a report to the chairperson within 7 days. We will see what is the last day by which the company should have received the vote. From that day, within 7 days, the scrutinizer will prepare a report and give the report to the chairperson. Okay. See, in e-voting only, we have 3 days. Everywhere else, we have 7 days time limit for the scrutinizer's report. Alright. And the date of resolution over here will be the last day by which the company should have received the votes. No concept of meeting over here. So I can't say that the date of resolution will be the date of the meeting. So whatever is the last day by which the company should have received the votes, that will be considered as a date of resolution. Alright guys, quorum concept, proxy concept and all will not apply. So in postal ballot, there is no meeting at all. In postal ballot, the entire voting is happening from home only, either using internet or using the postal services. But there is no meeting at all over here. Then over here, there are two matters for which postal ballot is prohibited. Ordinary businesses and all those matters where we have to give auditors and directors the right of being heard. Then there are 10 matters wherein postal ballot is mandatory. But even for those 10 matters, if the company is a one-person company or does not have more than 200 members, for these two companies, even for those 10 matters, postal ballot is not mandatory. Then we learned that in the even for postal ballot, a notice has to be sent. Okay, there is no meeting over here. So we can't call it as notice of meeting. We will call it as notice of postal ballot. Notice of meeting we will send to all those persons who have the right to attend the meeting. Notice of postal ballot we will send to all those persons who have the right to vote by way of postal ballot. So notice of general meeting we will send to these three categories, but notice of postal ballot we will send only to people who have the right to vote through postal ballot, that is only to the members, not to the auditors and not to the directors. And please remember, just like e-voting, even this notice cannot be sent by normal post, because in normal post there is no proof of delivery. Generally, section 101 notice can be sent by normal post also. We have this point only in e-voting and in postal ballot. In the two modern methods, here only we have a point that normal post we cannot use because there is no proof of delivery. Okay, then we learned that a very important point over here guys, by when should the company receive the vote? Listen members, we will see when did the company dispatch the notice. From that day, within 30 days, the company should receive your vote. This is the last day by which the company should receive your vote. This is only considered as a date of resolution. From this date, within 7 days, the scrutinizer will prepare the report and give to the chairperson. Now which chairperson? There is no chairperson of meeting over here. So he will give it to the chairperson of the board of directors. Understanding, there's no meeting in postal ballot, no. So there's no chairperson of meeting. If there's no meeting, there's no chairperson of meeting also. So he will give the report to the chairperson of the board of directors within 7 days from the last day by which the company should have received the votes. Okay, and the date of resolution will be this last day, but this is the last day by which the company should have received the votes. So this will be considered as a date of resolution. From this date, within 7 days, he will prepare the scrutinizer's report and give it to the chairperson of the board. And public notice also has to be given over here. In the public notice also we have to mention the 30 days point, and here we also have to put the details of the officer to whom the members can reach out to in case they have any issues in this voting process. Okay guys, now listen a very important point. If the same matter is covered in section 108 e-voting also and 110 postal ballot also, in a particular situation, if both the sections are applicable, section 108 e-voting and section 110 postal ballot, if both the sections are applicable in a particular situation, then company you can apply any one of the two. We had discussed a very detailed example, not going into the example again, but you remember, right? If section 108 is also applicable, section 110 is also applicable, then apply any one. Okay, so this was it about our discussion on all the 4 methods of voting. Okay, remember guys, some very important points I'll tell you now. Listen to me. Out of all the 4 methods, some very important points I'll tell you. Important point number 1, in remote in e-voting section 108, first there is remote e-voting which is followed by a general meeting. Okay, then another important point, remote e-voting process will remain open for 3 days and it will close on the preceding day 5 p.m. Okay, and one more point, remember, members who have already voted electronically, they can still attend the meeting, but they can't vote again at the meeting. But members who have not voted electronically earlier, they can attend the meeting, they can appoint proxy also, and they can vote at the meeting also. Then one more important point guys, if voting is happening by poll can be taken up within 48 hours. But if the poll is relating to adjournment of meeting or relating to appointment of chairperson, these polls have to be taken up immediately. Okay, and remember, in e-voting, in poll and in postal ballot, in all the 3 scrutinizers have to be appointed. In e-voting, the scrutinizer is appointed by the board of directors. In poll, the scrutinizer is appointed by the chairperson of the meeting. In postal ballot, the scrutinizer is appointed by the board. Why like this? Why this difference? Even that we have discussed already. Then we had also learnt in poll alone, in e-voting alone, the scrutinizer has to submit the report within 3 days. In poll and in postal ballot, in both he gets 7 days time to submit the report. And also remember, in postal ballot there is no meeting, but still a notice is issued. We won't call it as notice of meeting, we will call it as notice of postal ballot. So we will give this notice only to those members who have the right to vote. So we will not give it to directors and to auditors and all, we will only give the notice to the members. And remember, in section 108 also, in postal ballot also, in both of these, the notice cannot be sent by a normal post because there is no proof of delivery. Also remember, in section 108 and in section 110, that is e-voting and postal ballot, in both of these sections we have to give a public notice as well. That point is not there in poll. Okay, so with this, voting is completed, guys. Let's go forward to our next discussion now. Let's go to circulation of members resolution, section 111. Come on everybody. So under section 111, what did we learn? First of all, we learned that generally in shareholders meetings, whatever resolutions are passed, whatever matters are discussed, all the initiatives are taken by the board of directors only. In fact, it is the board of directors only who call the meeting also. But whenever the members want to take initiative, for them we have 3 sections, section 111, section 115 and a little later section 100 EGM. Even there we will be learning about members taking initiative. So whenever the members want to take initiative, they have 3 sections and one of the sections is section 111. That's what we are learning right now. So in section 111, the members have 2 rights, guys. Number 1, they can themselves introduce a resolution. Number 2, if the directors have already proposed a resolution relating to that resolution, they can prepare a statement and ask the company to circulate that statement to all the members. So members are having how many rights? 2 rights. Number 1, right to introduce resolutions, and number 2, relating to already proposed resolutions, they can prepare a statement and get that circulated. Now if the members want to exercise any of these 2 rights, if 1 or 2 members are trying to exercise, of course we will not listen to them. So members who want to exercise any of these 2 rights put together, they must be holding at least 1/10 of the paid up share capital of the company containing voting rights. Same point we will be learning a little later in EGM also. So what are we saying over here? That the members who are wanting to exercise this right, those members put together should be holding at least 1/10 of the paid up share capital of the company carrying voting rights. Okay. Now these members who want to exercise this right, they are called as the requisitionists. They will submit 2 things to the company, a written requisition and money. Okay, let's talk about this written requisition now. This written requisition has to be signed by all the requisitionists. So either they can send 1 requisition which is signed by all the requisitionists, or let's say there are 20 requisitionists. They can submit 2 requisitions where one is signed by 10 of them, another one is signed by the other 10 of them. So either they can submit 1 requisition which contains all their signatures, or they can submit to the company multiple requisitions in such a manner that all the requisitions put together will contain the signatures of all these requisitionists. Okay, and number 2, they will also submit, they will also deposit some money to the company. How much money? The company will incur expenses in giving effect to the members' request. Members are requesting to pass a resolution, members are requesting to circulate a statement. So the company will be incurring expenses to give effect to the members' request. So to help the company meet that expense, money also will be deposited by the members to the company. So till here understood, guys? Under section 111, it is the members who are taking initiative. The members have 2 rights over here. Either they can themselves introduce a resolution, or relating to already proposed resolution, they can prepare a statement and ask the company to circulate it to all the members. So for this, the members who are requesting, those members put together should be holding at least 1/10 of the total voting power of the company carrying voting rights. Now these members are called as requisitionists. They will submit 2 things to the company, written requisition and money. This written requisition will be signed by all the requisitionists. So they have 2 options. Either they can submit 1 requisition which contains all the signatures, or they will submit multiple requisitions in such a way that all the requisitions put together will contain the signature of all the requisitionists. Then how much money will they deposit with the company? That much money which will help the company give effect to the members' request. Then what will the company do, guys? Once the company receives this request, company will, like for example, if it's a statement, then the company will circulate the statement to all the members. And if the members want to introduce a resolution, company will give notice about the resolution to all the members. Okay. Then we learned the time limit, that when should the members submit this request to the company. See, the time limit will totally depend upon out of the two rights, which right is a member trying to exercise. If they want to introduce a resolution, then before the date of meeting, leave 6 weeks. Before 6 weeks itself, they should submit the requisition. But you tell me guys, what if on the date on which they are submitting the requisition, on that date, what if meeting itself is not announced? Then it is impossible to calculate 6 weeks guys. So that is why in that case, the time limit itself will not apply. I'll repeat again. The time limit will depend upon which of the two rights the members are trying to exercise. If they want to introduce a resolution, then we will see what is the date of the meeting. Before the date of the meeting, leave 6 weeks. Before 6 weeks itself, they should submit the requisition to the company. But on the date on which they are submitting the requisition, if a meeting is not even announced already, so you can't even do any 6 weeks calculation and all. So in that case, the 6 weeks limit itself will not apply. That's what I've mentioned over here. The time limit is not applicable if, as on the date of requisition, company has not yet called the meeting. If on the date of requisition, if the company has already not announced a meeting, then the 6 weeks time limit itself will not apply. Then if the members are trying to exercise the second right, that is if they want to circulate a statement relating to an already proposed resolution, then before the date of general meeting, leave 2 weeks. Before 2 weeks itself, they should submit the requisition to the company. So the time limit is depending upon which of the two rights do they want to exercise. If the right is relating to introducing a new resolution, the time limit is 6 weeks. But the 6 weeks time limit also will not apply if on the date on which they are submitting the requisition, the meeting is not even announced yet. Then if they want to circulate a statement, your 2 weeks time limit will apply. Okay. Then we learned that the company need not circulate the statement to the members. Just now we learned, right? The members relating to an already proposed resolution, they can circulate a statement guys. So for this, they will submit this written request and all, and then the company will circulate the statement to all the members. But the company need not circulate the statement to all the members if the company proves to the central government that this statement is only to secure needless publicity, or if it is defamatory to the company. Then in that case, the company need not circulate the statement to the members. Like for example, let us say the members, let us say there is already a proposed resolution relating to buyback, okay, and some members of the company have given a statement saying that the buyback is not going to be good for the company. They have made the statement and they want to circulate the statement to all the members, but the statement is containing bad language, it is containing offensive language, it is unnecessarily going to defame the company, it's unnecessarily going to affect the reputation of the company, and those members are doing this only to get negative publicity. So in such cases, the company will go to the company will go to the central government. Central government, by the way, has delegated this work to RD. So as per the law, company will go to the central government, prove to the central government that see, the members are misusing the right. They are giving a statement which is only going to cause a lot of bad reputation to us. So in such cases, the central government will pass an order saying that yes, this statement is only to secure needless publicity. It is defamatory for the company. Company, you need not circulate the statement to the members. And don't worry company, whatever expenses you have incurred in this regard, all those expenses will be indemnified by those requisitionists. Got it guys? That's all. This is it about section 111, circulation of members' resolutions. Here remember, it is a members, it is the shareholders, they are the ones who are taking initiative. Members put together who are holding 1/10 of the paid up share capital of the company carrying voting rights. They have two rights guys, right to introduce resolutions and right to circulate statements relating to already proposed resolutions. They will submit written requests plus money to the company. Company will pass on the statement to all the members, or company will give notice of resolution to all the members. Remember the time limits. For resolution, the time limit is 6 weeks, and for circulation of statements, the time limit is 2 weeks. And also remember guys, the company need not circulate this to the members if the company is able to prove that the statement was given only to secure needless publicity and if it is defamatory for the company. Okay, now come on, let's go to section 115 now, special notice. Now even this is a section where the members are taking initiative. Members are taking initiative totally 3 places I told you, right? Section 111 which we just completed, section 115 and section 100 EGM later. So section 111 we have completed. Now we are taking section 115. Here we are talking about a special notice. So here also the initiative is taken by members who are holding at least 1% of the total voting power or paid up share capital of at least 5 lakh. Something very similar we had seen in poll. nil. But there the difference is, there instead of 1%, it was 1/10 of total voting power. So 1/10 means 10%. So in poll, it was 10% of total voting power, or 5 lakh rupees paid up share capital. In section 115, it is 1% of total voting power, or 5 lakh rupees paid up share capital. Okay, anyways, so in section 115, initiative is taken by members put together who are holding at least 1% of the total voting power of the company, or 5 lakh rupees paid up share capital. Now under section 115, the members are taking initiative only relating to 4 matters. Matter number 1, the auditor is retiring. We don't want to reappoint him. Instead, we want to appoint Mr. A. Matter number 2, the auditor is retiring. We don't want to reappoint him. Appoint anybody else, just don't reappoint him. Number 3, we want to remove the director before the expiry of his term. And number 4, in the place of the removed director, we want to appoint another director. So only in these 4 matters, if the members want to take initiative, welcome to section 115. So here the members will give a special notice to the company. When should they give the special notice to the company, guys? When is the meeting going to be held? Before the meeting, in the last 3 months. This is when they should give the notice. They should not give the special notice too early, not before 3 months. They should give the special notice during 3 months before the meeting, but don't give last minute. Don't give in the last 14 days. So the notice has to be given during 3 months before the meeting, but earlier than 14 days. Okay. So the members will give special notice to the company, and the company will inform to the members. The company will give a notice to the members about this resolution. The company, so when will the members give the notice to the company, guys? Not earlier than 3 months, but earlier than 14 days. Okay. And when will the company give the notice to the members? 7 clear days in advance. But if it is not possible to give individual notice to one member, then they can simply give as an advertisement in one English paper, one vernacular paper, having wide circulation in the state where RO is situated. Okay, that's all. This is it about section 115, guys. But the point that you have to remember is, in section 111, the last section that we learned, okay, the members can take an initiative relating to any matter. But under section 115, the members can take initiative only with respect to these 4 matters. So if the matter is coming under these 4, we have to come under section 115. If the matter is if the matter is not getting covered under these 4, only then we will go to section 111. Okay. So under section 115, special notice, the members who put together are holding at least 1% of the total voting power, or at least 5 lakh rupees paid up share capital. They are taking initiative. They are giving a special notice to the company saying that they want to pass one out of these 4 resolutions. They are giving a special notice to the company not earlier than 3 months, but at least 14 clear days in advance. They are giving the special notice to the company. Company will give a notice to all the members at least 7 clear days before the meeting. But if the company is not able to give this notice individually to one member, we can simply give it as an advertisement in one English paper, one vernacular paper, having wide circulation in the state where the RO is situated. But please remember, what are the 4 matters? Number 1, the auditor is retiring. We don't want to reappoint him. We want to appoint somebody else in his place. Number 2, the auditor is retiring. We don't want to reappoint him. Appoint anybody else, just don't reappoint him. Number 3, removing the director. And number 4, appointing a director in the place of the removed director. Okay, total 4 points only, guys. Alright, remember how many members will take initiative, what are the 4 matters, time limit. The most important point over here is time limit. The members will give the special notice to the company at least not earlier than 3 months, but at least 14 clear days in advance. And the company will give notice to all the members that we have received a special notice like this at least 7 clear days before the meeting. But if it is not possible, they will simply give an advertisement in the newspaper. Okay, so this was our discussion regarding section 115. Now taking you to the next section, section 114. Very simple section, guys. The different types of resolutions. 2 types of resolutions, ordinary and special. In ordinary resolution, the number of votes in favor is more than the number of votes against. Remember, the members who did not even come for the meeting, we will not care about them. Members who came for the meeting but did not vote, we will not care about them. We will see how many members voted yes, how many votes are yes, and how many votes are no. If the number of votes in favor is more than the number of votes against, then ordinary resolution is passed. In SR, if you see, the number of votes in favor should be at least 3 times the number of votes against. Like here, the number of votes against is 4. So 3 times the number of votes against, 3 times of 4 is 12. Number of votes in favor is 6. Is 6 more than or equal to 12? No. So therefore, special resolution is not passed. Special resolution means number of votes in favor should be at least 3 times the number of votes against. Ordinary resolution means the number of votes in favor should be more than the number of votes against. In special resolution, number of votes in favor should be at least 3 times the number of votes against. Now listen to me. If the law says SR is required, can AOA say no, OR is enough? No. But if the law says OR is required, can AOA say no, we need SR? Yes. So AOA can be stricter. AOA cannot be lenient. But if the law is not saying anything, if the law is not saying what kind of resolution is required, then by default OR only is required. Okay. Then we had learned, guys, let us say that there are 3 matters. Okay. 3 matters which have to be discussed in the meeting. So for these 3 matters, ideally 3 separate resolutions have to be passed, because what if I want to vote yes for one and no for the other 2? So ideally 3 separate resolutions have to be passed. But to save time, can the company say that one single resolution will be passed? So if you vote yes, it's as if you are voting yes for all 3. If you vote no, it's as if you are voting no for all 3. So there are 3 matters. Can the company decide to do all the 3 matters through one single resolution? The answer is no. If there are 3 matters, we need 3 separate resolutions for them. But however, multiple matters can be moved as one single resolution if 4 conditions are fulfilled. Condition number 1, the chairperson so desires. Condition number 2, not even one member is objecting to it. Now condition number 3, even poll they are not demanding. And condition number 4, the members are unanimously adopting, which means not even one vote is against this. Getting my point? So generally, if there are 3 matters, there will be 3 separate resolutions. But however, the company may decide to move these 3 matters in the form of one single resolution, provided the chairperson so desires, the members, not even one member is objecting to it, a poll also they are not demanding, and each vote is in favor. There's not even one vote which is against. Okay, so this was about passing resolutions or conducting multiple matters through one single resolutions. Now listen, coming to section 116, we had learned over here that if the resolution is passed in the adjourned meeting, the date of the resolution will be the date of the adjourned meeting only and not the date of the original meeting. If the resolution is passed in the adjourned meeting, the date of resolution will be the date of the adjourned meeting and not the date of the original meeting. Then we learned under section 117, there are 8 things which we have to file with the ROC within 30 days in form MGT 14. 8 things have to be filed with ROC. Special resolutions, unanimous resolutions, that is resolutions where all the votes have to be in favor, not even one vote should be against. Then board resolutions under section 179 subsection 3, class meeting resolutions, other prescribed resolutions, winding up resolutions, MD appointments, and resolutions under 181 1A and 181 1C. So these 8 resolutions have to be filed with the ROC within 30 days in form number MGT 14. Now coming to another very important concept, guys, section 118, minutes. Relating to minutes, we have 2 sections, section 118 and section 119. Please don't lose your patience. We've almost come towards the end of the chapter, guys. We just have to discuss about minutes, AGM and EGM. We've done a very extensive revision. At the same time, without wasting even 1 minute, we've done a very consistent revision, a very in-depth revision. So now that we are in the last part of the revision, this is not where you give up, okay? So come on, sit up straight. The last 3 concepts, let's do each of these concepts better than the other one, okay? Come on. Minutes. Minutes contain a written record of everything that was transacted in the meeting. The minutes contain a fair and correct summary of everything that happened in the meeting. That is a minute. The minutes book is nothing but a summary of all the businesses that were transacted in the meeting. Now the minutes book has to be prepared within 30 days of the conclusion of the meeting. But minutes also has to be prepared for postal ballot. In postal ballot, there is no meeting, so you can't say 30 days from conclusion of the meeting. So in postal ballot, we will say within 30 days of the resolution. So minutes have to be prepared. They have to be prepared, signed. Everything has to be completed within 30 days from conclusion of the meeting. But if it is minutes relating to postal ballot, it has to be completed within 30 days from the date of the resolution. And I hope you recall, in postal ballot, the date of resolution is the last day. Remember, we had put in this corner over here, the last day by which the votes should be received by the company. So minutes under section 118, they are a fair and correct summary of everything that happened in the meeting. They should be prepared within 30 days of the conclusion of the meeting. But if the minutes book is relating to postal ballot, it has to be prepared within 30 days from the date of the resolution passed by postal ballot. Each page then each page in the minute book has to be numbered, then secretarial standard relating to minutes issued by ICSI also has to be followed. A separate minutes book has to be maintained for members meeting, creditors meeting, board meeting, committee meetings, postal ballot. This indicates to us that minutes are prepared not just for members meeting, it's also prepared for board meetings, committee meetings, creditors meetings, debenture holders meetings, class meetings. For all this also minutes are prepared. Then in case any officer, any director, any auditor was appointed in the meeting, proper details about the appointment also have to be written in the minutes book. Then we discussed in postal ballot minutes, what will we write? There's no meeting only. So what will we write in postal ballot minutes? We will write over here the details about the resolution, then the result, whether the resolution was passed or not passed, and a summary of the scrutinizer's report. Then we discussed that if the minutes are relating to board meetings, then we will write 2 extra points. Number one, the first extra point will be which director was present at the meeting. Then the second extra point will be out of the directors who were present and voting, which director voted against the resolution. You remember the logic, guys? I told you through this we will be able to identify the culprit, the directors. We will be able to identify the directors who are actually at fault. We will be able to fix accountability. So we need to know which directors are present in the meeting. We need to know which directors voted against the resolution, because directors who are absent, who did not even come for the meeting, of course we will not punish them. Directors who voted against the resolution, they were not in the favor of the fraud, we will not punish them also. So to fix accountability, we need to know that which director was present, and out of the directors who were present, who voted in favor and who voted against. So that is why all these details also have to be written in the board meeting minutes book. Okay, then we learned that yes, no doubt, the minutes book should contain a fair and correct summary of every little thing that happened in the meeting. But however, the chairperson has a superpower. The chairperson has absolute discretion. If according to him there is a matter which is DID, if according to the chairperson of the meeting there is a matter which is defamatory or immaterial or irrelevant or detrimental to the company's interest, then he will direct that particular matter should not be entered in the minutes book. Yes, no doubt the minutes book is supposed to contain a fair and correct summary, but the chairperson has a power which overrides that rule. The power is he has absolute direction. He has absolute discretion. If according to him any matter is defamatory, irrelevant, immaterial or detrimental, he can pass an order saying that particular matter should not be entered into the minutes book. Okay guys, then we had learnt about signing of the minutes book. We said that the board meeting minutes and the committee meeting minutes should be signed by the chairperson of the meeting, but if he is unable to sign, it can be signed by the chairperson of the next meeting. And a very important observation we had, that the 30 days point is applicable only for general meeting minutes and postal ballot minutes. We learned, right, that the minutes have to be prepared within 30 days of conclusion of the meeting or within 30 days of passing the resolution by postal ballot. All that point is applicable only for general meeting minutes and postal ballot minutes. For board meeting minutes, for committee meeting minutes, that 30 days time limit is not applicable. Okay, then general meeting minutes will be signed by the chairperson of the meeting. If he is unable to sign, then we will not go to the chairperson of the next meeting. No, if he is unable to sign, the board will authorize one director for this purpose. That director will sign. If it is postal ballot minutes, we can't say chairperson of meeting, because in postal ballot there is no meeting. So therefore chairperson of board. And if he is unable to sign, or if the board doesn't have a chairperson, then the board will authorize one director for this purpose. That director will sign. Got my point, guys? Then we learnt about the evidential value of the minutes. We learnt that the minutes book will be like an evidence. Later, if the case goes to the court and if the court asks, what is the proof that the meeting was even conducted? What is the proof that this person was appointed as your auditor? What is the proof that resolution was passed? You will simply show the minutes book. The minutes book will be an evidence that first of all meeting was conducted. It will be an evidence of all the proceedings which took place in the meeting. It's an evidence of all the resolutions which are passed in the meeting. It's an evidence of all the appointments which are made in the meeting. Then after this, guys, we had also learned that the minutes can be maintained in loose leaf form, that is in loose paper, which are just maintained in files. But we have to ensure that we take these papers from file at regular intervals and bind them into a book. Okay. And then we had learned about preservation of the minutes book. The minutes book relating to the general meeting has to be preserved at the RO only. But the board meeting minutes book can be kept at the RO or at any other place which the board of directors will decide. But no matter what kind of minutes book, it has to be preserved permanently in the custody of company secretary or any other director authorized by the board. Okay, so this was section 118. Then we have one more section relating to minutes, section 119. This section talks about the inspection of the minutes book. So the inspection of the minutes book can be done by the members only. It can't even be done by the directors. See, I'm talking about inspection of the general meeting minutes book and the postal ballot minutes book. Okay, so this is relating to the members. So only the members can inspect. The directors and all can't inspect this. Now they can inspect the minutes book of the meeting and they can inspect the postal ballot minutes book during the business hours. For inspection, we will not charge any fee. But if they want, they can ask copy also. We will give them last 3 years copy. We will give them the copy within 7 working days. If they're asking for a soft copy, we will not charge any fee. If they're asking for a hard copy, we will charge a fee. Okay, so that's it guys. This was your entire discussion with respect to section 118 and section 119 relating to minutes. So minutes are a fair and correct summary of everything that happened in the meeting. They are prepared within 30 days of the conclusion of the meeting. If it is postal ballot minutes, there is no meeting. So therefore, it will be prepared within 30 days from the date of the resolution which was passed by way of postal ballot. Then each page will be numbered. Then secretarial standards relating to minutes issued by ICSI have to be followed. Then separate minutes book has to be prepared for each kind of meeting. Then whenever any officer is appointed in the meeting, proper details about his appointment have to be written in the minutes book. If it is postal ballot minutes book, we have to write in that the details of the resolution, whether the resolution was passed or not passed, and a brief summary of the scrutinizer's report. If it is board meeting minutes book, we also have to write that which director was present at the meeting and which director voted against the resolution. That way we will be able to fix accountability. Then we learned a very important point that the chairperson, he has absolute discretion. Key word guys, if according to him a certain matter is defamatory, immaterial or irrelevant or detrimental, then those matters will not even be entered into the minutes book. Then we learned about signing of minutes, the board meeting minutes and the committee meeting minutes. These minutes will be signed by the chairperson of the meeting, or if he is unable to sign, by the chairperson of the next meeting. General meeting minutes will be signed by chairperson of the meeting. If he is unable to sign, then the board of directors will authorize the director for this purpose. That director will sign. If it is postal ballot minutes, it will be signed by the chairperson of the board. We can't say chairperson of meeting because there is no meeting only over here in postal ballot. So postal ballot minutes will be signed by chairperson of the board. If he is unable to sign, or if the board doesn't even have a chairperson, then the board will authorize one director for this purpose. That director will sign. Okay. Then we said that minutes have evidential value, and we spoke about preservation of minutes book. It has to be preserved permanently forever. And lastly, we spoke about inspection. Inspection can be done only by members at the registered office at any time during the business hours, and for inspection we will not charge a fee. If they want copies, then only we will charge a fee. Can the members send a friend to inspect on their behalf? All that is not allowed. Only the members can inspect, or if they want, they can take copy. Last 3 years minutes also they can, last 3 years minutes book they can take as copy, and if they are asking for a copy, we have to give them the copy within 7 working days. For soft copy we will not charge any fee. For hard copy alone we will charge a fee. For just inspection also there is no fee. Okay. Then we had the small section, section 120 guys. This was a purely optional section. This section says that if you are a listed company, or if you are a company with at least 1000 members plus debenture holders plus other security holders, then these companies, if they want, they can maintain all the registers, minutes and all in electronic form. But it's not a mandatory section guys. It's a totally optional section, because the section has the word may. The section says company, you may maintain all this in electronic form. Okay. Then we started learning about AGM, Annual General Meeting, section 96. Now in the Annual General Meeting, the ordinary businesses will also be discussed, special businesses will also be discussed. In fact, we had learned the 4 ordinary businesses will be discussed only in the AGM and not in the EGM. Now every company will have to conduct an AGM, but of course in one-person company, no concept of AGM and all, because one member guys, what meeting will he have with himself? So every other company other than one-person company, every other company has to conduct mandatorily annual general meeting. The name itself suggests every year one meeting has to be conducted. In the notice for the meeting itself, it has to be mentioned that this is notice of AGM, so that members know that okay, this is not notice of EGM and all, this is notice of AGM. Okay. Then we had learned that what is the time limit, when should the AGM be held. The time limit depends upon, is this the first AGM or is this subsequent AGM. The first AGM has to be completed within 9 months from the end of the first financial year. For the first AGM, there is no extension also. Subsequent AGMs, you have 3 time limits. Out of the 3 time limits, you will find the earliest. That will be the last day by which the AGM should be conducted. Now, what are the 3 time limits? Number 1, between 2 AGMs, the maximum gap can be 15 months. Number 2, from the end of the financial year, within 6 months, the AGM has to be conducted. Number 3, in each calendar year, one AGM has to be conducted. So, out of the 3, you will pick the earliest time limit. That would be the last day by which the AGM should be held. So, for the first AGM, it is 9 months from the end of the financial year. For subsequent AGMs, the gap between 2 AGMs should not exceed 15 months. The AGM should be conducted within 6 months from the end of the financial year, and every calendar year there must be one AGM. So, on the basis of this, you will find a time limit, guys. That will be the last day by which the AGM has to be conducted. Now, in case you are not able to conduct the AGM within this much time limit, you can go to the ROC and you can ask for extension. ROC will give you 3 months extension. But please remember, for the first AGM, there is no extension. Okay, then we had learned that where should the AGM be held. If it's a listed company, the AGM can be held at the registered office or any other place, but in the same city where RO is situated. If it's an unlisted company, we can hold the AGM at the RO or any other place in the same city where RO is situated, or any other city, guys, but in India, where provided we get prior written consent of all our members. So, if it's a listed company, only 2 options, RO or any other place, but in the same city where RO is situated. If it is unlisted company, at RO, any other place, but in the same city where RO is situated, or any other city, but in India, provided we are able to get prior consent of all our members. Okay, if it's a government company, the meeting can be held, the AGM can be held at the RO or any other place, but in the same city where RO is situated, or any other city also as approved by the central government. But an important point over here is for Section 8 company, it's different. In Section 8 company, the time, the date, the place of the AGM, everything will be decided by the board of directors as per the directions given in the general meeting. Okay, so this is where should the AGM be held. Then AGM should be held only during business hours, that is 9 AM to 6 PM. It should not be held on national holiday. We have only 3 national holidays, guys. August 15, your Independence Day, Jan 26th, Republic Day, and October 2nd, Gandhi Jayanti. So, on these 3 national holidays, AGM should not be conducted. Okay, so this was Section 96. Then we have Section 121, which talks about report on AGM. See, minutes will anyways be prepared. In addition to that, one report on AGM has to be prepared under Section 121, applicable only for listed companies, guys, and this has to be submitted to ROC. It has to be filed with ROC within 30 days of conclusion of AGM. See, minutes also will be prepared within 30 days from conclusion of meeting. This also has to be prepared within 30 days of conclusion of meeting. But thing is, minutes we don't file with ROC, but this has to be filed with ROC, and this is applicable only to listed companies. It will be in form number MGT 15. It will be signed by the chairperson of the AGM. If he is unable to sign, it will be signed by 2 directors, out of which one of them will be managing director, and it will be signed by the company secretary as well. Okay. Now in this report, we will write about the date where the AGM was held, the place where the AGM was held, what were the matters which were discussed in the AGM, what were the resolutions which were passed in the AGM, then was it adjourned or not, then whether the AGM was convened, held and conducted as per the Companies Act or not. Also, it will contain a summary of everything that happened in the meeting. Okay, so this report on AGM under Section 121 MGT 15 is applicable only to listed companies, but this and minutes are 2 independent concepts. Just because you are preparing minutes doesn't mean company you can escape from this, or just because company is preparing this doesn't mean company can escape from minutes. Minutes also have to be prepared under Section 118. Under Section 121, this report also has to be prepared. Okay, so this report will be applicable only for listed companies. This report has to be filed with ROC within 30 days from the conclusion of the AGM in form number MGT 15, and it has to be signed by the chairperson of the AGM. If he is unable to sign, by 2 directors, one of whom will be managing director and the company secretary. Okay, guys. Then listen, everybody. This was Section 121. Then in your AGM discussion, one last section is Section 97. Section 97 has 2 preconditions. Precondition number 1, the company is defaulting, company is not conducting AGM. And precondition number 2, one member is making an application to NCLT. Even one member can make an application to NCLT, guys. If both of these conditions are fulfilled, then NCLT will pass an order asking the company to call the meeting. NCLT will call or direct the calling of the meeting, and they can issue any ancillary or consequential directions as the NCLT thinks expedient in relation to calling, holding and conducting the meeting. NCLT can give any direction. NCLT can also say that just one single member present in person or in proxy, that itself will be counted as quorum. NCLT can give any random direction over here, and know that this power of NCLT will override the act. This power of NCLT will override the AOA. But when can NCLT exercise this power? Only if the company is defaulting in conducting the AGM and also a member is making an application to NCLT, which means this order NCLT cannot pass on its own. Okay, so this was section 97. So relating to AGM, 3 sections we spoke, guys: section 96, section 97 and section 121. Section 96 says every company has to conduct an AGM. It's annual, so it has to be once in a year, and in the notice itself it should be mentioned that this is notice of AGM. We saw the time limit for the first AGM. The time limit is 9 months from the end of the financial year, and there is no extension for this. For subsequent AGMs, we have 3 time limits. Out of them, whichever is the earliest will be the last day by which the AGM has to be held. For these AGMs, we get 3 months extension provided we are able to give the ROC a justifiable reason. Then we learned that where should the AGM be held? For listed company, RO, or any other place but in the same city where RO is situated. For unlisted companies, in the RO or any other place but in the same city where RO is situated, or any other city provided we get prior consent from all our members. If it's a government company, RO, or any other place but in the same city where RO is situated, or any other city approved by the government. And if it is section 8 company, the time, the date, the place, everything the board will decide as per the directions of the general meeting. Then the AGM cannot be held on a national holiday, and report on AGM has to be prepared in addition to minutes only in listed companies as per section 121. It has to be prepared within 30 days of the conclusion of the AGM in form number MGT 15. It will contain details like when was the meeting held, where was it held, what was the business transacted in the meeting, what were the resolutions passed in the meeting, were there any appointments made in the meeting, then was the AGM conducted as per the Companies Act or not, and a summary of everything that happened in the meeting. Then this has to be filed with ROC within 30 days from conclusion of the meeting. Finally, we learned about NCLT's power. NCLT will exercise power under section 97 only if the company is defaulting in conducting the AGM and also members have made an application to the NCLT. Only then the NCLT will interfere. So NCLT will pass an order calling or directing the calling of the AGM, and NCLT can give any ancillary or consequential direction as it thinks fit. It can also give a direction that just one single member present, that itself will be counted as quorum. Even that direction NCLT can give. So NCLT's power under section 97 is overriding the act and it is overriding the AOA. Okay guys, so this was our AGM discussion, 3 sections, section 96, 97 and 121. Now coming to our EGM discussion, extraordinary general meeting. Here ordinary businesses and all will not be discussed, only special businesses will be discussed. Now who can call an EGM? Either the board can call an EGM on its own, which means the board is taking initiative, or the board is calling an EGM because the members are requesting. And there is one more method, and which is through NCLT. For that we have a separate section altogether, section 98. We'll see it a little later. So who can call an EGM? Either the board will call the EGM on its own, or the board will call an EGM because the members are requesting, or NCLT can call the EGM. Okay, now our whole focus right now will be on this point where the board is calling an EGM because the members are requesting. Now if same point guys, if 1 or 2 members are requesting, we will not listen to them. So how many members should request? Members put together who are holding at least 1/10 of the paid up share capital carrying voting rights. The same point we had learned even in section 111, circulation of members resolution. There also the same limit we had. So if the members are requesting, the members who are requesting put together, they must be holding at least 1/10 of the paid up share capital carrying voting rights. Now these members who are requesting, they are called as requisitionists. So the members who are holding at least 1/10 of the paid up share capital carrying voting rights, they are called as requisitionists, and they will submit a requisition to the company at the registered office. In this requisition, they will state the matters for which they want to call the EGM. They will not give reasons and all, they'll just state the matters. Now we will see when did the company receive the requisition from the requisitionists. From that day, within 21 days, the board should proceed to call the meeting, and the board should actually conduct the meeting within 45 days from the date of receipt of the requisition. You remember we did all this calculation to understand why 45 days. Okay, so anyways, the board shall proceed to call the meeting within 21 days from the date of receipt of requisition, and the board shall actually hold the meeting within 45 days from the date of receipt of requisition. Both the time limits are from the date of receipt of requisition. Then we discussed, if we waited but the board did not call the EGM within 21 days, then in that case requisitionists, they themselves can call the EGM. They can themselves call and hold the EGM within 3 months from the date of requisition. Now if they are themselves calling and holding the EGM, whatever expenses they are incurring for this, they can get those expenses reimbursed from the company, but only reasonable expenses. They should not incur too much excessive or lavish expenses and all. They shouldn't incur. It should be reasonable expenses the company will reimburse, but company will not bear this out of its pocket. Company will deduct this from the salary of the defaulting directors. Okay, then for this EGM also notice has to be given, but here the requisitionists themselves are calling the EGM. So here the notice will be issued by the requisitionist itself, and for this notice explanatory statement and all is not required. And if the requisitionists themselves are calling the EGM, this EGM cannot be held on a national holiday. Generally EGM can be held on a national holiday, only AGM can't be held on a national holiday. But if requisitionists themselves are calling the meeting, the EGM cannot be held on a national holiday. If the requisitionists themselves are calling the EGM, the EGM has to be only at the RO or at any other place but in the same city where RO is situated. If it is any other EGM, it can be held anywhere in India, but if it is this requisitionist EGM, only in these two places. And if in this meeting which requisitionists themselves are calling, here if there is no quorum, we will not adjourn the meeting, we will simply cancel the meeting. This was something which we've already learnt in section 103, quorum. Okay guys, so this was our discussion, a very important discussion relating to EGM. So here we have discussed that that EGM is called either by the board on its own, or EGM is called by the board upon the request of the members who put together are holding at least 1/10 of the paid up share capital carrying voting rights, or the EGM is called by NCLT. Now when the members are requesting, the board has to call the meeting within 21 days and the board has to actually conduct the meeting within 45 days from the date of receipt of requisition. If the board is not doing so, then the requisitionists themselves can call and hold the meeting within 3 months. So there are totally 3 time limits guys. Once the board receives the requisition, within 21 days they must call the meeting. Once the board receives the requisition, within 45 days they must actually hold the meeting. And if the board doesn't call the meeting within 21 days, then the requisitionists themselves can call and hold the meeting within 3 months from the date of requisition. And then we learned whatever expenses the requisitionists incur in themselves conducting the meeting, they can get reimbursement from the company, but only reasonable expenses, and company will not bear it out of its pocket. Company will deduct it from the remuneration of the defaulting directors. And then we learned that generally for explanatory statements we have to generally for special businesses we have to put explanatory statement in the notice. But however, if the requisitionists themselves are calling the meeting, in that notice explanatory statements are not required. Then we learned generally EGM can be held even on a national holiday, but if requisitionists themselves are calling the meeting, it cannot be held on a national holiday. Then we learned generally EGM can be held anywhere in India, but if requisitionists themselves are calling the EGM, this EGM shall be held only at the RO or any other place but in the same city where RO is situated. And generally if there is no quorum, then the meeting will get adjourned. But if the requisitionists themselves are calling the EGM and in that meeting if there is no quorum, the meeting will get cancelled. Okay, then we had learnt after all of this, I've spoken to you about all these points. Coming to section 98 now. In section 98, the NCLT is calling the EGM. Now when will NCLT interfere? Only if it is impracticable to call or hold the EGM. If for example the company is not even having board of directors. Let's say the company had 5 directors, all the 5 went on a vacation and let's say they met with an accident and they died. So the company is not having a functional board of directors right now. Or let's say there's a deadlock in the company, or let's say every meeting there is no quorum only, so they're not able to pass important decisions in the company. So that is why in such cases the NCLT will interfere. That is, NCLT will interfere only if it is impracticable to call or hold the EGM. See, under section 97 the NCLT will interfere and will call an AGM. In section 98 the NCLT will interfere and will call an EGM. In section 97 NCLT will interfere only if the company is defaulting in calling the AGM and one member at least is filing an application. But in section 98 the NCLT will interfere if the company, if it is impracticable to conduct the EGM in the company. And here we will not wait for an application. We can get an application from member, we can get an application from director, but NCLT can also take action suo moto over here under section 98. Okay guys, rest of the section is the same. This is the difference. So under section 97, the NCLT is interfering to call an AGM. In section 97, NCLT is interfering because the company is defaulting in conducting the AGM, and NCLT cannot interfere on its own. NCLT is interfering because an application was made by a member. Under section 98, NCLT is interfering to call an AGM because it is impracticable for the company to call an AGM. Here either the NCLT received an application from a member or a director, or NCLT is doing this on its own. Okay guys, so that's it. This was our EGM discussion. We had two sections over here. Section 100 where we spoke about the entire section, the entire concepts, and section 98. Okay, so with this guys, we are done with all our concepts in our management and administration chapter. And there's one more small point over here, that when it comes to one-person company, all these concepts relating to notice, AGM, EGM, proxy, quorum, chairperson, voting, all these provisions itself will not apply for one-person companies. In one-person companies, whenever a resolution has to be passed, one member only know, that one member will let the company know what is his decision. The company will make a note in the minutes book. That member will sign the minutes book. That's all. The date on which the signing happens, on that day the resolution is passed. Okay, so that's it guys. With this, we are done with our entire revision on the management and administration chapter. I had done this revision last time, I think around 2.5 years back, and that was that video on YouTube for me which gave me my biggest breakthrough. Okay, and after 2.5 years, I've done this video all over again, and trust me when I say this, in these 2 years in between, I have not had the guts to redo this video because I wasn't sure I would be able to do it in the same way as nicely as I had done it the last time 2 years back. But very proudly I can say that this video is even better than what we had done 2 years back. It has taken more or less the same amount of time only, but the coverage, the kind of coverage I was able to do for you in this revision video is a lot more than what we covered in the last one, and this is making me really happy. So I think I've done my part. If you enjoyed this video, if it was even one bit useful for you, if you felt that this chapter became a little more bearable for you because of this revision video, please ensure you let me know in the comment section below, because it will really motivate me to bring in a lot more videos for you. Thank you so much guys. Bye-bye. Hello guys, in this session let's do a quick revision of dividend. So we had started learning with some very basic points like what exactly is dividend. We said that if company has made profit and if the company is distributing that profit to its shareholders, equity shareholders or preference shareholders as the case may be, that distribution of profits is called as dividend. But this is the general meaning of dividend. How is dividend defined in the Companies Act? Companies Act simply says that dividend includes interim dividend. The Companies Act simply gives us an extensive definition. It gives us an inclusive definition. It doesn't define what exactly is dividend. It just tells us that dividend includes interim dividend. So this means that whatever rules and regulations are applicable to dividend, it will also apply to interim dividend. Okay. Then we learned that dividend can either be expressed as fixed amount per share or it can be expressed as a percentage. Now if it is a percentage, it will generally be a percentage of face value, a percentage of nominal value only. But only if it is mentioned in the AOA, then it will be a percentage of paid up value. But by default, dividend will always be a percentage of face value. Only if it is mentioned in the AOA, only then it will be a percentage of paid up value. Then we learned that once a dividend is declared, the company has to pay the dividend only by way of money, that is by check or by warrant or through electronic mode. The company cannot pay dividend by way of goods. In kind, it is not allowed. Once dividend is declared, it has to be paid in money form only. Then we had learned instead of declaring dividend, the company can declare bonus shares. But once a company has declared the dividend, now the company has to pay the money. Once company declares a dividend, company cannot say that instead of giving you the dividend, I'll give you bonus shares. Bonus shares cannot be issued in lieu of dividend. See, company can issue bonus shares also, declare dividend also. Company can do both together. Instead of declaring dividend, company can issue bonus shares. Instead of issuing bonus shares, company can declare dividend. But if company has declared dividend, then company has to pay the money. Company cannot give bonus shares instead of paying the money. Similarly, if company has issued bonus shares, company has to give the bonus shares. Instead of giving bonus shares, company cannot give dividend money. So yes, dividend and bonus shares, they are both distributions that we make to shareholders, but however both are two different distributions. They are not even comparable. When it comes to dividend, we have to give money to the shareholders. We can't give them shares. When it comes to bonus, we have to give shares to the shareholders. We can't give them money. But instead of declaring dividend, company can issue bonus shares. Instead of declaring bonus shares, company can declare dividend, or company can do both. But point is, once company has declared dividend, now the company has to pay the money. Instead of paying the money, company cannot give bonus shares. Okay, then we learnt about the different types of dividend. Here we learnt about the different types of dividend in two buckets. First, we spoke about equity dividend and preference dividend. Equity dividend is something that we pay to the equity shareholders. The rate is going to be decided by the board of directors. The rate keeps changing. But when it comes to preference dividend, it is paid at a fixed rate. And we know that we always pay preference dividend first. Even after paying preference dividend, if the company still has any money left, only the balance money is used to pay equity dividend. Then we learned that there are two more types of dividend on the basis of the timing of declaration: interim dividend and final dividend. Let's first talk about final dividend, guys. Now, final dividend is something which is declared at the AGM. It is an ordinary business. It is recommended by the board of directors. It is approved by the shareholders at the AGM by passing ordinary resolution. Now, here there are 2 to 3 points. Let's discuss them all together. First of all, if the company wants to pay any final dividend, any AOA authorization is not required. By default, every company can pay final dividend. Okay. Another point, if the board of directors have decided not to recommend final dividend, can the shareholders insist that they want dividend? No. Shareholders cannot insist on declaration. If the board of directors have declared 5%, can the shareholders increase it to 7%? No. The shareholders cannot increase the rate. But if the board has announced 5%, can the shareholders decrease the rate to 2%? Yes. So the shareholders cannot insist on the declaration of dividend. Shareholders cannot increase the rate, but the shareholders can decrease the rate. Okay. So this is about a final dividend discussion, guys. And oh yes, one more point we had discussed. If you recall, we learned that final dividend, once it is declared, it becomes a debt which the company owes to the shareholders. Now the company has to pay the money. The company cannot revoke the dividend. See, either the company should not even declare the dividend, because dividend is not an obligation. It is not a charge on profit, it is an appropriation of profits. So either the company should not even declare the dividend. But if the dividend is declared, then it becomes a debt which the company owes to the shareholders. It cannot be revoked. However, it can be revoked in exceptional circumstances like fire or war with the consent of shareholders. Okay. Then we had learnt about interim dividend. Now this is something which is paid in between the AGMs, which means if dividend is declared in the AGM, it will be final dividend. But AGM 1, AGM 2, somewhere in between, on some date in between, if the dividend is declared, that is if the dividend is declared outside of the AGM, not in the AGM, outside of the AGM, then it is called as interim dividend. In interim dividend, the shareholders don't have any role to play. Interim dividend is declared, it is recommended and declared by the board by themselves. We don't need any shareholder approval over here. It is entirely a decision which is taken by the board of directors. But however, if the company wants to pay interim dividend, then for that a prior AOA authorization is required. And one more thing we had learnt is interim dividend over here. See, once a company declares interim dividend, it can be revoked. It can be revoked with the consent of all the shareholders. It can be revoked. Okay. So the major difference is that final dividend is declared at the AGM. Interim dividend is declared outside the AGM. In final dividend, it is recommended by the board and approved by the shareholders by passing OR at the AGM. Interim dividend, the shareholders don't have a role to play. The board itself decides, the board itself declares. Final dividend, AOA authorization is not required, but to pay interim dividend, AOA authorization is required. Then final dividend cannot be revoked. It cannot be revoked unless there is an exceptional circumstance. It cannot be revoked. But interim dividend can be revoked with the consent of all shareholders. It can be revoked. Okay. So this was about interim dividend and final dividend. Then we learned that in two situations, in two cases, the company is prohibited. It cannot declare dividend. Two prohibitions, guys. Prohibition number 1, if the company has done any default with respect to deposits, company first rectify the default, only then you can declare dividend. But here we had learned that if the company does any default with respect to deposits, the problem is only in equity dividend. Company cannot declare equity dividend, but preference dividend can still be paid by the company. Getting my point? So if there is a default with respect to deposits, the company cannot pay equity dividend, but the company can still pay preference dividend. And once a default with respect to deposits is rectified, then company can pay equity dividend also. This is the first prohibition. The second prohibition we learnt was about Section 8 companies. Section 8 companies are prohibited. They just cannot distribute dividend. First of all, they are companies with charitable objectives, guys. So first of all, they will not even have profit, but company by chance, by mistake, if you made profit, use that profit for your charitable objectives, but you are prohibited from distributing dividend. Okay, so this was about the prohibition. Now moving on to the next point, guys, sources for declaration of dividend. Company can declare dividend only out of profits. Company can declare dividend out of current year profits also, out of earlier years surplus also. Company can declare dividend out of free reserves also. Company can declare dividend out of money given by central government or state government pursuant to a guarantee also. But company cannot declare any dividend out of capital. Company cannot declare any dividend out of capital redemption reserve, debenture redemption reserve. From all these places, company cannot declare any dividend. Okay, and before the company can declare dividend, the company has to first set off all the losses, and company also has to provide depreciation. Only then the company can declare dividend. So guys, what are the points we learned over here? What are the sources for declaration of dividend? Company can pay dividend only out of profits, out of current year profits, out of profits of earlier years, out of money in the free reserves. Using all this, the company can declare dividend. But dividend cannot be declared out of capital. Dividend cannot be declared out of revaluation reserve, capital redemption reserve, notional gains, imaginary profits. All this you cannot use. We can use current year's profits, we can use earlier year's profits, we can use free reserves, we can use money given by the central government or state government for the purpose of dividend. Okay, but before we declare dividend, we always have to first set off the losses. We have to provide depreciation, only then we can distribute dividend. Alright, then here we had learned a special rule with respect to interim dividend. Now, interim dividend can be declared by the company in between the year also. Interim dividend can be declared after the year is over also. Do you remember? Like for example, if the year is from 1st April to 31st March, now interim dividend can be declared anywhere in between the year also. It can be declared after the year also. If the dividend is declared after the year, then we can pay interim dividend out of the profits of the year. If the interim dividend is declared somewhere in between the year, then we will see what was the preceding quarter. Till that preceding quarter, whatever profit the company has made, using that profit also interim dividend can be declared. But however, in the current year, if the company has made loss, then company can take money out of surplus in P&L account. Now, in case the company is taking money out of surplus in P&L account, then there is a limit that how much maximum interim dividend can be declared in such cases. The maximum dividend will be the average dividend of the last 3 years. Okay. Now, relating to interim dividend, a lot of extra points also we had learned. First of all, we had learned that can interim dividend be paid out of free reserves? No. Then we learned that surplus in P&L account means what? It means earlier year's profits which has not been transferred to free reserves till now. We can use that, but we can't use free reserves. Remember guys, interim dividend cannot be paid out of free reserves. So this special point is only with respect to interim dividend, that interim dividend can be paid out of profits of the year. In case interim dividend is declared in between the year, interim dividend can be paid out of the profits that the company has earned up to the preceding quarter. But in case in the current year, if the company has made a loss, then the company can take money out of surplus in P&L account, that is out of the earlier year's profits. But however, company cannot take money out of free reserves for the purpose of interim dividend. Now, when will the limit apply? The limit of the maximum limit will apply only if the company is taking money, only if the company is paying dividend out of surplus in P&L account. That is, current year company has a loss, then only company will touch the surplus. Only in those cases the company will only in those cases the maximum limit will apply. The maximum limit will be the average of the last 3 years dividend. Okay, then after this we had learnt about if in case a company is paying final dividend. Okay, if the company is paying final dividend, in that case company has 4 options guys. Company can either take money out of current year profits, or the company can take money out of surplus in P&L account, which means earlier year's profit, or the company can pay dividend out of accumulated out of free reserves, or the company can pay final dividend out of the money given by central government, state government. But that's not a part of our discussion now. So for now, company can take money out of these three places. Now for interim dividend, company cannot take money out of free reserves, but for final dividend, yes, company can take money out of free reserves. Now if the company's if the profits are inadequate, or if the profits are absent, then only the company will touch the free reserves. When the company touches the free reserves, that is when these 4 limits will apply. Understanding? The 4 limits will not apply if the company is paying dividend out of current year profits, or if the company is paying dividend out of surplus in P&L account. In these 2 cases, these 4 conditions will not apply. These 4 conditions will apply only if the company is paying dividend out of free reserves. Okay. Now what are the 4 conditions? Condition number 1 is the same like what we learned in interim dividend. The maximum rate of dividend over here can be the average of the last 3 years dividend. But in case in year 1, in year 2, in year 3, in all these 3 years, if dividend is not even declared, if it is 0, 0, 0, then in that case this condition 1 itself will not apply. And the second condition is that maximum how much amount can you draw from the reserves? 1/10 of paid up share capital plus free reserves. Then condition number 3 is from this number you are supposed to first set off the current year losses, only the balance number you are supposed to see. And the last condition says that after you withdraw money from the reserves, how much minimum balance should stay in the reserve? Minimum 15% of paid up share capital should still stay in the reserve. So on the basis of all the 4 conditions, you will calculate your amount of dividend that can be drawn from the free reserves. Out of these 4 numbers, you will pick the least number, and that will be the maximum amount of dividend which the company can declare out of free reserves. And guys, I'm reiterating on the most important point over here. First of all, this is with respect to final dividend. This is not with respect to interim dividend, because for interim dividend we have already studied over here. When it comes to final dividend, company has 3 options. Company can pay dividend out of current year profits, or out of surplus in P&L account, or out of free reserves. Now if the company is paying in final dividend out of current year profits or out of surplus in P&L account, then these 4 conditions will not apply. These 4 conditions will apply only and only if the company is paying dividend out of free reserves. When will the company pay dividend out of free reserves, guys? If the profits are absent, which means company has made a loss, or if the profits are inadequate, which means company has made profits but not enough profits to pay dividend. In those cases, the company will pay dividend out of free reserves. Only at that time these 4 conditions will apply. What are the 4 conditions, guys? Condition number 1, the maximum rate will be the average of the last 3 years dividend. But if in year 1, year 2, in year 3, in all the 3 years, if the company did not even declare any dividend, then in that case this condition itself will not apply. Only the remaining 3 conditions will apply. Condition number 2, the maximum amount that the company can draw from reserves is 1/10 of paid up share capital plus free reserves. But from this amount, we should first set off the current year loss. Only the balance amount we can draw from the reserves. And lastly, once we draw the money from the reserve, how much minimum balance should still stay in the reserve? 15% of paid up share capital. Out of these 4 conditions, guys, we will pick the least number, and that is the maximum amount which the company can draw from the reserves. Okay. Now also remember, all these conditions will not apply to a 100% owned government company. Remember, that is, if there is a company wherein 100% of the capital is owned by central government or state government or both, for these kind of companies, this condition itself will not apply, which means these kind of companies cannot even declare final dividend out of free reserves. They have to declare dividend only out of profits. If they don't have profits, they can't distribute dividend at all. Which companies? Not all government companies, guys, only 100% owned government companies. That is, the entire 100% of the capital is owned by central government or state government or both. In these companies, if the company is not having profits, company cannot declare dividend out of free reserves. It is not allowed. Okay. Then after this, we had learnt about to whom will the company pay dividend. We said that the company will pay dividend to the registered shareholder, that is the person whose name is appearing in the register of members, or to his order, or to his banker. Then after this, guys, we had learnt one more situation. Let us say A has sold the shares to B. Okay, but who's the seller? The seller is Mr. A. He only was a member of the company. So in the register of members, as of now, A's name only is written. So A has sold the shares to B. A or B, one of them has submitted all the documents to the company for registration of the transfer. They have submitted the instrument of transfer. They have submitted the share certificate and all. And the company has not registered the transfer till now. So things are pending from whose end? Things are pending from the company's end. Now meanwhile, if the company declares dividend, now company will pay dividend to the registered member. Registered member is Mr. A. Now if Mr. A gets a dividend, it's going to be unfair because A has actually sold the shares to B. It is because of the company's delay that A's name is still appearing in the register of members and B's name has not been entered into. So in such cases, the company will not give the dividend to A. There are two options possible over here. If the transferor Mr. A authorizes the company in writing that company please pay the dividend to the transferee, then the company will pay dividend to Mr. B, company will pay dividend to the transferee. But however, if Mr. A does not give any such authorization to the company, then in that case the company will keep the dividend in the unpaid dividend account once a transfer is registered. Once A's name is removed from the register of members and the transferee B's name enters into the register of members, then the company will pay dividend to Mr. B only. Okay, so this was a case where the registration, the transfer is pending registration and meanwhile the company declares dividend. Similarly guys, in this period, if the company declares any rights shares or any bonus shares, all this also will be kept in abeyance. In abeyance means all this also will be kept pending only. Once a company registers a transfer, the rights shares, the bonus shares, everything will go to the transferee Mr. B only. Okay. Then we learned about the whole process for declaring the dividend. We learned first of all, from the date of declaration of dividend, within 5 days itself, the entire dividend money has to be set aside in a separate bank account. That way what happens, this company has arranged the entire money within 5 days itself. So that money cannot be used for any other purpose except for paying dividend. So there are totally 5 time limits guys. The first time limit is from the date of declaration of dividend, within 5 days itself, the entire dividend money has to be deposited in a separate bank account in a scheduled bank. Now comes my second time limit. From the date of declaration of dividend, within 30 days itself, the company has to either pay the dividend money or the company has to post the dividend warrant. If the company is using dividend warrant, it doesn't matter when did the shareholder receive the dividend warrant. What matters is when did the company post the dividend warrant. The posting should happen within this 30 days period. Okay. Then the third time limit guys, the company is ready to pay the dividend money within the 30 days period, but the shareholder hasn't come and claimed the dividend money. In that case, if we have any unpaid or unclaimed dividend, then once the 30 days period is over, within the next 7 days itself, the unpaid unclaimed dividend will be transferred by the company to unpaid dividend account. If there is any delay in this transfer, then 12% per annum interest will be levied on the company for the period of delay. This was the third time limit. Then we learned the fourth time limit. Once we transfer the money into unpaid dividend account, from that day within 90 days itself, the company has to prepare a list. The list will contain the names of the shareholders to whom that unpaid dividend belongs, what is their last known address, and how much money, how much dividend do we have to pay to them. This list has to be published by the company on its website and also on other websites approved by the central government. Do you remember we had seen an example for this, Concord India, their list we had seen. So whatever unpaid dividend we have, the list, the details about that, company has to prepare a list and publish that list. So the first time limit is from the date of declaration, within 5 days itself, the company has to set aside the entire dividend money in a separate bank account. Second time limit, from the date of declaration of dividend, within 30 days itself, company should either pay the dividend money or post the dividend warrant. Then we learned from the date of declaration, within 30 days, company is willing to pay, but however there is still some unpaid unclaimed dividend. Within the next 7 days itself, it has to be transferred to unpaid dividend account. If there is a delay in this transfer, then the company will have to pay 12% per annum interest for the period of delay. Then after this, we had learned that once a company transfers money into unpaid dividend account, within 90 days itself, a list will be prepared by the company and published on its website and also on the websites approved by the central government. Then the last limit guys, the fifth limit, the money will stay in the unpaid dividend account for 7 years only. For 7 years, if that shareholder has not come and claimed the money, after 7 years, the money will be transferred along with the accrued interest to IEPF. To whom? To IEPF after 7 years. So money will stay in unpaid dividend account for maximum 7 years. Within 7 years also, if it is not claimed, then the unpaid dividend along with interest will be transferred to IEPF. Company will also give a statement to IEPF with the details of the shareholders to whom this money belongs, and IEPF will give the company a receipt as evidence of this transfer. Then we learned that when we are transferring the unpaid dividend to IEPF, at that time we will see in the last 7 years, 1 year at least has the shareholder claimed dividend. If the last 7 years, even 1 year, if he has not claimed dividend, then even the shares also will get transferred to IEPF. Okay, when will the shares get transferred to IEPF? Only in the last 7 years continuously he has not claimed any dividend at all. Only then his shares also will get transferred to IEPF. Then can the shareholder later claim his dividend money from IEPF? Can he reclaim his shares from from IEPF? Yes. If he follows the prescribed rules, then he can reclaim everything from the IEPF. Then after this, we had learnt about transfer of reserves to transfer to reserves before declaring dividend. We said this is not mandatory. Company, it's not mandatory to transfer to reserves before declaring dividend. Before declaring dividend, should you transfer to reserve or not? If you should transfer, then how much should you transfer? The Companies Act is saying all of this the board of directors will decide. The Companies Act is not interfering in all this anymore. Then IEPF we spoke about, guys, and then finally our most important discussion was about section 127, where we learned that in case a company has declared dividend, now within 30 days the company has to pay the dividend or post the dividend warrant. If the company does not do this within 30 days, then severe punishment applies. This is an extremely important penalty section which you should not skip. What is the punishment? The directors will be punished with 2 years imprisonment and minimum 1000 rupees per day of default. The special point about this penalty is that the fine is minimum amount, not maximum amount. Minimum 1000 rupees per day of default. What about the maximum amount? There is no limit. So the directors will be punished with maximum 2 years of imprisonment and minimum 1000 rupees per day of default. The company will be punished with 18% per annum interest. Try to recall same 18% interest we had in deposits chapter also. But however, we learnt in these 5 cases, even though the company has not paid the dividend within 30 days, still there will be no punishment. Number 1, dividend was not paid because of operation of law. Number 2, the shareholder had given some directions, but those directions cannot be complied with and the shareholder has been informed about the same. Number 3, there is some dispute going on that the shares belong to whom? To whom should the dividend be paid? There is a dispute going on. Number 4, the company has to pay dividend to the shareholder. The shareholder has to pay call money to the company. So the company is setting off the dividend against the call money. And number 5, because of any other reason beyond the company's control. In such cases, even though the dividend is not paid within 30 days, even though the dividend warrant is not posted within 30 days, still there will be no punishment on the directors, there will be no punishment on the company. Okay, so this was our discussion on the dividends chapter, guys. The most important part of the dividends chapter, I would say, number 1 are the 4 conditions. If the company wants to pay final dividend out of free reserves, then the 4 conditions apply. The second most important part of this chapter is the section 127. You should remember the section number also over here, and you should remember the punishment also over here. It's a very unique punishment, guys. The fine is minimum fine, not maximum fine. Minimum 1000 rupees per day of default. Maximum, no limit. Okay, so with this, we'll close this chapter, guys. Thank you. Bye-bye. So starting off with our revision on audit and auditors now. See, the very first thing that we learnt over here is who is competent authority. We learnt that if the company has an audit committee, then the audit committee will be the competent authority. If the company does not have an audit committee, then the board of directors itself will be the competent authority. This itself indicates to us that every company will not have audit committee. So audit committee is mandatory in which company now? That is written in section 177. Audit committee is mandatory in all listed companies and in all those public companies which have paid up share capital of at least 10 crore or turnover of at least 100 crores or outstanding LBDD, loans, borrowings, debentures, deposits more than 50 crore. Point to be noted, at least, but more than. So those public companies with paid up share capital at least 10 crore or turnover at least 100 crore or outstanding loans, borrowings, debentures, deposits more than 50 crores as per the latest audited financial statements. So if the company is a listed company or a public company which fulfills any of these 3 criteria, then for that company audit committee is mandatory. Then we learnt once a company has an audit committee, company should continue with the audit committee. But however, if there are 3 consecutive years in which none of the 3 criteria are fulfilled, then the company can discontinue the audit committee. Okay, so we learnt competent authority. If the company has audit committee will be the competent authority. If company does not have an audit committee, then the board of directors will be the competent authority. And then we had also learnt which company audit committee is mandatory. Number 1, listed companies. Number 2, those public companies with paid up share capital at least 10 crores or turnover of at least 100 crores or outstanding loans, borrowings, debentures, deposits more than 50 crores as per the latest audited financial statements. And guys, what if for the company audit committee is not mandatory, but the company is still having an audit committee? Even in that case, the audit committee will be the competent authority. Okay, then we learnt about the whole process for selecting and appointing the auditor. Totally there are 4 steps, guys. In step number 1, the competent authority, either the board or the audit committee, as the case may be, the competent authority, they will select the auditor. Terminology is very important over here. They don't appoint the auditor, they select the auditor, because the auditor is appointed only by the members later in step 4. So in your step 1, the competent authority is selecting the auditor. They will select the auditor on the basis of 3 criteria, guys. Number 1, what are the qualifications and the experience of the auditor? Number 2, whether this qualification and experience is commensurate for the size and requirements of the company. That is, whether the qualifications and experience are enough to meet the size and the requirements of the company. Number 3, what are the orders and pending proceedings going on against this auditor relating to professional misconduct before ICI or any other authority or any court. On the basis of these 3 criteria, the competent authority will select an auditor. In step 2, the competent authority will recommend that selected auditor to the members in the AGM. But remember, it depends. If the competent authority is board of directors, the board of directors will directly recommend that person whom they have selected to the members in the AGM. But if the competent authority is audit committee, this is where the whole drama arises. If the competent authority is audit committee will recommend the person that they have selected to the board of directors. Audit committee cannot directly recommend to the members. Audit committee will recommend to the board of directors. There are 2 possibilities now. The board may agree with the audit committee's recommendation. The board may disagree with the audit committee's recommendation. If the board agrees with the audit committee's recommendation, the board will simply pass on the recommendation to the members in the AGM. But if the board disagrees with the audit committee's recommendation, then RRR. The board will refer back the matter to the audit committee, request reconsideration and also give reasons. Now there are 2 possibilities. Audit committee may reconsider and give another name. In that case, the whole process will again start. But if the audit committee refuses to reconsider, then the board will simply record reasons and then they will send their own recommendation to the members. So in the second step, guys, the competent authority is sending the recommendation to the members. In the first step, they have selected one person to be appointed as auditor, right? They are sending the recommendation of that person to the members in the AGM. If the competent authority is board will directly send to the members in the AGM. But if the competent authority is audit committee cannot directly send to the members. Audit committee will send to the board. If the board agrees with the recommendation, board will pass on the recommendation to the members. If the board disagrees with the recommendation, then RRR. Board will refer back the matter to the audit committee, request reconsideration and also give reasons. If audit committee refuses to reconsider, board will simply record its reasons in the board report and send its own recommendation to the members in the AGM. Then in the third step, before we can appoint that person as auditor, we have to get from him a written consent saying that he is willing to be appointed as auditor. And number 2, guys, he'll also give a certificate. Now in the certificate, 5 things will be written. Number 1, he is eligible for appointment and he is not disqualified. Neither under Companies Act nor under Chartered Accountants Act, he is not disqualified. Number 2, there is a provision in Companies Act, right, which says that a person can be an auditor for how many years? What should it be? His term of appointment. So in the second point, the auditor will write that the appointment is as per the term of appointment provided under the Act. That is, he will mention in the certificate that if he selects this appointment as auditor, then the term for which he will be appointed, it is as per the provisions of Companies Act. Then number 3, the proposed appointment is within the limits laid down under the Act. Which limit? There is a limit. A person can be an auditor in how many companies? There is a limit. So in the third point, the auditor is saying that even if he selects this company's audit, even if he is selected as this company's auditor, then still the total number of companies where he will be an auditor now will still be within the limit. Basically, he is not exceeding the limit. There is a limit how many companies a person can be an auditor of how many companies. There is a limit. In the third point, he is saying that he is not exceeding the limit. In the fourth point, he will give the list of proceedings which are going on against him relating to professional misconduct, and he will also mention that this list is true and correct. And lastly, he will mention that he is satisfying section 141, which means he is meeting all the qualification criteria, he is fulfilling all the qualification criteria, and not even one disqualification is applicable to him. Okay, so he will give a written consent and a certificate. Both of these he will give before he is appointed. So in the first step, the competent authority, on the basis of 3 criteria, they will select an auditor. In the second step, the competent authority will recommend that selected auditor to the members in the AGM. Number 3, before we can appoint that person as auditor in the AGM, we have to get from him 2 things: written consent and certificate. Now comes the fourth step, guys. The members will appoint that person in the AGM by passing a simple ordinary resolution. Then the company will inform the auditor, congratulations, you have been appointed. Company will also give a notice to ROC informing the ROC within 15 days from the meeting that whom have we appointed as auditor. This is our whole process for appointing the auditors. So who selects the auditor, guys? Board of directors or the audit committee. Basically, whoever is a competent authority, they only select the auditor, but the auditor is appointed by whom? Appointed by the members in the AGM. And how do the members appoint the auditor? What kind of a resolution they pass? A simple ordinary resolution. So this was the whole manner, the whole set of steps for selecting and appointing the auditor. Now coming to section 139 subsection 1, this section says that every company should have an auditor, even 1% company, guys, even small companies, guys, every company requires an auditor. Who can be appointed as an auditor? You can be an individual also, you can be a firm also. But if you're a firm, you can be a partnership firm also, you can be an LLP also, but you should be a practicing chartered accountant. If you're an individual, you must be a practicing chartered accountant, you should be a member of ICI. If you're a firm, your partners, at least majority of your partners have to be chartered accountants, practicing chartered accountants. Okay, now section 139 subsection 1 says when we're appointing an auditor, then the term of appointment has to be 5 years. Section 139 subsection 1 does not say at least 5 years or up to 5 years. It says that the term of office has to be 5 years, which means the term has to be equal to 5 years, not less, not more, it has to be equal to 5 years. 139 subsection 1 does not have any problem if the same auditor keeps getting reappointed. So 139 subsection 1 says the same person can keep on getting reappointed in the same company as auditor. See, the cooling period point, all that is mentioned only little later in 139 subsection 2. 139 subsection 1 simply says that every company has to appoint an auditor. The auditor has to be an individual or a firm. The firm can be a partnership firm or LLP, but it should be chartered accountants. If individual, it should be a practicing chartered accountant. If it's a firm, majority of the partners should be chartered accountants. And when I say chartered accountants, I mean member of ICI. Then the term of office of the auditor has to be equal to 5 years. We can keep on reappointing the auditors. So this is what section 139 subsection 1 says. But 139 subsection 2 says, wait, there is a cooling period concept. 139 subsection 2 says, if the same auditor, if you keep on reappointing the same auditor over and over again, then that auditor will not be independent anymore. And that will be super risky. We have already learned the lesson thanks to the Satyam scam. So section 139 subsection 2 very clearly puts a criteria of cooling period. That is, this subsection says that yes, generally the term is 5 years. Yes, generally the auditor can be reappointed. But wait, in specified companies, you can appoint an individual as an auditor only for one term of 5 years. You can appoint a firm as an auditor only for 2 terms of 5 years each, so total 10 years. After this 5 years and 10 years, as the case may be, there will be a mandatory cooling period of 5 years. Now, in this mandatory cooling period of 5 years, you cannot appoint the same auditor, you cannot appoint another firm which has a common partner, you cannot appoint another person or another firm which is belonging to the same network of firms. So, there is a restriction that who can be appointed during this cooling period. This is what section 139 subsection 2 says, guys. Come on, once again. Section 139 subsection 2 says that yes, as per section 139 subsection 1, generally we appoint an auditor for one term of 5 years, and generally we keep reappointing him also. Yes, no doubt, this is allowed. But in some specified companies, we can appoint an individual as an auditor only for one term of 5 years. We can appoint a firm as an auditor only for 2 terms of 5 years each, so total 10 years after that cooling period of 5 years. Okay, now 2 things we have to revise, guys. Number 1, who are the specified companies, and number 2, who can be appointed in this cooling period, who cannot be appointed in this cooling period. First, what are the specified companies? This cooling period concept does not apply to each and every company. It applies only to certain specified companies, that is listed companies, unlisted public companies with paid up share capital at least 10 crores, private companies with paid up share capital at least 50 crores, and all those companies which have borrowings from banks and financial institutions plus public deposits at least 50 crores. And also this section is not applicable to 1% companies and small companies. So this cooling period concept is not applicable to every company, it is applicable only to these companies. If your company does not come in this category, then no cooling period, which means you can keep on reappointing the same person as auditor again and again, you can keep reappointing. But if your company comes in this list, then you can appoint individual as auditor for 1 term. You can appoint firm as auditor for 2 terms, then cooling period of 5 years. What are the specified companies, guys? Tell me one last time. Listed companies, unlisted public companies with paid up share capital at least 10 crores, unlisted private companies with paid up share capital at least 50 crores, and all companies with borrowings from banks and financial institutions plus public deposits at least 50 crores. Point to be noted, public deposits, not all deposits, not deposits accepted from members, only those deposits which we have accepted from public. So listed companies, unlisted public companies with paid up share capital at least 10 crores, private companies with paid up share capital at least 50 crores, and all companies, public or private doesn't matter, which have loans from banks and financial institutions plus public deposits at least 50 crores. For these companies only this cooling period concept is applicable. If you happen to be a 1% company or a small company, if a 1% company or a small company fulfills any of these criteria, still for 1% company and small company this cooling period concept will not apply. Okay, now focusing on who cannot be appointed in cooling period. Of course, same auditor cannot be appointed in cooling period. Okay, then listen. If the outgoing auditor is a firm and the incoming auditor is also a firm, then on the date of appointment of the incoming auditor, both the outgoing and incoming should not have a common partner. I'll repeat again. If the outgoing partner is a firm and the incoming partner is also a firm, if the outgoing auditor is a firm and the incoming auditor is also a firm, then on the date on which you are appointing the incoming auditor, on that date both the firms should not have common partner. Then guys, in the third point, this was very interesting. If you remember, we had also seen a question from this point. I'll give you a revision of this point a little slowly. My outgoing auditor is a firm. In that firm, there was a partner. That partner was in charge of the firm. He was also certifying financial statements. That partner left that firm. He retired from the firm. Okay. And then he has gone and joined another firm. Okay. Now we want to appoint this firm. Are we appointing the same auditor? No. Are we appointing another firm which has a common partner? No guys, on the date on which we are appointing this firm, there is no common partner because his partner has retired from the outgoing firm. So there is no common partner. But still, in this firm, the partner who was in charge of the outgoing firm, the partner who was certifying financial statements, he is a partner over here. So even though there is no common partner on the date of appointment, still this firm cannot be appointed. Are you understanding this? Did you recall this point, guys? Yes, I'll tell you once again, okay? I'll tell you once again what exactly happens here. My outgoing auditor is a firm. My incoming auditor is also a firm. Okay. In my outgoing auditor, there was a partner. In that firm, there was a partner. That partner was he was the person who was in charge of the firm. He was the person who used to certify financial statements also. He retired from that firm and he came and joined another firm. Okay. Now, the company during the cooling period wants to appoint this another firm. So on the date of appointment, there is no common partner because that in-charge partner, that main partner, he has retired from that outgoing firm, guys. So there is no common partner. But still, this another firm cannot be appointed because in this another firm, the same person who was in charge of the outgoing firm, the same person who was certifying financial statements earlier, that same person is a partner here. So even though there is no common partner, still this another firm cannot be appointed. And lastly, we learned the outgoing auditor can be individual or firm, I don't care. Incoming auditor can be individual or firm, I don't care. But both outgoing auditor and incoming auditor are belonging to the same network of firms, same brand name, same common control, can't be appointed as auditor. Okay guys, but please remember this cooling period concept will not apply to every company, will apply only to these companies. So this was section 139 subsection 2 talking to us about term of auditor. Then we spoke about section 139 subsection 3. We said members may decide upon rotation of auditors. The firm is having 5 partners. The members can decide that year 1 partner A will audit. Year 2, partner B will audit. Year 3, partner C will audit. Like that, the members of the company can decide to rotate the auditing partner. And also we learned that there can be joint auditors as well, but rotation of auditing partner, joint auditor, all this is only if the members decide. This was 139 subsection 3. Then we learned about 139 subsection 6, first auditor in non-government companies. This was very simple, guys. From the date of incorporation, within 30 days, the board will appoint the first auditor. But if the board doesn't appoint within 30 days, then from the date of incorporation, within 90 days, the members will appoint the first auditor in the EGM. Now this first auditor will hold office till the conclusion of the first AGM. Okay. Then we learned about auditor of government companies. First auditor of government company, if you see, from the date of incorporation, within 60 days, CNAG will appoint. If CNAG does not appoint within 60 days, within the next 30 days, the board will appoint. If even the board doesn't appoint within the next 30 days, in the next 60 days, the members will appoint. Okay. Now even over here, the first auditor's term will be till the conclusion of the first AGM. Then we had learned, guys, in government companies, subsequent auditor appointment is also very different. Generally, if you see, the auditor is appointed by the members, guys. Generally, it is the members who appoint the auditor of the company, and generally, the auditor is appointed for a term of 5 years. No, all these provisions are not applicable in government companies. In government companies, first auditor appointment is also different. Subsequent auditor appointment is also different. The subsequent auditor will be appointed by C&AG within 180 days from the start of the financial year, and he will hold office till the conclusion of the AGM of that particular year. So even the first auditor appointment is different, subsequent auditor appointment is also different. Here the members and all are not appointing the subsequent auditor. There is no 5 years term, there is no cooling period concept and all. From the start of the year, within 180 days, CNAG will appoint, and that person will continue to hold office till the conclusion of the AGM for that particular year. Okay, so this was it about a discussion regarding first auditors and auditors in government companies. Then we had learnt about casual vacancy, guys. Casual vacancy means even before the term of the auditor expires, even before that there is a vacancy because of DDRR, because of death, disqualification, resignation or removal. Because of any of these 4 reasons, there can be a casual vacancy we discussed. Now, if there is a casual vacancy, we can't let a vacancy stay in the office of the auditor. So the casual vacancy has to be filled. Now, it has to be filled by whom and when? It depends. In non-government companies, it has to be filled within 30 days by the board of directors. But however, in non-government companies, if the casual vacancy is because of resignation, then in that case, even over here, within 30 days, the casual vacancy will be filled by board by appointing another auditor. But however, we also need ratification, we also need approval from our shareholders within 3 months in an EGM by passing OR. Okay. Then we learned in government companies, in companies owned, controlled by government, in these companies and all, from the date on which the casual vacancy happens, within 30 days, the casual vacancy will be filled by CNAG. If CNAG doesn't fill within 30 days, within the next 30 days, the board will fill. In government companies, because of resignation, there is no special provision. Okay. So in non-government companies, if the casual vacancy is because of resignation, then from the date of casual vacancy, within 30 days, the board will fill the vacancy by appointing another auditor. But we also need approval of the shareholders, we also need ratification of shareholders within 3 months. But however, if it's a non-government company and the casual vacancy is not because of resignation, even over here within 30 days the board will appoint. But if it is not because of resignation, we don't need any shareholders ratification. In government companies, within 30 days CNAG will appoint. If CNAG doesn't appoint, within the next 30 days board will appoint. But doesn't matter which category, guys, the casual vacancy auditor, his term will be till the conclusion of the next AGM. Okay, this was a casual vacancy discussion. Then coming to the discussion of section 139 subsection 9 and 139 subsection 10, where we spoke about reappointment of retiring auditor. Let me first give you a revision of the base that we built for this section. We said that even during the tenure of 5 years, in every AGM, we are creating a legal fiction as if the auditor is retiring and is then getting reappointed. Even during his tenure, guys, 5 years is not over yet. Still, we create a legal assumption as if in every AGM he is retiring and we are reappointing him. Okay, but however, in case he is attracting any disqualification, then we cannot reappoint him. We'll have to appoint another person as an auditor. Or if the retiring auditor is giving a notice saying that he does not want to be reappointed, then we can't reappoint him, guys. Or if the members have passed an SR saying the retiring auditor should not be reappointed. In his place, let's appoint Mr. A this time. Or if the members are passing an SR saying the retiring auditor, let's not reappoint him, appoint anybody else, just don't reappoint him. If they pass an SR like this, then he will not be reappointed. In that case, we will appoint another person as auditor. But if he is not attracting any disqualification, if he has not given any notice like this, if members have not passed any SR like this, then he is deemed to be reappointed. So if he is deemed to be reappointed, tell me, did we appoint any other auditor in the meeting? No, guys. So it is as if the same auditor only is continuing. Okay, so this was our revision of section 139 subsection 9 and 139 subsection 10, guys. During the tenure of 5 years, in each AGM during the tenure of 5 years, we will assume, we are creating a legal fiction. We are assuming as if the auditor is retiring and getting reappointed, as if he is retiring and getting reappointed. But however, if he is attracting a disqualification, then we cannot consider as if he is reappointed. So in that case, we will have to find another auditor. Or if he has given a notice saying that he doesn't want to be reappointed, then we can't reappoint him. We'll have to appoint some other person as auditor. Or if the members are passing an SR saying that they don't want to reappoint him, they want to appoint another person in his place. Or if they are saying appoint anybody else in his place, just don't reappoint him. In such cases, he is not deemed to be reappointed. So in that case, we'll appoint another person as auditor. But if he is not disqualified, he is not given any notice like this, and also members have not passed any SR like this, then he is deemed to be reappointed. So we'll continue with the same auditor itself. Okay, guys, then after this we had learnt about removal of auditors, section 140 subsection 1, removal of auditors. We learned that removal of auditor will of course result in casual vacancy, which will get filled like what we learned just now under section 139 subsection 8. Yes, it will result in casual vacancy, but they'll fill off, the board will fill the casual vacancy like how we learned in 139 subsection 8. And 140 subsection 1 applies to all auditors, whether you want to remove subsequent auditor, first auditor, casual vacancy auditor, same process only. First of all, the board of directors will take initiative. So in section 140 subsection 1, who is taking initiative, guys? It is a board of directors who are taking initiative. If they want to remove the auditor, it's a board who is taking initiative. So board will pass a board resolution. Within 30 days of the board resolution, an application will be made to the central government asking for approval. Central government will take its time and give approval. Once we receive the approval, within 60 days, we must conduct a general meeting of shareholders in which we must first give the auditor whom we want to remove an opportunity of being heard, and then an SR has to be passed by the members to remove the auditor. That's all, guys. This is the process. So we need board resolution, central government approval and SR. Now see, this much revision is fine, but we have to remember the little points also that we learned in class. We learned point number 1, that the same process will apply whether you want to remove subsequent auditor, first auditor, casual vacancy auditor, doesn't matter. Same process only will apply. Then we also had observations. The member, it is the members who appoint the auditor, but who removes the auditor, guys? Board plus central government plus members. To appoint the auditor, only OR is required. To remove the auditor, SR is required. One more thing, did you notice? For central government approval, there is no time limit. Central government will give approval within how much time? There is no time limit over there. Okay, this was section 140 subsection 1. Here, to remove the auditor, it is a board of directors who are taking initiative. They first pass a board resolution. Within 30 days itself, company files an application with the central government asking for approval. Central government will then give approval to the company, and then within 60 days of receiving the approval, we have to conduct a general meeting of shareholders wherein we have to first give that member and we have to first give that auditor an opportunity of being heard, and then only pass SR of the members. And then once this SR is passed, the auditor will be removed. Once the auditor is removed, there will be casual vacancy. Once there is casual vacancy, section 139 subsection 8 will apply. Casual vacancy, if it is in a non-government company, the board will fill the casual vacancy within 30 days. If it is a government company, CNAG will fill the casual vacancy within 60 days. If CNAG doesn't fill the vacancy within 60 days, within the next 30 days, the board will fill the vacancy. Properly understood this entire section, guys? Section 140 subsection 1 this was. Okay, and one more point I had told you during this discussion, that for this SR, can we pass this SR through postal ballot? We said no, this SR cannot be passed by way of postal ballot, because in our postal ballot section 110, we had clearly learned that there are two matters where postal ballot is prohibited. Number 1, ordinary business. Number 2, all those matters where we have to give auditors and directors opportunity of being heard, like removal of auditors and directors. So for these matters, postal ballot is prohibited. Doesn't matter what kind of company, this SR has to be passed at the meeting. Postal ballot is prohibited. just an interconnection of sections. Okay, then coming to our next section guys, 140 subsection 2 and 140 subsection 3, which talks about resignation of auditor. This was simple guys. The auditor who wants to resign, he will simply give a statement in ADT 3 along with the reasons that why is he resigning to the company, to the ROC, and of course if the company is a government company, he will also give this to the C and AG. He should give this statement and all within 30 days from his date of resignation. He must give this statement. And of course if there is a resignation, then there will be casual vacancy guys under section 139 subsection 8. So again it will be filled by whom? It depends. If it's a non-government company, within 30 days it will be filled by the board. But if it is because of resignation, then we also need members' ratification within 3 months. If it's a government company or a government owned or a government controlled company, then within 60 days the CNAG will fill the vacancy. If CNAG doesn't fill the vacancy within 60 days, within the next 30 days the board will fill the vacancy. This was about a resignation discussion. Then we learnt about section 140 subsection 4 guys. Here we had a super intense discussion where we spent quite a lot of time understanding three sections. We interlinked 3 sections here. Section 139 subsection 9, just now we revised this section, the reappointment section, remember, the retiring auditor is deemed to be reappointed, that one. Section 115 which we learnt in our management and administration chapter, special notices, and section 140 subsection 4, this section which we are going to learn now. So here we had learned that when the board of directors, when they want to take initiative to remove the auditor, when they want to remove the auditor, for them the process is section 140 subsection 1. But what about the members guys? What if the members want to take initiative? What if they want to remove the auditor? What if they don't want to continue with this auditor? Then for them the process is given in section 140 subsection 4. Do you remember in section 139 subsection 9 we had learned that if the members pass an SR saying that the auditor is retiring, now let's not reappoint him, let's appoint Mr. A in his place. Or if the auditor or if the members pass an SR saying auditor is retiring, let's not reappoint him, let's appoint anybody else in his place, but let's just not reappoint him. If the members pass an SR like that, then the retiring auditor will not get reappointed. Remember guys, that is the situation over here in section 140 subsection 4. So first of all, I'll straight away take you to the summary that we had created over here. What is the situation? We have a retiring auditor, but why are we calling him retiring auditor? Is it because his tenure is over? No, we are calling him as retiring auditor because thanks to section 139 subsection 9, we are creating a legal assumption that every AGM the auditor is retiring and the same auditor is getting reappointed. We are creating a legal assumption. So his tenure is not over, his 5 years are not over yet, we are still within the 5 years, but every AGM we will treat as if he is retiring and he is getting reappointed. So that is why we are calling him as retiring auditor, but his tenure is not completed. Okay, so we had learned in section 139 subsection 9 that if the members pass an SR that they want to appoint some other person as auditor, or if they want to pass it, or if the members want to pass an SR saying that they don't want to reappoint this retiring auditor, then that retiring auditor will not get reappointed guys. Yes, so that is my situation. I have a retiring auditor. I am calling him retiring auditor not because his tenure is getting over, but because section 139 subsection 9 creates a legal assumption that every AGM the auditor retires and the same auditor is getting reappointed. But we will not reappoint him if the members pass an SR saying that they want to appoint some other person as the auditor, or if the members pass an SR saying that he is anyways retiring, let's appoint anybody else in his place, let's not reappoint him. So if the members pass that SR, then he will not get reappointed. So now there are two possibilities. Either this SR will get passed or this SR will not get passed. If this SR is passed, then the retiring auditor is not going to get reappointed. But if the SR is not passed, then the retiring auditor will get reappointed. Okay. Now what is the process to pass the SR? The process to pass the SR is given both in section 115 and in section 140 subsection 4. So, I am talking about section 115 because this is a section which talks about the process where the members take initiative. Even in this discussion, what am I talking about? I just told you over here, right? Who is taking initiative guys? In section 140 subsection 4, it is the members who are taking initiative. When the members want to take initiative, then automatically section 115 process will apply guys. Now section 115 says that members who are holding at least 1% of the total voting power or 5 lakh rupees paid up share capital should give a special notice to the company not earlier than 3 months but at least 14 clear days in advance. All this is management and administration chapter. Then what will the company do then? Company will immediately give to the retiring auditor a copy of the special notice forthwith. with, immediately as soon as a company receives a special notice from the members saying that they want to pass an SR like this, immediately company will give a copy of the special notice to the retiring auditor. The retiring auditor will give to the company a written representation of reasonable length and will request the company, please notify this to the members, please send this to the members. Now company will send to all the members a notice of the resolution. In that notice of the resolution, company will tell the members that like this we have received a representation from the auditor, and they will also give a copy of the written representation. All this they should send to the members at least 7 clear days before the meeting. But if it is not possible to send it at least 7 clear days before the meeting, then in that case the company will simply give it as an advertisement in newspapers. Then we learned at the meeting the retiring auditor will be given an oral opportunity of being heard and an SR will be passed. Once the SR is passed, that retiring auditor will be removed and another auditor will be appointed in his place. If you remember, even in section 140 subsection 1, where the board of directors are taking the initiative to remove the auditor, there also SR is passed. Here also, when the members are taking initiative to remove the auditor, here also SR only is passed. Okay, so this being a very important section, guys, I'm going to give you a revision of this revision one last time. So here in this section we have a retiring auditor. We are not calling him as a retiring auditor because his tenure is over. His tenure is not over. We are calling him retiring auditor because of section 139 subsection 9, which creates a legal fiction that every AGM the auditor is retiring and the same auditor is getting reappointed. Because of that legal fiction, we are calling him as retiring auditor. So we have a retiring auditor, but his tenure is not over, and the members, if they they want to pass an SR saying that he is retiring, now in his place let's appoint Mr. A, or they are passing a resolution saying let's appoint anybody else but let's not reappoint him. So if the members are able to pass this SR, then the retiring auditor will not get reappointed. If the members are not able to pass this SR, then the retiring auditor will be deemed to be reappointed because of section 139 subsection 9. So to pass this SR, what is the process? Who is taking the initiative? Members are taking initiative. As soon as members take initiative, section 115 comes into the picture. Section 115 says members will have to give a special notice to the company. But how many members? Members put together who are holding at least 1% of the total voting power or rupees 5 lakh rupees paid up share capital, those members are taking initiative by giving to the company a special notice at least 14 days in advance, but not earlier than 3 months before the meeting. Okay, and then as soon as the company receives this special notice from the members saying that they want to pass this SR, immediately company will give to the retiring auditor a copy of the special notice. There is no time limit given for this, guys. Only the law just says forthwith, which means the law just says immediately. So as soon as the company receives a special notice from the members, immediately company will give to the retiring auditor a copy of the special notice. The retiring auditor will then give to the company a written representation of reasonable length and request the company to please send this to all the members. Now company will anyways be sending to all the members a notice of the resolution. In that the company will mention that we have received a representation from the from this auditor, and they will also send a copy of the written representation to all the members. When should this be done, guys? At least 7 clear days before the meeting. See, this is in addition to the notice of meeting. Notice of meeting section 101 notice that has been sent 21 clear days in advance. That is already sent, but because the members are giving special notice, a notice about the special notice has to be sent by the company to all the members. For that the time limit is 7 clear days. So along with that itself, the company will also send a copy of the written representation. Now at the general meeting, we have to give this retiring auditor an oral opportunity of being heard, and then the members will pass an SR. Once they pass an SR, this retiring auditor will not get reappointed. Instead, we'll have to appoint another person in his place. Okay, and then here we learned 2 extra points as well. We had learned that what if the retiring auditor abuses his rights? What if he uses bad language in the written representation? He is sending this written representation. No, what if he is abusing his right by defaming the company unnecessarily in that written representation? In that case, we will make an application to NCLT. NCLT will pass an order saying don't send a copy of that written representation to the members. Also, don't read it out at the meeting. Then we had learned what if the retiring auditor sends a written representation to the company too late? We are not able to send it to all the members. What if we receive it too late? In that case, we will simply file it with the ROC. We will not send it to all the members, and later we will simply read it out at the general meeting. Okay, so this is how we had learned section 140 subsection 4, guys, a very important section. And then in section 140, the last subsection we learned was what if the auditor acted fraudulently. Here the auditor himself has done the fraud. If the auditor has acted fraudulently, or if he has abetted or colluded in any fraud relating to COD, company officers or directors, then in that case either the central government or any other person can make an application to NCLT, or NCLT can also take action suo motu. What action will NCLT take? NCLT will ask the company to change the auditor. But however, If it was central government who made the application, NCLT will act even more faster. Within 15 days itself, NCLT will ask the company to change the auditor, and the new auditor will be appointed by the central government. And what will happen to this fraud auditor, guys? For the next 5 years, he cannot be appointed as an auditor in any company, and also he will be punished under section 447. Okay, then after this we had learnt about qualifications of auditor who can be appointed as auditor. You have to be a chartered accountant, that too a practicing chartered accountant holding a valid certificate of practice. You have to be a member of Institute of Chartered Accountants of India. And if you are appointing a firm, yes, we can appoint a firm also. The firm can be a partnership firm also, it can be an LLP also. But in the firm, majority of the partners should be qualified to be appointed as an auditor. Majority of the partners should be chartered accountants, and only those partners who are chartered accountants, only they can act and sign on behalf of the firm. Okay, so who can be appointed as an auditor, guys? Only a chartered accountant holding a valid certificate of practice, only a chartered accountant who is practicing chartered accountant, also a member of ICI, only he can be appointed as an auditor of the company. In case we are appointing a firm, majority of the partners should be chartered accountants, and in case we are appointing a firm, only those partners who are chartered accountants, only they can act and sign on behalf of the firm. Then we started learning about the disqualifications of auditors. We had 10 disqualifications, guys. My first disqualification was any body corporate cannot be appointed as an auditor. But however, LLP is an exception. Yes, LLP is a body corporate, but LLP can be appointed as an auditor. But only Indian LLP can be appointed as an auditor. Foreign LLP cannot be appointed as an auditor. Then we learned officer of the company, employee of the company, their partners and employees, then directors and KMP of the company, relatives of director and KMP, they cannot be appointed as auditor. We learnt relative of director and KMP only can't be appointed as auditors. Relatives of other employees can be appointed as auditors. Then we learnt if I myself or my partners or my relatives, if any of us have any securities of cash or subsidiary of holding company, then I cannot be appointed as auditor in the company. But my relatives can hold securities, how much, guys? My relatives can hold securities of up to 1 lakh face value. If my relatives hold securities of more than 1 lakh face value, only then I will be disqualified. But point to be noted that 1 lakh face value is only for my relatives, not for me myself, not for my partners. If I or my partners or my relatives, if any of us hold securities in cash or in subsidiary of holding company, I will be disqualified. I can't be appointed as auditor in the company. But my relatives alone can hold securities up to 1 lakh rupees face value. All my relatives put together can hold securities of up to 1 lakh rupees face value. But what if earlier they were holding securities less than 1 lakh rupees face value? So I was appointed as auditor. But what if later they bought more securities and now they are holding more than 1 lakh rupees face value? In that case, I should take corrective action within 60 days. Within 60 days, I should ensure that the relatives holding comes within 1 lakh rupees face value. If I am able to do that, then I can continue as an auditor. If I am unable to do that, then I'll be attracting a disqualification and I'll have to vacate the office. Then in the fourth disqualification, we learned neither me myself nor my partners nor my relatives, none of us should have borrowed a loan of more than 5 lakh rupees from cash or from subsidiary of holding company. None of us should have borrowed a loan from cash or from subsidiary of holding company more than 5 lakh rupees. Okay. Then in the fifth disqualification, we learned neither I myself nor my partners nor my relatives, none of us should have given a guarantee or a security to cash or subsidiary of holding company of more than 1 lakh rupees. So be careful. For loan, the amount is 5 lakh rupees. For guarantee, the amount is 1 lakh rupees. Then in the sixth disqualification, we learned if I have any business relationship with cash or with subsidiary of holding company or with subsidiary of associate company, then I cannot be appointed as auditor in the company. But if my business relationship is in the form of professional services which I am allowed to render, then I am not disqualified. I can be appointed. If the business relationship is in the form of transactions which are happening in the ordinary course of business and at arm's length price, even then I can be appointed as auditor. I am not disqualified. I can be appointed as auditor. Please notice it should be in the ordinary course of business and at arm's length price. Both the conditions should be fulfilled. The transaction should be in ordinary course of business and at arm's length price. Okay. Then I can be appointed as an auditor. Then we learnt if any person is already in full-time employment somewhere, he can't be appointed as an auditor of any company. Then if a person has been convicted by any court for any fraud, then in that case for 10 years from the date of conviction, he cannot be appointed as an auditor in any company. But once 10 years are over, then he can be appointed as an auditor. Then we learnt I can be an auditor in maximum only 20 companies. But this limit will not apply to 1% company, small company, dormant company and private companies with less than 100 crore paid up share capital. So we will see the total number of companies where I am auditing, total number of companies where I am the auditor. From that, remove 1% company, small company, dormant company and private companies with less than 100 crore paid up share capital. Look at the balance number of companies. The balance number of companies should not be more than 20. Once it reaches 20, I can't become an auditor in more companies. I will become disqualified to be an auditor in more companies. companies. But please remember guys, in these 4 companies, there is no limit. I can be an auditor of any number of these 4 companies. Then we learned if I am rendering services under section 144, prohibited services under section 144 if I am rendering to company or to subsidiary company or to holding company or to subsidiary of holding company, if I am rendering section 144 prohibited services, then again I am disqualified. I cannot be appointed as an auditor of the company. What are these prohibited services guys? Prohibited services like accounting and bookkeeping services, internal audit services, financial information services, actuarial services, investment advisory, investment banking, financial services, management services. If I am rendering any of these services to the company, then I can't be appointed as the auditor of the same company. So this was a discussion of section 141. Okay. Then after this we had also learnt about section 141 subsection 4, which talks about vacation of auditor. Here we had learnt that when I was appointed as auditor, at that time I did not attract any disqualification, so I was properly appointed. But during the tenure of my office, I attracted a disqualification guys. Now I can't continue as auditor. I'll have to vacate, I'll have to leave my office. So there will be casual vacancy. Even earlier when I taught you about section 139 subsection 8 casual vacancy, I told you that casual vacancy can be because of 4 reasons. Remember DDRR, death, disqualification, resignation, removal guys. So that disqualification is this disqualification only. During the tenure of office, if the auditor attracts any disqualification, then he'll have to vacate from office. He can't continue as auditor. So this will result in vacation of the office of the auditor. So this was section 141 subsection 4 guys. So with this, the 141 series was over, and then we started learning about section 142. In section 142, we had learnt about remuneration of auditor. I'll straight away take you to the material. We'll revise about remuneration from the material itself. So under section 142 we had learned that remuneration of auditors is fixed by whom? It depends upon is he a first auditor or any other auditor. Here for first auditor we learned that the remuneration will be fixed by the board of directors. For other auditors the remuneration will be fixed by the company. Either the company will fix the amount itself or the company will fix the manner in which the remuneration will be fixed. Okay. Then we learned about the powers of the auditor. We learned that the auditor has totally 3 powers guys. Number 1, the auditor can access the books of accounts and vouchers at any time. Doesn't matter where they are kept, whether they are kept in the RO, whether they are kept at any other place, the auditor has a power to access the books of accounts. This we had connected with our accounts of companies chapter. We had learned in accounts of companies, we learned that only the directors can access the books of accounts. But along with the directors, even the auditors are given the power. Under section 143 subsection 1, even auditors are given the power, even they can access the books of accounts of the company. Not only can they access the books of accounts, but if they want more information and explanation, they can ask for information and explanation also. Not only can they access the books of accounts and vouchers of the company, they can also access the records of subsidiaries and associates, but only to that extent that is required for the purpose of auditing the CFS. Then we had learnt about the duties of the auditor. Number 1, the auditor has to do inquiries. He has to do 6 inquiries. In these 6 inquiries, if he gets a satisfactory response, no need to put in the audit report. But if he gets a negative response, only then it will be put in the audit report. What are the 6 points? Number 1, whether in case the company has secured loans and advances, whether those loans are properly secured or not. Then whether if the company has any shares or debentures or other securities of other companies, then has the company sold them during the year at a loss. But this point will not apply to banking companies and investment companies. Then whether loans are wrongly shown as deposits and vice versa. Then whether directors' personal expenses have been debited to the company's P&L account. Then if there are book entries in the company, are the book entries prejudicial to the company's interest or not? And lastly, if the company is saying that during the year it has allotted shares for cash, then the company should have received the cash. So has the company received the cash or not? If the company has not received the cash, the treatment which is shown in the books and the balance sheet, is it correct and regular and not misleading? So if the company is saying that we have allotted shares for cash, company should have received the cash. If company you have not received the cash, what accounting treatment are you showing in books and balance sheet? That should be correct and regular and it should not be misleading. So 6 inquiries he will do about loans and advances, about shares and debentures, sale of shares and debentures, whether loans are shown as deposits, whether directors' personal expenses are debited to company's P&L account, whether book entries are prejudicial to the company, and whether company has received the money against the shares. If not, whether the accounting treatment is correct or not. If any of these 6 inquiries, if he's not getting a satisfactory response, if he's getting a negative response, only then he will put about it in the audit report. Otherwise, he will not put about it in the audit report. Then we said that the auditor will have to express his opinion, whether according to him and whether to the best of his knowledge and information, whether the accounts and the financial statements examined by him give a true and fair view of 3 things guys: state of affairs of the company as at the end of the year, profit or loss for the year, cash flow also for the year. Then we had learnt about auditor's report. The auditor will prepare an auditor's report and he will give this report to the members. When he is preparing this report, he will keep in mind the provisions of the Companies Act, accounting standards, standards of auditing and other matters required to be included in the audit report like CARO and all. Please notice it is the members who appoint the auditor. So auditor will give the report also to whom? Report to the members. Later when I show you cost auditor is appointed by the board of directors. So he will give the report to whom? To the board of directors. The statutory auditor will give the report to the members. The members only appointed the statutory auditor. The statutory auditor is rendering service to the members. So he will give a report to the members. Okay. Now in the audit report, what will he write, guys? We saw the contents as per act also, content as per rules also. I'll quickly revise the contents for you. Number one, whether whatever information and explanation he had asked, whether he has received it or not, whether company is maintaining proper books of accounts or not, whether the branches are sending proper periodical summarized returns or not. In case a branch office is being audited by some other branch auditor, then has the branch auditor sent the branch audit report? If yes, how has he dealt with the audit report? Then whether the balance sheet and P&L are matching with the books of accounts of the company or not, whether the financial statements are as per the accounting standards or not, then whether he has any observations or comments on the financial statements of the company or on any matter which will adversely affect the functioning of the company, whether any director is disqualified or not, then whether he has any qualifications, reservations or adverse remark, and whether the internal financial controls are adequate and effective or not. In addition to this, we saw some more contents as per the rules, guys. Number one, whether the pending litigations disclosed by the company in the financial statements, whether the impact of the pending litigations disclosed by companies in the financial statement is correct or not. Then whether the company has made an adequate provision for material foreseeable losses. Then number three, has the company transferred amount to IPF on time or is there any delay? Then we had spoken about this funding company, intermediary company, ultimate beneficiary. You remember this we had learnt, where the funding company is giving loan to intermediary company and intermediary company will pass on the loan to the ultimate beneficiary. So if I am an auditor of funding company, I have to put in my report whether there is any such transaction. Similarly, if I am an auditor of intermediary company also, I have to put in the audit report whether there is any such transaction. Then whether dividend rules are properly followed or not, and whether the accounting software that the company is using, whether it is maintaining properly audit trail and edit log or not. Then we learned that in case the auditor is giving any qualification or if he is giving any negative opinion in the report, he should also give reasons. Like if he is saying that the financial statements are not as per accounting standards, he can't just say that and stop. He also has to elaborate that which accounting standard is not followed, what is the problem, what is the impact. He also has to give reasons that if he is giving a negative opinion, why is there a negative opinion, he has to give reasons also for that. Then we learned if you are auditing government companies, then there are 5 extra points. Remember, audit of government companies, 5 extra points we learned. Extra point number 1, the auditor will have to give his report to the CNAG also. Then extra point number 2, the CNAG sometimes gives direction to the auditor of the government company. Now what are those directions? Even that has to be written in the audit report. What action did the auditor take because of these directions, and what is the impact on the accounts and financial statements? Even this has to be written in the audit report. Then third extra point, if CNAG thinks it is required, within 60 days of receiving the audit report, he will order a supplementary audit. In the supplementary audit, either it will be done by the same auditor or it will be done by any other person whom the CNAG will authorize. Then the fourth extra point we learned, the CNAG, he will also give his comments on the audit report. So now the company will have two things: audit report given by the auditor and comments given by CNAG. Both of these the company will send to each member. And lastly, CNAG, if he thinks it is required, he will also order a test audit. Test audit is nothing but audit under section 19A of CNAG, duties, powers and conditions of service act 1971. So if you are an auditor of a government company, there will be 5 extra points. You will have to submit your report to the CNAG also. So you will anyways be addressing your report to the members. You will also be submitting a copy of your report to CNAG. Then extra point number 2, if you are auditing a government company, the CNAG will give you some extra directions to follow during your audit. Like he will ask you to prepare some extra reports and all. So in the audit report, whatever contents we learned, that you will anyways write. In the audit report, you will also write what directions CNAG has given to you, what action have you taken on those directions, and what is the impact of all of this on the accounts and financial statements of the company. Then if the CNAG thinks it is required, within 60 days from the receipt of audit report, he can order a supplementary audit, which means an extra audit, an additional audit to be done either by the same statutory auditor or to be done by any other person. CNAG will decide. Then in case the CNAG thinks it is required, he can also order test audit. Test audit is nothing but audit under section 19A of CNAG, duties, Powers, Conditions of Services Act 1971. And one more point we had over here, the CNAG, even he will give his comments on the audit report. So now company will have two things, audit report given by the auditor and comments given by the CNAG. Both together the company will send to each and every member. Okay. Then we learned about branch offices. We learned that there are branch offices. If the company is having a branch, we'll have to see the branches in India or the branches outside India. If the branch is in India, it can be audited either by the statutory auditor of the company or it can be audited by any other person, but even this person should be somebody who is eligible to be appointed as auditor of the company. If the branch is outside India, it can be audited either by the statutory auditor itself or by any other person who is eligible to be appointed as auditor as per the laws of that foreign country. Now this branch auditor, he will also prepare a branch audit report and he will give it to the statutory auditor of the company. Okay, and even section 143 subsection 12, which we will be learning a little later, which talks about fraud. What if the auditor finds a fraud in the course of his audit? That will also apply to branch auditor. Then we learned that accounting standards, auditing standards, both have to be followed by the auditor, and if CARO is applicable, even that has to be included in the audit report. Okay. Then comes 143 subsection 12, very important guys. Section 143 subsection 12 puts another extra duty on the auditor. On which auditor? On the statutory auditor, on the cost auditor, on the secretarial auditor, and on the branch auditor. On these four auditors, an extra duty is put by section 43 subsection 12. This subsection says that, listen auditor, when you're doing the audit, in that course, if you are identifying a fraud, then you have to report about it. We are not talking about those frauds which management themselves is telling you about. We're talking about those frauds which you yourself are identifying. If you yourself identify a fraud in the course of audit, then in that case, you have to report about the fraud. Now we'll have to see, is the value of the fraud less than 1 crore or is the value of the fraud at least 1 crore? Depending upon that, the provision will change. But whether it is less than 1 crore, whether it is at least 1 crore, there is a common provision, guys. What is a common provision? As soon as the auditor comes to know about the fraud, within 2 days itself, he will prepare a fraud report. In that fraud report, he will put 3 things, guys. Number 1, nature of the fraud. Number 2, what is the amount involved in the fraud. And number 3, who are the parties involved. These 3 things put together, he will prepare a fraud report within 2 days. Now, if the fraud is less than 1 crore, he will simply give this fraud report to the competent authority. Okay, and the board of directors will take remedial action, and the board will also mention in the board report that what remedial action have they taken. But if the value of the fraud is at least 1 crore, if the value of the fraud is at least 1 crore, then in that case, even over here, the auditor will prepare the fraud report. He will send the fraud report to the competent authority within 2 days. As soon as he comes to know about the fraud, within 2 days, he will prepare this report, send it to the competent authority. But he will not stop with that. He will tell the competent authority to send their reply within 45 days. So now the auditor will have 2 things. He will have the fraud report which he has prepared. He will have the reply which the competent authority has given. Now on that reply, he has to give his comments. So now there will be 3 things: the fraud report which he has prepared, the reply of the competent authority, and his comments on their reply. All these 3 things within 15 days of receiving the reply, all these 3 things he has to put in one sealed envelope and send by registered post acknowledgement due or by speed post to whom, guys? To the Secretary of Ministry of Corporate Affairs, and he also has to send an email confirmation. All of these points we learnt over here, guys. He'll prepare a fraud report. He will send it to the competent authority. Within 2 days, he will send it. He will ask for reply within 45 days. Once he gets a reply, he will put his comments also on the reply. Now, there will be 3 things: his report, the reply of the competent authority, and his comments. All the 3 things he will send to the Secretary of MCA in form ADT4 in a sealed envelope within 15 days of receiving the reply. He will also send, and what mode will he send it? Registered post acknowledgement due or by speed post. Not sending electronically and all. Send by post. Hard copy has to go. Registered post with acknowledgement due or by speed post. And he will also send email confirmation. He can't send only by email. Hard copy has to go. By post it has to go. But he also has to send an email confirmation. Okay. And this has to be printed on his letterhead, clearly indicating his name, his address, his email ID, his contact number. His signature also should be there on the report. His membership number also has to be there on the report. But however, if the auditor knows about the fraud, but still, if he is not reporting this fraud like this, if it's a listed company in which he is an auditor, then 5 lakh rupees penalty will be imposed on him. If it's an unlisted company where he is the auditor, then 1 lakh rupees penalty will be imposed on him. Okay, so this was about section 143 subsection 12. Very important, guys. 144, I already spoke to you about this. Section 145 says, in case the auditor has given any qualifications, observations or comments, this alone will be read at the general meeting. The whole audit report will not be read at the AGM. Only this only will be read at the AGM. Then we learned that auditor has to attend every meeting of the members, not board meetings guys, meetings of the members, AGM, EGM, every meeting of the members he is supposed to attend. If he is unable to attend, then he can send another person on his behalf, he can send an authorized representative on his behalf, but even that person should be a person who is qualified to be the auditor. Now he can go to the meeting. Can he go and speak at the meeting? He can speak at the meeting, but only on those matters which concern him as an auditor. He can speak at the meeting, but only on those matters which concern him as an auditor. Finally, we learned about section 148, cost records and cost audit. We said that even in accounts of companies chapter, we had learned the meaning of books of accounts. Books of accounts includes items of cost. Items of cost only are called as cost records. But every company does not have to maintain cost records. So here, if you remember, we had drawn this diagram. We said out of all the companies, only some companies will maintain cost records. Out of that, only some companies will get those cost records audited. So which companies have to maintain cost records, guys? Number one, you may be a domestic company, foreign company, I don't care. But you must be a micro or a but you must not be a micro or a small enterprise. Second condition is that you must be producing goods or rendering services mentioned in table A or mentioned in table B. And number three, your total turnover, A plus B plus others, everything put together, your total turnover should be at least 35 crores. You must not be a micro or a small enterprise. You must be producing goods or providing services mentioned in table A, table B, and your total turnover, everything put together, should be at least 35 crores. If all these conditions are fulfilled, then you will have to maintain cost records. Now, once those cost records are maintained, once they are prepared, they will be approved by the board, signed by any one director authorized by the board, and will be sent to the cost auditor for audit. The cost auditor will be either a practicing CMA or a firm of CMAs, cost and management accountant, CMA. Cost auditor has to be a CMA. But the same person who is a statutory auditor cannot also be the cost auditor. The statutory auditor and the cost auditor can't be the same. The statutory auditor and the secretarial auditor can't be the same. The statutory auditor and the internal auditor can't be the same. But the statutory auditor under Companies Act and the tax auditor under Income Tax Act 44AB can be the same. The statutory auditor under Companies Act and GST auditor under GST Act both can be the same. Okay. Then after this, we had learned that from the starting of the year, within 180 days itself, the board of directors will appoint the cost auditor. We have to get written consent from him and that he is willing to be appointed as cost auditor, and same certificate which we have to get from statutory auditor, same thing we have to get from him also. Now his term will not be 5 years and all. His term will be till he submits a cost audit report for that particular year. And when should he submit the cost audit report, guys? Within 180 days from the end of the year, he should submit the cost audit report to whom? To the board of directors. It is the board who appoints him. He submits the report also to the board of directors only. As soon as the board receives a report, within 30 days, the board will send a copy of the report to the central government. If the central government needs any information or if the central government has any questions, central government will ask the board of directors and board of directors will send their response within the given time. Alright, so this was our entire discussion, our entire revision of the auditors chapter, guys. I think we've done it in record 1 hour. Alright, I'm hoping you're nice and confident. With this, we'll close this chapter and confidently we'll now walk into our next chapter. Thank you guys. Bye-bye. Hello everyone, in this session we are going to take up a quick revision on this chapter, General Clauses Act 1897. We had learned that any central act, if you're reading, you can take the help of General Clauses Act for interpretation. The General Clauses Act contains the definitions of all commonly used words. It also contains a lot of interpretational principles. So any central law, if you're reading and if there's any ambiguity in reading the central law, you can take the help of General Clauses Act to interpret. You can use the General Clauses Act not only to interpret central laws but also rules and regulations made under these central laws. This itself indicates to us the General Clauses Act is not applicable to state laws. Then how will we interpret state laws? For each state there is a separate state General Clauses Act. We will apply that. We will apply the State General Clauses Act to interpret the state laws. The General Clauses Act 1897, this is only for central acts and rules and regulations made under the central acts. This General Clauses Act came into force on the 11th of March 1897 and it does not have any territorial applicability. This point means I cannot say that it is applicable to this part of India or it is applicable to this part of India. Like that I cannot say. Instead, I will say that it is applicable to central laws and not applicable to state laws. But then what exactly do you mean by central laws? Again and again we're talking about central laws, but what do you mean by central laws? Central laws means those laws which before independence were made by the Governor General. After Constitution, they were made by the Indian Parliament. But in this period, after independence, but before Constitution, we did not have the Parliament because Parliament, President, Prime Minister, all all these are byproducts of the constitution. So only after constitution we have the parliament, but before constitution and after independence we had the constituent assembly, which came under the dominion legislature. So after independence but before constitution, all the laws which are made by the dominion legislature, they will be considered as the central laws. Dominion legislature nothing but the constituent assembly. Okay, so if the laws are made before independence, central laws are those laws which are made by the governor general. If the laws are made after constitution came into force, then central laws are those laws which are made by the Indian parliament. If the laws were made after independence but before constitution, central laws are those laws which were made by the constituent assembly, that is the dominion legislature. Then we learnt, I am reading the Constitution of India, I am getting a doubt, can I use the General Clauses Act to interpret the Constitution of India? Yes. Then we learned, I am reading the General Clauses Act. In that itself I got a doubt. Can I use the General Clauses Act to interpret the General Clauses Act? We said yes, we can do that. Then we learned that will General Clauses Act apply to all central laws? It depends. The General Clauses Act came into force on 11th of March 1897. After this date, if any central law is made on that central law, in that central law, if there is any doubt, if there is any ambiguity, yes, you can fully apply the GC Act. Nicely you can apply. The whole act you can apply. So laws which are made after 11th March 1897, to those laws the GC Act is fully applicable. Then we learnt before 11th March 1897, before GC Act 1897 came into the picture, we had one more GC Act. We had an old GC Act, GC Act 1868. Now that law had come into force on 3rd Jan 1868. So from 3rd Jan 1868 till 11th March 1897, in this period we had the old GC Act. So if any law was made in this period, to those laws GC Act is partially applicable, which means some sections will apply and some sections will not apply. Like for example, in this period the Indian Contract Act was made. In this period the Negotiable Instruments Act was made. Now to all those laws GC Act will still apply, but not fully, only partially it will apply, which means some sections will apply and some sections will not apply. Now how will I know which sections will apply, which sections will not apply? All that is written in section number 4. Then we learned 3rd Jan 1868. Before this, if any law was made, to those old laws, the GC Act will not at all apply. So laws made after 11th March 1897, GC Act will fully apply. Laws made before 3rd Jan 1868, GC Act will not at all apply. And laws made in this period, to these laws the GC Act will partially apply. Then after this we had learned the General Clauses Act, it is an interpretation act. It helps us in interpreting all central laws. So any central law if you are reading, along with that bare act, you will also keep the bare act of the GC Act. So that is why the GC Act is also called as the law of all laws. It is also called as the father of all laws because it has to be read along with all the other central laws. This was held in the case of Chief Inspector of Mines versus K.C. Thapar. It was held in this case that General Clauses Act it is an interpretation act. It contains the definitions of all the commonly used words. General clauses, common words. It contains a definition of all commonly used words. It contains all interpretation principles. It has to be read along with all central laws. So therefore it is an interpretation act. It is a law of all laws. Then we learned, okay fine, why? Why do we even have the General Clauses Act? We learned that there are totally 3 reasons why we have the General Clauses Act. Number 1, to shorten the other acts. Now all these commonly used words are defined in the GC Act, guys. If the GC Act was not there, all these words would have had to be defined in each act. Each act is already long. The act would become longer by adding to it the definitions of all these words. So the law would have become longer. So because of GC Act, those common words don't have to be defined in other acts. The other acts are shorter to that extent. Second reason, uniformity. If GC Act was not there, then this word document would have been defined in each law. 100 laws are there. Each law would have given different definition. So 100 different definitions of document we would have had, and that would have become so complicated. So by putting all the commonly used words in one law, we are able to have one common definition. We are able to have a uniform definition. We are able to have a uniformity of expression. Then we learnt that the GC Act not only contains definitions of common words, it also contains a lot of interpretational principles like he will include she will include he, singular and plural. All these interpretation principles are also there in GC Act. It not only contains all the definitions of the commonly used words, it also contains the interpretational principles. So why do we have the GC Act? For 3 reasons. Number 1, to shorten in the other acts, number 2, to bring uniformity of expression, and number 3, to put in one place all the interpretation principles. Okay, so this was our introductory part of GC Act, and then we started learning about preamble. Preamble, we learned that it is a part of the act. Every act has a preamble. Every act has a preamble. The preamble tells us the scope, object, and purpose of the act. We spent a lot of time discussing this point, if you remember. When I read the preamble of Companies Act, it says it is an act to consolidate and amend the law relating to companies. So when I read the preamble, I know what is the scope of the act. This act will apply to what? Only to Companies Act. When I read the preamble of Negotiable Instruments Act, it says an act to define and amend the law relating to promissory note, bills of exchange, and check. So when I read the preamble, I get to know what is the scope of the law. The scope of the law is only the law will apply only to promissory note, bills, and check. So through the preamble, I will get to know about the scope of the law. I will get to know the applicability of the act. Then it also tells me the object and the purpose of the act, that why exactly was the act even introduced. Like for example, if you look at the preamble of the Consumer Protection Act, if you look at the preamble of Consumer Protection Act, it says that this act is to protect the interest of consumers. So when I read the preamble, I get to know that what is the object, what is the purpose, why exactly was the act even introduced. Then we learn that the preamble is a main source to understand the primary intention of the lawmaker, that why exactly did he even make the act. Then whenever you are reading the act, if there is any ambiguity or if the language is not clear, you can come to the preamble. We are not saying preamble is one-stop solution for all the problems in your life. We are not saying like that. We are saying that if you have any doubt, come to preamble. You may get an answer, you may get a solution. Okay, then we learned it is an aid to construction, that is, it helps in interpretation. Whenever a word has more than one meaning and a doubt arises as to which meaning is intended by the act, you can have a look at the preamble. One very good example we saw over here, guys, the Land Acquisition Act. In the Land Acquisition Act, in so many places, this word property is used. Now this word property has more than one meaning, guys. It can be movable also, it can be immovable also, guys. So a doubt is arising that which meaning is intended. I will come to the preamble. The preamble says this in this act. The preamble says that this act gives us provisions for acquisition of land. So looking at the preamble, I know now, okay, here when they say property, they're talking about land only. They're talking about immovable property only. So when I was reading the law, there was a word property. This word property has more than one meaning. I got a doubt which meaning is intended, movable or immovable. I came to the preamble. Preamble said acquisition of land. Preamble used the word land. So now I know that it's only for land, it's only for immovable property. So when the word has more than one meaning and a doubt arises as to which meaning is intended by the act, I can come to the preamble. I may get my answer over there. But we learned that the preamble will not override the plain provisions of the act. If the preamble and the act, if they contradict with each other, between these two, which of the two will we always give priority, guys? We will always give priority to the act. The act will always override the preamble. Preamble will not override the act. Okay, this was a preamble discussion. Then we spoke about definitions. We discussed that in every law there is a definition section, generally in section 2, but sometimes like in Transfer of Property Act, section 3 also can be possible, but generally it is section 2. Now, why does each law have a definition section? There are two reasons, guys. Reason number one, because of the definition section, there is proper interpretation, there is better interpretation. And reason number two, to shorten the language of the enacting part. To shorten the language of the enacting part. What does this mean? If you recall, I gave you the example of Income Tax Act. Now, in Income Tax Act, section 2 gives us all the definitions. Why does section 2 give us the definitions? Why do we need the definition section in Income Tax Act? Because number one, because of the definition section, there is better interpretation, there is proper interpretation. And reason number two, in the definition section, for example, this word dividend is defined. Now, in the entire Income Tax Act, wherever we use the same word dividend, again and again we don't have to give the definition. So this way we are able to shorten the language of the Income Tax Act. So why do we have the definition section inside each law? Because of two reasons. Number one, to help in proper interpretation, and number two, to shorten the language of the enacting part. To shorten the language of the enacting part. Generally it is section 2, but sometimes it can be section 3 also, like in Transfer of Property Act. Then we learned the definition section of the Income Tax Act will only be used to interpret the Income Tax Act. So the definition section in each act will be used only to interpret that particular act. Then we learned that sometimes instead of giving the definition, the law refers you to some other law. Like in Companies Act, the word security, instead of telling us what is security, the section says if you want to know what is security, go to section 2 clause H of SCRA 1956. Yes, even this is allowed. Instead of defining defining the word. The law may direct us to another law, the law may direct us to another section, even that is allowed. And then we learned whenever we get a doubt while reading an act, we will first try to find the meaning from that particular act itself. We will try to find the meaning from the definition section of that particular act itself. If that act itself is not giving us a definition, then only we come to the General Clauses Act. Then we learned about the 4 different types of definitions. Number 1, we have the exhaustive definitions, which are also called as restrictive definitions, that is definitions which have the word means in them. These definitions exactly define the word. In these definitions, the meaning of the word is restricted to whatever meaning is given in the definition. Now, when I say the director means a director appointed to the board of the company, only that person who is appointed to the board of the company, only that person only is a director, nobody else is a director. So the definition is exactly defining the term. The meaning of the word is restricted to the definition. These are called as exhaustive definitions. Then we have extensive definitions, which are also called as inclusive definitions. Here whatever is given in the definition, it's only examples of the word. Like when I say dividend includes interim dividend, I will read it as dividend also includes interim dividend. So whatever is normally understood as dividend, that is anyways dividend. Dividend also includes interim dividend. It is not that dividend is only interim dividend. No, dividend also includes interim dividend, which means the meaning is not restricted to the definition which is given. The meaning is not restricted to the definition. Whatever is given in the definition, that is also included in the term, but the meaning is not restricted to the definition given. These are extensive definitions. Then we learned about ambiguous definitions. Here we learned that it was very ironical. It was ironical that I was reading the act. I came across a word. I did not understand the meaning of the word. So I came to the definition section of that particular act. In the definition section, the meaning is given. But that meaning itself is so confusing that my doubt only increased. These are called as ambiguous definitions. Ambiguous definitions are those definitions which don't give us proper clarity. When I was reading the act, I had a doubt. So I came to the definition section hoping I will get clarity. Yes, definition is given, but the definition is a confusing definition. The definition is an ambiguous definition. When this happens, the court cannot blame the parliament that what kind of a law are you making. Court cannot do that. Instead, the court will have to somehow bring accuracy and certainty to the meaning. How to do that? By doing 2 things. Number 1, the court will also read the other provisions of the act. The court will not read the definition in isolation. The court will read the definition in the context of the other provisions of the act. That way we may be able to arrive at the meaning. And the second alternative, the second option is the court will also keep in mind the ordinary meaning of the word, the general meaning of the word. Here I had given you the example of Industrial Disputes Act. Now when I am reading the Industrial Disputes Act, I came across this word industry. I got a doubt that whether this word industry will include hospital and educational institution or not. I got a doubt. So I went to the definition section. Yes, the definition section does give the definition of industry, but the definition did not answer my question. So in such cases, I can't blame the parliament that what kind of laws are you making. I have to somehow bring accuracy and certainty. How will I do that? I will read the definition along with all the provisions of the act. I will not read the definition alone separately. I will read the definition along with all the other provisions of the act. I had told you, just one single piece of a puzzle will not make any meaning, but that piece along with all the other pieces will give me a better picture, will give me a clearer picture. Same way, just one definition section alone if I read, it will not give me any meaning. I should read it along with all the other provisions of the act, it will give me a better meaning. So when I read the definition along with the other provisions of the act, it makes me realize, it makes me interpret that any entity which has a profit-making motive will be an industry. So if the hospital and the educational institution, if they have a profit-making objective, even they will be considered as industry. This is how I interpreted the definition. You understood, guys? So whenever there is an ambiguity in the definition itself, we have to bring accuracy and certainty. And how will we do that? By not reading the definition in isolation, by reading it along with the other provisions, by reading it with the context in which the word is used, and also keep in mind what is the general meaning, what is the ordinary meaning of the word. With this, we will be able to resolve the ambiguity. Then we learned if a definition is subject to contrary context, which means the same definition has multiple meanings. The definition of relative has so many meanings now. now. I am getting a doubt. Which meaning to pick? We have to pick the meaning depending upon context, language and object. CLO, context, language and object. Then we learned that if the provision uses a word shall, it becomes a mandatory or an imperative provision. But if the provision uses the word may, it is directory or enabling provision only. But this is a general rule. There may be exceptional cases where even though the lawmaker has used the word may, we will interpret it as if it is mandatory. There may be exceptional cases where even though the lawmaker is using the word shall, we will interpret it as if it is directory. So it depends upon the interpretation of the statute and the way the words are used in the law. Then we learned about bill and act. Bill is nothing but a draft of the legislative proposal, which means it is not the final law, it's only a draft. But even though it is a draft, it is still in proper format. And what is act, guys? Once a bill is passed in both houses of the parliament and also gets a president's assent, then the bill becomes an act. And once it becomes an act, it becomes a law of the land, which you and I, everybody has to follow. Okay, then we learned about preliminary. We learned that every law has a preliminary. I had given you the example of preliminary of the Companies Act. So preliminary is nothing but that first section of each law which tells us about four things. Number one, the commencement of the act, that when will the law commence. Number two, the applicability of the law will apply to what. Then S for short title, what is the name of the act. And E for extent, scope, nothing but to which part of the country does the law apply. So preliminary is the introductory part of the law. It's generally section 1 which tells us four things: CASE, case, C for commencement, A for application, S for short title and E for extent. Okay, then we started learning about the definitions. So this is where we started learning the definitions. The first definition we learnt was act. When we say offensive act or wrongful act, what does act mean? So act used with reference to an offence or a civil wrong includes a series of acts, which means not just one action. It will include multiple actions as well. It includes doing something and also not doing something. It includes doing something wrong. It also includes not doing something that you are supposed to do. Like for example, the doctor gave wrong treatment, so the doctor did something wrong. Or let's say a patient came in emergency. When a patient comes in emergency, the doctor is supposed to immediately act, but the doctor did not even act. He's still sitting over there sipping his coffee. So he did not do something he's supposed to do. So act includes both giving the wrong treatment, doing something wrong, even that is act. Not doing something, simply sitting over there and watching the patient suffer, even that is going to be an act. So act includes both doing something also and omission. Omission means not doing something that you're supposed to do, but it should be illegal omission, only then it will be covered over here. So what is act? Act used with reference to an offence or a civil wrong includes a series of acts, words which refer to acts done and illegal omissions. Then we learned about affidavit, oath and swearing. We learned that whenever we have to make a declaration or a statement in the court, like for example, whenever a witness has to make a statement in the court, he has two options. Either he can do swearing. Swearing means he will keep his hand on the Gita or on the Bible and he will promise on God that whatever he is saying is truth but nothing but the truth. But we said that some people don't believe in God and some religious groups don't allow this swearing on God. So in all those cases, wherever you don't want to swear, in all those cases, instead of swearing, there's another option, and that is you can make a written declaration, you can make a written statement in front of the magistrate. This is called as affidavit. So affidavit includes affirmation and declaration in the case of persons by law allowed to affirm or declare instead of swearing. So affidavit is nothing but an affirmation and declaration, which means something in writing. And who is making this affirmation declaration, guys? Those persons whom the law is allowing that okay fine, you can give affidavit instead of swearing. So what is an affidavit? An affidavit includes affirmation and declaration in case of persons by law allowed to affirm or declare instead of swearing. Then we learned about Central Act. We already spoke about Central Act in the beginning of our chapter itself. Central government means before the Constitution, Governor General, and after the Constitution, President. Then we had learned about enactment. Now this is important. Enactment includes three things, guys. RAP. R for regulations. Regulations of Bengal Code, Madras Code and Bombay Code. A for act. Both act made by the Parliament and act made by the state legislature. So act will include both Central Act and State Act and provisions contained therein. So enactment includes R for regulations, enactment includes A for act, and enactment includes P for provisions. Okay, so RAP, regulations, act and provisions. Act can be both act of the Parliament also, act of the state legislature also. Then we learned about commencement. Commencement is nothing but the date on which the law comes into force. Commencement is nothing but the date on which the law comes into force. About this we will be learning a little more in detail in the upcoming concepts. Just wait and see. Then we learnt about calendar year, financial year and month. We said that the law just uses the word year. Year by default refers to calendar year, and calendar year means as per the British calendar, that is Jan to December. And financial year means April to March, 12 months. Month means month as per the British calendar. Then we learnt about government and government securities. When the law just uses the word government, like Income Tax Act says that gratuity is exempt for government employees. So when I say government employees, it will include both central government employees also, state government employees also. So government includes both central government and state government. So similarly, section 2 clause H of Securities Contract Regulation Act defines securities. You must have learned that in prospectus chapter also. In the definition, the word government securities is used. So government securities will mean what? Government securities will mean both central government securities also, state government securities also. So when we use the word government, we're talking about both central government and state government. Okay. Then we had one more discussion over here, guys. Government. When I talk about government in the wider sense, we will say that government has three wings: legislative, that is the parliament; executive, that is the president; and judiciary, that is a court. But when I talk about government in narrow sense, I will talk only about the president, executive. Okay. Then we learnt about good faith. This was extremely important. Good faith means you should do it honestly. You should do the action honestly. In the General Clauses Act, whether you did it negligently or not doesn't matter. If you did it honestly, that is enough. That is the definition of good faith as per the GC Act. But however, just some time back in the revision also we spoke about this, that there is that period, remember, in that period the GC Act is partially applicable. From the 3rd of Jan 1868 to 11th of March 1897, in this period the old GC Act was existing. So whatever laws were made in this period, to those laws the GC Act 1897 is only partially applicable, which means some sections will apply and some sections will not apply. Which sections will apply, which sections will not apply, all that is written in section number 4, guys. And section number 4 clearly mentions that good faith will not apply to laws which are made in that period. So like for example, Indian Contract Act is made in that period. Which period you are understanding, right? From 3rd of Jan 1868 to 11th of March 1897. In this period the old GC Act was existing, guys. Any law is made in this period, to those laws GC Act 1897 will only partially apply. Now Indian Contract Act 1872 is made in this period, to that, so to interpret the Indian Contract Act 1872, the GC Act will only partially apply. Now where is this partial applicability written? In section 4. So section 4 will give us a list of sections which will also apply to laws which are made in this period. Now that list does not include good faith, guys, which means in Indian Contract Act, if I want to interpret what is the meaning of good faith, this good faith definition which is given in the GC Act will not apply. So then how will I interpret? Then how will I interpret the meaning of good faith, guys? We said that in such cases, to interpret the word good faith, we will go to civil law. In this period, if any law is made, to those laws, the GC Act definition of good faith will not apply. So in this period, if any law is made, if you want to interpret the word good faith in these laws, go to the civil law. The civil law says you should not only do it honestly, but you must also do it carefully with due care. So if you did the act honestly, but if you did the act carelessly, then it will not be considered as good faith. Like for example, the doctor was very honest, guys, but he did a careless mistake. Under GC Act, it will be considered as good faith, but under Civil Act, it will not. Under the civil law, it will not be considered as good faith, because civil law says you must not only do it honestly, you must also do it carefully. Okay. Then we learned about official gazette. We learned that it's like the official publication of the government. Whenever the government wants to make an official communication, it is through the gazette. It is printed weekly by the Department of Publication, Ministry of Housing and Urban Affairs. So whenever a new law is made, or whenever a notification is issued, or whenever rules are made, all of these are published in the official gazette. And nowadays we learned we have the e-gazette, we have the online gazette, and we have a separate gazette for the central government, and we have a separate gazette for each state. Okay, so this was a discussion about official gazette. And also remember, we had learned that whatever is written in the official gazette is authentic, it is accurate, and it adheres with the government policies and decisions. And it's like the official bulletin board of the government. It's like the public journal which is issued by the government of India. Okay, then we learned about imprisonment. We said imprisonment can be of two types. It can be rigorous or simple. Now rigorous means it will include even hard labor, but simple imprisonment is just nothing but spending time in the jail. Now whenever there's an offense, should you be imprisoned with rigorous imprisonment, or should you be imprisoned with simple imprisonment? Who will decide that? The court will decide. The court at its discretion will decide that, depending upon how severe the crime was. Then we learned about document. We learned the document is nothing but matter. Matter which is written, expressed or described where upon any substance using letters, figures or marks to be used for recording that matter. We had a very extensive discussion on document, guys. It is matter. This matter is written, expressed or described. So if it is oral audio recording, it is not document. It has to be written, expressed or described, which means the words have to be in visible form. I must be able to see the words either written or printed or painted or drawn, but it should be in visible form. So document includes matter written, expressed or described where. Where is it written, expressed or described? Not necessary it has to be written on paper. It can be on any substance. It can be on a silver plate. It can be on a tree. It can be on a rock. It can be anywhere. It can be on any substance using letters, figures and marks to be used for recording that matter. Then we learned about Indian law. Indian law includes two things. Number one, act, ordinance, regulation, rule, order, bylaw, other instruments, and it also, but however, it does not include those acts which were made by the UK Parliament. Here we learned Indian law means act. Act, you know. Ordinance is nothing but temporary laws which are made by the president or by the governor when the parliament or the state legislature is not in session. And then we have rules, regulations, orders. What are bylaws? Bylaws are what? Bylaws are the rules and regulations made by the municipalities and all. So Indian law will include all of this, but it will not include UK Parliament. Now here I had given you the example of Indian Contract Act 1872. Yes, it was made when the Britishers were ruling our country. But it was not made by the UK Parliament. It was made by the Indian Legislative Council. The Britishers had appointed an Indian Legislative Council for India, and that Indian Legislative Council only had made the Indian Contract Act. So yes, it was made during the Britishers' rule, but it was not made by the UK Parliament. So the Indian Contract Act was will be considered as an Indian law. But however, the Government of India Act 1935, this was passed by the UK Parliament. So therefore, this will not be considered as an Indian law. The reason why I gave you this was to indicate to you, to let you guys know that just because a law was made during the time when the Britishers were ruling our country, you cannot say it is not an Indian law. It will still be an Indian law if it was made by the Indian Legislative Council at that time. If it was made by the UK Parliament, like Government of India Act, you have Indian Councils Act, they were made by the UK Parliament, they will not be considered as Indian law. Then we learnt about the meaning of person. Person includes CAB. C for company, A for association, B for body of individuals. But this is an extensive definition, which means it will include individual also. It will include HUF also. It will include LLP also. It will include an idol of God also. Then we learnt about immovable property. Immovable property includes four things. Number one, land. Number two, benefits arising out of land. Number three, things attached to the earth. And number four, things permanently fastened to anything attached to the earth. Again, land, benefits arising out of land, things attached to the earth, and things permanently fastened to anything attached to the earth. We had a big discussion on this point, guys. Benefits arising out of land. This is whatever benefit that land gives me, like groundwater. As long as the groundwater is in the land, it is immovable. But once I take the water out, it is not immovable anymore. Then the fish in the ocean. As long as the fish is in the ocean, it is immovable property. But once I catch the fish, it is not immovable anymore. Then animals on my land. All of these are benefits arising out of land. As long as the animals are on the land, it's a benefit arising out of land. But once I catch those animals and sell those animals to you, they will not be immovable property anymore. So benefits arising out of land are nothing but whatever benefits the land gives me. Then we learned that generally we come to the General Clauses Act only if that particular act is not giving us a definition. Generally, if the law, like for example, let's say you're reading Income Tax Act, you want the definition of a particular word. The Income Tax Act is not giving you the definition. Only then you come to GC Act, guys. But there is an exception, and the exception is if the law is giving you definition, if Income Tax Act is giving you definition, but if it is a negative definition, which means like for example, Transfer of Property Act does give the definition of immovable property, but it doesn't tell us what is immovable property. It tells us what is not immovable property. So which means there is a law, Transfer of Property Act, which is giving a definition, but it is a negative definition. In that case, that definition also will apply. The GC Act definition will also apply, right guys? And that is how we had understood whether the right to catch fish, is it immovable property or not under the Transfer of Property Act. Transfer of Property Act says immovable property will not include standing timber, growing crops or grass. So the Transfer of Property Act gives us a negative definition. So we will not only apply this definition, we will also apply the GC Act definition. So if I apply this definition, the right to catch fish is neither standing timber nor growing crops nor grass. If the right to catch fish came under any of these three, I would have my answer here itself that okay, it is not immovable property for the purpose of TOPA. But however, when I am reading this, right to catch fish is not covered under any of these three. So which means now I will apply the GC Act, and the GC Act says benefits arising out of land is immovable property. So right to catch fish is also a benefit arising out of land. Hence my conclusion will be, for the purpose of Transfer of Property Act, for the purpose of TOPA, right to catch fish will be considered as immovable property. Understood? Whenever the law is giving us a definition, but if it is a negative definition, then not only will that negative definition apply, also the GC Act definition will apply. Then we had learnt about the other definitions. Movable property means any property which is not immovable. Registered means registered as per the Indian Registration Act. Rules means rules that are made because of a power given by enactment. Like Companies Act gives power to central government that you can make rules. So using that power, central government is making rules. Income Tax Act 1961 gives power to CBDT that you can make rules. So using that power, CBDT is making rules. Offence means any act or omission which is punishable by law, and writing includes printing, lithography, photography, any other mode through which words are put in visible form. Okay, then we started learning about the interpretational principles. So with this we spoke about all the definitions of the commonly used words. Now after this, whatever we will be revising, these will be all the interpretational principles. For this I will straight away take you to the classroom notes that we had made. Okay, see, our very first interpretational principle was coming into operation of an enactment, that is when will the law come into force. See, here we learned that if the law was made before the constitution came into force, we need the Governor General's assent. But if the law was made after the constitution came into force, we need the president's assent. Now when will the law come into force? It depends. If in the law itself a date is mentioned, it will come into force on that date. If the law doesn't mention a date, but the law says that this law will come into force on whichever date it is notified by the government, now we will wait and see. Whenever the government notifies, on that date it will come into force. But if the law doesn't mention a date, the law also doesn't say that it will come into force on a date which is notified by the government. If the law doesn't say either, then by default the law will come into force on the date on which it is published in the official gazette. Then we had a detailed discussion on this point, guys. This point wherein the law is mentioning that it will come into force on a date on which the government notifies. Like the GST Act says that the GST Act will come into force on whichever date the government notifies. Now GST Act was made in March 2017 itself, but the government notified it only in July 2017. So we were waiting and we were seeing, okay, when is the government going to notify? When is the government going to notify? Because whenever the government notifies, that time only the law will come into force. So if the government is not notifying, in such cases, can the court issue a mandamus? Can the court issue an order and tell the government, bring it into force tomorrow itself? Can the court issue a mandamus asking the government to bring the law into force on a particular day? No. But can the court give a direction to the government to at least consider the question and to at least tell us that when will the law come into force? Yes. And this was important, guys. Can the court issue a mandamus to the government and tell the government to bring the law into force on a particular day? No. But can the court give a direction to the government to at least consider this question and to at least tell us that when will the law come into force? Yes. Be careful about the words used over here. Guys, I hope you understood this point. I'll repeat once again. See, in the law, when will the law commence? The law commencing means when will the law come into force? Either on a date which is mentioned in the law. No date is mentioned in the law. Instead, the law says that this law will come into force whenever it is notified by the government in the official gazette. So we are going to wait and see that when is the central government going to notify in the official gazette. Central government is not even notifying. We are waiting. Central government is not even notifying. In that case, law is already framed and ready. We just have to wait for it to be notified by the government. In this period, can the court tell the government? Can the court order the government to notify on a particular date? No. But can the court direct the government to at least consider, to at least think about it and tell us that when will the law come into force? Yes. Okay. Then after this, we had discussed that can the law apply retrospectively? No, it will always apply prospectively only. It will apply retrospectively only if it is mentioned in the act very clearly. And then we learned if the law commences on 1st Jan, when will it commence? 12 o'clock, 9 o'clock, 10 o'clock, when will it commence? As soon as the clock strikes 12, as soon as it is 1st Jan, the law will commence. Then we had a very important discussion regarding repeal. Repeal is nothing but we are replacing a law with another law. Companies Act 1956 had repealed the 1913 Act. The 2013 Companies Act repealed the 1956 Act. Now, whenever a repeal happens, there are 5 things which will not get affected. Whenever a repeal happens, we cannot revive anything which is already dead. Like Companies Act 2013 repealed the 1956 Act. So does it mean that the 1913 Act which was repealed by the 1956 Act, will this come back to life? Can we say that Companies Act 1913 was cancelled because of 1956 Act? When 1956 Act itself is not existing anymore, so the repeal will also get cancelled, and will the 1913 Act come back to life? No. What is dead will remain dead. Just because 1956 Act has been repealed doesn't mean that the 1913 Act will come back to life. No, repeal will not revive anything. Repeal will not affect anything which is already already performed under the old act. Under the old act, companies are already incorporated. All that will not get affected. The repeal will not affect any claim, privilege, responsibility or debt under the old act. It will not affect any punishment which has already been given under the old act. Under the 1956 act, the court has punished you. That punishment will still continue as it is. It will not affect any inquiry, litigation or remedy, RIL. It will not affect any remedy, inquiry or litigation initiated before such repealing, which means before the 1956 act could be repealed, before that itself I filed a case against you under the 1956 act. For the purpose of that case, the 1956 act will still continue. So even though 1956 act is repealed, we cannot revive anything which is already dead. We will not affect anything which is already performed under this old act. We will not affect any claim, privilege, responsibility or debt which you have already incurred under the old act. We will not affect any punishment which has already been ordered under the old act. We will also not affect any remedy, inquiry or litigation which has already been initiated under the old act. So under the old act itself, if any case is going on, that case will still continue to go on under the old act only. Then we learnt when an act is repealed, we will treat as if the act never even existed. The act will be removed from all the books, but only for these 5 purposes only that act will still continue. But for all other purposes, the act, it's as if the act doesn't even exist anymore. Then we learnt about section 6A, repeal of amending act. This was very interesting. Here I'll straight away come to this part case. This is how I had explained it to you. I have the Indian Penal Code. An act is passed by the parliament to amend the Indian Penal Code. Now the Indian Penal Code is amended. Now the government makes another act to repeal this amending act, which means this amending act is not existing anymore. So what will happen to this amendment? Will this amendment also get cancelled? No. We said that the amendment will still continue. By default, the amendment will still continue. Understanding? We have the Indian Penal Code. An act was passed by the government to amend the Indian Penal Code. Now Indian Penal Code is amended. Now this act alone is getting repealed by the act. Now is getting repealed by another act. Now what will happen to the amendment in Indian Penal Code? That amendment will still continue. However, if this new act, if this repealing act clearly mentions that the whole objective is to undo the amendment, to cancel the amendment, then the amendment will also get cancelled. Otherwise, by default, even if the amending act is repealed, the amendment will still continue. Then we had learnt about revival of the repealed enactment. Now Companies Act 1956 has been repealed. Can this be brought back to life? Can this be revived? Yes, but to do that, the government has to give proper purpose and intention and why do they want to do it. Then we learnt about reenacting of laws repealed, section 8. Section 8 says that even though Companies Act 1956 is repealed, still in so many laws, we still refer to the 1956 Act. Like for example, even though the Companies Act 1956 is repealed, still in Income Tax Act 1961, for a very long time it was mentioned in section 115JB that book profit is profit as per Companies Act 1956. So does it mean that even though the 1956 Act is repealed, does it mean that for this purpose this Act is still alive? No. Section 8 says that if other laws are still referring to the old law, we will read it as if they are talking about the new law. So even though the Income Tax Act still says Companies Act 1956, we will read it as if it is saying Companies Act 2013. Then we discussed about section 9. This was simple. When the law uses a word from, we will exclude the first day. We will start counting only next day onwards. But when we say the word to, we will include the last day. So from will exclude the first day, but to will include the last day. Then how do you compute time? Section 10, this says that whenever you have to do some filing, let's say you have to file your resolution with ROC, or let's say you have to make an appeal before the court, and for filing resolutions, for making appeals, you have a time period. Okay, now on that last day of the time period, if the court is closed or if the office is closed because of whatever reason, then in that case you can make the submission or you can do the filing later whenever the court reopens or later whenever the office reopens. In simple words, whenever you have to do any filing or if you have to do any submission on the last day of that particular period, if the court or if the office is closed, then whenever the court or the office reopens again, on that day if you go into the submission, it will be as if you have done the submission on time. Then how do you measure distance? Not by roadways, not by waterways. You measure the distance in the form of aerial distance. Remember, straight line on a horizontal plane. Then after this we had learnt about duty to be taken pro rata. Whenever we calculate taxes, taxes have to be calculated proportionate. Like if tax depends upon quantity, weight, measure and value and all, as the quantity increases, the tax also will proportionately increase. So duty has to be taken pro rata, which means proportionate calculation has to be done. Then we learned about gender and number. Wherever we use a masculine gender, it will also include the feminine gender and vice versa. But however, we have to be careful. If we are talking about succession laws and inheritance laws, here male child will refer to male child only. In succession laws and in inheritance laws, we cannot say male will include female and female will include male. We can't say that in succession laws and inheritance laws. Then we learned that if a word which is referring to a common gender is available, but still the lawmaker is still using the word which is referring to a specific gender. Like for example, the word parent. The word parent refers to a common gender. The word parent is available. Okay, the word referring to a common gender is available, but still the lawmaker has specifically used the word mother. Now here you cannot say that mother will include father, because if the lawmaker wanted to write about both mother and father, he would have used the word parent. But instead of writing the word parent, he has used the word mother. So mother will include mother only now. So this was about this third point. Similarly, the word cattle denotes common gender. This word denoting common gender is available. So if the lawmaker wanted the law to apply to both cow and to bull, he would have used the word cattle. But he has used the word cow, which means he's very clearly indicating his intention that he wants a provision to apply only to cow and not to bull. Then we learned about number, that singular will include plural and plural will include singular. However, if the law says one house, then one house only. Here you can't apply singular plural rule, but if the law says a house, then a house will include multiple houses also. So singular will include plural and plural will include singular. Then we learned that whenever the law is giving you a power, you can exercise the power from time to time as the occasion requires. You can exercise the power. Just because the law is giving you the power, it is not necessary that now itself you have to exercise the entire power. Not necessary. You can exercise the power from time to time as and when the occasion requires. Then we learned whenever the law gives you a power to appoint, either you can appoint by name or you can appoint by office, that is ex officio. Like if the central government has a power to appoint the chairperson of NAFRA, either the central government can appoint by name Mr. Naveen, or the central government can appoint by office. That is, central government can say that whoever is occupying the office of Secretary of Ministry of Finance, that person will automatically become the chairperson of NAFRA. So here, instead of appointing by name, we are appointing by virtue of office. This is called as ex officio appointment. Then we learned about section 16, which is a very important section, which says that if you have the power to appoint, you will also automatically have the power to remove. You will also automatically have the power to dismiss. Like for example, if the CEO of a company has a power to appoint an employee, the CEO will also automatically have the power to remove or dismiss or suspend the employee. Then we learned about substitution of functionaries, section 17. Here we learned that if the provision has to be applied to a particular person, we can just mention his official title. That is, we can just mention the name of his office. Like for example, if we want to give the Commissioner of Income Tax the power to inspect returns, we don't have to mention his name in the act. We can just mention in the act that the Commissioner of Income Tax has the power to inspect the returns. So we can just mention his title. We can just mention the name of his office. That will be sufficient. Then after this, we learned about section 18. We learned that, like for example, I'll straight away give you the example itself once again. Right now, telecom is being regulated by TRAI, Telecom Regulatory Authority of India. There are some provisions which are applicable to TRAI. Now, let us say in the future, TRAI is dissolved and in its place the government brings another authority that will become the successor of TRAI. Now, whatever provisions were earlier applicable to TRAI, those provisions will automatically apply to the successor. Then in the law, it is not necessary to explicitly mention that the provisions will also apply to successor. Like that, it is not necessary to expressly mention. It is implied that if provisions are applicable to an authority, the provisions will also apply to the successor of the authority. It is implied. Then we learnt about official chiefs and subordinates, section 19. Relating to this, we had a nice question also, which we discussed if you remember. So here we had learnt that if there is a superior and if there are provisions which are applicable to the superior, now if for some reason the superior's powers are delegated to his subordinate, then all those provisions will apply to the subordinate also. I had given you the example where there is a director, let's say director of the Telecom Commission. The director has some duties, he has some responsibilities, he has some powers. Now the director is on leave, let's say he's on sick leave. Now in that case, all his responsibilities will temporarily come to the deputy director. So whatever were his powers, whatever were his rules, whatever were his responsibilities, whatever provisions were applicable to him, those provisions will now automatically apply to the deputy director. So whatever provisions were applicable to the superior, all those provisions will also apply to the deputies and to the subordinates who are doing the duties of the superior in his absence. Then we learned about construction of orders, etc. issued under enactments. Here we learned that this word construction means interpretation. That is, if let us say there is an act, let us say there is Income Income Tax Act 1961. Now under Income Tax Act 1961, one notification, I've already put the example over here. We have Income Tax Act 1961, which is giving us a proper definition of dividend. Now under Income Tax Act 1961, one notification, for example, is issued relating to dividend. Now in the notification, again, do they have to define dividend? No. Whatever definitions are given in the act, they will also apply to the notifications, orders. Whatever definitions are given in the act, those definitions you can also use to interpret the rules, to interpret the notifications, to interpret the circulars. The same definitions you can use even to interpret all of these. Then we learned the power to issue will also include the power to amend and vary. If the CBDT has a power to issue rules relating to income tax, then by default CBDT also automatically has a power to amend the rules also, to rescind, that is to cancel the rules also. Then we learned about making of rules or bylaws and issuing orders between passing and commencement of the enactment. We know very well that there will be a time gap between when was the law passed and when did the law commence. Law commenced means when did it come into force, there will be a time gap. In this time gap, can rules be made? Yes. But in this time gap, will the rules come into force? No. The rules will always come into force only after the law comes into force. Then we had a very important discussion relating to previous publication, guys. So here in section 23, we had learned, guys, that this process will apply whenever the rules have to be made by previous publication process. Previous publication process means we have to follow 4 simple steps. In the first step, the authority, whoever is making the rules, they will first make a draft. And they will publish this draft in the official gazette. Now, when they are publishing the draft in the official gazette for the information of the public, along with the draft, they will also put a notice in the official gazette which will specify a date. A date saying that when is the authority going to take up this draft once again. So before this date, before the authority can take up the draft once again for consideration, before the date itself, we, the general public, we have to send our suggestions, we have to send our opinions, we have to send our objections to the authority before that date. The authority will consider these suggestions. It is not, the authority is not bound by our suggestions. They will only consider our suggestions, and on this basis they will make the final rules. Here we had learned that once the final rules are published, it will be a conclusive proof that this entire process has been properly followed. Then we learned between the draft and the final rules, what if there are changes? We will see if the changes are ancillary and if the changes are not foreign. 2 keywords, guys. If the changes are ancillary, which means they are not material changes, and if the changes are not foreign, then no need to republish the draft once again. You can straight away publish the final rules. But if between the draft and the final rules, if there are significant changes, then we have to republish the draft and do the whole process once again. Then after this, we had learnt about continuation of orders, etc. issued under enactments, repealed and reenacted. We said that if the law is already repealed and in its place if a new act has come in, then what will happen to all the rules and what will happen to all the orders and notifications which were issued under the old act? I had given you the example over here. It's a fictitious example. Let's say we had the Motor Vehicles Act earlier, and under the Motor Vehicles Act, a pollution certificate was required, and for this rules were given. Motor Vehicles Act, under this act rules were given which tell us the procedure that how to get the pollution certificate for the vehicles. Now later, let us say this Motor Vehicles Act was repealed and in its place a new Motor Vehicles Act was brought in. Now even this new Motor Vehicles Act says that a pollution certificate has to be issued. Now for this pollution certificate, what is the process? No process is given over here, guys. So in that case, whatever rules were issued for the old act, the same rules will continue. This means that the act will get repealed, but even though the act gets repealed, under the act whatever rules were issued, under the act whatever notifications were issued, under the act whatever orders were issued, they will still continue. They will not get discontinued, they will still continue. To the new act, those rules made under the old act, those rules will still apply, provided the law doesn't mention otherwise. If the law specifically says, if the new law specifically cancels the old rules, or if the new law specifically says that the old rules will not apply, then it will not apply. But by default, even though the Motor Vehicles Act is repealed, under this act whatever rules were issued, they will still continue to exist, they will still continue. Okay. Then we had learnt of the same offence, if the auditor did a fraud, if the same offence is punished under 2 laws, then can the trial happen under 2 laws? That is, can under both the laws evidences be submitted? Yes. The trial can happen under both the laws. The conviction can happen under both the laws. The court can do the discussion under both the laws. Now, if the court concludes that under Companies Act you are not guilty, does it mean that under Chartered Accountants Act also you are not guilty? No, you can be guilty under one law and you may not be guilty under another law. That is possible. But in case you are guilty under both the laws, can the court punish you for the same offence under 2 laws? No, the court can punish you only under any one law, which law the court will decide. And finally, we had learnt about service by post. Here we had learnt that whenever something has to be sent by post, it is enough if it is properly addressed, if it is prepaid, and if it is sent by registered post. Once I do all the three, it will be considered as if I have properly served the post. Once all the three are done, it's as if the post is properly served, and it is as if it is served within the ordinary course of post. Now, even though I have properly addressed the post, even though I have prepaid the postal charges, even though I sent it by registered post, when the letter reached you, you refused to accept the letter. So the letter came back with an endorsement of refusal. Still, it will be presumed as if the notice has been properly served, because all these three things were done. And finally, guys, we learned about citation of enactments. Here we said that whenever we want to refer to a particular law, we can either refer to it by its name. Like if I want to talk about Companies Act 2013, either I can use its name, Companies Act 2013, or I can write Act number 18 of 2013. I can refer to the law by either its name or by the act number and year. Similarly, if I want to talk about a particular section, I don't have to write the whole section all over again. I can simply refer to that section, I can simply refer to that provision by section and subsection number. So if I want to write about section 198 of Companies Act 2013, I don't have to write the whole section all over again. I can simply refer to the provision by writing the section number. Even that will be enough. Okay. So that is it, guys. With this, we've done a very extensive revision of the General Clauses Act. You've been asking me for this revision for so many days now, and I'm glad I was finally able to do it, and I'm very happy that how it has come out. I'm very sure it's going to be very effective for you. Thank you, guys. Bye-bye.